Session. It's going to be reasonably calm, I suspect, in Europe. We're waiting for the Powell speech a little bit later on. We are now into the open. The opening trade is upon us, and as you can see, it is a quiet one. It was a quiet one yesterday. We're in mid-August here, folks. It's probably, as you are well aware, that does tend to lead to quiet markets, but I wonder whether we're going to get some volatility later. Volatility's been really suppressed of late, though it has come up this week. Look at the VIX. We've gone from 14 to 16 this week, so just incrementally beginning to tick higher. Not by much, not a big spike, not a scary spike, but just pay attention to that. Stock 600 barely budging, FTSE 100 actually down by 0.2%, which is interesting considering the expectation for a more muted open, but we're dealing with sort of splitting hairs here. The CAC's down by 0.2%, the IBEX is down by 0.2%. We'll see what the DAX does this morning. There's a few defence stocks that might be kind of in focus there, so keep an eye on them. We'll wait and we'll watch and we'll see what the DAX does in just a moment. Anna, sectors, single stocks, what do we got?
Yeah, let's go into the sectors because we set this up with a reference to NVIDIA and that story and whether we'd see weakness in the technology sector. As ever, it's tricky to always find that directly in Europe, but we do see it. So technology is the worst performing sector today. So that NVIDIA story, Nasdaq futures down 0.3%, does seem to be having a negative impact on stocks. And so, as I say, that sector is weaker. SAP down, but we're not talking about by much, you know, down by 0.4%. ASML down by 0.7%. So there is weakness in technology, but not to a huge degree. To the upside, we see energy stocks up by 0.4%. We see a slight bounce in the oil price. 67.86 is the Brent price right now, and some of the oil names are a little stronger, but again, very little moving more than 1%. So we're not talking about big moves here. On balance, Guy, things look negative. We've got 3/4 of sectors, would we say, in negative territory, around a quarter, or maybe a third in positive. But so the balance of things is negative as we wait for Jackson Hole.
ASML is down. So that is certainly a factor that we are seeing in the market this morning. So Polish banks seem to be down. I want to get back to that and figure out what is happening there. I just want to check there's no ex-dividends that I'm missing, or maybe there's another story that I'm missing.
Yes, Chloe was talking to us about some of that, wasn't she, about the latest on the Polish banking sector.
But we've got Shell up. Standard Chartered is, as you say, up on some legal news. Total is trading higher. BP is up. So there is definitely an energy trend to the upside. But yeah, it feels as if we are seeing a fairly quiet market this morning. You've got 225 up, 335 down.
Yes, this is summer, folks, and we are here for another week, perhaps. Salman Ahmed joins us, Global Head of Macro and Strategic Asset Allocation at Fidelity International. And I want to start with that, actually. It is summer. It is August. I remember last August, things got really choppy. That was to do with Japanese data and expectations around rates, but that went global because not everyone's at their desks, a lot of computers in charge, and volatility can happen in those kind of markets. And I wonder if there's a risk of that right now. We've got Jackson Hole today. We've got NVIDIA earnings next week. Both of those could be big volatility events, couldn't they?
Yes, and they have certainly the potential to be, in the sense, as you're right. I mean, last year on August, we did get some wobble, which was corrected fairly quickly. But of course, I think in terms of what happens over the next few months, I think the Jackson Hole speech today, especially the September FMC meeting coming through in mid-September, I think it's a quite important event. And volumes are down, and as you said, market liquidity can be thin, so you can get oversized reactions. But those two events are the known unknowns at the moment.
Yeah, and how are you thinking about Jackson Hole then, Salman? I mean, weigh in. We've had every view imaginable. Some people suggesting, you know, the markets, are right to think that we'll get some clues around a rate cut. Others saying, no, we'll get something more hawkish, and some saying he'll try to not poke the bear, in the views of one guest, and not try and trigger any political backlash and try to keep a low profile.
So I think we have been in the camp of that Fed will only cut once in December. And this has been our view for many, many months now. And we are still think that this is a live meeting, so it's a 50-50 meeting. And there are, I think, if you take a step back, there are three dimensions I think we have to be thinking about, not only for September, but onwards as well. Firstly, with this hyper data-dependent Fed, we'll take a step back and start thinking about forward-looking indicators when it comes to tariff impact on inflation, for example. Second step is this inflation shock one-off, or it's going to be, more persistent? And I think that depends on, as Chair Powell has already said, on how the Fed may respond to it. So those are the two traditional factors, and then there is the unspoken politics, elephant in the room. And I think that's also important because the institutional signaling has to be passed, and I think that's not an event, that is a trend, and I think the first signs of that are potentially going to come through hopefully today.
Do you hedge the downside in stocks given all of that?
So technically, there has been some a little bit down. We've seen some profit taking, I would say, in U.S. equities. They've done really, really well over the last few months. I think the epicenter of this is the bond market and dollar.
Fine.
I think that's where you have to.
But if the bond market freaks out, particularly the long end, how vulnerable are tech stocks and by extension US equity markets? And do I want to be buying volatility? The VIX is only at 16 at this point. Insurance is cheap still on the downside. Is that something? Do I want to be thinking about protecting my downside after such a strong run as you say?
So I think we have been focused more on the credit market. We think because from a cross-asset perspective, that is the market which is the most expensive. If you look at, for example, if you believe in the growth slowdown story, then credit market spreads are too tight. If you believe in a stagflationary kind of a tension, again, credit market is exposed. And then if you think, okay, the monetary policy setup is changing, fiscal, macro volatility, so you're not getting paid in that segment of the market, and that's where we are focused on rather than the equity. I think equity is probably going to get affected if things get really bad.
How mispriced is credit then?
Sorry?
How mispriced is credit then?
I think it's probably the most mispriced one. Spreads are at all-time tight levels then. So
but they keep getting tighter.
Exactly, keep grinding tighter. So if you have a choice from an asset allocation perspective, I think we are leaning more towards that, okay, you may still get upside and you have a pro-risk view, play it through equities, don't play it through credit. You're not getting paid.
And is the tariff story going to hurt some of provide more weakness for some of the credit names? Is that going to be the straw that breaks that camel's back or moves us away from those record tights then, Salman? Because you point out that the effective tariff rate is now closer to 19% than the 15% that people were sort of talking about when we had more positive expectations, I suppose.
Definitely, and it's creeping higher. So, of course, we're not expecting, this will double now, because obviously tariff rates are less than 3% going into this change in economic policies. It has increased multiple times over. But the intake of revenues right now is running at around 10%. So that is what the system is taking in. But that would gradually go up as the scope of these tariffs continues to widen. So the main, I think, complication in terms of the macro signal which is coming in right now, and I think it has linkages with the monetary policy developments as well, and depending on which side of the narrative Chair Powell comes through today, is that inventories have gone up as well. So that they are mixing the picture in the sense like how much front running happened and how much confusion they are creating into the real impact of that. So we are in that camp, and we remain in the camp that stagflationary tension in the U.S. will continue, and that's related to the credit view, but also the fact that we think this is a Fed which will be on hold because that inflation is in the pipeline.
Yeah. Have companies dealt with the imposition of tariffs better than you would have anticipated, Salman, then? Because I suppose that's the inventory story, isn't it? Is the ability of businesses to front-run the tariffs by bringing in a lot of inventory, to find additional suppliers, and that maybe limits the extent to which we see this in inflation, or at least delays it.
I think we are in the second camp, which is delay camp. So because you can't, there is front running, we saw in the data, but it comes with a lag. So the economic side of supply factors is very patchy. We are a demand-driven system. So we have very good data on demand, very bad data on supply, and inventory is a very good example of that. It comes with a lag. You can't tell how much has been used, how much has been run down till it's too late. From that like inflationary impact perspective. So we think that the pass-through will start to move towards 50%, but that may take a few months. Remember, there's only 2 months till the 10% collection rate was breached. So it hasn't been this is not a financial crisis, right? This is an economic policy shift, so it will take time. So we are in that delayed response camp rather than that this is not going to happen.
What's your view on the dollar right now?
So we have and remain in the camp that dollar is in a multi-year downward trend.
Okay.
Tactically speaking, even if the Fed is on hold for interest rate differentials to favor the dollar, other things have to start changing, right? There is you have the medium-term fiscal picture.
Okay.
You have the economic.
How does that impact my investment strategy? If I'm looking, does it undermine the case of the United States? And to what extent? If I'm getting 10% returns out of the United States, but I'm getting a lot of that eaten up by dollar depreciation as a non-US investor, do I need to look elsewhere, or is the US still the best place to be?
So I think we are pushing for diversification, and a lot of our clients and investors are looking to build in diversification from a strategic asset allocation perspective. Remember that strategic asset allocation shifts are big shifts, but they take time to come through. And we have seen a lot of strategic asset allocation reviews being done this year. Usually they're done once every 3 years. This year there's a higher frequency of strategic asset allocation reviews, especially from Asia, which are coming out, which tells us that, and there's a lot of discussion on FX hedging, there's a lot of discussion on, what should be your optimal hedging ratio, benchmark design. So I think this work will start to translate into big shifts, but they will happen over a longer period of time rather than, it's not like a one-day story in that sense.
Okay. Salman, nice to see you. Thanks for stopping by to see us. Salman Ahmed, Global Head of Macro and Strategic Asset Allocation, joining us from Fidelity. Core 6 looks like this. This is what we're watching across Europe. Tech stocks firmly in focus. As you can see, defense stocks coming back, continuing to come back. ASML is a little bit softer this morning, as is Schneider. A little bit of weakness in luxury, but not very much. Elsewhere, the action appears to be in that NVIDIA trade. So let's get some more details on that with Chloe.
Good morning. So, let's start with a little bit of weakness. Oh, actually, it just turned back to the green here for Siltronic, but there was a little bit of weakness at the open for those two, which are suppliers to NVIDIA. And NVIDIA told some of its suppliers to halt production related to H20 chips after a China directive to stop using those particular chips. And we have a little bit of weakness for BE Semi, but Siltronic is actually going up a little bit. Those are not major moves in any case. Moving on to Polish banks. Polish banks are down by quite a bit, and that is off the back of news about new taxes. So their taxes are going to go up from 19% to 30% from next year as the Polish government tries to plug a massive fiscal deficit. So they're taking quite a beating across the board. We're down 7% kind of across those three major Polish banks. Moving on to the defense sector, where we've got a bit more of a positive story from Rank and Hensoldt. Both of those companies got upgraded to a neutral rating by Citi analysts. Citi analysts said that those two will really benefit from a rise in defense spending in Germany in particular. So we are up, particularly for Hensoldt, up 3.7%. And finally, let's end with AkzoNobel, which is a paint maker, a Dutch paint maker. And Cevian Capital took a stake in the company and said that there was significant value potential for that company. And so we are up on the back of that 4.3% this morning.
Chloe, thank you very much. Chloe Melly from our equities team with the latest on those stocks. Yeah, really interesting, that story around AkzoNobel and chemicals, the best performing sector at some part this morning in the early hours of this morning, Guy, as we watch Cevian take a stake there. And, do you interpret that as a vote of confidence in the management team's strategy, or are they after some change?
I interpret that as paint's going to get more expensive. It's already quite expensive. Looks like it's going to get even more expensive. When stocks have actually moved this morning, which I think is interesting as well, Vestas is coming back a little bit. It's certainly off its low. So it gapped lower first thing this morning and has come back a bit. Still down by 1.1% on the back of Trump's ire directed towards windmills, which is now starting to show up in terms of trade policy.
Yeah, it does seem to be, though, every couple of weeks we get new stories that reset our expectations about how much he doesn't like them versus our earlier expectations. And so there's a lot of volatility in this sector, isn't there? We've been talking about NVIDIA all morning. We will continue to do so. NVIDIA reportedly halting production of its H20 chips, asking its suppliers to do so. We'll get the details next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Tehran, and this is Bloomberg.
Friday the 22nd, 8:17, 17 minutes into the equity market session, and you are looking at a very becalmed market. We are going nowhere in a hurry. We are waiting for Jay Powell a little bit later on. He is the main event of the day. You could see some volatility around tech stocks, though, in the United States a little bit later on. We're seeing a little bit of that this morning, and this is very much focused on what we are seeing in terms of the NVIDIA story that we've been bringing to you. Apparently, the company has reportedly instructed suppliers, including Samsung and Amkor, to halt production of its H20 AI chip. This is the chip that's designed for China. Tech publication, The Information, says this comes after Beijing advised companies to steer clear of the chip on security concerns. Robert Lee, senior analyst at Bloomberg Intelligence, joins us now. Robert, good morning. Is this about security concerns? Is this about something else? What are we learning?
Okay, well, thanks for having me on. So according to the story that broke about a week ago, the one you mentioned in your prelude, that Chinese government, unconfirmed I should say, was encouraging local AI companies to procure their suppliers their supplies from companies like Huawei on national security concerns. As to, you know, how grounded those claims were or not, we'll have to wait and see. But I think let's just take a step back from the news and the headlines at the moment. It's very clear that one of China's strategic objectives is to secure self-sufficiency on the technology front for all sorts of reasons. I suppose, you know, to state the obvious, China and the US are major geopolitical rivals. I think from a Chinese perspective, the US has also proved itself to be an unreliable partner. So I think those are two of the reasons why China will continue and double down efforts to become self-sufficient in tech. And just an additional reason, obviously, as the government looks to rebalance the economy away from previous years where the economy was very much driven by fixed asset investment, high tech is seen as a major driver of future economic growth, so-called new productive forces. So again, that's another reason that underpins China's strategic move to becoming self-sufficient in tech. And these sort of headlines really, I think, will again cause the Chinese authorities to, if anything, increase or double down their efforts to achieve that.
Yeah, so we'll see what it is exactly that NVIDIA has been saying to its suppliers about production of H20 then, with all of that in mind and that Chinese logic. In terms of what Jensen Huang's been saying, he keeps pushing back against any Chinese perception that there are backdoors in the chips or location functionality in the chips that they're supplying, the H20 chips. What do you make of his comments then, Robert?
Oh, far be it from me to contradict Jensen Huang, but I think it's always incredibly difficult from an engineering perspective to prove these claims either way. Because don't forget that these chips are fabricated at literally the atomic scale. So whilst we can use very powerful electron microscopes to, you know, to look at their physical, you know, how they're physically put together, it's very hard to make a hard and fast conclusion based on the physical structure as to whether there are any so-called backdoors. But similarly, software or the middleware, another software, operating software that is operating on these chips, it's very hard to get access to the source code to prove or disprove such claims. But I think, again, what is underlying this is the, you know, heightened geopolitical rivalry between China and the US. China will almost certainly double down efforts to achieve self-sufficiency. It obviously wants to fully support its emerging national champion, Huawei, which on a global scale is the main local rival to NVIDIA. So obviously that helps support Huawei's business domestically and helps reduce that reliance on US components. So very briefly, that begs the question, looking forward, even if we look forward 6 months, 12 months or beyond, you know, how will this story evolve? China is obviously still reliant on American components, whether it's Intel chips, whether it is Qualcomm chips, whether it is American software. If this story continues to evolve in the coming years, we could see, you know, further moves by the Chinese authority to push and champion local suppliers at the potential cost to American companies.
Do the Chinese suppliers have the software stack and the infrastructure that goes around the chips in order to be able to compete? Is that where the real gap actually ultimately lies, and that's where the NVIDIA advantage sits?
Okay, I think in terms of third-party benchmarking services that have tried to compare the performance of NVIDIA's chips, I think it's still, nobody would disagree, even in this part of the world, that the American technology is superior. But again, with the full weight of the state behind them, and you know, with obviously a very strong engineering base who is rapidly going up the skills curve, you know, China is progressively narrowing the gap. More so on the software side of AI, but progressively on semiconductors as well. The big issue or stumbling block that they face is really access to high-end lithography equipment, which, as you appreciate, is dominated by the likes of ASML. ASML is the only company globally with EUV equipment that can produce very advanced leading-edge chips. So obviously there is a strategic imperative for the Chinese government and Chinese authority to try and drive a technological breakthrough. As to whether that will be achieved or over what timescale remains to be seen. It could take years, but again, it is of national strategic importance, and I think with a very strong engineering base, ultimately the Chinese will do it. It's just a question of exactly when that happens.
Okay. Robert, thank you very much. Robert Lee, Senior Analyst at Bloomberg Intelligence. Thank you for the update on NVIDIA and tech. Now, after decades of cautious saving, Germans are finally embracing the stock market, we understand. A booming market has spurred a significant shift. 3 million Germans have started to invest in stocks since 2022, the largest increase in stock ownership in Europe outside of Britain. For more, let's talk to Bloomberg's Sagarika Jaisingani, who's Deputy Team Leader for EMEA Equities and Investment Strategy. Sagarika, great to have you with us. So Germany hasn't typically been known for a big retail investment community. So what have we learned here?
Sure thing, Anna. You're absolutely right. When you talk about the countries in Europe, across the world, that are most famous for retail participation, Germany doesn't really feature highly on that list. Having said that, though, I mean, there's reasons for that, right? You said that the psychological scars that were the result of the hyperinflation era, and more recently, relatively speaking, the tech bubble as well, because the data that we have shows that the number of retail investors in Germany just before the tech bubble was actually on the rise. It was quite significant.
Are you talking about 2000?
Yes.
Right, okay, we're going back away.
Yes, not 2022, not that was a bubble. But after that, the proportion of investors really fell off. So they got quite burned in that one. And it's taken a long time for that mindset to now shift out of that. What is finally driving them back into the market now? That's the answer to that is twofold. One is the German stock market has been very hot. Not just this year. This year, of course, it is outperforming the S&P 500, tracking 20% plus gains. But it has had a similar scale of performance over the last 2 years as well. So it's becoming more of a buzzword among younger investors who are more open to this. There's a very significant worry also, which is the second part of this, which is what is the pension outlook looking like? The current system in Germany is a pay-as-you-go system for pensions, which is that the current workforce is funding essentially pensions for current retirees. So as the population ages, what happens to that? So there's the people that we spoke to for this, there's significant questions on, is that even sustainable? So there's two factors at play here.
Just quickly, how fast is this evolving? That all sounds very sensible. In the United States, we're kind of getting the gamification effectively of the markets. Is there any evidence of that happening in Germany? Is this becoming entertainment in the way that maybe we're seeing over in the United States, or is this kind of quite Germanic and quite sensible, and this is the right thing to do?
Oh, there's definitely both of that, because if you look at the avenues that are being used to advertise to mom and pop investors, it's across the board. There has been social media is the go-to in today's world. So there's been a crop of financial influencers, finfluencers as they call themselves. Again, they're common in the US. This is not a conversation we were having in Germany, a couple of years ago. They are everywhere now. There is, we spoke to, one of the people we spoke to, he's an 82-year-old finfluencer, self-styled. He is a former broker and a trader, so he's definitely a finance professional. He said, I've spent 50 years trying to get Germans to invest in stocks, and what I heard was, it's like a casino, it's only for the rich. Some said it was like a highway robbery. That is now changing because of all of this education and information that's out there.
I could be doing this for a while, yes. Keep going. Sagarika, thank you very much indeed. Sagarika Jaisingani joining us on the markets. Up next, we're going to talk trade. That's next. This is Bloomberg.
opinion at least, the reason that the U.S. is so creative and innovative and has so much interesting development and has, most of the largest trillion-dollar businesses is because we have the best capital markets. And capital market development is really what creates the funding in order to pursue ideas. So in America, any idea you have, there's a market for it. Right, so building markets like the securitization markets in the U.S., really allowed for non-financial companies to get into the financial industry business. And that was really a derivative of making the securitization market so competitive. So building securitization markets and continuing to grow markets and figuring out how to continuously fund ideas, I think that's going to be the next stage of growth for these markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
This is the opening trade. 30 minutes into today's session. Let's take stock of where we are then on Friday's session. We see some weakness, a little bit of weakness across European equity markets, but not much. We're waiting for the Jackson Hole address later from Chair Powell, so that's going to be the big thing in markets to watch out for. In the meantime, though, we do see a bit of weakness and technology to the fore. NASDAQ futures are weaker. That all has to do with what NVIDIA has been saying to its suppliers about the H20 chip into China. Interesting reporting from elsewhere on that, and that's taken the edge off NASDAQ futures, also taking the edge off European tech stocks. We watch that. On the other side, though, some chemicals positivity coming through in the shape of AkzoNobel, which has attracted some interest from Sevian Capital. So we keep that in focus. So we're kind of flat, not doing much, Guy, as we wait for Jackson Hole.
If you want a snapshot of an August market, I'm going to give you one. Here you go. Stock 600, higher, 275, lower, 297. I guess we're going to call that fairly finely balanced. Take a look at the volume. We're down by nearly half. We are seeing a light volume day. I do wonder, remember, Powell speaks at 3 p.m. London time. The markets in Europe have still got an hour and a bit in which to trade. I do wonder where the volatility potentially has picks up later on in the day. We get a quiet kind of morning, early afternoon, and then things start to move. There's an interesting 52-week high out there. That's 52-week low, sorry, actually. Taylor Wimpey. This is the 1 year on Taylor Wimpey. This is the UK house builder. Look at it, tracking lower and lower and lower. There's a bunch of factors here that are coming in. One of which is what is happening with the regulatory backdrop in terms of what is happening with housing in the UK. That's one factor. Just trying to get houses built is hard, and we don't see much easing of that, despite what the Labour government is saying. You've also got the rate environment, which is worth paying attention to as well. House building is slowing down, it seems, not speeding up, much to the annoyance of the government, and we're going to get Bailey speaking. The data in the UK at the moment speaks to maybe steady rates, not lower rates, not significantly lower rates, and that's being priced into these kinds of stocks. And as you can see, Taylor Wimpey down by nearly 40% this year. That stock certainly being punished, and today, another 52-week low, Anna.
Guy, let's get an update on some of the other stories that we need to know about this morning. The Justice Department in the United States has signaled possible plans to investigate Federal Reserve Governor Lisa Cook, with a top official informing Fed Chair Powell of the probe and encouraging him to remove Cook from the board. Cook on Wednesday said she intended to remain at the central bank after Trump called for her resignation. NVIDIA has reportedly instructed suppliers, including Samsung and Amkor, to halt production of its H20 AI chip. Tech publication The Information says this comes after Beijing advised companies to steer clear over security concerns for the chip, especially built for the Chinese market. NVIDIA, for its part, has repeatedly denied it adds backdoors into its chips. Now, the US and the EU have outlined trade plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminium. European Commission President Ursula von der Leyen says the deal provides predictability and stability for companies and consumers and strengthens transatlantic relations, though, Guy, crucially, there are still hurdles to overcome to achieve those lower tariff rates.
Many hurdles still to be ironed out. Can you iron out a hurdle? Wrinkles, maybe, I should be putting into that sentence. Maria Demirtis, Economy Strategy and Finance Centre Europe leader at the Conference Board, joining us on this subject. Maria, good morning. We thought we had a trade deal. We thought we'd be kind of dealing with the reality of that now, but we feel that we are still a long way away from it. What is going on? Why is it taking so long to get this trade deal between Europe and the United States to actually work and deliver?
Well, trade deals are notoriously difficult to agree in the best of circumstances. They are anything between 18 months and 5 years, and that is under normal circumstances. I don't think we have normal circumstances now, given that what's at stake is so high, and given that actually it's not just about a trade deal, it's all about geopolitics, much more than just about trade. So that's not surprising. Where we are now, we've got a little bit more clarity on the possibility of a deal. Again, we don't have a deal, we have a framework, meaning an agreement of how we are going to approach this. Some good news that came out of yesterday's announcements, the 15%, of course, which is better than 30%, and crucially, it will include some pharmaceuticals, semiconductors, and also some pharmaceuticals will be under the most favored nation clause, which is under WTO, which means effectively lower tariffs. So these are good news. Perhaps the most important, in my view, of these good news is that we have dodged the bullet of an outright trade war. I think this is crucial. There are big voices here in Brussels and in capitals that would have wanted a slightly different reaction from the EU, meaning an escalation. But we've managed to avoid this, and I think that's a success.
Have we managed to avoid this for now? How big is the risk of escalation still?
Yeah, I'm afraid you're right, in the sense that it really is just for now. And I think the most obvious example of this is in cars. Very little has been agreed on cars in terms of reducing the tariff rates. For the moment, cars are under the close to 30% tariff. They have not been included to this new 15% tariff rate. Not only that, but also what we understand from what was announced yesterday, the Europeans will need to go first in terms of removing tariffs on some industrial goods and allowing easier access to agricultural products. For these things to happen in the way that the EU is governed, it will require capitals to agree on this, and possibly the European Parliament, which means that it will take a long time. All of this makes me believe that it will not happen in the short run. It won't happen in the medium run either, in my view. And that, of course, is important because the countries that have been pushing for greater trade deals, better trade deals with the US, have been those countries that produce cars. And I mean here, Germany. So, if Germany doesn't get lower tariffs on cars, I think the mood might actually change. And that, of course, we're back to what can we do to escalate.
Maria, in terms of the process and how it is managed now in this new world, do you feel that we're in a kind of rolling situation of permanently in trade negotiations? I mean, do you think the new administration in the United States is minded to bring these things to conclusion, or does it suit their purposes to have this being an ongoing narrative?
Difficult to tell. I think on the one hand, we have President Trump, who's always arguing for deals. On the other hand, you see that these things are not easy to achieve. I think the time scale that he had always been putting forward is unrealistic. Like I explained earlier, trade deals take a long time because there is a lot at stake. In the current situation where negotiations isn't just about trade, it's about dependencies on defense, it's about dependencies on energy. All of these things are so complicated, and the new administration in the US is really interested in extracting rents from all of this. On the other hand, the EU has very little cards in its hands simply because we depend on the US very much on semiconductors and primarily on defense. This is crucial for the EU, and it will be a very difficult negotiation time in the next several of years. So dare I say, the whole lifespan of the administration for the EU.
Take us into one sector that I know has got a lot of attention, perhaps because it always attracts outside attention, and that's the drinks sector. The Europeans failing to achieve any kind of carve-out or special treatment for wines and champagne. I mean, how should we view this kind of conversation? Are the Americans going to be facing pressure from consumers to bring things in more cheaply, or is everybody in the States going to be fairly happy with just replacing with domestic production?
Well, I mean, I think, if your question is about the inflationary impact in the US, yes, we are going to see it. We already see it in import prices in the US, and this is only going to deteriorate. And actually, some of the numbers in terms of consumer confidence, but also expectations, are telling us this. There will be an impact on prices in the US, and that, of course, will mean two things. The US consumer will start substituting. They will have to substitute, but that means that they have less choice. That's why we say that actually tariffs is not a good thing for the consumer, because it reduces choice. So it will be the choice for European goods or for general goods in the consumption basket, and it will be much more expensive for that. Now, when it comes to the particular product, from the point of view of the EU, I think the EU is now taking the position that we need to discuss economic value. So what is the products that represent the highest economic value? And next to that, and in my view more importantly, what is the most important goods when it comes to economic security? And that is why semiconductors are really the ones that matter the most for the negotiation process, rather than other goods like wine or agriculture. I think this is absolutely crucial. And of course, remember, next to that, we need to buy more defense from the US, and we need to rely on the US for security guarantees when it comes to Ukraine. That reduces the space that the EU has to negotiate anything.
Maria, is this a permanent situation that may even outlast the Trump administration? How long-term is the current environment going to exist for? Have trade deals, as you say, trade deals take a long time to do. If you were to change the administration in Washington, completely change the strategy right now, how long would it take to put things back to where they were before? Do you think things are ever going back to where they were before?
It's difficult to think of going back. These are one-way streets, typically. I think the issue of who is the ally here is crucial, and that may possibly change with a change of tone coming from the US. For the moment, it doesn't feel like we are allies with the EU, the UK, and the US. We don't feel like we are allies. It feels much more like a negotiation about extracting rents, and of course, at the expense of Ukraine, because this is really what needs to be resolved as quickly as possible. So, in the current administration, I don't think much will change. But in the next administration, I think, in the possibility of realizing that we need allies, everybody needs allies, and that includes the US. That may change. It could change quite fast, but I don't think we can really realistically say of going back to what. These are one-way streets, and we will go somewhere else. We will find better ways of being friends, and some things will resolve and some we won't.
But a new reality is now with us and is unlikely to change. Maria, great to catch up. Thank you very much indeed. Maria Demertzis, Economy, Strategy and Finance Centre Europe leader at the Conference Board. Coming up, will Jerome Powell signal September rate cuts in his speech at Jackson Hole today? Expectations are maybe moving away from that. We're going to look forward to what we can hear and what we should expect. That's next. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The last where you saw services inflation, which is probably not driven by the tariffs, really start shooting up, is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
Somebody waiting for the data then, at least partially. Chicago Fed President Austin Goolsbee there, speaking from Jackson Hole ahead of Chair Powell's speech. Let's get an update from Valerie Teitel on what she's thinking ahead of Jackson Hole. And we're all waiting hours until 3 o'clock UK time, I think, Val.
Yeah, that's right. I am holding my breath until Jerome Powell's speech is released. But I think those Goolsbee comments we just heard really put into good perspective what we've heard from Fed officials over the last 24 hours. No one out there claiming that the September rate cut is a done deal. Many of them saying that they still want to see more evidence in the data before they make that kind of decision. That compared with some, that as well with some hot data we got yesterday, the PMIs coming in strong, led to a slight repricing in the front end. We did see yields shoot up in the 2-year yield. And ever since that hot PPI print now, these 2-year yields have drifted higher, around 10 basis points higher since last Thursday. And that's led to the pricing for this September rate decision to start edging down. It was over 100% last week. It's now ticked all the way down to 75% before this, before we hear from Fed Chair Powell later today. It's also given the equity market a bit of a struggle. This rise in front-end yields and that tech rout has led to the S&P 500 to underperform, falling for 5 straight sessions, looking to make it 6 with S&P futures down over 1.5% in the last 6 sessions. But it all really comes down to today, where to next for this equity market and for the bond market. If he's going to be dovish, he's going to have to change his tune when it comes to the labor market. That is the big catalyst for a dovish surprise. On the hawkish side of things, Guy, we could be looking at maybe a quite technical speech where he removes some sort of monetary policy framework that was put in during COVID. And if he wants to sound neither and in some way say that there's still big questions ahead, he'll point to the more data we have before that September 17th decision. Remember, we still get another payroll report and another CPI before that decision.
Great stuff, Valerie. Valerie's going to be holding her breath until 3 p.m. today.
Sounds dangerous.
I'm going to watch that with interest to see what happens. Jackson Hole, what a place to hang out this weekend. If you don't have the luxury of hanging out in Jackson Hole this weekend, and I can think of fewer nicer places, there are other options available, I have to say. There's going to be some great tennis coming up. I think Alcaraz has got a really tough run through this morning. I think Djokovic as well is going to have a tough run too. So that's going to be interesting to watch. The Women's Rugby World Cup is on. Going to be paying attention to that. The Notting Hill Carnival. I generally avoid that part of London during this weekend, but I'm told it's fun.
It's great fun. Yeah, very loud, but great fun if you like that kind of thing. Great food. You were keen to point out which sport we were talking about in the US Open. I think it's self-explanatory. I think that looks like a tennis ball.
Yeah, I think US Open, I think golf, but anyway, it does look like a tennis ball, I admit, moving quite swiftly, so yeah, I like the graphic. Anna's going to be spending a great deal of attention focusing on what is happening at Reading. The lineup I hear is...
I'm not sure many of our viewers have Reading and Leeds Festival in mind for their weekends, but those with teenagers might be focused on what's happening over at Reading and Leeds.
Yeah, Anna's going to be paying a great deal of attention because she is definitely one of those. If you are not attending Jackson Hole or any of those fantastic events this weekend, you may be heading off on your annual summer holiday. We've also got a UK bank holiday coming up this weekend, and then you've got another holiday coming up in the United States next weekend. So this kind of feels like it's peak season for holidays, and there's plenty of choice out there, but where should you be going? Well, let's ask a few experts. Bloomberg Pursuit's luxury reporter Sarah Rappaport joins us now to talk about trends in travel. So I'm nervous about using the word hotspot, because hotspot has different connotations these days, particularly given what is happening around Europe at the moment. So let's kind of park hotspot. But if I was looking for a cool spot to go to, where would it be?
Lined it up perfectly, Guy. It's all about cool occasions now, because the weather in the Med is just so hot. We're seeing record temperatures in places like Greece and wildfires.
Yep.
So people are pushing their August holidays into September.
The shoulder months, I'm told.
Shoulder season, they're really the peak times now. Rates are rising. You can't get the kind of deals you used to be able to in September or even June. So in places like Antiparos and Paros, hotels are just as booked in September and June as in July and August. And people are picking places like Copenhagen or Stockholm or even Scotland to go to instead of the Med, which I know is wild, but...
Going wild in Scotland.
Wild indeed. You have one of the best jobs at Bloomberg, I think, Sarah, because you get to write about and experience luxury travel and all that goes with that. And for some people, this will be a dream, what I'm about to mention, and for others, this will be a nightmare. But luxury sleeper trains are making a resurgence.
It's like the Orient Express, isn't it?
I know.
This is what I think about.
Extremely
but is that the
glamorous.
reality?
I think they're wonderful, but they are a very high price point. And just for you, Guy, I found a fun fact. It's the 200th anniversary of the British rail system this year.
Okay.
And luxury sleeper trains
and it's really improved since then.
Well, maybe not. But Belmont, what we're seeing now, has launched the Britannic Explorer. And it is the first luxury sleeper train in England and Wales, and it launches soon this month. £11,000 for 3-day journeys to Wales, Lake District, and Cornwall.
Wow.
So that does include food and drink and activities.
So you go to Cornwall, then you go to Wales, and then you go to the
different
Lake
journeys.
District.
Some go to Wales, some go Lake District and Cornwall.
In 3
You
days.
can pick 3 different destinations, And those are booking up with Americans excited to go on trips, mostly rich Americans, to be honest. But they're very popular with the people trying to go to the UK.
Okay, so sleeper trains and a return of cooler holidays and shoulder months for some of the hotter places. Those are some of the trends. We'll continue this conversation, but Sarah, thank you very much. Thank you. Sarah Rappaport. Let's widen the conversation now with Tom Cahalan, who's founder of luxury travel agents Dorsia Travel. Tom, thank you for joining us. So no doubt you recognise some of the trends that Sarah was just talking about there. But if you're thinking of new and exciting up-and-coming destinations that luxury travellers should think about and have on their radar, what comes to mind?
Oh, Hannah, have you considered the Reading and Leeds Music Festival this weekend? No, I'm kidding.
That sounds very luxurious.
Exactly. I love that being there. We're seeing very, very similar to what has just been said regarding, I always used to recommend May, September, great time for Europe. The rates have gone up so high now that September is peak season. The weather can still be very, very hot. So we're actually seeing a lot of people prepared to travel significant distances to places like Mozambique. Now, there it might not seem quite as normal as you might think, but you've got extremely high-end luxury properties there. You've got a lot of money going into conservation. So as a result of that, you've got new national parks are being restored to what they used to be, and value for money is very, very high in these places as well.
Okay.
And I think that's been seen generally across a lot of places, like the Indian Ocean. Other than the Seychelles, it's generally off peak this time of year. You can risk the rainy season, but when you're comparing rates of getting, say, a 250 square meter villa in the Maldives in one of the best luxury resorts in the world versus a 30 square meter room in Saint-Tropez, to a lot of people, it can be very appealing to look elsewhere, look much further afield.
Is climate change, Tom, changing things? Is the over-tourism narrative changing things? How quickly are we seeing the tourism industry evolve around both of those two stories?
Yeah, that's an interesting question, because going back to the Maldives, traditionally, a lot of properties in May, they just shut. And some of them even go into June and July, and they're so low peak, you can be single-digit occupancy numbers. But now, actually, it can be quite a good time of year to go there. And some of that is because of climate change. But it works both ways. So I'm just focusing on the Maldives for a moment. But traditionally, peak time is end of December till April. This year, January was extremely wet. It rained a lot there. So it can work both ways in that you think you're going somewhere when it's peak, but the weather can be so sporadic, you don't quite know what you're getting. So I think generally you're... Sorry.
Well, I was going to say, and what is it that people are going for? Is it still luxury hotels, or is it about the sort of villas and the large homes and the big parties, taking your friends with you? What's the vibe these days, Tom?
It's all going to depend, but we are seeing a lot of multi-generational family bookings. And so the way that companies have responded to this since COVID is, I think initially from COVID, you had companies going, people are afraid of being around each other, let's build villas. But subsequently, COVID is not a point that comes up anymore, but people have realized that spending time with their friends and family and having these exclusive use large villas is an extremely appealing element of it. So you're going to have certain people, it's going to be just purely, it's a beautiful location. Some, because you get to take all your friends and family. And again, if you're comparing that to certain places, if you're comparing what you can get, even at peak in, say, the Maldives, where you can take an entire private island for less than you could take 2 or 3 entry-level rooms in certain parts of south of France or Italy, it starts to become a real... It's still not cheap, but it starts to look like value for money.
Yeah, everything's relative, particularly when you've got your relatives with you. Yeah. Tom, thank you very much indeed. Tom Carlan, co-founder of Dorsia Travel. And what you should be maybe thinking about this weekend, if you're not, of course, going to the Reading Festival. Or the Central Bank Festival, which is in Jackson Hole.
Absolutely. I'm going to spend all weekend trying to focus on what's happening at Jackson Hole and monetary policy instead, Guy. Because, I mean, have we still got our countdown clock? That should be running.
Not many hours to go.
Not that many hours.
Val's still holding her breath.
Yes.
We're
checking on her at regular intervals to make sure she's okay. But, yeah, not many hours to go. And so the big question remains, what kind of...
Is he a dove or
message?
Is he a hawk?
Yes. And does he try to be neither? Is it possible to be neither? Does he upset people? Does he upset the White House?
Maybe a moose. Plenty of moose there as well. Stay with us. Great coverage coming up from Jackson Hole, the Economic Symposium. We've got some interviews coming up, which you are definitely going to want to pay attention to. Some former Fed presidents, some great guests. Rich Claret, I think, has got some really interesting things to say around what is happening here. Also, Mr. Bullard, I think he's going to be worth listening to as well, considering he potentially could be on the list for the next Fed chair. Anyway, the big event, of course, is the Fed chair, Jerome Powell. He is speaking at 3 p.m. UK time. Everything's basically about the countdown into that, as a result of which that'll be the big focus on the Pulse next. It is coming up shortly. Have a great weekend, folks. This is Bloomberg.
you missed it on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
The day of reckoning. Markets cautious as traders await Jerome Powell's final Jackson Hole speech. But rate cut bets are trimmed after hawkish comments from Fed speakers. The EU and US outline plans to cut tariffs on cars, pharmaceuticals and chips within weeks, but there's still no deal on wine and spirits. Plus, Nvidia said to halt production of its made-for-China H20 chip. That's after Beijing warned Chinese companies to avoid them. So market positioning, there is a steady mood here leading up to the speech, of course, from Jay Powell at Jackson Hole. Will he validate the market pricing around September for the first cut of the year, or will he kneecap that view and focus in instead on inflation risks? S&P futures then currently eking out some modest gains after 5 straight days of losses, but it is on a knife edge and it will be dependent on what we hear from the Fed chair, it seems. The benchmark 10-year, we're checking on that, largely unchanged in the session. At the front end, the 2-year at 378, more sensitive, of course, arguably, to what we hear from Jay Powell later today. Euro dollar at 115, a little soft on the single currency, down 0.1%. And Brent in focus again, some more ire focused on India from the Trump administration. Unchanged so far in the session at 67 and 69 cents on Brent. Let's flip the board and have a look at how things are shaping up across the map when it comes to the European session. You have the grocers and personal care under pressure as a sector. Chemicals holding on to some modest gains. But again, this is very much a market looking for that direction. The FTSE 100, which broke through fresh records this week, currently a little softer, down 0.1%. Over in France, you're seeing very modest gains on the CAC 40. Slightly brighter picture over in Spain and Italy. The DAX, though, in Germany, a little softer by 0.1% with German GDP data coming in below expectations for the second quarter. We'll get the analysis now on all things Fed and these markets. Let's get to the show.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and happy Friday. Welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua this Friday. Central bankers then, of course, and economists gathered at the Federal Reserve's annual Jackson Hole conference amid inflation concerns. and growing political pressure on the Fed. Traders will be listening, of course, to Jay Powell's speech for any hint of what policymakers may do at that September meeting.
I don't see any chance that there's a nod toward a September cut or any promise of a September cut.
The caution I would give, if they do move in September, I don't think that's the start of a cycle. I think it's an individual decision. Then they'll wipe the slate clean and take the next 6 weeks, try to understand these cross currents again.
I think they're modestly restrictive. I'm still trying to find ways of what's being inhibited in the economy from where our policy rate is today. But I think we're on a good path.
For sure, it feels to me like it's a live meeting. As you know, before April 2nd, before we got some uncertainties coming on the policy side, I believed that we had pretty stable full employment, that inflation's coming down to target.
Okay, let's bring in Bloomberg's Valerie Teitel right now for the market reaction to this. And what we've been hearing from Fed officials and the messaging out of Jackson Hole so far, at least, Val, seems to be modestly hawkish.
Yeah, that's right, Tom. All those Fed officials we heard from in the last 24 hours, none of them seem to have penciled in a September rate cut as a done deal. Many of them talking about how we still need confirmation of the labor market continuing to weaken and progress on inflation before they pencil in a cut in September. That's led to some front-end repricing. We saw yields move higher yesterday across the Treasury curve. The two-year yield, the very policy-sensitive two-year yield, rose around 4 basis points in the session, has risen now around 10 basis points since that hot PPI print that we got last week, leading to these bets on the September rate cut to really pare back. You know, it was only last week we were pricing in 100% or so of odds for that rate cut on September 17th. It's now all the way down to 75%. So some of that hawkish language really tempting a rethink about what we could hear today. It's also caused some problems with the equity market. Yes, we've had tech have a wobble this week, but we're now have clinched 5 straight losses for the broad U.S. equity market. The S&P 500 down for 5 straight sessions, and futures over the last 6 have now lost over 1.5% in that time frame. But where to next really depends on the signal from Powell later this afternoon at 3 p.m. A dovish scenario would see him in some way suggesting or expressing concern about the labor market, and that would be the signal that the market would need to pencil in that September cut. On the hawkish side, though, he could talk about more technicalities when it comes to their monetary policy framework. He could drop something called flexible average inflation targeting. So something our own Anna Wong has written about, and something that Nick Timrose over at the Wall Street Journal did as well. If he wants to sound neither, he could just sound as ambiguous as those Fed speakers that we heard from over the last 24 hours. Stress data dependence, stress the fact that we still need to see more labor market evidence, more evidence on CPI before we're penciling in that September decision.
Okay, Bloomberg's Valerie Teitel, thank you for breaking it down for us with that preview. Let's get more analysis right now in terms of the market reaction, how to think about positioning around this event and beyond with Ursula Marchioni, EMEA Head of Investment and Portfolio Solutions at BlackRock. Ursula, good morning. Thank you for joining us in the studio. Those 3 scenarios have been outlined then by Valerie Teitel. Where do you think Jay Powell ultimately lands in this speech later today?
It's going to be a very interesting one to watch, I agree with you, because to Valerie's point, there's 3 components here that we need to focus on. The first one is the inflation picture. If we look at going into today, we had a CPI and a PPI reading recently that are somehow divergent or in dissonance. CPI in line with consensus, PPI way hotter. So again, the jury is still out there in terms of how much of the tariff effect has been transmitted. Not much yet. We've seen something in furnitures, in electronics, but broadly speaking, is a benign picture, yet is there more to come? And we saw some commentaries around earnings this very week around prices going out by the week. So I think that will be an area within the speech to focus on. Labour market weakening, I'm obviously referring to the latest payroll, but also the 2 prior downwards revisions, which were significant. And so I think there's a picture there where weakening is solidifying as a forward look. And then more recently, yesterday, PMI, a flash PMI that actually was very good. And so painting a picture of economic growth. And so how do you square those 3? I think the main areas to look at within the speech will be these 3 components and how they get combined and messaged. We also need to remember, though, Tom, that there's still over 3 weeks to go between the 16th and 17th of September, with a CPI coming out, another payroll. So it will be unlikely for Jay Powell to confirm a clear path, having still missing data on those two.
Given the mixed picture on the data that you outlined for us there, and the fact that you do have more labour market data and more inflation data coming through before the September decision, does that not make the case for a Jay Powell who later today stresses data dependency and keeps his optionality?
I think that is a very possible scenario, and I think that it's been somehow what investors have been doing in August. So if I read flow numbers and where people are voting with their money, July was a very different picture to what we've seen month to date. July, very much an equity month, 60 billion going into exchange-traded products. US equities seeing a resurgence, including from international investors. The big story this year has been repatriation. 88% of US equity purchases have been done by the US retail investor. And yet in July, we saw European investors buying US equities again to the tune of 4 billion. So that was July. Moving into August, and I think that this connects with, big events risk, such as the one today, we've seen this cautious approach coming in. Yes, the last 5 days of S&P sliding down are an element, but I would zoom out. It's been there, this theme of cautions and taking some chips off the table for the entire month. We've seen flows turning towards more defensive sectors in the US, industrial and utilities. In Europe, we've seen dividends, financials, the strongest month on record for small cap. So I think that this picture is really connected with the large decision that needs to be taken in the weeks to come.
Is it caution when it comes to US equities and taking chips off the table, or is it a signal that we've reached the top now, given the stretch valuations in tech, and specifically if a Fed decides that in fact September is not going to be the month in which they cut for the first time? Would that be the event that locks in a deeper downside for this equity market? How convinced are you that this is short-term, the selling that we've seen in the last few days?
I hear the question. Look, I think there's a lot to be considered, but if I take a step back, year to date, we have seen, as the year progressed, more attention and caution around tech. Month to date, we've seen outflows from the sectors. Prior 2 months, flat. May was again an outflow month. So we have seen chips being taken off the table, but Tom, it's been, in terms of magnitude, a very contained trend. And so for me, putting that in context with the fact that from a megaforce perspective, AI is still part of an industrial revolution that we're going to have to see playing out, continues to make the case going towards year end into an AI megaforce component within portfolios, together with US banks, for example, if we remain in that market. US healthcare we like. If I move into Europe, defense, if I think about European banks. So there's a theme there around selectivity and granularity, which means that whatever happens around these big events, and the one today and in 3-4 weeks being another one, will somehow be well absorbed by a diversified and defensively tilted portfolio.
Yeah. We were speaking to Karen Ward of JP Morgan earlier this week. She described, in terms of the rotation from US equities into European equities, there's been such a key theme in April and May. She says we're really actually only in the opening innings of that in terms of the flows that she's looking at. Do the flows that you're seeing on the ETF level, do they support that view that we're just in the early innings of that rotation from US into Europe?
I'm not sure I would. So the first element that I would consider, that I would flag, is that rotation has been done by domestic investors. So purchases of European equities from US domiciled investors are very contained. European investors indeed have bought European equities this year 4.5 times with more conviction than what we had seen in 2024 at this point in the year. So there's definitely been a repatriation trend going on. But to your question, over the last couple of months, we've seen that somehow plateauing or slowing down. Again, we still like elements of the European market banks, as I mentioned, being one. So I think there's still room to go, but it will be more of a selective, precise exposure purchase than an overall market entry, which is what we saw earlier in the year.
But before we let you go, your call on defence stocks in Europe, and that is one that it's certainly not counter consensus. But in an event where we get some kind of peace agreement between Ukraine and Russia, and the reporting in the last few days seems to suggest we are a long way from that. But in the event of that scenario, does that undermine the case for European defence, or is it immune to that because of the structural changes happening at the fiscal level?
We believe the latter. So again, if you take a step back and think about the great moderation ended with COVID and look at where we are now in terms of geopolitical fragmentations and tensions, I think you can make clearly the case of a paradigm shift in that sense. Commitment from the German government being a point in case. So obviously a ceasefire will be welcome and potentially have an impact in the short term. But in the long term, I stand by the call.
Okay, Ursula, thank you very much indeed with the analysis on what to think about around the Fed and where to position and those flows as well into areas like US banks. AI as a mega trend continues and favouring defence stocks in Europe. Ursula Marchione, EMEA Head of Investment and Portfolio Solutions at BlackRock. More details on the Fed right now, because Fed officials are reportedly preparing to U-turn on their signature economic policy from 2020. The Wall Street Journal says Jerome Powell will use his Jackson Hole speech this afternoon to outline plans to move away from focusing on the risks of near zero interest rates and low prices, which prevailed, of course, when the policy was introduced back in 2020. Coming up, meanwhile, the EU and US outline plans that could cut tariffs on European cars and offer discounts on other goods. Wine and spirits, though, not yet part of the mix. It could all happen in the next few weeks. We'll get the details next. This is Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Today, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for a special episode of Surveillance at 9 a.m., only on Bloomberg.
Welcome back. Back to trade now. The US and EU outlining trade plans that could reduce tariffs on European cars to 15% within weeks and potentially offer discounts on steel and aluminium. White House trade advisor Peter Navarro credits the breakthrough in Ukraine talks for paving the way to the deal.
I can think of no deal more important than with the European Union. This is like a really important mountain to climb, and we climbed that. And President Trump got up to the top of the mountain today. In many ways, the Ukraine situation has been a total wake-up call for Europe.
Right, let's bring in then Bloomberg's trade czar Brendan Murray here and sitting on his own mount, and deservedly so as well. Brendan, what do we know? So we've been looking for additional details around this agreement that Europe and the US came to. The headline was 15% tariffs, but also there was all the nuance, and you unpacked that for us in the weeks after that and the days after that announcement, of course. Now we have some more detail. How significant is it? What's been achieved?
It's incremental progress, I would characterize it. The Europeans got some clarity on the sectoral tariffs like semiconductors and autos, and they have some understanding that those aren't going to stack on top of each other. There's the 15% is a ceiling, but as the European trade minister said yesterday, this is really the beginning of this process. These talks are going to go on for months and months. They still have a lot of issues to work out. The wine and spirits tariff at 15% is not pleasing the French or the U.S. industry. So there's still we did get some details, but there's still a lot of caveats in what we got in this joint statement yesterday. Not a whole lot of solid commitments.
Okay, so there's a lot of work still to go, and you'll have to wonder if this is a template for other trade agreements that are in the works. The headline deal, and then you work through the mechanics of the detail in the months that follow. In terms of the relationship between Brussels and Washington, that of course has been strained. How important is this in terms of putting a floor under that relationship?
Yeah, it's the other aspect of the deal was the investment pledges. These are the the hundreds of billions of dollars worth of investment and purchases that the Europeans have pledged to make. Those are the kinds of things that President Trump asked them to do, and they followed through. Whether or not they actually materialize is a whole other question. But as Peter Navarro said, they made some progress, but they're still a long way from resetting and rebalancing the transatlantic trade relationship. There's a lot more work to do, and a lot of fine print left, which is really the hard work left to be done.
In other parts of the trading relationship emanating out of the US, de minimis, so these small, low-price packages entering the US, that had been significant if you're a Chinese e-commerce player shipping into the US market, and that rule was put in effect, and it affected companies like Shein. But there's a broader story here, and this is being rolled out further, and there's implications. Talk us through what's happening on the de minimis rule.
Absolutely. This is a really important story that we should keep an eye on in the week ahead. Next Friday, the de minimis exemption for duty-free treatment for goods under $800 that has applied to China and Hong Kong since May. That goes away for every country. So if you're sending a gift or a product from the UK, from Germany, from Japan, all these other countries, you're going to have to pay a tariff on it. You're going to have to calculate what that tariff is. And all these mail services around the world are suspending their shipments to the U.S. while they try to get a handle on what these new rules are. The customs duty has to be paid by the shipper. And so it's a really, it's a developing story. We're seeing these mail services, one after the other, come out and say, we don't have any clarity from the U.S. Customs Agency. And so it could disrupt shipping, an already disrupted global shipping industry to a significant degree until they get some clarity on this.
And to be, if I'm sending a packet of Percy pigs to my relatives in LA, that's going to be hit with a tariff.
Well, there is
an exemption for
everything under 100. Everything under 100.
100, okay.
If you can verify that
Yeah.
it's worth less than $100, you can send those to your relatives. But if you're an airline and you have a lot of cargo capacity in the cargo hold of passenger planes, a lot of goods destined for the U.S. over the next week are going to be impacted. So there's a real commercial and consumer element to this that we need to stay on top
Brendan,
of.
Fantastic. Thank you very much for that update. Other suites, of course, are available. Bloomberg Trade Czar Brendan Murray. 2 chips now, and NVIDIA. Just the latest twist in the saga and the unfolding tale around semiconductors. NVIDIA is lower in pre-market trading after reportedly instructing suppliers, including Samsung, to halt production of its H20 AI chip. Tech publication The Information says this comes after Beijing advised companies to steer clear over security concerns for the chip, which is built specifically for the Chinese market. NVIDIA, for its part, has repeatedly denied that it added backdoors into that semiconductor. Bloomberg Intelligence analyst Rob Lee joins us now for the details and what this all means. What is the latest, Rob? What does it tell us about NVIDIA's prospects in the Chinese market, if indeed this reporting is confirmed?
Well, I guess in sort of British colloquial terms, this is the H20 hokey cokey, isn't it? We're one step in, one step out, in, out, then about shaking it about. But their strategy, their visibility on their H20 China business remains hugely uncertain. So prior to recent developments, it had been expected, following President Trump's decision to allow them to resume production, that production would likely start at the very tail end of this year at the earliest. So as I said, based on these unconfirmed reports, I should stress in the information, that is in disarray, or certainly it's certainly overshadowed by significant uncertainty at the moment.
And Rob, Jensen Huang is on the ground in Taiwan. He's been reflecting on some of this, and he's been stressing that there are no backdoors in these H20 chips.
Well, I guess you have to take what he says at face value, but from an engineering perspective, it's incredibly difficult to prove or disprove otherwise. Because first of all, if you did an examination of the hardware, as you appreciate, these chips are built at the atomic scale. So sure, you could take a very powerful scanning electron microscope, look at the structure in detail. But again, it's very difficult from a physical examination to make those sort of conclusions. And then equally, you would need access to the software that's running them, the firmware and other operating software, which it would be very difficult to access. So I would say, whilst the Chinese government has allegedly highlighted some concerns on that front, it's very difficult to disprove or prove. And equally, that echoes, if you remember, back to several years ago, where there were, again, unconfirmed allegations coming the other way that Huawei's technology had a similar backdoor, which is why I should say Huawei's telecoms equipment was stripped out of a lot of telephone exchanges and telecoms infrastructure from European countries, for example.
Yeah, a reminder that two can play at this game. Bloomberg Intelligence analyst Rob Lee, thank you very much indeed on the latest when it comes to NVIDIA, the H20 chip and shipments into China. Staying with tech, Bloomberg understands Meta is hiring another key artificial intelligence executive from Apple, even as the social networking company prepares to slow its recruitment. We are told that Frank Chu, who has led Apple AI teams focused on cloud infrastructure, training and search, will be joining Meta Superintelligence Labs. Chu follows several of his colleagues to Meta, which has also hired the head of Apple's AI models team. And in a court filing, OpenAI says that Elon Musk identified Meta boss Mark Zuckerberg as one of the people he communicated with about financing a deal to purchase the maker of ChatGPT. OpenAI says, in the end, neither Zuck nor Meta participated in the $97 billion bid. The company's board formally rejected Musk's bid back in February. And Bloomberg understands Anthropic is nearing a deal to raise as much as $10 billion in a new round of funding. The fundraising is a higher than expected sum and one of the largest mega rounds to date for an artificial intelligence startup. Bloomberg has previously reported Anthropic was in advanced discussions to raise up to $5 billion in the round at a valuation of $170 billion. Coming up, the EU and US paved the way for lower tariffs on autos, pharma and chips. We're going to look at the implications for Europe and in particular the powerhouse of that Eurozone economy, at least on some measures, German industry, the impacts of this agreement, what it means for Germany and the relationship between Berlin and Beijing. That's coming up. This is Bloomberg.
Applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
Good morning and welcome to the Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. The day of reckoning, markets cautious as traders await Jerome Powell's final Jackson Hole speech. But rate cut bets are trimmed after hawkish comments from Fed speakers. The EU and US outline plans to cut tariffs on cars, pharmaceuticals and chips within weeks. But there is still no deal on wine and spirits. Plus, Nvidia falls in pre-market trading after reportedly halting production of its made-for-China H20 chip after Beijing warned Chinese companies to avoid them. The US and EU have released details of a deal that lowers tariffs then on autos, pharmaceuticals, semiconductors and lumber to 15%. The announcement bringing some relief to Europe's manufacturing sector. Joining me now to discuss is Dalia Marin, Professor of International Economics at the Technical University of Munich, who has also been doing a deep dive on the relationship on a trading level between Germany and China. And we'll get to that shortly, Dalia. But I want to start on this agreement, at least filling out some of the details when it comes to the EU-US trade deal. How significant do you think that is? Some of the sectors getting some relief. Tariffs will be capped at 15%. What do you make of what we've been hearing out of Brussels and Washington in the last 24 hours?
So the major impact of this deal is that the German firms or the European firms now have more security what is going to happen in the near future, because before there was a zigzag policy with the tariffs, and no firm knew what kind of trade policy will prevail. So planning was very difficult to do. So the major impact of this deal is that that firms have more security.
Yeah, Professor, do they have enough security now? Do they have enough certainty to be able to start increasing investments, to start putting money to work again in CapEx? Is that certainty now there for European firms?
Yes, there is more certainty. Full certainty is not there because you don't know whether this is not going to change in the future. So that's the new world we live in. But at least for now, they have more security. And I think firms will start to make decisions, because our research shows that when firms are faced with uncertainty, that has devastating effects on their decision, and firms have started to reshore production back to their home market because of this uncertainty. So I think it will help to keep globalization going.
And the importance of having that certainty, at least, was articulated, or at least put in the spotlight by the weaker than expected second quarter data, GDP data out of Germany. And on some analysis, that was because of some of that uncertainty, because of the tariff risk, because of what's happening in trade. When do you expect to see a convincing recovery in the German economy?
I think we can expect a convincing recovery in Germany. And the reason is that the government has decided to get rid of the debt brake and to start to spend, in particular to defense, and that will stimulate the economy. And on top of it, it will also help German economy to reorganize, because the auto sector and the machinery sector are under much pressure, and so some of this pressure will be relieved by going into defense. So so this is going to happen in the future. So I'm pretty optimistic.
Okay. So that ties in nicely then to the analysis and the research you've been doing around the relationship between Germany and China. What are the most startling outcomes that have come about as a result of that research in around this central trading relationship, not just for the two countries, but for the world?
Yes, Europe is facing a deindustrialization shock worse than the US experienced in the 2000s when China entered the WTO. So Germany is particularly hit because its industrial structure are more similar to the Chinese. So in particular, the two core sectors of the German economy, namely cars and machinery, were particularly hit. In both sectors, Germany stopped to be a net exporter to China. In fact, in machinery, Germany got to be an exporter in 2015. And if you imagine that the machinery sector was the major part to industrialize the Chinese economy, this is particularly dramatic. Yeah. But also in the car industry, this is happening. Car exports to China dropped by 70%, and imports increased more than doubled. So this is a very dangerous situation that these two sectors might migrate to China. So policymakers to act.
Okay, Professor, we appreciate your time. Dalia Marin, Professor of International Economics at the Technical University of Munich. We had some problems, of course, with the line there, but some analysis in terms of the relationship, the trading relationship, and how that's changed with 70% drop in terms of German exports of autos to China, and a reverse scenario with more Chinese cars being sold into the German market. And some of the prescription coming through from there from the Professor, including the call for more JVs and more state support, ultimately, for some of these key sectors in Germany and in Europe. Now, staying with Germany, there are memories, of course, still of hyperinflation, which kept investors on the sidelines for decades. The mood, though, is finally shifting. The stock market is booming, up around 20% year to date, and small investors are finally piling in. For more on what is driving the surge, I'm joined by Sagarika Jasingani, who is Bloomberg's deputy team leader for EMEA Equities and Investment Strategies. Is Germany not known for mum-and-pop investors and retail investors, but that is starting to change?
Absolutely. Thank you for having me. You know, I was on the show earlier and I was saying that when you talk about what are the countries where the retail crowd is popular, Germany doesn't feature on that list, or it hasn't. And so when we got into the story, that was our, you know, the most telling thing for us, the number of retail investors that we were able to reach out to, the amount of data we were able to generate, that tells us this is actually a thing. And this is, you know, it's a significant trend that has taken hold among people who have traditionally been shy. They've been very risk-averse, and fair enough, you have the psychological scars from the hyperinflation era, what they went through with the tech bubble popping in 2000, after 2000. So it's taken them a long time to come back into the market. But there is serious conversation happening now around the stock market is a buzzword, given the boom that we've seen in the DAX, not just this year, but the last 2 years as well. And at the same time, there is growing concern about, you know, what happens to my pension. The current system is on a pay-as-you-go basis, which is that the current workers fund the pension for current retirees. So in an aging population, there's questions around how sustainable is that. So people are starting to say, I've got to take ownership of this now to secure my future tomorrow, and the stock market is a viable way to do that.
Okay, so that's one of the catalysts, clearly, is what's happening with pensions in Germany and the run-up, of course, in German equities. What have you been hearing from some of the case studies, from some of the people you've been speaking to, and how sustainable do you think this trend is ultimately? I mean, if we get a sell-off, does that suddenly wash everyone out of the market and they say, you know what, that was a mistake? I mean, there are broader economic consequences to this.
Absolutely. What we've heard from them, we've actually, we spoke to a range of them, starting from 19, 20-year-olds who are at uni, you know, discussing swapping trading advice around the lunch table, right up to people who are nearing a retirement, looking at this as I mean, everybody's looking at this as a serious thing. The stories were really fascinating. You know, we spoke to one, she's a mum-to-be expecting her first child early next year. And she said that traditionally when you have a baby in Germany, you open a bank account for them. Now I'm thinking I'm going to buy this baby and start an ETF for this baby straight away. You know, so that shows that this is actually a sustainable, fundamental shift in the way that they are thinking about it. And to your point about what happens if there is a sell-off, the data that we've seen is now consistent over 3 years. This is not a flash in the pan that, you know, it's a month or a quarter out. There has been a steady increase to about near, you know, the 20-year highs over the last 3 years. Comparatively, a survey from BlackRock across Europe showed that 3 million Germans have started buying stocks in the last 3 years, which is the second biggest increase after the UK. So this isn't something that is here today, gone tomorrow. Okay, fantastic reporting on a shift, at least for now, in terms of Germany's investment intentions and mum-and-pop investors, retail investors getting involved. Sagarika Jasingani, of course, implications for companies wanting to raise capital and for the growth prospects of Germany as well. You can get that reporting, of course, on Bloomberg.com and on the terminal. Back to the Fed now. Kansas City Fed President Jeffrey Schmidt says American businesses are showing renewed optimism that is filtering through to the labor market and putting the focus back on inflation. Schmidt spoke with us from Jackson Hole about the economy and growing political pressure on the Fed.
I'm a little philosophical about the whole conversation of Fed independence and where our role is in the American economy. We're almost 250 years old as a nation. I think there's something to be said. We were built on words, and we continue to debate those words legislatively and judicially. Whatever friction we might have with other branches of the government, I think great steel's tested by fire. So we can always be better. We can always do this better. But I think the nature of independence and I think, don't believe me, believe other nations that have central banks and don't. It seems to work, but I'm always open for the conversation of how do we make it better.
Well, the big question for everybody, especially for Wall Street, is what happens on September 17th?
So this is, as you know, kind of an interesting month because we've got Jackson Hole and then we've got quite a few weeks of data to kind of pull in. So I'm really, I think everybody's quite interested in some of the maybe the prints that happened in the last couple months and kind of where they go from here. So I'm like everybody. I think there was some fascinating conversations at the last FOMC. As you know, there were a couple of dissents. I think my interpretation of what's happening, especially in the labor market, is that the first couple quarters, a lot of business people were just saying there's uncertainty enough, and I think they kind of cooled a little bit on the higher side. But the most recent couple weeks that we've been talking to businesses in the district, there seems to be a burgeoning optimism again, that they've kind of digested and they've been agile enough to try to work their way through some of the new policies from the administration, and maybe going forward, maybe we'll see a little bit of uptick. That said, I still believe that the inflation number is trending closer to 3 than 2.
Well, we saw that in the minutes that in general, the Open Market Committee felt that inflation was a bigger danger at this point. Would you say that's your view now?
It would be my view now. I think with an understanding that what may have happened in the first couple quarters on the labor side, which I think concerned several people were on the committee, and me included. But I think this PPI was interesting, that print was interesting, but I really believe that when we talk to a lot of folks in our district, is that if you had to kind of lean or have a bias toward, it would be on the inflation side.
Kansas City Fed President Jeffrey Schmidt speaking with Bloomberg's Michael McKee, of course, at Jackson Hole. Now, some other stories making the news this Friday. The UK's tax authority tightening up scrutiny on pensions relief claimed by higher earners. This according to the Financial Times and the Telegraph. The moves include a clampdown on claims made on the phone and stricter checks, for example, asking for evidence when it may previously not have been required. According to the reports, a review by the tax office found around a third of claims under £10,000 were incorrect. And the UK government says it will buy 6 new land scepter systems from multinational European arms maker MBDA over 3 years in a deal worth £118 million. They include so-called anti-air modular missiles capable of hitting a tennis ball-sized object travelling at twice the speed of sound, as well as launchers and support vehicles. And shares of WH Smith slumped 42%, the most on record, after the discovery of an accounting error forced it to slash its profit outlook in North America. It is a major setback in a key growth market for the British retailer. A financial review found an overstatement of about £30 million in expected headline trading profit for North America this financial year. The error came after it booked income from suppliers earlier than it should have. Coming up, the pivot from babies to boomers, how consumer companies are reassessing their customer base amid falling birth rates and aging populations. That story is next. This is Bloomberg.
You missed it on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Earnings season is here.
We're deep into earnings season.
A lot of earnings.
We are not short of earnings to bring you.
Bloomberg is first to break the numbers.
Barclays, Stellantis, and AstraZeneca.
Shell, Credit Agricole.
VW and Puma.
Earnings are coming in bang in line with estimates.
With the smartest insights.
We are trying to focus on what we can control.
Predictability, consistency in outlook is very important.
We are a European player.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back. Now, South African retailer Spar is reshaping its growth strategy. Both its UK and Swiss businesses are up for sale as it looks to focus on its core African and Irish operations. Bloomberg's Jennifer Zabasaja sat down with the company's CEO, Angelo Swartz, to talk about the company's restructuring.
South Africa has more retail space per capita than most emerging markets. With more than 1,400 shopping malls dotted across the country, retail is big business. And in the hunt for growth, many companies have looked to overseas expansion. The Spar Group is one example. Just over a decade ago, the company acquired licenses to operate Spar-branded shops in countries including the UK, Ireland, Switzerland, and Sri Lanka. I met the CEO, Angelo Swartz, at Spar's Durban headquarters. He told me local investment restrictions were part of that motivation.
I think that idea was driven primarily by South African legislation, which limited investment managers from investing too big a part of their portfolio out of South Africa. And therefore, many investment managers were really looking for South African companies to be proxies in other markets.
Spar is largely a wholesale business. In the UK, for example, over 300 independently owned shops all carry the same brand. They benefit from centralized marketing and distribution. In exchange, the Spar Group collects fees and leverages purchasing power with suppliers. But in recent years, its African revenue has far outpaced what it gets from Europe. Take Switzerland, a country with strong trade protection measures. Groceries there are often 50% more expensive than in its European neighbors. When Swartz took over as CEO just 2 years ago, he decided to divest the Swiss and UK businesses, materially strengthening the balance sheet.
When we looked at the businesses in the UK and the business in Switzerland, is our view that those businesses are subscale, and the amount of capital that it would have to go into those businesses to get it up to scale to meet our strategic ambitions would be misplaced.
Retail analyst Alec Abraham argues Spar's biggest mistake was taking its eyes off South Africa.
When you go into a new country, there's a very different operating environment, and you need to be focused to understand that market and to succeed in that market.
Back home, Spar is expanding its DIY and pharmacy businesses and is building out its liquor operations.
And I think with Spar being where it is and how competitive the South African market is, we really just want to refocus on our home markets.
That's because liquor shops in South Africa are expanding fast. Last year, they grew almost twice as quickly in the country as conventional supermarkets.
Our liquor brand, Tops, has been around for also about 25 years. And through independent retailers, we've become the single biggest retail liquor brand in this country.
Spar's CEO has branded this battle for shoppers as South Africa's wine wars, a high-margin, high-growth area in an otherwise struggling consumer market.
We have shown that our business has the ability, and our independent retailers have the ability to compete directly with the chains, empowered by us. And we are now the second biggest supermarket brand in this country, which is no mean feat.
Having sparred with what today are smaller supermarket rivals, Swartz may soon be ready to take on #1 ShopRite in what could be his toughest fight yet.
And for a deeper dive, catch our TV show Next Africa, airing on TV on the last Friday of every month. You can watch our previous episodes in full on your terminal, on our website, and of course on YouTube. Now, something a little bit different. Shrinking birth rates have many consumer companies worried, but they may be looking the wrong way. The real growth isn't in babies, it's in baby boomers, with older adults now holding more spending power than younger generations. Andrea Felsted from Bloomberg Opinion joins us now on why companies need to rethink who they are selling to. Why then, Andrea, should companies start to pay a bit more attention to the silver economy, the grey-haired economy?
Exactly. Well, birth rates are shrinking. We have more older people. We're living longer, albeit gains are slowing. That gives a big market, and they have lots of money. There's quite a lot of wealth concentrated in older generations. Although their incomes tend to shrink as they get older, they have a lot of assets, and they typically like to spend that on travel and services. But increasingly, they're going to want products and also need products.
For example, I mean, what kind of things could these companies look to do in terms of switching from the products? I mean, now for kids and babies to the elderly.
The most successful one has been nappies to incontinence care, which is growing very quickly. But nutrition is another real opportunity with less infants. But there's a lot of the technology that we need to feed babies. You know, you need specialist nutrition. It's a highly regulated market. You can put that to older people. As we age, our appetites shrink, but we need more nutrients. That means very densely packed food, and it helps that protein is a big obsession with GLP-1. But that could pave the way for these specialist foods for older people. Toys is another thing that, you know, the toy market will shrink as there are few children, but if you they're already catering to adults. But if you go up the age range, you've got older adults. And one of the most fascinating things was these sort of animatronic pets that are really successful with the elderly. They respond to touch and sound.
These kind of pillows that move and have little robots.
No, they're actually like lifelike cats and dogs. And as a cat owner, they're very realistic because the cat doesn't always respond to you, whereas the dog nearly always
So just to project into the future, I'm looking at a world where I'm being fed some protein slop, I'm sitting in an incontinent pad, and I'm playing with an electronic cat. Is that my future?
That's your future, but that's very good for consumer companies, because it might not be you buying the product. It might be, you know, it could be even worse. You could be in a care home. So the care home or the facility is buying it for you. So that's another big market. It's another big area to tap into.
Okay, Andrew, you have not reassured me. But changing demographics is real.
Yeah.
What other things could companies, and are companies looking at doing around the changing demographics?
They definitely are. One of the most interesting things is this idea of living for longevity. We all know we're going to live longer. So we start preparing for that in our younger days. So obviously skincare is one of the things most obvious, but vitamins and minerals, there's a lot of research being done into supplements that can help prepare you for your older days. So it's not just about catering to people when they're very old, it's helping people prepare throughout their lives.
Yeah, longevity is such a massive theme, isn't it? And that's the part I like. I like that part, Andrea. No, it's great reporting. Some of it's very counterintuitive, and it's the Bloomberg Opinion piece, of course, that you should read this weekend. Andrea Felsted, Bloomberg Opinion columnist, of course, and you can find that on Bloomberg.com and, of course, on the terminal. Let's segue back to the markets right now, shall we? And check in on US futures. Of course, traders are girding themselves for the speech out of Jackson Hole from Jay Powell. US futures pointing high by 0.2% after 5 straight days of losses. And of course, markets and traders have paired those bets on that September cut and the prospects of September cut now just at around 70%, when just over a week ago you were pricing an almost 100% chance of a September cut. The Fed speakers we've heard from the last 24 hours or so have been a little bit more cautious in terms of the signalling around this. What will Jay Powell say ultimately? Will he validate the concerns about the labour market? or push back on some of these bets that we're seeing. Nasdaq 100 futures also pointing a little higher, up a 0.1%, despite the concern around Nvidia, the pre-market pressure on that company on the back of the H20, the H20 story into China. We'll have full coverage, of course, of Jackson Hole, the economic symposium, including interviews with current and former Fed presidents. It starts at 2 p.m. London time. You need to tune in for this. And then, of course, the big events. Drum roll. Jerome Powell speaking at 3 p.m. UK time for this last time at Jackson Hole in his current role. This will be his last symposium, of course, as Fed chair. Stay with us for all of that. Up next, Bloomberg Brief. This is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
A cidade estava sitiada.
Nisso ao começo eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering, and someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Good morning. It's 5 a.m. in New York City. I'm Matt Miller in for Danny Berger here with your Bloomberg Brief. This is what you need to know. Equity futures wavered to wrap up a week that was entirely in the red. Maybe we'll see some green today. That's as markets await Fed Chair Powell's speech at the Jackson Hole Symposium. We're going to bring you that live with special coverage all morning. And Nvidia is said to have asked its suppliers to halt production on its H20 chips. We'll take you through that story as well. Take a look at futures here. We are in the green today. As I said, every single day this week has closed in the red, but S&P futures now are about 0.2% higher. NASDAQ futures a little bit less, only 0.1% the gain there. The small caps are doing the best as markets await any sign of a potential rate cut in September. Odds are still betting on a 20 basis point cut. For some stock stories to watch right now, let's go over to Valerie Teitel. She's in London with the latest. Valerie? I'm not sure if Valerie's microphone is on there. All right, we'll get back to Valerie and get that stocks news to you as soon as we can. We have her. Sounds like we have her back. Valerie, are you good to go?
Maybe I'm good to go. Can we start with NVIDIA in the red, falling around 1%? And this is coming after reports that they have paused production of their H20 chip. Remember, that chip was a chip designed specifically for the Chinese market. And this comes after China has urged local firms to not use this chip on the back of some security concerns can be seen as maybe these trade negotiations reaching new levels when it comes to the chip industry, and maybe a broad move by China to keep protecting its homegrown chip industry. But let's move on to earnings. Let's talk about Workday. This is the HR software firm. They gross profit missed estimates, but they did announce a new acquisition of their second AI-linked acquisition. They agreed to acquire Paradox, which will help them automate some of their recruitment process. Lastly, let's end also with earnings. Zoom Communication gave a strong forecast, Matt, and this is off the back of customer demand for its new suite of AI tools.
All right, Valerie there with a wrap of some of the stocks we need to be watching this morning. In just moments, we are going to push ahead to Chair Powell's remarks with Jeffrey Yu of BNY. And later this hour, we're going to talk to Jack Caffrey of JP Morgan to discuss the equity market and the reactions that we've seen. We are about 5 hours away from the highly anticipated speech from Fed Chair Jay Powell. Let's get a preview right now from Bloomberg's Balazs Pence. Balazs, what exactly can we expect, or what are we presuming to expect from Fed Chair Powell today?
Well, what everybody's hoping for is some sort of a hint, a wink, a nod in terms of the direction of monetary policy from Chair Powell. And he has used the Jackson Hole meeting before to indicate which way rates might go. What markets will be particularly looking for is whether he gives any sort of pushback to the market pricing that's developed, particularly since last week's relatively benign inflation report. But as we have seen, as we heard from several Fed members, past and current, there is sort of an emergence of a focus on the underlying data, and there's more of a focus returning to inflation concerns rather than the jobs market, which everybody assumed would have made a September rate cut a done deal. So there's a lot riding on this speech, and people will be very eagerly parsing every single word out of Chair Powell's mouth.
All right, so what are the other sort of, I guess, events that we need to be watching for? I know that we have at least one labor report coming between now and the September meeting, and a few different inflation reports. What are the biggest data points that you think Powell and his colleagues are going to be looking ahead to in the next month?
As we heard from several Fed speakers over the past week or so, they have been more concerned about the underlying data, and they have pointed at the pickup, for example, in services inflation that's indicating that there's more inflationary pressure in the economy, and they're of course still looking at any sign of the tariff pass through into the inflation numbers, and whether that's a one-time blip in the numbers, or whether that's kind of a more prolonged effect on inflation. And there's another thing in the background that we still have to talk about, which is this tussle between President Trump and Chairman Jay Powell over which way the Fed should go. There's been a lot of talk about central bank independence, and Powell will be among friends. It's a safe space for him with a lot of other central bankers present in Jackson Hole. So it might not be a surprise if he also makes a nod towards central bank independence during his very highly anticipated speech.
All right, Balazs, thanks so much. Balazs Pence there talking to us about what to expect. Joining us now is Jeff Yu, Senior Market Strategist at BNY. And Jeff, one of the things we're expecting to get is perhaps a change in the framework the Fed uses to go about monetary policy. What are you expecting?
Well, overall, going to the September decision itself, we're not expecting really a full-throated endorsement of market pricing, to your earlier question. So yes, markets are looking for a cut. So maybe we'll lean in that direction, but is it going to be a full endorsement? I'll go back to Goolsby's comments. Yes, it is going to be a live meeting. Secondly, let's look at the theme of Jackson Hole this year. Labor markets in transition, right? Demographics, productivity, macroeconomic policy, and things like that. So going going back to the core inflation numbers, which have been rising, especially the services figures. So that speaks back to the labour market in places like the US and the UK, where wages really the key input into services inflation. Are there structural trends taking place, which means inflation will be elevated, and then you have higher terminal rates or higher neutral rates? So I think all of this will be under discussion as well. But overall, balance, I think that's going to be the key word. Let's not rock the boat right now.
Each day this week, Jeff, I check out my WIRP function, my WIRP function, and here we have odds of 75%. That's a little bit dated because right now I'm looking at less than 71%. To put it in odd terms, 17.7 basis points of a cut. What do you think we're going to see? Because last week at this time, we may have thought 50 basis points would be appropriate.
Well, so is it fully justified right now, just based on the data run that we've had, especially with respect to prices? Probably not in that sense. Is a cut at some point this year justified, given the direction of travel for the labour market, for the economy? So yes, right. So we just have to look at the short-term, medium-term, put things into perspective. But let's look at the global policy framework right now. Again, here, the BOE. If the BOE had seen the data on the inflation side, on the labour market side, on the GDP side, before their cut, I don't think they would have cut, right? I know you can't prove the counterfactual, but I do think that central banks globally, and in particular with the Fed, with high-frequency data coming through, they don't want to fall into that trap as well. So don't end up regretting something just because of forward-looking data that you didn't have.
If I looked at inflation, I would think it's going higher and higher, just from the CPI and PPI numbers, which then begs the question, does the Fed really want to cut rates into rising inflation that's already 60% above its target rate? But I guess a lot of people, Jeff, question the components of the inflation numbers that we get. Are you among them?
So I would actually go back to the services print, right? So it is still above 2%. It's been consistently at those levels. But that just speaks to wage growth. I know wage growth isn't exactly accelerating to the extent that maybe headline figures are lurking in that sense. But if we look at, where the inputs into the US economy are, so where the drivers are, I think they should be concerned that, similar to the UK, while labour markets are clearly cooling, they are loosening in terms of jobs numbers, you're not seeing that directly translate into weaker wage growth as well. That's the gap right now. BOE's been talking about it. They anticipate that to happen for 6 or 7 months. It just hasn't happened. It's surging, if anything. You talk about US services inflation at 2. In the UK, it's almost at 5. So in that context, I think they need to look at the structural aspect, so that outside the immediate issues surrounding September rate cut is what I'm looking for within the debate amongst the central bank governors at Jackson Hole as well.
You keep mentioning the UK, and it worries me. Do we really compare the US to the UK economy? I mean, is the US economy in that bad a shape?
No, certainly not in terms of stagflation, right? So we're talking about UK services inflation, more than twice the level of US. But these are two economies which are particular within the G10 as having far greater input in driving growth in consumption, in services. So I think that's where we just need to be a bit more attuned to the different dynamics and why that link between slower labour market growth and wage growth. Why has that link broken down? I really think that needs further exploration. And also, we need to run the risk of, or just face the risk that the central bankers might just say, wherever you are, well, services inflation, the supply issues, the structural issues in the labour market, demographics, again, a theme at Jackson Hole. It's just something that is not the central bank's role to really resolve. So how much is fiscal impulse, how much is fiscal spending feeding into services inflation as well from public services, globally, that is something to look at as well. So I actually worry that central banks, they look at their scenarios, the Fed, looking at their own scenarios and just say that a lot of inputs into inflation, just things we can't deal with, they need to lean back on the government.
Jeff, one of the parallels I've been thinking about lately is the UK used to be the dominant global economy, used to have the world reserve currency. That's obviously declined. How about the dollar? How much of a problem are debts or threats to the Fed independence or threats to other economic institutions in the U.S.? How much of an effect has that had on the dollar's spot at the top?
Right. So I'm glad you asked that question, Matt, because really it is a theme, especially since April, that it's something that's talked about but not really actioned upon. So the dollar has adjusted, but if anything, our custody data show euro was probably a bit too underheld, a bit overhedged in the first place and at the end of last year. So now that's adjusted. And if anything, the weakness in the dollar and the slight increase in various forms of term premia, inflation premia in the US Treasury market, that has actually attracted international investors to get back into the long end of the curve. If I look at short utilizations, are people really shorting the long end of the curve despite fears of stagflation and bear steepening? No, they are not. So I really don't think there is an alternative. Maybe along the edges, people will look for positive factors, positive reasons to move into other currencies. But again, that dollar diversification story, I really wouldn't overplay it right now.
Got it, Jeff. Great to get some time with you. Really appreciate it. Jeffrey Yu there of BNY. Let's get to some of the other top stories trending on the terminal this morning. China makes a thinly veiled jab at the U.S. for threatening world peace. Its assistant foreign minister told reporters that a certain country seeks to put its national interest above the interest of others. China will be hosting Russia's President Vladimir Putin, India's Modi, and Turkey's Erdogan at its biggest annual diplomatic event at the end of this month. And the Trump administration won't look to take stakes in chip makers like TSMC or Micron. Those two companies are slated to invest in the U.S., but unlike Intel, there's no talk of the U.S. taking any equity. Plus, postal services across the world are suspending parcel deliveries to the U.S. That's ahead of the Trump administration bringing an end to the de minimis tax exemption for lower value packages, which starts next week. That affects more than 4 million parcels which flow through the U.S. each day. Coming up, NVIDIA puts a halt on its production of H20 chips. More on that next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays. NVIDIA shares down in the pre-market trade. That's following reports from The Information that the chip maker has instructed suppliers to halt production of its H20 chips. The halt coming after Beijing reportedly asked its tech firms to avoid the company's quote, inferior AI processor. Of course, there are higher technology processors from that company. CEO Jensen Huang spoke to TVBS News in Taipei about the chips earlier today.
U.S. government, the Trump administration,
has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
For more, I'm joined by Bloomberg Intelligence senior analyst Robert Lee, and this is fascinating on many different levels, Robert. I know that, you know, we had previously, months ago, seen a directive from the Chinese government that that companies shouldn't be buying these chips because of energy consumption issues. I wonder, when Beijing makes those kind of orders, do companies in China listen?
Okay, well, maybe let's just briefly take a step back from these news headlines, etc., and try and understand quickly what the direction of travel is here. And I think there's plenty of evidence for all sorts of reasons, mainly strategic, that China is really gunning for and pushing to achieve technology self-sufficiency for a number of reasons. One of those is to drive so-called new productive forces within its economy, because it looks to the high-tech sector as a driver of future economic growth. But clearly, given these current geopolitical times, the relationship between China and America that once existed is under some strain, shall we say. And also from a Chinese perspective, the US has proved itself to be a somewhat unreliable and unpredictable partner. So no wonder China is doing everything in its power to achieve self-sufficiency. And obviously, given AI is at the core focus of where the technology sector is being developed at the moment, to be self-sufficient and to reduce its reliance on US suppliers such as NVIDIA is absolutely what it wants to achieve. So the national champion here, as you're probably aware, in China is Huawei. So there are, again, these unconfirmed reports in recent weeks that Chinese authorities are encouraging local AI companies to use Huawei chips. And then we've had this unconfirmed report emanating from the tech journal The Information that NVIDIA has signaled to some of its component suppliers to actually stop or to halt production. So again, allegedly, those companies are Samsung and Amkor, which put together related components to the H20. So I think it's been, the H20 saga continues, regardless of how this ends. I think China is going to continue to push to be self-sufficient in these core technologies for the reasons I've just explained.
Robert, I'm just wondering about the state of the command economy in China, because as it stands in the US, when the Trump administration tells corporate leaders to jump, they tend lately to ask how high. And I would imagine Beijing has even more power. However, back in March, when China's National Development Reform Commission advised companies not to buy H20 chips, or rather to buy maybe others instead, it doesn't seem like many of them took heed. So how strong is the power of Beijing to control what Chinese companies do?
Well, I suppose in terms of, from an industry perspective, I think even in this part of the world, people would give full admission to the fact that NVIDIA's technology at this point in time remains superior. NVIDIA's got a stranglehold on the global market, the supply of these AI accelerators, which are essential to run and develop AI applications and large language models. So really, until the last 18 months or so, there have been very few alternative providers. But the supply, locally supply, again, which is emanating from the likes of SMIC and Huawei, has risen up significantly, and therefore, given the geopolitical backdrop, it makes sense for local companies to focus on these local suppliers and reduce the uncertainty that comes from being reliant on suppliers coming out of the US.
All right, Robert, thanks so much for joining us. Bloomberg Intelligence senior analyst Robert Lee talking to us about NVIDIA. Let's stay with tech right now, because I want to give you a couple of stories that stand out on Meta. First, news that the tech giant signed a $10 billion cloud computing deal with Google. The deal marks the first major cloud computing deal between Meta and Google, and we'll see the Alphabet subsidiary paid over 6 years. Next, more poaching switching from Meta. Despite a reported AI restructuring and hiring freeze, the company has come back for another Apple executive. Bloomberg sources reveal that Frank Chu is going to join Meta's superintelligence lab. Chu becomes at least the 6th employee to swap Apple for Meta this year. Let's get a look at the Mag 7 stocks. This week, it's been a rough one for Mag 7 stocks, and that's why we've seen a lot of the drops. Here's a pre-market look at NVIDIA, down 1%. Meta, however, little changed, as is Apple, actually showing about a 3% gain to the upside there. Alphabet shares, after news of that Google deal, up 1.2% in the pre-market. Coming up, the Journal reports that Powell plans a U-turn at Jackson Hole. A look at what else is making headlines in your front page news. This is Bloomberg.
With the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number 2, because you could be number 2 in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own niche.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Time now for your front page news. First up on the Washington Post, the Trump administration's plan to vet all 55 million foreigners with U.S. visas. In an emailed statement, the State Department told the Post that it's looking to revoke visas for overstays, criminal activity, or any form of terrorist activity, which would be great. Next, the Financial Times reporting that Jefferies is telling senior bankers, if you want bigger bonuses, collaborate. According to the FT, Jefferies President Brian Friedman said that to managing directors in an off-site meeting, Jefferies didn't respond to our requests for comments. And the Wall Street Journal reports that Jerome Powell plans to make a U-turn on an economic strategy that has soured. The Fed is quietly scrapping an approach to monetary policy focused on the risks of near zero rates and low prices. The Fed chair is expected to lay out these changes today during his keynote speech at Jackson Hole at 10 a.m. New York time. We have special live coverage all morning right here on Bloomberg TV, and we'll bring you that speech live as well. Right now, we're looking at futures that are slightly higher on the S&P as the U.S. 10-year yield holds at 4.33. Coming up, we'll speak with Jack Caffrey of J.P. Morgan on the rotation in stocks.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Matt Miller in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Equity futures rising this morning, counter to the trend we've seen all week of red numbers. That's as markets await Fed Chair Powell's speech at the Jackson Hole Symposium. We'll bring it to you live at 10 a.m. And NVIDIA is said to have asked its suppliers to halt production on H20 chips because, well, the Chinese maybe just aren't buying enough of them. Let's take a look at what's going on in the markets. As I said, S&P futures up 0.2%. We've had down days every single day this week, but it's Friday. NASDAQ futures up a little bit less, 0.1%, as NVIDIA actually falls in the pre-market. And the small caps are gaining the most. Russell 2000 futures up 0.4%. For some of the individual stocks to watch, including NVIDIA, let's go to Valerie Titel in London. Valerie?
Yeah, let's start with NVIDIA right there in the red, falling over 1%. This is off the back of those reports from the information that they've halted production of their H20 chip, that chip that was specifically designed to comply with export controls for the Chinese market. We've also seen other chips or other chip-related stocks that are in NVIDIA's supply chain, such as TSMC, fall in the red in Asia trade. That stock was down 1.3%. Moving on to earnings, let's talk about Workday. They did come in a miss with earnings. And very interestingly, they agreed to acquire yet another AI company. They're acquiring Paradox to use AI tools in order to automate the hiring process for its customers. That stock is down 4% in the pre-market. Lastly, another AI theme perhaps here, Matt. Zoom Communications jumping 5% in the pre-market trade. They did come out with a beat when it came to their earnings and forecasted some pretty strong sales off the back of a new suite of AI tools that they have produced for their clients, one of those being an AI assistant. Matt?
All right, Valerie, thanks very much. Valerie Teitel there with a look at some of your individual movers this morning out of London. Let's get now back to Wyoming. Fed Chair Powell is set to deliver remarks at Jackson Hole at 10 a.m. Eastern. Joining us now is Bloomberg's Enda Curran. The Wall Street Journal out with an interesting take that he's going to ditch the Fed's framework. I guess they do a review. It's been 5 years since this new framework went into effect, in which they decided or agreed to let inflation run hot. But inflation's running hot right now, and we're expecting a cut in September. So what's the deal?
Well, two things going on, as you mentioned, Matt. That framework is up for review. Around 5 years ago, at that time of non-existent inflation, the Fed basically said, look, they can allow inflation to run over the target for a little while to make up for the period when there was no inflation. That was the thinking back then. It had its critics at the time, but nonetheless, looking back now, obviously, there's a debate among economists about whether that framework was the right approach given the inflation crisis that the US went through over the past few years. So that's up for debate now. One of the topics of the symposium is on this framework, so it's expected there'll be some guidance, perhaps, in terms of where the Fed will go on that next. Now, to be clear, not everyone thinks that's why inflation got out of control and why the Fed was seen as being behind the curve, but it's part of the mix, part of their deliberations, and they're expected to set new rules of the road, so to speak, for the years ahead.
I guess, the idea was at the time that they wanted an average over the long run of 2%. And since we'd been so far below, they would let it run hot so that it would hit that average. They have no choice but to throw that averaging idea out the window now, right? Because if they want it to average 2% over the long run, they need inflation to be zero for quite some time.
And that's exactly it, Matt, because circumstances are so different now to what they were back then. There's a view that this framework just isn't fit for purpose right now. And you look where inflation is, it's still well above target. We had that scare in the recent inflation data warning, hang on, forget about the tariff side of things. Look what's going on here with services prices. Hints of resurgence on that side of things. So inflation remains well above their target. The officials, this is why there's such a debate about can the Fed ease rates, can they cut borrowing costs in the months ahead or not, or risks stagflation. And in that context, then, that's where you bring in this framework. And I think there are skeptics who say, well, that really isn't setting the kind of rules of the road that we need right now. And by the way, this inflation, we're kind of also in a world where inflation remains both persistent and volatile. And given the backdrop of what's going on with world trade and everything else, that's not expected to end anytime soon. So I think it's seen as a case for debate around this Fed framework.
Do we expect potentially the Fed to just throw out the 2% target? I mean, as debt to GDP is 100% here and we need to inflate our way out of that, does the Fed just say 3% is cool with us, or at least signal that it is?
Well, that would be a big move. I'm not sure the Fed have given signals on the target per se, Matt, but obviously there is a raging debate going on. You often hear economists say, what's the difference between 3% and 2%? Why does the Fed need to get all the way down to 2%? You have the big debate going on at the moment about the depth of the slowdown in the economy with the labor market. Are things slower than we thought? Why isn't the Fed cutting? And of course, you have the political backdrop, which is significant pressure on the Fed both to cut rates for the economy and bring down, as you just mentioned there, inflate your way out of debt, bring down debt servicing costs. nonetheless, we are where we are, and that is the Fed has that 2% as its main target, and that's why they're so careful in sending such cautious signals about cutting policy in the months ahead, because their great concern is that if they cut too soon or by too much, you end up in a situation then whereby inflation takes off again at a time when the economy is slowing, and that's where you're getting into stagflation and the danger of policy error. So it's a tricky one for the Fed. They were too late on the way up, and now they don't want to be accused of being too late on the way down.
All right, Enda, thanks very much. Bloomberg's Enda Curran joining us out of Washington, D.C. Let's talk now with Jack Caffrey, Equity Portfolio Manager at J.P. Morgan Asset Management, joins us here on set at 731 Lexington Avenue. Jack, you know, we've had down days on the equity market every single session this week, although we're still hanging around all-time highs, right? 6,400 or thereabouts. What do you expect for this equity market in light of Jerome Powell's speech this morning?
Well, I think to some extent, unfortunately, we have to think that what we're going to hear is, you know, the quacking of a lame duck coming out at 10 o'clock. And we've been hearing we're going to replace, we're going to potentially get more openings on the board to change the composition. And so I do think to some extent you're going to hear about a policy that might have a relatively short half-life, not the 5 years that we've been talking about as a starting point. Second, inflation has become higher and more volatile. I think that makes it more challenging to think about what future earning streams wind up being worth. And ultimately, I think that has been, to some extent, a little bit of the challenge. But, you know, step back. Big picture, this has been ultimately a pretty good year, all things considered. Markets up, you know, almost 8% before we pulled back a touch. And so we've had a bad week in the context of a good year. Perfectly normal, I think, in the scheme of things, when all things considered. And we still get reminded that guidance remains a little bit more challenging as we've winding down the guidance season. We've had some pretty big companies come out and say our future remains a bit cloudy until we get a little bit more policy certainty in terms of what the consumer wind up paying over the next 3, 6, 9 months.
How does the consumer look to you? Because earnings have been really good, actually, much better than had been expected post-Liberation Day. You know, expectations continue to rise. But I'm looking at earnings growth, at least from the 474 companies that have reported so far, of 11%.
I almost think we need to rename it. It's not earnings season, it's guidance season. Because companies do such a fantastic job of rebasing expectations to what they think they can achieve. You can put out all the caveats you want, and so it's in no one's interest to deliver an unrealistic message and then miss it. The fact is, when we've looked at guidance, you've had, you know, some of the most important companies offer things are a little slower than we would have thought. We're not sure where things are going, and you go down 5, 6, 7% a day. I think as of last week, you know, the average stock was actually down 1% on earnings day. So to some extent, it's not what you did, it's what you can do. And the guidance remains a bit cloudy. And we can sit back and say, tariffs are not in the inflation. Well, the reality is that tariffs really just kicked in on the beginning of August. They're at much higher rates than anyone would have anticipated 6 months ago. We're just experiencing a relief shock, if you will, that they're not quite as bad as they sounded as though they might be in early April. But they're still on the come.
Well, one group of companies that has come away unscathed is the Mag 7. In terms of tariffs, for the most part, right, it doesn't make a difference. Google is still going to spend $80 billion in CapEx next year. Facebook is going to spend $100 billion in CapEx next year. Those numbers just keep coming higher and higher.
And that's why we've had sort of this two-tier market. If we wind up looking through, the Magnificent Seven earnings growth is 13% this year, accelerating to 17% next year on the back of effectively moving cash from balance sheet 1 to balance sheet 2 among the Magnificent Seven. Step away from the Mag 7, call it the forgotten 493. That's where you actually, I think, need that tariff policy. You need that fiscal policy to be a little bit clearer. Who's going to get what spending cuts will happen when, in terms of, you know, if you think about the healthcare industry, been a particularly volatile place. There you see earnings growth accelerating from 3% to, call it 13%. So actually the earnings acceleration into 26 is much stronger away from the Magnificent Seven, even though the scale of the billions we're spending is almost unimaginable a few years ago. It's kind of reminiscent of some other industries, whether it was the build out of fiber in 2000, 2001, or if you will, even the fracking industry, where, you know, fracking was going to forever set us free to infinite supply of oil. Sometimes those investment surges don't quite work out as cleanly. They work out great for one or two people, but the 5 or 6 others who are competing find themselves saying, was it all worth it?
Are there industry groups, Jack, that you think stand out aside from, you know, tech and communication services?
Well, I think there are 2 interesting places to be looking right now. I'm more of a value investor, so I'm going to naturally try to gravitate to things that people are not as frequently talking about. What I'll come back to is utilities. You know, here's a group trading about 80% of the broad market multiple, and to some extent, you know, when we think about artificial intelligence, there are seemingly 2 gating factors. You know, access to an NVIDIA chip. That's what everyone wants to talk about. And then there's the power to actually turn those chips on. I think that's where things get interesting because it's probably the first time in a long time that people have talked about utilities as growth stocks. Second, that growth is actually not being set necessarily on the basis of wild ambitions, but instead, I want a contract from my buyer and then working with the regulators to make sure that I have a balance sheet that earns an adequate return on that capital that we're about to spend to actually make sure investors get paid something for having put up the money, whether that's credit investors or equity investors. So add that with a 2.5% dividend yield against a longer-term forecast of 7% equity returns. It's kind of an interesting place to start.
Where else do you find value? We were talking to Howard Marks the other day, and he said, you know, things are looking seriously frothy. So maybe he doesn't see it yet.
Yep.
But
well, I think historically, what's been our biggest source of inflation in the West? It's been energy prices. Energy is to some extent being abandoned, and yet it seems like the world's energy markets are actually providing the stimulus to the consumer right now in the form of lower prices at the pump. I think the stocks, again, you're trading 75% of a market multiple, 3.5% dividend yields, so you actually get paid something to be somewhat patient when you look at energy. And ultimately, in the world we still live in, oil does make the world go round. I do think you have to take a somewhat longer-term horizon, but in that view, I think it makes both an interesting hedge against a world where inflation might run hotter and be a little bit more variable. Second, managements are not drill baby drilling. You've seen the rig count go from 589 in the U.S. to 539 over the past, call it 7 months. So to some extent, you know, lower prices are potentially curing lower prices. And with a 3.5% dividend, you are incentivized to be a little bit patient. And that higher energy in the future, particularly from natural gas, is again making its way into higher utility bills that are potentially, you know, a bit of an offset against, you know, the pump relief. But you pay the gas tax effectively weekly when you fill up your car. You don't perhaps notice what the gas surcharge that's running through your utility bill is because it's buried with 8 other lines.
it's amazing, you know, I would expect energy to already have soared due to the demands of data centers. But when I look at the S&P 500 and break it down into industry groups with my GRR function on the Bloomberg, year to date, it's just done nothing yet. Yet, maybe the key word.
Well, I mean, ultimately, energy is a sector when you get it right. You're up 40, 50%, as you were in, say, 2022, when everything was going down. And when you become effectively a 2% sector, you know, you can effectively double, and wow, you become 3% of the S&P. But I think that's where, you know, to borrow from an idea from Howard Marks, to do better than your peers, you can't look like your peers. And so ultimately, you have to find yourself asking yourself, where can I find an interesting idea people don't want to talk about because it's unfashionable, it's old economy, but where management's doing the right thing, they're giving you a reason to be patient with them, and you effectively wind up getting exposure to protecting yourself from what normally goes wrong in a growth-dominated market.
All right, Jack, great taking some time with you. Thanks so much for coming and joining us. Jack Caffrey there from JP Morgan. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think, could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
NVIDIA has instructed its suppliers, including Samsung and Amkor, to stop production of its H20 chips, this according to the information. The halt comes after Beijing reportedly asked local tech firms again to avoid NVIDIA's AI processor. Shares are down by more than 1% in pre-market trading, and of course it's a huge stock, so it's important to watch. Take a listen to CEO Jensen Huang speaking to TVBS News in Taipei about the chips earlier today.
U.S. government, the Trump administration has approved the licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
For more, Valerie Teitel is back with us. And Valerie, this is interesting because he is implying, or this report is saying, that the Chinese are again advising local firms not to buy the H20 chips. They already did that in March. Is it finally happening?
Well, look, the one thing that's really the key to focus in here on what is really China's aim in doing this. Yes, they have warned local firms repeatedly recently not to use the H20 chip, warning of security concerns. But this could also really be seen somewhat as a power play maybe by the Chinese government because they want, frankly, better chips. The H20 chip is a chip that's essentially not as good as NVIDIA's top-tier Blackwell chip. And perhaps this is a message from the Chinese government that they want export controls lifted, especially when it comes to their more sophisticated processor, that Blackwell chip. That was something that President Trump kind of teased a few weeks ago in the Oval Office, saying that the CEO, Jensen Huang, wanted to come see him about a better chip for the Chinese market. But big questions really on, is this already impacting demand for NVIDIA? Remember, it was just a few weeks ago that NVIDIA even got these export licenses back on track for the H20 chip after the U.S. government suspended those export licenses back in April. We've seen the likes of NVIDIA trade lower in the pre-market. We also had one of their key elements in their supply chain, TSMC, trade lower as well over in Asia.
All right, Valerie, thanks very much. Valerie Teitel there talking to us about NVIDIA, and it is trading down, as she mentioned, in the pre-market. That's a more than $4 trillion stock and does tend to weigh on the S&P, although S&P futures are up. NASDAQ futures not quite as much. Let's get over to Washington, D.C. An official telling Bloomberg that the Trump administration will not seek equity stakes in chip makers such as Micron and TSMC. If you were waiting for that, because those chip makers are boosting their investments in the U.S. Maeve Sheehy of Bloomberg Government joins us now from Washington. Maeve, to me, it would seem like NINSS, right? Because this administration is going to want to invest in, take equity stakes in American companies.
Yeah, the administration has been very clear that they want to take equity stake in companies like, for example, Intel. That's been the big one recently. But these bigger companies that are kind of putting their operations in the U.S., increasing their U.S. investments, the Trump administration does not appear to be interested in equity right now, which is really interesting. There's been this kind of debate between free market Republicans who are saying that the U.S. government should not be taking equity in private industry. So it's a really interesting debate that's playing out here.
Yeah, that is fascinating that there are still free market Republicans. You're in Washington, D.C. That must be an incredibly rare breed in this protectionist party.
Yeah, you are seeing a more protectionist lean in the party, but you're also seeing there are still some traditional free market conservatives, especially in Congress. You have people who were elected, decades ago at this point and are kind of clashing with the more isolationist wing of the party. And you're seeing that in, economic issues. You're also seeing it in foreign policy.
The argument is that this is really a national security move more than, a centralized economy move. Is that winning over people in Washington? Because obviously if we were to go into a wartime footing, we would want to have our own suppliers of chips.
Yeah, so I'll start with the caveat that it is August, so lawmakers are on recess, and we're not hearing as much from them as we would normally. It does appear that the Trump administration is generally winning over Republicans with trade issues and economic issues like this one. And with specifically the Intel deal, you hear the Trump administration saying that basically the Biden administration was giving away grants for free with the CHIPS and Science Act, which was President Joe Biden's one of his big signature legislative accomplishments. So you are seeing the Trump administration use that argument to say, they've given this money away, but they want to have some equity in exchange.
All right, Maeve, thanks very much. Maeve Sheehy there of Bloomberg Government, coming to us out of Washington, D.C., where free market capitalists are surely a dying breed. Coming up, we're going to get you set up for your trading day with everything you need to know. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
This is Bloomberg Brief. I'm Matt Miller in for Danny Berger here in New York City. Let's take a look at what's ahead over at Jackson Hole. Boston Fed President Susan Collins will be joining Bloomberg Television at 9 a.m. Eastern. We have a special event planned for Jackson Hole coverage. Tom Keene will be joining you along with Lisa Abramowitz. At 10 o'clock, it's the main event. Fed Chair Jay Powell will make his remarks to the Wall Street Journal saying that he's going to announce a change in the Fed's framework. They no longer need to let inflation run hot, even though inflation is running hot. That's followed by former Fed Vice Chair Richard Clarida at 10:15. A friend of Bloomberg Television. You'll want to watch that for sure. And then in terms of the market today, get ready for NVIDIA to pull down the indexes. The information reports the chip maker is halting production of its China-specific H20 chips. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest.
Every trading day.
Only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Aqua in Sintra, Portugal, and this is Bloomberg.
Powell talks at all about cutting rates, it's going to be sort of incremental steps ahead.
He will probably put a lot of focus on the importance of preserving price stability.
Very much unlike last year when Powell made it clear that a cut was coming. He's going to keep his options open.
There is a decent economic argument. This isn't really about political interference at all. Powell will be cautious.
Jay Powell, in terms of his legacy, is looking at what happens to his mandate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, following 5 days with no gains, investors looking ahead to Fed Chair Jay Powell's big speech as a divided committee is getting together in Jackson Hole, Wyoming. Political pressure continues to build before the Fed's September meeting. The White House wants...
But no one on the Fed, at least those we've heard from in the past week, is ready to solidify those cuts. John, we heard from Hammock saying that she doesn't see the case for a cut given the current data. Schmid, we don't have definite data to be moving policy rates right now. Goolsbee, he come down. More and more we hear from, it sounds like those two dissenters are still just that, the outliers.
Isn't that amazing, Danny? I've noticed the same thing in the last 24 hours. It struck me too. Post-payrolls, things have changed so much for investors. Post-payrolls, things appear to have changed very little for Fed officials.
And it seems like maybe they've changed very little for Powell, too. We got a sneak peek from a Nick Timrose story in the Wall Street Journal of the framework he plans to show. It's very technical, but the takeaway I had from it was they want to be more flexible on employment and more rigid on inflation. The net sum of that seems to be more hawkish, but is this a market that's ready for a very marginally more hawkish Powell?
We've seen it on repeat from the South Side over the past few weeks. Chairman Powell is not going to lock it in. He's not going to commit to a rate cut in September. We're putting a lot of weight on the next two big prints for economic data in this country, CPI and payrolls.
And I think if Powell wants to sound more hawkish, he could do just that, right? He could say we are data dependent, we have those two pieces of key data coming in, and we're not pre-committing to anything. The issue with that, John, is if that is interpreted very hawkish, you get a sell-off in this market and stocks in the front end. What's the reaction from the White House?
Well, let's talk about the reaction from the longer end of the curve as well. I want to talk about things globally, not just stateside. This is worldwide. 30-year bond yields in America getting closer and closer to 5%. Up a basis point this morning, 4.93. In Japan, 30-year yields, record highs. In the UK, early this week, the highest since 1998. Just starting to bleed. That leakage at the long end of the curve continues.
And I think it's important to note that we will be hearing from UATA and other central bankers at Jackson Hole. So while Powell is the most important, it will be interesting to hear what they say too. And it presents this problem. Even if you want to cut to unlock the housing market, for example, how do you do that when longer end yields continue to creep higher? And it is a global problem of fiscal positions being unsustainable and growing debts.
We've got a lot to get through this morning. It's 4 hours away. Chairman Powell in Jackson Hole. Equity futures into that positive by 0.2% on the S&P. Coming up this hour, Marvin Lowe of State Street ahead of Chair Powell's remarks. Alex Norrister of the Cato Institute as NVIDIA looks to hold H20 chip production. And Sucharita Kadali of Forrester following Walmart's profit miss. We begin this hour with a divided Fed coming together in Jackson Hole.
I think they're modestly restrictive. I think we're on a good path.
I'm just open to the possibilities. Now, what that means, though, is that precisions and forecasts are going to be very hard.
Once the labor market stumbles, it falls. And it falls quickly, and it falls hard. I think we'll likely need to adjust the policy rate sometime in the coming months.
It looks like a market a healthy labor market that's still well in balance, but with some, disappointing signs.
It feels to me like it's a live meeting.
So here's the view on Wall Street this morning. Marvin Lowe of State Street writing the following. We are finally here, and the initial enthusiasm that Powell was going to signal imminent rate cuts in September has tempered. Marvin joins us now for more. Marvin, welcome to the program, sir. What can we expect a little bit later this morning?
I think the chair is going to be ready to acknowledge that they're about to talk about cuts. It probably won't be more than that. If we kind of look at where their expectations have been all year, they were saying that 2 cuts were appropriate. Really starting to talk about it in the fall is where we are at this point, and we're not going to get much more than that in terms of specificity with regard to September being something that they're going to make the start of the cutting cycle. They're just not there yet.
Marvin, there's this really odd disconnect that Danny and I have been talking about over the past few days. Most people expect a rate cut in September. Very few expect him to lock it in later on this morning. So, Marvin, just how high is the bar for the chairman to surprise hawkishly this morning?
I think it's pretty high. Remember, Jonathan, at one point this year, we were saying they were going to cut in July. So the markets are always inclined to hopefully get those rate cuts because they really do support a lot of other parts of the markets, particularly with valuations where they are. But ultimately, the way we've been looking at it for a while is that the data is not there, and the uncertainty around trade and its impact on prices is still making its way through the system. And we've heard a lot of the Fed remain consistent in that type of approach.
It's remarkable, though, that, Marvin, you can have a market that's still pricing in as high of odds as it is for a cut, despite the Fed speak, despite PMIs yesterday, the highest since December of 2014, and then you also, 2024 rather, and then you also have the commentary there saying that what they saw in the PMI data would be suggestive of a hike, not a cut. Marvin, why is this market so stubborn to price out some of the cuts it has?
Yeah, I mean, it's not as if the data is overwhelmingly strong. It's not as if we've got an across-the-board reacceleration that we have to be concerned with. Certainly the employment data is important. I don't want to discount it, but it was one print, and really the focus of the labor market as one of the the key topics for this Jackson Hole shows that there are potentially changes that are concerning the Fed with regard to the labor market. Given that the economy is still holding in there, if you will, and it does feel as if the balance of risk is pretty balanced at this point, waiting to see if those concerns, continue to dog the economy is an appropriate approach. In terms of the pricing, we really have gone from talking about the potential of 50 basis points a little over a week ago to one where we're getting to even odds for September, which is kind of where I think we should go into this meeting.
Does that mean that this market maybe is less susceptible, or is it a fragile market heading into today's speech with 5 straight days of losses and just low volumes of August?
Yeah, I mean, I think valuations are key to this. I think August is key to this. I think when we talk about a Fed that can be patient, there's also a positive economic story associated with that to a certain degree. If we were really seeing, jobs weakness, it would signal something significantly worse. So our view and the view from a lot of the investors that we talk to is that they're willing to just wait and see how things evolve because there is no imminent economic cliff that a lot of people see.
Marvin, can we get to the story at the long end of the yield curve worldwide? 30-year bond yields in America, very sticky, very close to 5%. If you look abroad, Japanese yields on that maturity, the highest on record. In the UK, earlier this week, the highest since 1998. Marvin, how disconnected, unanchored is the story at the long end from the debate at the front end?
You know what? I think that's been really one of the most interesting developments over the course of this year. You and I, Jonathan and Danny, we've talked about the shape of the curve a lot over the last several quarters, and it really does show that there are structural changes that are occurring with regard to either debt, demand for debt, and really kind of those inflation dynamics, which continues to really dog the story. So they're all interrelated from a fairly closely tied perspective, but there's so much being put on the fact that lower short yields will actually result in a much cheaper funding environment. And I've been pushing back against that for quite some time.
So Marvin, breathe some life into that debate right now. What are you saying when you push back? What are you saying to people?
You know what? I've said it before, so I guess I'm not gonna risk saying something that's out of the blue. But a 10%, a 5% 10-year for the U.S. is something that, in my mind, is a scenario that's not out of the realm of possibility. And then if we kind of pull that through the housing market, if we pull that through global rate curves, if we pull that through overall steepness within the curve with the Fed cutting, it really does kind of change an economic environment that we haven't seen for decades.
Well, Marvin, just given that we are in a debt scenario, a deficit scenario that looks like wartime footing, is this a market, and really is it an economy that will just need to be run hot to have GDP move up high enough to have that nominal GDP in order to combat the rising deficits? Is that what this market is pricing in, and maybe what the economy needs?
I mean, that's a great question, Danny, for sure, because part of this average inflation targeting, part of this change in framework also potentially has some neutral rate implications to it, and we've been slowly creeping up on that neutral rate. The economy itself is so large and somewhat mature that we can't really run it that hot, but it can certainly run hotter than what we experienced before the pandemic. And I think with wages, with kind of some of this inflation number that's coming out, it's going to be a natural outcome from it.
Well, just looking at what the market is pricing for the end of 2026, if we can even go that far, Fed Fund futures for December 2026, 3.1%. Inflation swaps for December of 2026, 3.3%, Marvin. Those would seem to stand in opposition of each other, and surely one of them can't be right. So which is it?
Yeah, exactly. I mean, so market pricing is for this year, we make so much about, these basis points change in September and December. And all of a sudden we're going into Jackson Hole. It looks exactly what the Fed pricing is at this point, 3% at the end. 2 more cuts before the end of this year. But as we go into 2026, the market's, again, much more aggressive around that view. I think that the market is overly sanguine about where this neutral rate is going to settle and whether or not we're going to be in a position to get to that neutral rate by the end of next year.
Marvin, just before you go, I wonder if we're all tracking the wrong thing. If you track the politics, I think this makes sense. The White House at the moment wants lower rates. That's the debate at the front end of the curve. They might well be upset when they find out that lower rates could lead to higher rates at the long end, and not given that loosening in the mortgage market that they are ultimately looking for. For very political reasons, because ultimately that's a big debate in this country right now, politically, particularly here in this city. And I just wonder if we're all underestimating the prospect of a new Fed chair getting aggressive with the balance sheet and not just on interest rates.
Oh, my goodness. This is something that I've been thinking about for quite some time, particularly given kind of, if you will, this Mar-a-Lago report that has been out there and the fact that Treasury is really focusing more on the short end. I do think that if we're worried about independence, if we're worried about really policy not necessarily set up to allow the country to really perform with that dual mandate in always kind of driving them, it's one where balance sheet policy becomes one of the discussions. And if it becomes politicized and it becomes weaponized, it will ultimately still result in an environment where investors are not as concerned or not as comfortable really with how the rates market is going to respond. And you do still wind up with a lot of pressure at the long end of the curve.
Marvin Lowe, appreciate your time, sir. As always, Marvin Lowe of State Street. Let's just play this out. A lot of what ifs, forgive me, but let's just play this out. They drop interest rates, and let's say Marvin's right, and yields rise at the long end, and the White House starts to complain. What do you think the White House is going to want from an incoming Fed chair in that scenario?
Right, you get some form of yield curve control maybe. You get changes to the balance sheet, to your point. But it's this question of independence. But if you didn't have a White House and a Fed that somewhat work together, we've seen so many scenarios. I think the UK is really relevant in this case, where they're working almost in opposition to each other. So if you're cutting rates and the idea is to unlock the economy and you're having the long end go up, you kind of have to do something, right? Because it's having the opposite effect of what you want. So the cries might be that's a threat to independence, but what if the question becomes, is this necessary for the economy?
So well framed. Right now, 30-year bond yields at about 492.85, yields higher at the long end worldwide over the past few weeks. Let's give you an update on stories elsewhere this morning. It's not just about the Federal Reserve. With your Bloomberg brief, here's Yahira Anand. Hey, Yahira.
Exactly, John. We are seeing NVIDIA shares falling nearly 1% in the pre-market on reporting by the information that the company has asked suppliers to halt production of its China-focused AI chip, the H20. This comes after our reporting that Beijing urged local companies to avoid using the chip. This raising questions about the demand for the H20, which competes with similar products from China's Huawei. Meanwhile, 50% punitive tariffs on imports from India will kick in as planned next week. This as White House Trade Advisor Peter Navarro says India is cozying up to China and that its purchasing of Russian oil is helping fund Moscow's war in Ukraine. Indian officials are said to be perplexed by the U.S. criticism. And Zoom shares are surging more than 5% in the pre-market after it gave a stronger than expected sales growth outlook and raised its fiscal year forecast. Its revenue boosted by its new paid AI features and its expanded line of software products. I'll have more on that stock in your movers. That's your Bloomberg Brief. John?
Looking forward to it, Yahara. Thank you. More from Yahara later this hour. Up next on the program, China's chip crackdown.
China asked some questions about some security backdoors in our chips. We have made very clear H20 has no security backdoors.
That conversation up next with Alex Norrister of the Cato Institute. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the main event later on this morning, 10 a.m. Eastern Time in Jackson Hole, Wyoming. A speech from the Federal Reserve Chair, Jay Powell. The market waiting for that one, heading into it 5 days without gains on the S&P 500. Equity futures attempted to bounce higher by 0.2% on the S&P, on the NASDAQ by 0.2. Under surveillance this morning, China's chip crackdown.
The Trump administration has approved licenses for us to export H20s to China. Recently, China asked some questions about some security backdoors in our chips. We have made very clear and put to rest that H20 has no security backdoors.
So here's the latest this morning. The information reporting NVIDIA has instructed component suppliers to stop production related to the H20 chip. The order's reportedly coming after Beijing urged local companies to avoid using it.
Now, Trump's reversal, I have to say to start, had really ignited a buying spree of H20 chips. So for one, I wonder how many companies in China have front-run this or if what they've already bought is being held up. But on a whole picture, it does seem like it is a serious effort from the Chinese government to try to promote some of their homegrown chip makers and to try to have that independence. But it's interesting because Alibaba and the other tech companies had been saying to the government, we need those H20 chips, that we're actually going to lose out on tech supremacy if we don't have them, because without NVIDIA's chips, we fall behind.
I don't like where this is all going. Can you imagine what's going to happen to Intel if the government takes an equity stake in them of, say, 10%, and they've got 30% of their revenue coming out of China? What does everyone think is going to happen to the Chinese revenue if this is the pushback NVIDIA's getting at the moment?
Okay, but the other option, though, is that China is just bargaining for more higher-powered chips. There was a report from Reuters that NVIDIA was starting to work on a different kind of chip that they could sell into China that was better than the H20s. So maybe in some way, this is actually China saying, stop the H20s, we want something better.
We're negotiating through some of the biggest companies on the planet. NVIDIA right now, negative by about 1%. Let's have that conversation with Alex Norrister of the Cato Institute. Alex, intervention has consequences. Does it have unintended consequences?
It absolutely does. The long-term problems and even the short-term problems of the government trying to take these equity stakes in some of the most productive and innovative companies in the world is disastrous. And investors and firms are going to look at this and they're going to start to make investment decisions based on what makes politicians happy and on what favors they think they can make, rather than the profitability of these investments, which will eventually undermine a lot of the productivity gains that we get from these firms. I mean, we saw this back in the financial crisis, where the government took stakes in companies, temporary stakes, big bailouts in companies and auto companies, and then made investment decisions for them. This was not good for the auto industry. It wasn't good for the United States. And I fear that the effect of doing this with some of the most advanced chip makers in the world will be even more destructive.
Let's work through this, Alex. So let's say GFC was about distressed assets connected to the employment of thousands upon thousands of people in this country. The government felt like it had a role to play. Let's talk about this one. It feels unique. Here's the situation. The government doesn't believe that the free-handed market is going to allow them to build out domestic foundry capacity, and they need to for national security purposes. What is the free market solution to making that happen?
Well, I think the major free market solution for a lot of this is if the government thinks that it needs to have certain components in order to fight a war at some point, stockpiling is a good way to do that. Relying on exports from a lot of our allies is a good way to do this. I mean, if that was really the justification, the United States government would not be putting tariffs on other countries that are our allies. We would be increasing trade flows with these countries and away from the potential adversaries. So the Trump administration is trying to have every side of every argument in this debate over trade and chips and equity stakes in these companies, but these arguments are all contradicting each other, contradicting themselves, and as a result, a lot of investors and a lot of these companies, they don't know which way to turn. They don't know what types of investments to make, and they don't know what the administration or the next administration is going to do on this. It is not a stable environment.
To that point, Alex, often building up these types of things take longer than 4 years. It will take longer than this presidential cycle. Is it your estimation then that companies won't commit? We've already gotten a lot of investment promises from a variety of tech companies. Do those get followed through if there is this concern of what happens after 4 years?
The history of industrial policy in the U.S. and handing out subsidies for firms that do this is that oftentimes firms up front will say, yes, I'll do this, and then they pull back their investments. We saw this with Foxconn in places like Wisconsin and other states in the Midwest. We've seen it with companies throughout the country, basically, going back a long periods of time, that they will make a politically favorable judgment to make the current politicians look good, and then they'll pull back when they notice that they can't make the economics work. They can't make the investment profitable. And ultimately, that's probably a better situation than them investing tens of billions of dollars in projects that won't ultimately work. Listen, companies know what they're doing. They understand the rent-seeking environment that they're in. They understand this administration pretty well, and they are just trying to run it out without doing too much damage to themselves, to their investors, and to their share price.
They understand what the U.S. is doing. Alex, to what degree do companies understand and are able to navigate what China is doing? With AMD, NVIDIA, the latest being that China seemingly pushing back on allowing companies to buy H20 chips. How does an NVIDIA navigate that?
I mean, that right there is a, the $1 trillion question. The Chinese government has long been inscrutable to a lot of investors around the world. The Trump administration's decisions seem crazy to a lot of them, so they're really stuck between a rock and a hard place in terms of the investments that they want to make. But I mean, it's just going to be very, very difficult for them to navigate this. I mean, we have a budding geopolitical conflict between China and the United States that a lot of people try to compare it to the Cold War, but it is radically different because there are enormous and valuable trade flows between these companies. Chinese companies, Chinese firms, the Chinese government has long demanded payments of intellectual property from American companies to be able to operate in their markets. I think we're going to see a diversification where the Chinese government is going to continue to nickel and dime American firms and demand bigger and bigger concessions, just like the U.S. government is demanding from American firms in the form of equity stakes. So basically, the big loser in all this geopolitical conflict is going to be some of the most innovative American companies in the world, no matter which government is doing the pressure.
Alex, appreciate your time and your take. Thank you, sir. Alex Norrister at the Cato Institute. It's getting harder and harder to have a foot in each market, in China, in the US. In the president's first term, it was Apple and Tim Cook. In his second term, it's NVIDIA and Jensen Huang.
Jensen Huang had really appealed to the president and tried to become almost a politician, like we've seen from others, saying that we need to be selling into China or else American tech is going to miss out. It almost seems like that conversation has been well received because they are allowing it to do them. Maybe the other side of that coin wasn't thought about, what China's willingness would be.
They're getting some pushback. The stock is down by about 1% in the pre-market. Up next, we'll catch up with Sucharita Kodali of Forrester, wrapping up a massive week of retail earnings, plus Yahira with your morning movers. Zoom shares rallying by 5%.
Said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks, but that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
5-day losing streak on the S&P 500, the longest since the start of the year. Let's see if we can bounce up by 0.25% on the S&P, up by 0.2 on the Nasdaq. Some outperformance on the Russell, the small caps up by 0.5. In the bond market, 2-year, 10-year, 30-year bond yields, tension all over the place between 2s and 30s. I want to talk about the tension at the front end of the curve. We're looking for rate cuts from the Federal Reserve, 378.92. Yields just about unchanged this morning, but the data in the past 24 hours was okay. Claims wasn't terrible. PMIs were actually pretty decent, and some people have got a sneaky feeling that maybe the data and this economy starts to pick up in the months to come.
Well, the data in the PMIs was so decent that the commentary from the S&P said that the kind of data coming in would be more suggestive of a rate hike versus a rate cut, and that prices were picking up, and they were starting to pass it along to consumers. Maybe you take that along with what we heard from Walmart yesterday, saying that for now, they're able to keep prices lower than inflation, but it's picking up every single week. And I think that's why Powell's speech, maybe he doesn't want to commit to a cut.
Things are super finely balanced going into September. Post-Labor Day, we've got some payrolls for you. And then we've got CPI, September 17th, that Fed meeting. 3 hours until the opening bell. Should we get you some morning movers? Let's do that. Joining us now is Yahara. Hey, Yahara.
Hi, John. Yes, let's do that. We start on NVIDIA, heading for a 4th straight day of losses. Shares are down 1%. This time on a report by the information that the company, as we've been talking about all morning, has instructed suppliers to stop production of its China-focused AI chip, the H20, as Beijing continues to clamp down. But Wall Street is not blinking. Analysts keep lifting their price target ahead of the company's earnings next week on Wednesday. We're reporting that at least 9 have lifted their price target so far. Meanwhile, we have Workday shares also falling down 4% as the HR software maker's guidance disappointed, fueling concerns among the analyst community that AI could kill off legacy software players like Workday. It did acquire an AI-focused recruiting firm. This is its 2nd AI-related acquisition this year, but that has not been enough to assuage concerns, as we can see. But a company that is seeing some AI-fueled gains is Zoom. Shares are up 5% after the video conferencing company raised its full-year revenue and profit outlook. As analysts say that the company's AI features are actually helping other businesses automate tasks. So even after the post-pandemic slowdown, customers are still relying on Zoom, and on top of that, people are still working from home. John?
It's true. Not us, but it's true. People are working from home. Yahara, thank you. Appreciate it. I'm not complaining. I love it. Don't you love being in the studio?
Yeah, I love being in the studio. Also, I think Zoom is overused. We should be calling each other or meeting in person. I'm over Zoom.
Totally agree.
I'm over it.
Totally agree. I hated using Zoom. Still hate using Zoom.
Yeah.
Try and avoid Zoom meetings all the time.
Yeah, and it's like what background you use, do you blur it out, what angles it's too much. Obviously I like the setup where someone else knows where the camera should be for me and I don't think about it.
There you go, perfect. It's your job, but not ours. You do a great job of it, by the way, John. Thank you, sir. On our radar this morning, thank you. Divisions growing within the Federal Reserve ahead of Fed Chair Jay Powell's final speech from Jackson Hole. The Fed facing a September rate cut decision with officials weighing inflation and labor market risks. Amazing to me that we all said the minutes were dated from the Federal Reserve. They don't look so dated. Listen to officials over the past 24 hours.
I was going to say, Hammock doesn't see the case for a September rate cut. Schmid saying we don't have definitive data to be moving right now. Goolsbee saying the meeting is live, implying he wants to see where services inflation comes in. But maybe the market isn't moving until they hear from the man himself, and that's Jay Powell. But considering he's been siding more on the line of the hawks, why would he really do anything except say we are data dependent and then get into the weeds of what the framework for monetary policy will look like?
That speech coming at 10 a.m. Eastern Time. Just for the record, our director's also called John. That wasn't me speaking to myself, all right? Just to clean that up.
Good clarification.
Let's turn to NVIDIA. Shares lower this morning. The information reporting the company has asked suppliers to stop production related to the H20 chip. This comes after Beijing urged local companies to avoid using the hardware. The stock this morning's down by about 1%. The earnings are next week. And in many ways, the earnings is only going to be a small piece of the bigger story. The politics of all of this has become so interesting over the past few weeks.
More interesting and more complicated. How do you navigate something like this, where you appeal to the White House and say, our technology is important to preserve. In order to preserve that, you need China to be buying and not making their own homegrown technology. And then you get reports, for example, like Howard Lutnick speaking about this idea that they want to get China addicted to U.S. technology. Kind of a variation, let's be honest, on what Huang said, but then the Chinese hearing that and it upsetting them. How do you play between these two sides? It seems like NVIDIA is really stuck. Is it making new chips that they can sell into China? Will the U.S. allow that? So many different things. I don't even know how you would begin to scratch the surface of that on an earnings call next week.
Worth pointing out that the analyst community is still super bullish and constructive on this name. I think in the past week, the team were putting the numbers together. At least 9 upgrades to price targets on this stock over the past week, going into results next week.
Well, it won't surprise you at all that Dan Ives is still incredibly bullish. I was just reading his note this morning, basically saying the politics of the moment isn't the most important thing. It's the fact we're going through an AI revolution, as he likes to say, and NVIDIA is at the heart and center of it. Yes, it is, but what happens if a Huawei can also be at the center of it? What happens if China becomes less reliant with 15% of the revenue? That hurts with a stock that's as richly priced as NVIDIA is.
NVIDIA's had some shaky moments over the last week or so. We're down by 1% so far in pre-market trading. A final story here. National Mail Services are pausing parcel deliveries to the US as the de minimis exemption comes to an end. Starting next week, low-value packages mailed from other countries will be subject to tariffs and compliance with customs and border protection rules.
It just speaks to the messiness of trying to figure out where we stand with tariffs. I thought Finland's mail service was interesting, saying that customs need to be paid before we can be shipping to the U.S., but we literally have no idea how to pay those customs. It kind of echoes with what happened with gold a couple weeks back, where there was a lot of confusion. Is gold being tariffed? So a lot of refiners just stopped shipping it to the U.S. So it's not just the cost of tariffs, it's the cost of compliance and the confusion and the clogging of supply chains as you figure it out, and it especially gets more important as we move into the autumn and winter months when buying really picks up heading into the holidays.
We've introduced a lot of friction into the system over the past few weeks, and it's going to take a number of months to figure that out. Let's stay on trade and talk about retail. Walmart shares retracing earlier losses after the company reported a miss on profit for the first time in 3 years. Sucharita Gedalia Forrester writing, the next few weeks of other retail sales numbers will be telling. The street certainly is not optimistic about the consumer, given that the stock declined even though revenue growth was strong for this company. Sucharita joins us now for more. Sucharita, welcome to the program. Danny talked about it. The commentary coming from Walmart in the last 24 hours. Tariff costs are going up every single week. What are the mitigation strategies that they've introduced, and others too, that they've implemented that are allowing them not to pass that on to the end consumer?
Well, I think that certainly some consumers, particularly at the low end, absolutely think that the price increases are being passed on to them, and they've been seeing that over the last year to 2 years. But overall, I think that what has been happening is that Walmart has tremendous influence and purchasing power with its suppliers. So it can definitely force the suppliers and other companies further downstream to absorb some of that. So in a basket of goods that may be $100, you are going to see probably 20 or more suppliers being able to absorb different parts of that price increase. And it's either not as visible to Walmart or it's not going to be quite as visible to consumers, depending on what the basket of goods is that you're purchasing in the first place.
Well, Walmart is maybe unique in that manner, Sucharita, but just given how big of a presence it is in retail, what does that do to other retailers who maybe don't have that benefit? What does it do to other behemoths like Amazon? Is this a race just to see who can keep up with Walmart in keeping prices lower?
Right. Well, what we have seen over the last several years, and this is a story not just with Walmart, but also Amazon, is that they've been gaining share at the expense of most other retail sectors. So that's absolutely what happens in that environment. But what we're also seeing now at an individual retailer level is that there is a little bit of a rebound with certain sectors. We saw this in the monthly retail sales numbers the other week, where you're seeing rebound in do-it-yourself and home goods. You're seeing a little bit of a rebound in apparel. Now, these are all relative because we had declines in those sectors over the last several years. So they're just kind of catching up to where they were. But in the near term, they're holding their own, and it speaks to the fact that in spite of some of these claims and these worries that inflation is going to really, really hurt the consumer, we're still seeing consumers in the aggregate purchasing.
Sucharita, away from prices as much as you could possibly not think about those with Walmart, they also had a lot of commentary around their AI features, different agents that they're unveiling for different parts of the supply chain and to consumers. This also comes off the back of that report from MIT that 95% of companies using generative AI are having a zero return on investment. What is the AI use case for Walmart? Are they seeing a return on investment on the types of AI that they're trying to implement?
Well, the truth is that in the business world now, there is a bit of a frenzy to embrace generative AI, agentic AI. There is a belief that these will transform businesses, but at the very least, the hope is that they will transform your stock because you will be perceived as a technology-forward company, and hopefully you'll be able to find some sort of either revenue gains or earnings or cost savings somewhere in the business. For retail, the jury is still very much out on where the benefits are. A lot of the benefits of this so-called AI have been machine learning algorithms that have been embedded into software over the last 20 years. Are we seeing things that are tremendously new now? Not so much. There are the chat bots, there are some AI agents, but those are really either just new names for old live chat or kind of essentially the chat bots that we've had over the last several decades, or they will be variants of some of the machine learning algorithms that a lot of these companies have embedded into their systems quite effectively over the last decade, but we just didn't call it AI.
Not everybody can afford to make these investments, particularly at a time when costs for them are going up. Sucharita, is this just a situation, which I think is something Danny mentioned earlier this week, where the big just keep on getting bigger?
There are certainly scenarios here, like you see Walmart and Amazon growing and certainly taking share. But at the very, very small retail sector level, the minnows in the water, the companies that work with Shopify or BigCommerce, for instance, AI has absolutely empowered them to do things like create product descriptions at scale, or to be able to create new imagery on their website, or add videos, or do things in a way that makes them look more professional, even in spite of the fact that they may not have resources. So that is absolutely an empowerment tool that AI has provided, but it only goes so far because a lot of those companies still have to build brands, and it's not easy to build a brand. It's not easy to get production of physical goods at scale. It's not easy to get awareness, and that is something that Amazon and Walmart now have because they are so ubiquitous in the economy. It's not the case with little Shopify merchants.
True. It's a good point. Sucharita, appreciate your time. As always, thank you. Sucharita Ghazali there of Forrester. I think Walmart yesterday, an important data point for this Federal Reserve as they get together in Jackson Hole, Wyoming, one of the biggest retailers on the planet, also in this country, making the point that they're doing their best not to pass on higher costs. This is a different environment to the one that we were in coming out of the pandemic.
I think a lot about a conversation I had with a company that sold goods from China to people like Home Depot to Walmart in the US, and they had said that the big retailers completely cleaned out their inventory, that they have their own storage and was brought there. If you're a smaller company, to your point, you can't now turn to them and get goods that are pre-tariffed. They've been completely cleaned out by the big players. So Walmart is an important signal for the Fed, but if anything, they're doing so much better than everyone else is in navigating the prices. So you can't just use Walmart. A lot of the small businesses, which also make up a huge part of this economy, are suffering more.
They're one extreme. They're the best case outcome, I imagine, based on your commentary, and I agree with you. That stock this morning, recovering just a little bit after yesterday's losses. Futures, more broadly, trying to bounce by just 0.2% going into Chairman Powell later on this morning. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Elon Musk tried to enlist Mark Zuckerberg to help finance his unsolicited bid to buy OpenAI this year. That's according to a court filing from the ChatGPT maker. Neither Zuckerberg or his company Meta took part in the $97.4 billion bid. Meta declined to comment, and Bloomberg News reached out to Musk, but has yet to hear back. Meanwhile, Israel's top foreign policy aide traveled to United Arab Emirates to hold talks with the country's president. Sources telling us here at Bloomberg the meeting is part of a push for Israel to improve relations strained by the war in Gaza. The UAE warned earlier this month that Israel's decision to seize Gaza City would lead to, quote, catastrophic consequences. And a change is coming to Jefferies, the firm telling top bankers they must collaborate to maximize their bonuses. That's according to the Financial Times. The change is designed to support the bank's ambitions to work on larger corporate transactions and compete with bigger Wall Street firms. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, heading towards a live meeting.
Before April 2nd, before we got some uncertainties, it made sense for rates to come down. In the interim, we've had mixed messages. Feels to me like it's a live meeting.
That conversation up next with the former U.S. Labor Department Chief Economist, Betsy Stevenson. From New York, you're watching Bloomberg TV.
In case you missed it on the close.
Sweet Green, which has a kind of a similar business model to Kava, they're having some issues, and it's more about just the foot traffic. Maybe the price points are too high, or people have just moved on to other types of ways to feed themselves. What are you seeing?
We're not seeing anything underneath structurally in the business. If anything, we're seeing greater structural strength. In recent years, we've now underpriced CPI by 900 basis points. So again, our value scores continue to improve. We continue to make our food more accessible and really try and mitigate any of the impacts of, say, tariffs and not have to pass along to our guests.
There's been a lot of talk about how do you reimagine stores like this. What do you want your customer to do?
If you're in a hurry, we've got great digital channels. We've got 60 drive-through pickup windows. But if you want a great physical experience, you can have that walk-the-line experience, see the food, smell the food, interact with our team members. Our mission is to bring heart, health, and humanity to food. So we want to deliver that humanity in the four walls of our restaurants and have a great environment for you to enjoy your Mediterranean meal.
Don't miss the close, live every weekday.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Big day coming up in Jackson Hole, Wyoming. Equity futures at the moment heading into that positive by 0.2% on the S&P. On the Nasdaq, up by 0.2. The Federal Reserve's resident hawk, Cleveland Fed President Beth Hammack, with this to say yesterday: with the information I have, if the meeting was tomorrow, I would not see a case for reducing interest rates. She wasn't alone with that kind of commentary yesterday.
She wasn't. You could brush it off and say she's not a voter, but then you get someone like Schmidt, who is a voter, saying we don't have the definitive data to be moving in the policy rate right now. Goolsbee saying it's a live meeting. It was again and again we heard from various speakers really pushing back against the idea that September is a done deal. Again, the two dissenters, they seem like that. Dissenters still.
It's the calm before a potential storm. I stress potential. Bond yields totally unchanged. The 2-year, about 380. 10s this morning, 433. Under surveillance this morning, heading towards a live meeting.
Before April 2nd, before we got some uncertainties, I believed that we had pretty stable full employment, that inflation's coming down to target, and that it made sense for rates to come down. In the interim, we've had mixed messages. We still have a fair bit of information that we're going to get before September. It feels to me like it's a live meeting.
So here's the latest this morning. Tariffs and a tight labor market clouding the Fed's direction as investors await signals from Fed Chair Jay Powell in Jackson Hole today. The former U.S. Labor Department chief economist Betsy Stevenson writing in the New York Times the following: the Fed is looking at job numbers without a real understanding of what our current steady-state job growth should be. Betsy joins us now for more. Betsy, thanks for giving us some time. I want to give you some space just to explain that. What's your understanding of the current situation?
Yeah, thank you for giving me a chance to give the context, because the context is important there. Why do we not really know what the steady state should be? And the reason is that when we're looking at those job numbers, what we're trying to think about is how many workers are employers trying to hire? But on the other side of that is how many workers are there available for them to hire? And how much hiring does it take to keep our employment steady, right? So that we're at full employment. What we have right now is a big decline in immigration, and that is clouding these numbers because with people exiting, that's labor supply contracting. We definitely need fewer jobs being added each month. But the question is how many fewer? What's that steady state rate of growth? On the flip side, in 2024, 2023, a lot of people were worried that the economy was overheating because they were adding so many jobs per month. And it felt like, where could they be getting these workers? Well, we were seeing a resurgence of immigration, as we now know. And that resurgence of immigration was giving the labor supply that employers needed to be able to keep hiring at that very rapid clip.
Well, to that point, Betsy, the most recent reporting from the Journal does suggest that there will be a change from Jay Powell when he speaks today about the framework, about not just inflation, but employment as well, and how they view this labor market, given what you're talking about, and really the clouds and the unknowingness of how exactly this labor market is forming. How should the framework change? How should they be approaching this labor market?
Well, I think what they need to be right now is just incredibly data-driven, and that's going to mean looking at lots of sources of data, because they're trying to look at not just how many jobs are added, what's the unemployment rate, but what is the pressure in the labor market that could spark inflation. And so that's going to mean digging in and looking more granularly at unemployment rates for different groups of people. But remember, they have a dual mandate. They do want to keep employment at full employment, but they've also got to try to get that inflation back to their target of 2%. We had hit it, and then it sort of bounced up a little bit. And we might not think that inflation's, it's not out of control, but it's certainly not where they want it to be. And it looks like inflation might be about to tick up even further. So what they're going to be looking at is what's happening to inflation expectations, How tough do they have to be to keep that inflationary pressure down? And then they got to balance that with, is this slowdown in the labor market we're seeing, is this driven by employers just, not having enough oomph? Are we starting to see a recession where we're going to have a bunch of resources, which are workers and people, but also capital equipment that's just laying around and doing nothing? That's what a recession's all about. We don't want a recession, but we also don't want to see us demanding more than we can supply, and particularly with reducing our supply channels from overseas. That means that they're going to have to be a little bit careful to try to make sure that those reductions in supply don't lead to higher prices. I think this is the toughest position the Fed has basically ever been in my lifetime, at least.
Well, Betsy, just describing the state of things, it seems like labor market unknown, signals unclear, but what is known is that inflation is still with us. In fact, it's higher than it was this time last year at Jackson Hole. How can the Fed be cutting that next month?
I think that's a big question. I think that's why you're hearing a lot from members of the Board of Governors and the FOMC that it's not clear that they should cut. They're really, really going to have to be data dependent. What does that mean? That means that they shouldn't have made up their mind right now what they're going to do in September. There's data that's going to come in between now and then, and they're going to have to react to it. I will say, keep in mind that we want the Fed to react before we see a big problem. The Fed does the best. Think about coming into COVID. The Fed could see the writing on the wall with COVID because it was a pandemic and we had the health data before we had the economic data. And they were able to work to stimulate the economy to cut rates before we saw the problems of COVID. And I think that really helped us recover, have a less bad economic experience with COVID and recover quickly. But they kept rates too low, too long, and we had that surge of inflation. So it's a tough balancing act for them, and they're going to have to be looking forward, using the best data they can, and then they're facing a data crisis in the federal government, which is firing workers, cutting back staffing, which is making it so that the data is cloudier and it taking longer for accurate data to come out.
Betsy, a clinic. Appreciated your time. Fantastic piece, by the way. Thanks for joining us. The former Labour Department Chief Economist, Betsy Stevenson there, really framing what a difficult spot this is for the Federal Reserve and for the chairman in Jackson Hole this morning.
And I think if it was normal times, you could maybe make the argument of one-off price increases are true, but we're coming off of still high inflation in the scars of 2022.
Up next on the program, we'll catch up with Mike Schumacher of Wells Fargo, Jeanette Lowe of Strategas, the former Trump trade official Kate Kalukowicz, and Gershon Distenfeld of AllianceBernstein. The second hour of Bloomberg Surveillance just around the corner.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again. There was one quarter, a few quarters ago, we were not going to beat the quarter, we were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What you're seeing is a AI concern, pullback in big tech.
We don't think big tech is overvalued. The issue is the rest of the index is struggling to keep up on the earnings side.
We've got a great catalyst for bears, skeptics, and nervous investors to take profits without FOMO.
The market sentiment for the second half of the year, we think, is already pretty bearish.
I think investors have to reevaluate where we're going.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Your scores look like this. Equity futures on the S&P 500 shaping up as follows. Positive by 0.2% following 5 days with no gains on the S&P 500, the longest streak going back to the start of this year. On the Nasdaq, we're positive by 0.2. On the Russell, we're positive by 0.5. In the bond market, 2s, 10s, 30s, just about unchanged this morning. 379.56 at the front end. At the very long end, 492.44. Going into this one, 3 hours away, Chairman Powell in Jackson Hole, Wyoming, with a big speech going into September.
So maybe we're unmoved, waiting for that. I have to say, I'm surprised more attention isn't being given to this Wall Street Journal story about what we're going to get from Powell, about a change to the framework. Nick Timrose basically writing that they look like they're going to be abandoning flexible average inflation target while giving themselves more flexibility on the labor market. In other words, more rigid on inflation, less rigid on employment. That to me sounds hawkish. And remember, sometimes they put these stories out there to try to get a market reaction so he doesn't surprise the market when he speaks. Unfortunately, you're not getting a market reaction, so if that was the intention, it's not working. But he has to juggle maybe sounding hawkish on the margins and not upsetting the White House.
He was hawkish in the news conference.
Yeah?
His assessment of the labor market, solid. We've had this conversation now for weeks and weeks and weeks. We can all agree we've seen a step down in the payroll story. You can see it in the data. We'll see if it gets revised, but let's take the data for what it is right now. What's behind that? A turn in the cycle or a structural shift? And he gives a nod to the latter and not the former. Then the market's going to move against rate pricing for September and maybe beyond.
Oh, for sure. If this is more about supply for the labor market, if he tries to underline that, you could definitely get a reaction. But they probably, again, to come back to this, don't want to get the attention of the White House. There's so much going on. So maybe he wants to sound hawkish in the margins, doing it through a really technical way about talking about their framework. But I can't imagine that this is a chair who really wants to push back on market pricing just because of the ramifications of what it would mean.
Lisa, TK and Mike McKee on the ground in Jackson Hole, bringing you full coverage from that event, that get-together in a few hours' time. Look out for that. Futures this morning, positive and bouncing back by 0.3%. Coming up this hour, Mike Schumacher of Wells Fargo as investors are bracing for Fed Chair Jay Powell's speech at Jackson Hole. Jeanette Lowe of Strategas as the pressure on Fed Governor Lisa Cook continues to build. And the former White House trade official Kate Kalukowicz as the US and EU provide details of a giant trade pact. We begin this hour with Stock Steady as markets count down to Jerome Powell's final speech in Jackson Hole. Mike Schumacher of Wells Fargo writing the following: we think rate and FX markets are likely to react fairly sharply to the chairman's speech, just as they did last year. Mike joins us now for more. Mike, welcome to the program. Let's take it from the top. What are you looking for in a few hours' time?
Yeah, I think there's some boilerplate, John. So he's going to talk about the Fed's accomplishments and also challenges since 2018. It is, as you noted, his last speech as chair, so that seems like a pretty clear-cut thing to do. I almost certainly think he's going to unveil the new framework. That seems likely. The more symmetric approach makes a lot of sense. AIT, can anybody ever really explain it? No. Did the Fed use it? Not particularly, so good riddance. And then will he actually go down the rabbit hole of talking about near-term monetary policy? Of course, that's what we're all fixated on. That's the market question. I think it's not likely, but if he does, things get really interesting. So that's what people are going to be hinged on at 10 o'clock for sure.
Mike, based on the commentary we've had so far from other Fed officials, do you think we're overestimating just how much their views have changed since that payrolls report?
Probably so. I mean, the Fed talks time and time again about wanting to be data dependent. Now, it always is, but it's more intensely data dependent now than normal. And we haven't seen a lot of data, frankly, since the payrolls report. So I doubt views have changed a lot. So it seems to me there's been a tremendous amount of talk, and the ratio of talk to data has been a little bit skewed so far. But I get it. It's Jackson Hole. You think about Jackson Hole last year, Powell set the door wide open to a 50 basis point cut, which the Fed delivered in SEP, and of course markets went wild. So there is the precedent for this to be super market moving. Will he go down that road? I don't know. I think he must be very, very careful, but he has to be thinking about it.
Mike, what does supermarket moving look like? Let's say you get a Powell who just says, we're data dependent, and that's it. What's the reaction likely to be?
At that point, people say, not that interesting. Jackson Hole, once again, was talked about a lot, didn't actually deliver much, and people go about their way. I think where it gets really challenging, though, is let's say Powell does open the door to a rate cut, at least a little bit, in September. You can see pricing move a ton. So right now, the market's priced for what, 17, 18 basis points at the SEP meeting. That moves a little bit. Maybe that goes to 22 or 23. Where it gets much more intriguing, though, is if you think about the more distant pricing. So right now, the market's priced for the Fed to end the cycle at 305, something like that. That number can go down to 285, 290 in a hurry. You think back to non-farm, some of those more distant Fed pricing numbers move by 30 basis points in one day. Jackson Hole would not have that kind of impact, but it could. And if you flip it around, if he sounds hawkish, it could be a huge move in terms of near-term pricing. So it's really a very asymmetric approach here today.
Wait, sorry. So are you saying, Mike, that the bigger market reaction could be if he opens the door to cuts versus maybe slightly shutting the door to cuts?
It's a little tricky. So if he opens the door to cuts, there's not much reaction to near-term pricing because the market's still already teed up for a rate cut in September. There's much more of a reaction farther out. So think about market reaction or market pricing for middle of 26, late 26, early 27, that sort of thing. If instead he sounds hawkish, flip that around. There's a huge move in market pricing in the near term because if Powell basically says, I'm not comfortable, I need to see a lot more data, then what's the market going to price for September? 5 basis points, 10 basis points, maybe something like that. It probably wouldn't change the ultimate destination that much. So you'd see a much smaller reaction farther out in a bigger reaction in the near term. So it sounds tricky, but I think the market's going to have to parse his words super carefully today.
Mike, can we get more specific about where on the yield curve this might play out differently? We've been focused a lot more on the long end, and we're trying to figure out just how unanchored and disconnected the story at the long end is from the debate at the front end of the curve. 30-year bond yields making new highs over in Japan. Saw a similar story in the UK this week. Yields on a 30-year in America still getting closer and closer to 5% at the moment, too. So, Mike, I just wonder how you're thinking about that story at the moment.
Yeah, we're negative on the long end, John. We're negative in market after market. We think it's a story broadly across G10. You've got two things going at the same time, which are just hugely troubling. Number one is supply is picking up in virtually every country. The U.S., we know the story. Big deficit, that's fine. But when you think about the rest of the world, defense spending is climbing at a pretty rapid rate. That's going to flow through, we think, in the long-term issuance. So supply is picking up. Now, against that, think about structural shifts in demand. This is a big story. So for a long time, the DMO types, the treasury types, they've relied on structural buying from folks like insurance companies and pensions. We think that's declining. Take the case of U.S. pensions, for instance. On the corporate side, solvency is great right now. The average corporate has something like 105, 106% solvency. But what do you gain if you go from 105 to 110? Are lots more pensions going to buy bonds? No, they already made that trade. They're in, they're done. And insurance companies, same basic idea. Why would they step in and buy a lot of treasuries? Probably not. But it's not just a U.S. tale. It's also very importantly the case in Japan as well. So slowdown in structural demand against very, very sharp increases in expected supply. We're negative on 30s across the board. I don't think the chairman can say anything to change that story today.
So, Micah, this is so important. When you listen to the White House and the president, he's not asking for lower rates. What he really wants is lower borrowing costs. And one might not lead to the other. And I want to understand from your perspective, just from there, Mike, what you think happens next. What do you think happens if you're right? That they can drop rates at the front end, but rates at the long end stay stubbornly high, and borrowing costs for America and the government don't come down. What do you think they're going to do?
Yeah, the feedback loop gets tough, right, John? When you think about the U.S. interest burden right now, it's gone up to 3% of GDP, plus or minus. That number could climb to 3.5% pretty easily. It's already getting painful. It's already forcing pretty tough trade-offs in Congress. As that number ratchets up, then the pressure politically becomes much more intense. Is this a problem right now, today, for the Trump administration? Probably, but it could be much more severe in a couple of years. So I think the trade-off then becomes, how do you really try to bring down long-term borrowing costs? Pretty simply, you spend less money. So is there the political will right now to cut that deficit in the U.S. case from 6.5% down to, forget 3%, but even down to 5%? Just change the direction a little bit. We've seen no evidence. But as I noted, it's really a global problem. So it's the case in Japan, it's the case in Europe, it's the case in the UK. Broadly speaking, you're going to see those increases in supply for a long time. It's tough to rein that in, but at least changing the direction of travel in the U.S. would help quite a bit.
Well, Mike, the last time you saw deficits, the levels that we are, was wartime footing, was World War II. And back then, you did have the Treasury, to some degree, work along with the Federal Reserve to try to tackle that. At the risk of sounding incredibly controversial, Mike, why not chip away a little bit at that independence to have a Treasury and a Fed who work together to try to solve what is ballooning deficits and higher costs for the U.S.?
You could do something like that. You could say, look, we can pull out the 1950s playbook and let inflation go up and then over time get rid of that debt problem, but it's going to take quite some time. You could also go to more of a financial repression approach. People talked about this a couple of years. So effectively incent or compel banks, insurance companies, et cetera, to hold more government debt. That could happen. None of those things is particularly popular. But as far as getting the Fed together with the Treasury, that requires Congress to get involved. Is Congress really willing to make that step? I mean, at that point, you've got to be saying, hey, look, to the American public, we've got this problem. We're trying to deal with it right now. It strikes me that it's not really politically palatable to get way ahead of the game. So I suspect, although it's becoming an issue in the markets, it's not yet at the boiling point politically enough for people.
Well, Mike, I think Danny articulated the argument quite well in the previous hour. And for those of you that missed it, Danny essentially made the argument that for the Federal Reserve, never mind the politics, if they drop interest rates, and if you see the long end sell off and yields rise, then ultimately they haven't eased financial conditions in the mortgage market, which they might be concerned about. So, Mike, with that in mind, as Danny mentioned earlier, for monetary policy objectives alone, never mind the government, the White House, just for monetary policy objectives alone, do they need to think about that?
They do. And at the end of the day, John, it's a great point. Think about how much of the economy, let's say in the U.S., is tied to very, very short-term rates versus long-term rates. It's clearly long-term rates that drive the bus here. So the signal with respect to Fed funds is important. I think we all understand that generally speaking, there's a good correlation between long-term rates and short rates. But in this case, if very heavy government borrowing and the supply dynamic we talked about globally a minute ago really override the Fed, what does it accomplish by cutting the funds rate by 25 or 50 or more? Not a heck of a lot. And I think that's a tough optic for the Fed right now. So the Fed wants to try to message it to drive down long-term rates at least somewhat, but they're not cooperating particularly right now. Having said all that, if Powell opens the door to a cut, and if the Fed goes 25 basis points on SEP 17, or long rates going down, yes, I think they will, potentially a decent amount. But there's at least a greater than normal risk that you don't get that usual relationship.
Mike, appreciate your time. Thoughtful stuff. Mike Schumacher there of Wells Fargo. We're going down the market rabbit hole here, and it could have huge consequences for foreign exchange further down the road, but let's park all of that. I think you nailed it a little bit earlier. That's got to be a consideration for the committee of the Federal Reserve.
Right. If they want to start cutting and loosening monetary policy, then they have to think about the long end. And again, for all of the cries and fears about Fed independence, we might be in a situation where both the government and the Federal Reserve want the same thing. And that is more easy policy, but you can't do that if the long end is rising. And that's why I asked Mike, do you get in a situation where maybe the Treasury and the Fed need to work together, that the independence needs to kind of be chipped away at just to achieve the goals of, one, tackling the deficit and making sure that this economy isn't cracking under the pressure of more restrictive rates?
Bond yields just about unchanged this morning. 30s at 4.92. On the equity side of things, futures positive by 0.2%. With an update on stories elsewhere, with your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We are seeing NVIDIA shares falling 1% in the pre-market on reporting by the information that the company has asked suppliers to halt production of its China-focused AI chip, the H20. This comes after our reporting that Beijing urged local companies to avoid using the chip. This raising questions about the demand for the H20, which competes with similar products from China's Huawei. Meanwhile, Meta has made another big AI hire. Frank Chu, who has led Apple's AI teams focused on cloud infrastructure, will join the social media giant. That's according to people familiar. Chu will be joining Meta Superintelligence Labs and is at least the 6th Apple employee working on AI models to defect to Meta. This comes as Meta confirms it plans to freeze AI hiring after its blockbuster spending spree. And the Trump administration will not seek equity stakes in chip makers that pledge to boost their U.S. investments. An official saying companies like TSMC and Micron would be exempted from the policy after they announced the billions in U.S. investment plans. For Intel, talks are still underway about the White House taking a potential stake in the company. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, Governor Cook under pressure.
I refer people every week on a minimum to the Department of Justice for mortgage fraud. Did she sign these documents? I believe she did sign these documents.
That conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In case you missed it, on Bloomberg Open Interest.
When we look at our portfolio, we see an IPO pipeline that's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Speech from the Fed Chair Jay Powell later on this morning, less than 3 hours away from Jackson Hole, Wyoming. Futures right now positive by 0.2% on the S&P. On the Nasdaq 100 up by 0.17. Under surveillance this morning, Governor Cook under pressure.
We refer people almost every day. I refer people every week on a minimum to the Department of Justice for mortgage fraud. This is literally what I am required to do underneath the Housing and Economic Recovery Act of 2008, which is to ensure the safety and soundness of the mortgage market. Did she sign these documents? I believe she did sign these documents.
Here's the latest this morning. The Justice Department urging Fed Chair Jay Powell to remove Governor Cook from the board as it plans to investigate. Joining us now to discuss is Bloomberg's Mike McKee. Difficult, Mike, for the Fed Chair to address a legal process that hasn't officially started. I just wonder, Mike, you've been walking through the corridors of Jackson Hole in this annual get-together. How's this playing out?
Well, there's a lot of sympathy for Lisa Cook and the fact that she has joined Jay Powell in being the object of derision from the administration. They also recognize that at this point, what Pulte is doing is alleging misbehavior on her part. He is not a judge. He keeps saying she committed mortgage fraud, but that has yet to be investigated or adjudicated. So I think the sympathy is with Cook for right now, but we note she did not come to Jackson Hole, at least not as of last night. She wasn't at the opening dinner. We don't know what the new allegations that Pulte wants to lodge today are, but at this point, there isn't much more to say, except we're waiting to see whether she speaks anymore. I'm told she won't, but we'll wait and see how it plays out. I would not expect Jay Powell to say anything publicly about it.
We'll hear from Director Pulte at 9:30 Eastern Time. I'm aware of that time. Is that right, 9:30?
9:30,
Danny?
yep,
9:30 Eastern Time, Mike. So we'll hear in a couple of hours what he's got to say. Mike, I just wonder from your perspective how different this is to what happened with the Dallas Fed president a number of years ago. Danny mentioned that on yesterday's program, that ultimately it became a distraction and he resigned. How different is this?
We don't know yet, because we don't know whether the allegations are true and exactly what they entail and what it might mean. Now, the allegations against not only Robert Kaplan, but against the Boston Fed president as Rosengren, and then later on against Rich Clarida, who was the vice chair at the time, were that they profited from insider trading because they knew what the Fed was going to do. They were all cleared of that. There was no conviction. There were no court cases, but they did resign, as you say, because they were a distraction. I suppose that could happen in Cook's case, but the issue there is, of course, whether you want to give Donald Trump an extra seat on the Fed board.
But, Mike, should that be a consideration for the Federal Reserve?
You know, it's a tough thing to say, and I know that if you asked anyone there, they wouldn't comment on it, but I'm sure it is. I've talked to some of the Fed people here who used to say they knew Jay Powell was going to leave, and now they say, well, maybe he won't because of the situation. So there is a feeling that there could be danger to the Fed in doing that, especially given the aggressive way that Trump has gone after the central bank. But at this point, again, it's all up in the air. Nobody really knows what's going to happen next.
Mike McKee, thank you, sir. On the ground in Jackson Hole, Wyoming. Mike, thank you, sir. Looking forward to following your reporting. That's kind of shocking to me. If you believe it's a distraction, and let's see how this plays out, but I find that kind of shocking that you'd be worried about who the president might nominate to replace you on the Federal Reserve Board.
Well, also, to put it really simply, we don't know what's happened here. The legal case hasn't started. Pulte says he's going to present new evidence. If there is evidence of fraud, how do you stay on? If there is evidence of fraud, how do you stay on? And how do you have the political concerns be more important than that? That in itself is a threat to the Fed and the credibility of it.
And then the president has a right to replace you, just by definition. Jeanette Lowe-Strategas is with us now from a Baird company. Jeanette, welcome to the program. Just how much space does the president currently have to reshape this Federal Reserve?
Well, so that's obviously the Trump administration has been looking to try to put its imprint on the Federal Reserve. They would like to get more of their members in. I think the fact that Michael Barr, stepped down as vice chair but did not get off the Federal Reserve earlier this year kind of put some pressure on the administration in the sense that they felt like they were getting pressure back from the Fed, and they want to put more of their imprint now because they thought that they might have had that spot open. So this is, you have Stephen Murin potentially getting getting on the Fed within the next couple of weeks. So that's one piece. And then obviously this pressure on Lisa Cook, whether she is removed for cause or whether she steps down because of the political pressure, that creates another opportunity for the president to then have more members aligned with his views on the Fed. That's going to be important for interest rates. That's also going to be important for doing a vote on Governor Michelle Bowman's financial deregulation plan as well. So there is a pressure within the White House to try to make their mark and get a majority of members. And I think this is part of that effort.
Jeanette, in the short term, as to what you're saying, clearly has ramifications if you get more Fed governors who are more dovish. But in the long term, this concern about independence, the appointments to the Federal Reserve that Trump has made are very thoughtful people, the likes of Chris Waller. Some of the names being floated for Fed chairs, again, very credible and thoughtful people. Is it really a concern for wider Fed independence if Trump has more of his own picks on the FOMC?
Well, I mean, I think obviously the administration feels that they should be able to provide some influence on this. And they were expecting, it's like standard policy for a Fed chair to step down after their term ends, even if their term on the Fed board has not ended. So there obviously can be some concerns about whether or not he is pushing too much to have more influence. But at the same time, the administration could also argue back that they feel like governors are staying put to prevent them from having the influence that they should have during their term, during their administration. So, I mean, obviously I could see that there could be arguments both ways. One of the interesting things, obviously, with Lisa Cook is that she has a very long term left. So this would allow him to put someone on the Fed who would then be there for quite a long time.
Just the order of things today, Powell speaking at 10 a.m., 30 minutes right before him, we're going to get Pulte, him saying he's making a statement on new evidence in the Cook matter at 9:30 a.m. Jeanette, it's going to be the elephant in the room. Do you expect Powell to address it at all?
I don't. I think Powell, is focused on various other things. I mean, he's already been the subject of a lot of political pressure himself. I think he wants to make this kind of a speech that is going to be much more about his legacy, and it's going to be focused on certain components, changing the framework, focusing on what might be foretold for the September meeting. Those are the pieces I think that he really wants to focus on. I don't think he wants to make this political. He may say something about the independence overall, but I doubt that he would say anything about this case in particular.
Jeanette, thank you. Appreciate your take. Jeanette Lowe there, Strategas. We've repeated this over the past few days. It's odd enough and difficult enough to talk about a legal process that has started, never mind one that hasn't started. I just don't think it's something the chairman can tackle head on just yet.
Well, also just the fact that it would probably or maybe invite more ire from the White House if he pushes back really hard on this issue. Part about preserving the independence from Powell seemingly been trying to create a barrier, not getting into the politics, not answering journalist questions at press conferences. So I don't see why this case would be any different.
We'll let the process play out, if the process even officially begins. Up next on the program, the former White House trade official Kate Kalukowicz on the details of a trade deal between the US and the EU. Plus, Yahira Anand with your morning movers as Meta signs a $10 billion deal with Google. From New York, you're watching Bloomberg TV.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
5-day losing streak on the S&P 500, the longest since early January of this year. You've got to go back about 8 months in the equity market right now. Equity futures bouncing back by 0.2% on the S&P, on the Nasdaq by 0.14. With some morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with the latest retailer to report results, and that is BJ's Wholesale Club. Shares are up 1.25% after it raised its full-year profit outlook. And the CEO is striking an optimistic tone, saying, "We are pleased with the performance on business year to date and are confident in the outlook in the back half," underscoring the sense that consumers are still seeking value, and wholesale clubs like this one, along with discount retailers like Ross Stores and TJ Maxx, are able to provide that, so they are doing well. And we move to another retailer not doing so well, and that is Gap. Shares are down 2.6% after Barclays downgraded the stock to equal weight. The analysts there saying that tariff pressures have taken the company's blue sky margin scenario off the table. This comes just ahead of their earnings next Friday, where investors are hoping for a turnaround after a disastrous earnings report last time around that sent shares falling 20% due to the company warning that tariffs could cut profits by up to $300 million. And we have yet another mega AI deal, and no surprise, it involves the big spender Meta. We're reporting that Meta plans to spend at least $10 billion with Google Cloud to supercharge its computing power. This deal underscoring Meta pushing to scale AI fast and outpace competitors. And also Mandeep Singh says that this validates Google Cloud's pricing edge, since it was able to beat out both Microsoft and Amazon, which are market leaders in this space. John?
The company's been so aggressive over the past few months. Unreal to see. Yahara, thank you. Appreciate it. More from Yahara in just a moment. On a raise out this morning, our top story, divisions are growing within the Federal Reserve ahead of Fed Chair Jay Powell's final Jackson Hole speech. The Fed facing a September rate cut decision, with officials weighing inflation and labor risks. Do we have a dual mandate going into conflict?
Do we have also a Fed that is more biased towards the inflation side of the dual mandate? It seems that that is what we have heard from Fed officials speaking, but I thought Mike Schumacher put the market reaction really well, that if you have a more hawkish Powell, you have a big reaction on the front end. He confirms a cut, you have a reaction on the long end. But even that in itself, that asymmetry, shows us that the front end and long end are in conflict with each other. They're pricing in two different stories, perhaps in an unsustainable way.
Well, let's just sit on the long end, because this is something we've been talking about throughout this morning so far. The global developments over the past few months in Japan, in the UK, in the US, this leakage we're seeing at the long end of the curve, it's an international story. Is it going to become an American problem? Is it something that officials need to respond to?
Well, the story internationally is kind of the same one in the U.S., this issue of growing deficits. You see in Japan, they have auctions that have done extremely poorly, and you get a few of those in the U.S. If it grows to be a bigger problem, is it not just officials that have to do something, but is it the Fed that needs to get creative if they want to cut and make sure that long-term rates don't move even higher?
You can cut interest rates and financial conditions in certain places of the economy don't ease. You've been talking about this. I'm totally there with you. It's something we saw take place last year when they reduced interest rates by 100 basis points. Mortgage rates didn't go down, they went up. And if that repeats this time around, that is not the objective of this White House. They've talked about housing, they've talked about borrowing costs. If you see that play out, it's going to become a problem.
That's the thing. President Trump has been clamoring for rate cuts, over 100 basis points. We've seen 100 basis points get priced in over the next 12 months. What has happened? It's a 10-year that's remained flat, and it's a 30-year that has moved higher. But again, you might get in a situation where the White House and the Fed want the same thing, and that is easier conditions and a more controlled longer end of the curve.
There's another problem over at the Federal Reserve, a potential one anyway. The Justice Department urging the Federal Reserve to remove Governor Lisa Cook ahead of an expected probe into accusations of mortgage fraud. Top housing regulator Bill Pulte posting on X he will share new information regarding the story later on this morning.
I think the thing that really strikes me is the timing of this. He's speaking at 9:30. Who speaks at 10? It is Jay Powell. 30 minutes after we hear from whatever evidence this is. And look, it's unlikely, let's be honest, it probably won't change whatever Powell says, considering he probably has been thinking about this for some time. But it's going to be the elephant in the room. Sure, the theme of Jackson Hole is about a changing labor market, but the unofficial theme, let's be honest, is Fed independence.
Without a doubt, and the chairman's not going to address it, is he? Unless he gives some throwaway line about the important things. I just wonder whether everyone else who attends does it for him. This is something Lisa talked about yesterday, that you will have the likes of the ECB president, Christine Lagarde, who might do those kind of things for him.
And I know they're speaking, Lisa's speaking to Nagel later and some of the other officials from other central banks. I'm really interested to hear what they say to her and how much they beat that drum. Does it fall on deaf ears, though? How much of a difference does it make? But the Fed's problems are global problems, to the point of the yield curve, the longer end, affecting everyone in the entire world. So Christine Lagarde has skin in this game, surely. But where do they go from here with a White House that really seems intent on trying to get more appointees into the FOMC?
We're building up to a very, very interesting morning. It starts with Chairman Powell at 10 a.m. As Danny pointed out, maybe you want to look to what Director Pauli's got to say at 9:30 Eastern Time, 30 minutes ahead of those remarks. I mentioned Meta, Yahara did too, poaching another AI executive from Apple. Sources telling us here at Bloomberg that Frank Chu will be at least the 6th Apple employee to defect to the social networking company. We've seen a few of those in the past few weeks.
Yeah, two thoughts. One, poor Apple, who in the world do they have left? Two, there was just a story yesterday that Meta was looking at freezing AI hiring. It's like saying you're going to go on a diet but then eating $200 million worth of donuts that morning for breakfast. But they just keep hollowing out all of the AI talent. I think it also underscores kind of an unsettling part of this labor market, that you have a handful of people becoming incredibly wealthy with really high pays around AI. You also have people becoming wealthy because they are trading in the stock market around AI at the same time that it's a stagnating labor market. We've talked ad nauseum since COVID about a K-shaped economy. This feels like it's going to exacerbate that.
I don't know how this plays out in the long term, but Luke Cower, I think, did a fantastic job recently of talking about this, just how regressive the early stages of this might be, and that gap that we see, not just in America, but in other countries too, could get a whole lot wider in the first few, let's say, first few years of rolling this out.
I also think there's this really interesting conversation and debate going on about crowding out. Whether this is crowding out other investments. You usually think about it in the federal government, but this time around, if it is a hyperscaler type environment where they need a lot of resources, not just talent, not just capital, but power, but energy, does that crowd everyone else out? Is it normal people having to pay more for electricity because you have the AI hyperscalers hoovering up so much of it?
You've seen the same charts. This could become a huge problem politically going into the midterms. Not just housing, but the price of electricity. And I'm not sure how you explain it away. I'm not sure how you counter it either, particularly in places like Europe, where they don't have the energy abundance that we have in the United States.
And it's something that could also weaken the growth outlook. This is something Neil Dutta has talked about a lot. You add in all of this to what already seems to be like some cracks among consumers. What happens when they have to pay more for energy? To your point, Europe's also living with the scars of really high energy prices. How do they deal with that? How does consumer behavior change?
Meta this morning up by about 0.1%. Let's turn to trade. China creating a united front with India against US tariffs, writing China will firmly stand with India to uphold the multilateral trading system with the World Trade Organization at its core. Joining us now, Kate Kalukowicz, the former White House trade official. Kate, can we just sit on that statement? I'd love your reaction to that. China will firmly stand with India to uphold the multilateral trading system with the WTO at its core. The irony. Kate, your reaction, please.
Yeah, I'm struggling not to laugh out loud. You know, China likes to try to win this sort of rhetoric game, and the irony indeed of China, which really has been, of course, the source of the downfall of the WTO, trying now to lead is something I think the U.S. was probably chuckling at, won't respond to.
Kate, do you think they need to get the Europeans on side? And I'm talking about the US here. For a long, long time, China has benefited from the rest of the world being open and them being relatively closed. And this is something that successive US administrations have tried to do something about. And the Europeans have struggled to get on board with the United States. Do you think it's different this time around?
I do think it's different this time around. We've steadily seen a change in other countries, particularly the Europeans, being more willing to confront the Chinese economic challenges more directly. You know, moving from calling China a competitor to a really strategic problem. And of course, you've seen in these trade framework agreements the Trump administration has struck with a number of countries, provisions around economic security. And that's really code words covering provisions really directed at China, transshipment, export controls, you know, things that are really aimed at cutting this relationship economically between our trading partners and China. This is a dramatic change.
Kate, what does it look like, though, if you have a China who is more willing to take in and stand by the likes of India? What does that look like, and what does it mean for negotiations already underway or pauses underway between U.S. and China trade talks?
Well, I'd actually look at it in the lens of the U.S. and India. I look at the countries that are willing to sidle up next to China. I'd argue that's probably a losing prospect. China is not in it to support India. China is in it to fight the United States. I think that's a losing position for India. It would be a losing position for Brazil. And I think probably long term, we will see that start to fracture. China is not going to defend India's interests long term. It's going to look out for itself.
Well, at the same time, in the background of all of this, you have the U.S. Part of their approach to India has been that of Russian oil. Notably, they haven't hit out at China on secondary tariffs around Russian oil. Kate, how do you think the U.S. is going to continue to approach this if it is an India that has been stubborn and not willing to change course on that?
It's a great question. I think that this play with India has taken a little bit longer than folks had expected. You know, we were very close, I believe, to a trade deal between the U.S. and India, and a little bit of the stubbornness probably related to India's anger over President Trump declaring, you know, it was he who solved problems with Pakistan and a couple other national security related items. I think this has stymied Modi's ability to maneuver politically within his own country. So I suspect we will see a leader level engagement between the presidents at some time soon. I think it will take that to unstick this relationship. But I do remain relatively positive that we will see an outcome at a very high level that takes down some of the pressure here. It will have to relate somewhat, I think, to India's move away from Russian oil. This has been something the Trump administration has really prioritized recently, which is, you know, outside of the trade lane, but nonetheless could unstick some of the trade problems if India makes some changes the Trump administration is looking for.
To your point, India is one of the last that doesn't have that high-level agreement, and we're starting to kind of understand the contours of what happens after you get that agreement with yesterday newly published version of U.S. and EU trade. Kate, it's not yet a legally enforceable pact. It's certainly a step towards one. How far are we from definitive certainty when it comes to trade for places where we have gotten those agreements?
Right. These agreements, which, you know, are announced with a lot of pomp and circumstance, sometimes lack detail. We are still seeing a lack of legal detail. If you read the joint statement, you'll see very careful language around intends and will move towards. We're far away from some of the legally binding language, I think, that companies would like to see for certainty. But nonetheless, yesterday's statement, I think, is among one of the more detailed joint statements, laying out exactly what both sides expect to do going forward. We're at a fairly dramatic turning point in the transatlantic relationship. You know, we had a president who said the EU was created to screw the United States, and now we see all of these shows of camaraderie, not only the meetings at the White House earlier in the week, but this trade framework, which signifies a win on both sides.
They need each other. Kate, appreciate your time. Thank you. Kate Kalukowicz there, the former White House trade official on the current trade situation. So much has happened over the past few months.
So much has happened. Again, it's led to a lot of confusion as we try to figure out the details, just because, and Anne-Marie has been really good about this, the fact that everything's been done in reverse. You get the big picture thing, the high-level meetings, and then you figure out the details later. But I think your point on the Europeans is such a good one, because there's still a lot of sticking points. Things like digital sovereignty. Is the EU really want to give up some of their tough regulations on the world's biggest technology companies, which are American? So a lot yet to be figured out, even though you have that broad agreement.
It's not usually how diplomacy works, right? Usually they go into these back rooms, iron out all the details, then when everything's set, get the leaders to sit in a room, and then they basically sign off on everything that's already been agreed. It's like the reverse of that, as you described.
Right. Well, not only can you not do that, but it seems that even when you had that backroom kind of trading, like Switzerland, you can have a president come in and say, no, I wasn't part of this deal, so it doesn't count.
If you're just tuning in, welcome to the program. Futures positive this morning by 0.2% as we count you down to that Chairman Powell speech later on this morning with an update on stories worldwide. With your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. A New York appeals court has thrown out a massive fraud penalty against President Trump and his company. The court upheld the finding that he broke the law by inflating the value of his assets, but ruled the nearly $500 million fine was excessive. New York Attorney General Letitia James has vowed to challenge the ruling. Meanwhile, Eric Trump plans to visit Tokyo next month as part of the family's crypto industry push. Sources telling us here at Bloomberg, the U.S. president's son plans to attend a shareholder meeting of the Japanese Bitcoin treasury firm Metaplanet on September 1st. And you all were talking about trade. Well, here's the latest on India. 50% punitive tariffs on imports from India will kick in as planned next week. This as White House Trade Advisor Peter Navarro says India is cozying up to China and that its purchasing of Russian oil is helping fund Moscow's war in Ukraine. India officials are said to be perplexed by the U.S. criticism. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira in the next hour. Up next on the program, staying on the Golden Path.
We've had mixed messages. We've had some inflation reports that came in milder than we expected, and I was feeling good because I thought, if the tariffs kind of stay in their lane, there is a real sense in which maybe we never left the golden path.
Just how much has things changed? Gershon Diston, founder of AllianceBernstein, joins us next from New York. This is Bloomberg.
With the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number two, because you could be number two in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest.
Every trading day.
Only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Jumana Versace in Vienna, and this is Bloomberg.
Live from New York City, welcome to the program. Futures positive by 0.2% on the S&P 500, up by 1/10 on the Nasdaq 100. We are about 2 hours and 10 minutes away from hearing from the Fed Chair Jay Powell in Jackson Hole, Wyoming. Under surveillance this morning, staying on the golden path.
We've had mixed messages. We've had some inflation reports that came in milder than we expected, and I was feeling good because I thought, if the tariffs kind of stay in their lane, there is a real sense in which maybe we never left the golden path. The last inflation report that came in, where you saw services inflation really start shooting up, is a danger. I'm hoping that that's a bit of a blip.
We'll see if it is. Here's the latest. A divided committee coming together at Jackson Hole ahead of Fed Chair Jay Powell's speech at 10 a.m. Eastern Time. Gershon Distenfeld of AllianceBernstein writing, I would be surprised if Powell said anything to confirm a September rate cut, but he will keep the door open to it. I don't think he wants a bond market sell-off right now. Gershon joins us now for more. Gershon, welcome to the program, sir. It's been way too long. I'm trying to be super open-minded about this, and I'd love your view on things. The connection between the debate at the front end of the curve and the story out further along the curve. How connected are those two things?
Yeah, I think much less connected than we have had in the past. And I've heard guest after guest come on the past couple of days with you, John, and they're really dancing around the real issue. On the one hand, they admit that the Fed is in a really difficult position right now. Right, the dual mandate, and we'll see if Powell hints at changing it. But the dual mandate has them stuck. They're not sure what to do. Right, growth, inflation, giving different signals. But then at the same time, people are also admitting that what really matters is the long end of the curve. And what people are not then concluding is that the Fed just has a lot less influence on the direction of things than they've had in the past. That's just the reality. So, everyone's it'll be good theater to hear the speech at 10 o'clock. I'm looking forward to hearing it also. And if you're a trader and you care about what markets are going to do today, you're going to pay a lot of attention to it. But I don't think there's a lot that can be said that's really going to impact the real issue, which is a longer end of the curve.
Well, Gershon, on that point, if they have less control of the longer end of the curve, that means monetary policy transmission has changed, and their effectiveness of doing so has changed. A lot has been made about who holds debt these days and whether or not they can affect that as much. What does it mean going forward? What does it mean if the Fed wants to start cutting, if the long end is out of their control?
Well, obviously, there is some impact in the short end. Look, we're seeing it in the corporate market, right? We're seeing that on the margin, financing costs have been stubbornly high, and they've been flowing through to credit metrics. But I don't know if there's that much they can do. The reality is that it's a worldwide problem, especially in the U.S., we have a real problem with the budget deficit. And I think markets are going to continue to look at that. Look, this is a really out of consensus view because it's just not what we've seen over the past 50 years. But I would not be surprised if we wake up, I don't know when, 2, 3, 4, 5 years from now, and the 10 years at a much more normal rate. It's at 3.5%, I don't know, something like that. And the, close your ears for this, and the 30 years at 6%. I mean, I'm not predicting that's definitely going to happen. What I'm saying is it's not out of the realm of possibility. I think investors worldwide are going to be hesitant to lend for 30 years to the United States, given that there's just no political willpower on either side to get the budget deficit under control.
Gershon, I'm just trying to understand what that world would look like. 6%, maybe we can't even fathom that at this moment, but just something a little bit higher on the long end. What would be the mechanisms for dealing with that? And what does it mean about the trajectory of deficits in the U.S. and being able to grow and have debt issued and foreigners buy it?
Well, look, I think we have to remember that, if you look at the long arc of history, 5 or 6% is not crazy. When I entered this industry 30 years ago, right, the 10-year was in the mid-5s, and people thought, that was about the lowest it had been in 20 years. And people were like, wow, that's really expensive. It can only go up from here. And now we've been in a period of very, very low rates for a long time until recently, and people think the other way. There's a big recency bias, but I think that it's going to weigh on growth. There's no question about it. And, the question then is AI or other areas of productivity going to offset that? And we'll still have a good outcome. I think that's a very, very hard thing to forecast.
Gershon, what you're pointing to is concern about sovereign balance sheets. What I don't hear is concern about corporate balance sheets. So with that in mind, as a credit guy, how are you thinking about the relative value in, say, corporate America versus the sovereign, and how much tighter can spreads get?
I think the spreads are very tight. There's no question about that. But I think, John, it's important to recognize that it's yields that generate returns and not spreads. In fact, you put a gun to my head, I think spreads are going to widen from here, but I'd still recommend buying high yield or credit. And the reason for that is the way spreads are going to likely widen is at some point, we do expect the Fed to cut either 2 or 3 times this year and continue to cut potentially next year as it becomes clearer that, the data is softening on the growth side in the labor market. Well, what's going to happen then is the short end of the curve, and that's really where high yield is. High yield is a duration of under 4. Right, so the 3 to 5 year part of the curve is going to rally hard. High yields are going to come down as well, but they won't come down as much, which means that spread is going to widen. But for most investors, you're going to still get yield type or yield type plus returns from credit. So look, I'm certainly not banging the table. Back in April and May, I think things got very, very cheap. It's a relative value game. The reality is that everything is expensive right now. And I think we should expect lower returns across the board, both from stocks and from bonds. But that gap is going to close. Stocks have done so much better than bonds over the past several years, and that gap's going to close. And that's why I think people still need to have fixed income in their portfolio.
Gershon, just quickly, if you send the jet and I make it down there, do you think I'll make it down there in time? Get a cold beer, watch Chairman Powell together, sit out on that deck?
Yeah, I'm definitely in Jackson Hole, as you can see. Chairman Powell doesn't go anywhere without me and advising him up to the last second. But yeah, you can. No, you're a little bit late. You're in New York, John. Not going to be able to make it.
Wrong state. Gershon, enjoy yourself. Looks like you are already. Gershon Distenfeld there of Bernstein down in Florida. Having a good time. I think we're in the wrong state this morning.
I think we are, especially how rainy
it's been. On that deck with Gershon.
That's the way to watch
weather here's
Powell.
been dreadful the last few days, right?
Really, really bad. No, there's no other way to watch Powell besides beer in your hand, sunny skies. It's the way to do it.
Talking about fixed income, bond markets, and the Federal Reserve chair. Just how we like it. Up next on the program, Aaron Kennard of Clear Harbor Asset Management, Tony Wang of T. Rowe Price, Bruce Kasman of J.P. Morgan, and Jean Balvin of BlackRock as we count you down to an address from the Fed chair, Jay Powell in Jackson Hole, Wyoming, 2 hours away from New York. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
AI is definitely in the center of it, and we're looking for how do we spend time and which industries do you invest in. Investors becoming more and more digital or AI enabled that actually adds value to economic growth. And this, we think, could be time because you have a strong hardware power and you have a strong software power as we see, and it's accelerating significantly. But a very important, another element, which is changes in demographics. More AI-enabled softwares and applications may improve the people's lives and actually increase productivity in times where demographics are decreasing everywhere around the world. So this, I would say, is a major theme. So digitalization and AI-related technologies, and we think of it technology, but in reality, a lot of the businesses coming up and claiming to be technologies that are actually cannibalizing a lot of traditional businesses.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Powell talks at all about cutting rates, it's going to be sort of incremental steps ahead.
He will probably put a lot of focus on the importance of preserving price stability.
Very much unlike last year when Powell made it clear that a cut was coming. He's going to keep his options open.
There is a decent economic argument. This isn't really about political interference at all. Powell will be cautious.
Jay Powell, in terms of his legacy, is looking at what happens to his mandate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Chairman Powell 2 hours away, the opening bell 90 minutes away. Equity futures on the S&P 500 look like this. Here are the scores. We're positive 0.2% on the S&P, bouncing back from a 5-day losing streak, higher by 0.1 on the NASDAQ 100. In the bond market, huge debate about this debate at the front end and the connection to the story at the longer end of the curve. 30-year bond yields at 491.42, twos at 379. Going into this one, Chairman Powell 2 hours away.
And I think it's really telling that he is giving this speech at a moment where long ends are bumping up around cycle highs, where in Japan you're seeing JGB yields for the 30-year yield reach the highest that we've seen. Because there's a question just about the longer term, and we were just speaking about this with Alliance Bernstein, of in the future, how policy transmission works. If you have a Fed that maybe wants to cut, but a long end that is stubbornly high.
The efficacy of interest rate policy, which for monetary policy officials is a problem in and of itself. Layer on top the political pressure when the government right now want to lower borrowing costs and want to see mortgages and the price of mortgages come down. This could become a problem further down the road.
And of course, there's the risk that they exacerbate it by doing moves that seemingly damage the independence of the Fed. Whether or not it damages the independence is kind of not even the story. It's the perception of it that maybe makes people less willing to buy long-term bonds or just need a higher risk premium for doing so. So it's an administration that wants yields down, but let's be honest, they want mortgages down, so they need the long end of the curve to move.
This Federal Reserve is in a tricky spot. Your equity market attempted to bounce positive by 0.2%. Coming up this hour, we'll catch up with Aaron Kennard of Clear Harbor Asset Management as stocks look to avoid a 6th consecutive day of losses. Tony Wang of T. Rowe Price will join us ahead of NVIDIA earnings next week, and John Barvan of BlackRock as investors look for a signal from Fed Chair Jay Powell. We begin this hour in Jackson Hole, Wyoming, as the Fed Chair Jay Powell prepares to make his final Jackson Hole address. Lisa's there on the ground ahead of that speech. Bramo, frame things for us. What can we look ahead to in a few hours' time?
Look, I think you guys put it really well. This is a really fraught moment for the Federal Reserve because on one hand, the actual economic backdrop is so confusing. Is it really the inflationary pressure, or is it a potential weakening in the labor market that should take their attention? But also, how do you maintain Fed credibility? And as Danny was saying, it is not only the ability to act without political interference, but it's the perception to do so. And that is heightened by the idea that if this Federal Reserve makes the same sort of transitory mistake as they made several years ago, does that leave them without the credibility of being able to tamp down inflation? And that seems to be looming large, at least in the commentary of Austin Goolsbee, as well as some of the others, Jeff Schmidt and others who have spoken in the past 36 hours. Also, though, on the other side of the mandate, and what I was hearing from a number of Fed officials here on the ground yesterday, they have seen a market deterioration in the labor market, at least in anecdotal data, in addition to what they are seeing in the hard data in the past 6 weeks, that has them concerned. If they allow the labor market to fall out of bed, that too will impact their credibility at the same time that you have all of the allegations coming from the White House. So definitely a really interesting moment, and one that Jay Powell has to navigate given how much of a spotlight really is on him.
Lisa, let's just sit on that. It's how we started the program a little bit earlier this morning, just on the labor market. From a market perspective, a lot changed after payrolls. But listening to Fed officials in the past 24 hours, we didn't get the sense that their views had shifted that much off that one report. Can you just give us some more color on that? How much have views changed since payrolls?
You know, it's a great question, and it goes down to the division on the Fed that we keep talking about. We talk about Chris Waller, we talk about Mickey Bowman and how they were the first or the most dissent that we've seen on the Board of Governors in decades. But it goes beyond that. And when you talk to people in private, this is concerning to them because when they talk to their corporate clients or they talk to corporate executives, they hear a different story depending on what region they're in. This isn't one America that they're trying to gauge. An average American, as Patrick Harker, who's going to be joining us, has said, doesn't exist anymore. So how do they take what is going on in this sort of aggregate and form monetary policy? This is the reason why. How do you maintain Fed monetary policy credibility at a time where the transmission mechanism, as you and Danny were talking about, is really in question? How much can they influence in real time the labor market or inflation dynamics? I was speaking with one official yesterday who said it's quite clear that the Fed can influence inflation better than it can or more quickly than it can the labor market. So you don't want to disrupt the labor market because you cannot intervene in the same kind of way as you can for the inflation side. That's obviously a more dovish take. Clearly, there are many hawks who clearly have that scarring from 2022, also are very much dug in, especially given the political interference. So right now it feels like a splintered Fed at a highly fraught moment.
Lisa, just before you go, one final question. What they tell us in public, as you know, is so different to what they tell us behind closed doors. How is this story of Federal Reserve independence, the additional pressure on the institution, playing out in Jackson Hole?
So it's a really good point that in private conversations is where everybody keeps this, and where it has come down to is speculation on who's going to set the tone for the Federal Reserve next year. That is going to really be a big question. Who can actually placate President Trump's desires while remaining true to the economy, and how much can the market push back? How much can the Fed, whether it's with yield curve control or some other measure, try to tamp down some of the response that you may see in markets? But it all comes down to the dollar, because that ultimately is a release valve, and it isn't necessarily predicated completely on U.S. policy and U.S. traders. And that, I think, is a preeminent concern around a lot of policymakers here. The dollar weakens too much. All of a sudden, you have a new inflationary pressure in addition to a whole host of others.
Lisa, looking forward to the coverage. Bramo in Jackson Hole alongside TK and Mike McKee, about an hour away. That's when the conversation starts for them. 60 minutes after that, we'll hear from Chairman Powell. Lisa nailed it, yield curve control. Now, Danny, this has been our discussion so far this morning. Maybe a better interview question right now is not what do you want to do with interest rates? Not that, but what do you want to do with the balance sheet? And what will you do if long end rates don't come down?
Right, because they have this problem of cutting rates isn't necessarily going to bring the long end down. This is a problem that they had in past cutting cycles where they couldn't do that. So do you introduce the question of yield curve control, but how much is it a market that would push back against that? How much of it is seeing what's happening in politics and not willing to buy the long end of this yield curve? It is so much for them to consider. And again, the blunt force instrument tool of just rates isn't enough to tackle it.
Here's the view on Wall Street this morning. Aaron Canada, Clear Harbor Asset Management, writing the following: the Federal Reserve finds itself in a true conundrum. Our base case is that Fed Chair Jay Powell will leave the door open for a September rate cut and that his comments will do little to push back on this view. Aaron Canada, Clear Harbor Asset Management, joins us now for more. Aaron, welcome to the program, sir. Let's get into that. How much pressure is on this Fed chair today, and how much hinges on CPI in a few weeks' time and payrolls the first week of September?
Well, that's right, Jonathan. Thanks for having me. I think at the end of the day that the Fed has two more important data points to look at, and they don't seem to be in a position to want to sort of, shift towards the political narrative, which is that, that they need to cut rates to sort of, feed into the sort of White House narrative. I think that they're looking at the labor market. They're seeing those anecdotal signs of some softening. We saw that in the JOLTS data. We saw that in the last employment data set and the revisions and all the talk around that. But they're also sort of grappling with the reality that inflation, core CPI is at 3.1%. And if you look at, long-term break-even inflation rates, they're still, just below 2.5%. And there are other anecdotal concerns around tariffs and whether or not that's really fed through in their entirety with inventories now just having burned down from Liberation Day. So I suspect today may be an opportunity for the Fed to sort of continue to state what they said back on July 30th, and to probably put some weight on the next two big data points before the September meeting.
Just looking back at what Powell said on that July press conference, financial conditions are accommodative. The economy not performing as though restrictive policy were holding it back inappropriately. Aaron, if we got something like that, what would be the reaction from markets? Certainly not opening the door or at least confirming a September cut.
Yeah, it's interesting. I think that the risk today is, a week ago we were looking at the potential for a 50 basis point cut. If you look at Fed funds futures, today we're not even at the 100% likelihood of a 25 basis point cut. So, in some ways, I think that the Fed just may be trying to sort of pull the market back towards where its North Star is heading into September, which is probably a 25 basis point cut. And it's probably better from a market reaction perspective to have the market, wondering whether or not they're even going to do 25. I think I was looking at Fed funds futures. It's like a 65, 70% chance of a 25 basis point cut at the September meeting. That if you're the Fed, you sort of think, well, maybe that's a good position for the market to be starting to think about.
Well, Aaron, that's the bond market. What about this equity market that's seen consecutive days of losses, the most since the start of this year? How much of that reversing and getting back to rallying is predicated on getting a clear signal that we will be cutting rates?
I don't know. I mean, I think we've gone such a long way even since April. The S&P up over 30-odd%. We have, earnings that came in reasonably strong. I mean, 11% annualized earnings growth relative to the consensus just before, earnings came out at like 4 or 5%. If you look at Mag 7, which, big percentage, of course, of the market, over a third of the S&P 500, driving earnings, 26% growth rate, expectations for 13%. And the market's, taking a breather now. We're trading at 22 times forward on the S&P. If you look at the 493 names outside of the Mag 7 trading at 20 times, I mean, certainly this is not a moment to think that the market is super attractive on a valuation perspective, but the growth is there, and I think that's justifying sort of where we are at the moment.
Aaron, just to build on that, what would we need to see to support a more sustainable transition rotation beneath the surface of this equity market? Hints of it emerging sporadically over the past few days, but what would we need to see to make it more durable, sustainable?
Well, it's interesting, Jonathan. I mean, I think there are a couple of things in mind, and this has been a multi-month trend now. Year to date, you look at, who's leading the market from a sector perspective: industrials, utilities, communication services and technology are in there as well, but industrial is number one. And so I think that speaks to a broadening. If you look at the contribution of returns to the S&P this year, there are names outside the Mag 7 that are in there. Names like, and I'm not touting these, but just, you know, Philip Morris and Palantir. And so there's a broadening. If you see the rates, the Fed funds rate cut, you may start to see small cap equities start to broaden that rally. But I think the fear is that a rate cut or multiple rate cuts in particular could occur as a result of slower growth. And if we have a slower growth narrative, I don't think that helps small caps. If we have rates being cut because CPI is coming off, there's a perception inflation is normalizing, then I think you could see the broadening in the equity market.
Aaron, appreciate your time. Thank you, sir. Aaron Cannon there, Clear Harbor Asset Management, echoing what we heard from John Stolfus of Oppenheimer on the price action we've seen through the year so far.
The problem with that, though, is with industrials and utilities also rallying, you could make the case that those are also just AI-adjacent trades, that things like energy, AI data center build-outs, that's offering that premium that you're seeing going on in those stocks. So if the AI narrative falters, do those two.
Number two performer on the S&P 500 this year, Newmont. In the mix in the top 10, eBay, CVS, General Electric. There are some names outside of that concentration we talk about every single day.
There are, but again, if just given the market cap weighting, since the nadir in the spring, the top 10 stocks have contributed 60% of the returns. What are the top 10 stocks? It goes something like tech, finance. That's
NVIDIA,
what it looks like.
The big one
Correct.
next week. Looking ahead to that big name reporting earnings. Always too late. Equity futures on the S&P 500. Positive this morning, just about and looking to bounce. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. FBI agents raided former Trump National Security Advisor John Bolton's Maryland home this morning. Sources telling us here at Bloomberg the raid involves classified documents. Bolton was previously alleged to have included classified information in a book he released several years ago. Bolton and the FBI have declined to comment. Meanwhile, Russia is stopping oil shipments again to Hungary and Slovakia after a third Ukrainian attack on the Druzhba pipeline. Flows to the two nations average about 220,000 barrels a day. Now, Slovakia and Hungary are asking the EU's intervention, asking it uphold its commitments to guarantee the security of energy supplies for EU member states. And a federal judge ruling the sprawling immigration detention camp known as Alligator Alcatraz must wind down operations and be dismantled. The U.S. District Court judge ordered immigration authorities to stop bringing in detainees after finding it was built without proper environmental review. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I'm next on the program. The morning calls, plus Tony Wong of T. Rowe Price looking ahead to earnings from NVIDIA. Those earnings about a week away from New York City. You're watching Bloomberg TV. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
In case you missed it, on Bloomberg Open Interest. When we look at our portfolio, we see an IPO pipeline
That's the biggest since it's been in 2021.
In M&A and IPOs, we've actually had close to record performances in that space. We're going to have an interesting year.
We're having a lot more conversations around putting dates on calendars. I think we could see a very active second half of the year.
Don't miss Open Interest live weekdays.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
He's going to talk about the Fed's accomplishments and also challenges since 2018. It is, as you noted, his last speech as chair. I almost certainly think he's going to unveil the new framework. That seems likely. The more symmetric approach makes a lot of sense. Will he actually go down the rabbit hole of talking about near-term monetary policy? Of course, that's what we're all fixated on. That's the market question. I think it's not likely, but if he does, things get really interesting.
That is the market question. Here's the market action. Bouncing back by 0.2% on the S&P, on the Nasdaq 100, up by 0.2. That's the price action. Let's get you some morning calls. First up, Stifel cutting its price target on Zoom to 80, citing macro conditions and pressure on revenue growth. Your second call from Piper Sandler, raising its price target on Broadcom to 315, saying it's well positioned in the AI landscape. And finally, Evercore raising its price target on NVIDIA to 214, saying the chip maker is still the top pick in the near term. Let's stick with NVIDIA. Stock is down this morning. The company telling suppliers to halt H20 chip production. The information reporting China is urging local companies to stop using the hardware. Mandeep Singh of Bloomberg Intelligence joins us around the table. Mandeep, good morning.
Morning.
What's happening here over in China?
Well, we know when NVIDIA guided last quarter, they pretty much took off all the China revenue. Then during the quarter, we heard H20s could be sold. And now we are hearing the pushback from Chinese government saying probably they don't want the H20s to be sold to the Chinese companies. And in this case, I think NVIDIA probably is pulling back in terms of their ability to sell to China. So to my mind, nothing has changed in terms of the guide that they gave. It's just people were anticipating some upside to China revenue because NVIDIA would be able to sell H20s. I don't think that's happening. So that upside to estimates probably from the China side is going to go away.
There was that Reuters story earlier this week that NVIDIA was also looking at developing a different chip, maybe more powerful than the H20 that it could sell into China. Are there other strategies if H20, that source of revenue, gets cut off via China for NVIDIA to get around it with, say, a new chip?
I don't think so, simply because the government feels, you're dealing with sensitive data when you're training these models, and they just want to lower their reliance of the companies that are in the business of training large language models in China on, let's say, NVIDIA chips, or for that matter, AMD. And so from that perspective, I do think they want to rely on the local chip makers. But H20s is a deprecated version. Like NVIDIA is so far ahead in terms of where they are currently and where they want to go that selling H20s was, inferior to begin with. And if they can't sell those, I can't see them getting around that ability to, sell some other version of their chip.
Mandeep, stay close. I want to bring in Tony Wong of T. Rowe Price, who's following this sector very closely. Tony, welcome to the program, sir. How do you compare and contrast the ramp-up that we've seen in sovereign customers for the likes of NVIDIA, paired against the developments we've witnessed in China over the past 2 months alone?
Yeah, well, I think that AI and the demand for compute continues to be really strong here. I think you saw the cloud numbers be really impressive, and the AI race continues. I think what's going on in China is a continuation of that. It's probably negotiation of how much NVIDIA chips and at what power and performance is available. And in terms of just what they need, it continues to grow. So to me, I think what matters is that NVIDIA stays ahead, that the world is developing on U.S. technology, NVIDIA platforms. And to me, that's the North Star in terms of for what the market should look for.
To the point of NVIDIA staying ahead, Tony, clearly China, as Mandeep was laying out, wants them to use homegrown chip makers. How far away are those homegrown chip makers? Are they a realistic alternative to NVIDIA for China tech right now?
I don't think so. I think that you often get these types of news reports of China being pretty close with a new chip coming. We've seen this time after time over the last 5 to 10 years. And so to me, that's nothing new of a news cycle and probably part of negotiation. But to me, like the NVIDIA ecosystem, if you look at like what they're doing, essentially they're designing the whole system and more of the data center together. And what they're doing on the networking and the CPU and ARM and in terms of all the library of software, that continues to be like, I think, ahead. But, I think the company is continuing to execute and innovate on new product as well.
Well, it's the fundamentals that you're talking about, Tony, that remain strong with NVIDIA. But how do you factor and price things in, like what we're talking about in China, and on the U.S. side, too, looking at taking revenue from their Chinese sales? How does that impact where you think the fair value of NVIDIA is at this moment?
Yeah, well, I think here, after what we've seen since April, I mean, we're definitely at a different valuation range, and sentiment is very positive after this big run. And so when we saw a really good earnings season, and some of that has been baked in NVIDIA stock, I think that here, like, people will be looking for 26 sustainability. I think that 25 already, people have assumed that's going to be good. And so to me, like, it's going to be equation of demand. How do we think about new customers coming into the NVIDIA backlog, such as, Sovereign, as well as the existing clusters that are being built out, and then also supply in terms of how well they're ramping, and do we have power constraints potentially? So I think that's what's going to be on top of the market's mind coming in the next few weeks.
Tony, looking further out, we're focused more on assessing the amount of government intervention we've had and maybe will have in the months to come. Tony, how are you thinking about what's happening with Intel and what it could mean for other companies? One conversation we've had this week is that if we do take an equity stake in Intel and they do build out domestic foundry capacity, will other companies be pushed to use it in a way that might not be good for their bottom line?
Yeah, to me, I think that the tech trends and the competitive advantages of the tech companies matter the most. I think the government assistance and help, that obviously is beneficial. But at the end of the day, like, I think it's on Intel to, improve their product roadmap, improve their foundry operations, their manufacturing. And, historically, it hasn't been a capital issue. And so to me, it's more about the technology and focusing on what they're really good at, rather than perhaps like the government taking a stake. To me, the tech trends are what's most important and how well you're positioned.
Tony, thanks for joining us. Hopefully we can catch up again next week once we see the numbers. Tony Wong there of T. Rowe Price, a portfolio manager which holds NVIDIA. Just a final word on these developments this week, just in 30 seconds. How have you thought about these things, the prospect of taking maybe stakes in companies like Intel?
For whom? For the
US government?
Well, I mean, look, the foundry needs to be revived, and from that perspective, there is no shortcut. Even if government infuses, multi-billion dollars, it's not going to fix the foundry business. So from that perspective, it's going to take time no matter what.
There's nothing easy about this. Mandeep, it's good to see you. Thanks for dropping by. Mandeep Singh there of Bloomberg Intelligence. Up next on this program, we're just, 95 minutes away. Bruce Kasman of JP Morgan joins us to look ahead to Chairman Powell in Jackson Hole, Wyoming. Plus, Yohara's going to have some morning movers for you and another check on the retail space. BJ's is down by 2.3%. We've got a bounce back in this equity market. We're up by 0.2% following 5 days of losses on the S&P 500. Can we avoid day 6? The fate of this market today seemingly in the hands of one man, Chairman Powell in Jackson Hole. From New York this morning, good morning.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The opening bell's about 60 minutes away. Equity's doing okay. We're up by 0.2% on the S&P 500. We're all waiting for the same thing. Chairman Powell in 90 minutes in Jackson Hole, Wyoming. Remember a few years ago, 8-minute speech, pain, and basically closed things out and moved on, and they hiked interest rates aggressively. It was that year. It was that time. This is a different time. Things are much more finely balanced. And Danny, for that reason, I imagine this one goes longer than 8 minutes. You've got to do a framework review, a review of the labour market, inflation, where we are, maybe a reflection on your term as Chairman Powell. I don't know, but you can see this one taking longer than it did a few years back.
And maybe he doesn't want to be clear either. Maybe he doesn't want to be clear in saying it's pain or the time to adjust has come now. Maybe instead what we get is something that's highly technical, very reflective, but one that doesn't rock the boat too much because he understands the political pressures of the moment and doesn't want to exacerbate it.
We're all waiting for the same thing. The team's going to have special coverage on the ground for you. Lisa alongside TK together with Mike McKee to kick things off in about half an hour's time. As we count you down to the opening bell, let's get you some morning moves and cross over to Yahara for more. Hey, Yahara.
Hi, John. We start with the discount retailer Ross Stores. Shares are up 3.4% after the company projected stronger sales ahead, with executives saying that inflation will drive more shoppers to its off-price racks. The retailer saying same-store sales could rise as much as 3% in the next 2 quarters, topping Wall Street expectations. That mirrors the strength we saw over at TJ Maxx, underscoring the trend that consumers are spending, but they're being very value conscious. And sticking with that value trend, we have BJ's Wholesale Club. Shares are falling 2%. Shares were higher earlier today, but now investors are digesting what looks to be a mixed earnings report. While it did raise its full-year profit outlook and the CEO struck an optimistic tone about the back half, investors seemingly focused on that sales miss it saw in the second quarter. And we end on the newly merged Paramount Skydance. Shares are falling 0.4%. It's a small move, but it comes after yesterday's huge gains. This stock popped 14% as it becomes the latest meme stock of the summer. As for why, well, the frenzy traces back to excitement around Paramount's UFC broadcasting deal. That news lit up Wall Street bets, and it looks like traders are continuing to pile in, though it looks like they are taking some profits today. John?
Yahara, thank you. More from Yahara in about 15 minutes' time. Let's turn back to our top story. Counting it down to Fed Chair Jay Powell's highly anticipated Jackson Hole keynote speech. Bloomberg's Mike McKee is on the ground with more. Mike McKee, do you imagine this one might take longer than the 8 minutes from a few years ago?
I think it will, and I don't think we're going to hear about pain this time. But let me ask you a question here. What happens if we revert to the mean with jobs at the beginning of September, and we get a reasonable jobs number, and maybe even last month revised up a little bit? Then what is the Fed going to do? Are they going to cut rates? So as you were saying just before you went to break, the fate of Wall Street today hangs in the balance as we wait to hear from what the chairman says. He is likely to want to get Wall Street to pull back a little bit from essentially pricing in a rate cut, because still anything could happen. It's not easy to do, though.
Mike, is that your sense of things, that they need to reintroduce some two-way risk here? Because so much hinges on payrolls on the 5th and inflation on the 11th.
Well, they would like to do that. Now, of course, the payrolls numbers and the CPI numbers could introduce that risk as well, likely will move the futures markets. But right now, you've got not only the president pushing on the Fed, but you've got the markets pushing on the Fed, because they all want to see lower rates, even if they're not justified by the economy. What we've seen so far is members of the Open Market Committee saying we're open to the idea of a rate cut if the data justify it. But the Wall Street people aren't hearing the if the data justify it part.
Mike McKee, we're always skipping a story. You know that. Mike McKee on the ground in Jackson Hole, Wyoming. Looking forward to your coverage, sir. Kicks off in about 26 minutes' time. Let's stick with the Fed. Bruce Kasman of JP Morgan writing the following. Elevated inflation suggests that the removal of downside growth risks would make it unlikely that the Fed will deliver the substantial easing expected through the end of next year. Bruce joins us now for more. Bruce, it's been too long, my friend. Welcome to the program. July 30th was the last time we heard from Chairman Powell. It was in the news conference in Washington, D.C. How dated do you think those views are?
It's clearly dated because we've had important information both on growth with the weak labor report and also on inflation. However, I think it's important to look at what we got from that meeting, both in terms of Powell's description of the labor market as solid, as well as the committee minutes that showed that a majority of members still thought inflation risks were more important than growth risks at that time. So we're starting with a committee that I think has a somewhat hawkish bias around easing. I don't think from what you've heard so far from members that there's a consensus to ease. And I think whatever we get from Powell today, he clearly can't tell us what the September meeting is going to do. Having said that, I do think the weak labor market report is important. It does send a stall speed signal. I think the Fed traditionally has an asymmetric bias to being sensitive to recession risk. And I think he is going to tilt somewhat here in the direction of moving away from his description of the labor market as solid to tell us that the door is open for an easing that hasn't been decided at the September meeting.
So, Bruce, he opens the door, but to what degree do you think he would introduce that two-way risk, that two-sided risk, and try to maybe coax the market away from leaning as heavily as it is now to a rate cut in September?
I think right now, the market has decided that there's almost certainly going to be a rate cut. I think by opening the door but not saying we're going to walk through it, that does reflect the two-sided risk. So this is not a chair that's going to do what he did last year and basically promise a rate cut at the September meeting. But I think he has to reflect the rising risk. He has to reflect the shift in his own thinking. He has to tell us that September is a live meeting. If he does that, I think the market will pretty much stay where it is on the September call.
Bruce, if we also get some discussion about the framework, which we are expecting to, and you hear Powell talk about turning away from flexible average inflation targeting, if he sort of emphasized that, is there any signal in that alone, or is that more just details that matter not for near-term policy, but policy down the road?
I think the reality is the flexible inflation targeting regime never really took off. And I think there were some problems with the way it was described in the last framework review. I think Powell will basically tell us we're moving back, but I don't think it has any implications for how the Fed is going to set policy, not in September and not going forward from there. It'll be interesting color, but not impactful.
Bruce, their understanding of the labor market will be impactful. I want your understanding of the labor market first, and then we can talk about whether there's any daylight between how you think the Fed reads things. What do you think is going on here? So we've obviously had a step down in payrolls growth, and let's just run with the numbers we've got so far, because they might change. I've got no idea, and I imagine you don't either, but let's just run with these numbers. We've seen a step down in payrolls growth. Bruce, do you put more emphasis on the demand side or supply side, a cyclical turn or a structural shift?
Oh, I think labor demand is the key issue here, and I think in an economy that has slowed sharply in the first half of the year, what we're also seeing is a fairly substantial downshift both in the breadth and the magnitude of labor demand. I am concerned that when we see private payroll slow to the pace we've seen in the last few months, that's a warning signal. I call it a stall speed alert. But at the same time, we haven't seen businesses start to retrench. There's nothing suggesting layoffs have picked up. And there's also, I think importantly, no signs that the slowing in labor demand has really hit labor income, as wages have picked up somewhat in the last few months and hours have held up. So we have an economy that is downshifted. It's sending a risk signal, but it's not by any means breaking. And of course, we do have the flip side on inflation to worry about. I think you have to look at the Fed as responding to these asymmetrically. The recession risk, when it starts to pick up, becomes a dominant factor in their thinking. And as I said, I think it's enough to get you a couple of eases, maybe 3. It's not enough to get you the 130 basis points or so the market's pricing in over the next 18 months.
Bruce, Governor Waller's in your camp, without a doubt. But as you pointed out, the counterpoint to all of this is that measures of slack have been quite stable, and you pointed to wages. Wages are still okay. So you might get a few people on the committee who say this is more about labor supply, and that we've got a real risk here that we might get pushed in one direction when perhaps we should be looking in the other. Bruce, how do you think that debate's going to play out on the committee in September?
You could clearly see that in the minutes this week. And I am very much in Waller's camp in being concerned about labor demand, but I'm not with him. And I think most of the committee is not with him in the way he's reading the inflation data. And that's the tough part of this call, because there is inflation pressure building. I don't think underlying signals are telling us U.S. core inflation is below 3% at this point. If it wasn't for a risk issue, I don't think the Fed would have a case for easing. I do think there's a legitimate risk issue, and I do think it's appropriate to respond to that with modest easing as we go through the next 2 or 3 meetings.
Bruce, how important is it where we've come from? The fact that this has been 4.5 years of inflation consistently above target, the fact that you have scars of 2022 still really fresh, does that in itself push back against some of the Waller thinking that he might be right in normal times, but this time around, the risk of inflation is different?
I think that's right. And I think if we were sitting in a world where you didn't feel there was a heightened risk of a labor market break, you're not supposed to be easing, even as you see growth having slowed. But we do know that recessions are quite disruptive. We do know they're quite disinflationary. We also can see that so far the Fed hasn't lost its anchor on the longer end on inflation credibility. So I think in the balancing act here, if you are concerned about recession risk, you're supposed to respond to it. If I could put another point in here, I do think the Fed is politically vulnerable as an institution here. And I think the risk that they fail to respond to a downturn taking hold here would create a pretty substantial backlash, which I think does weigh on their minds in terms of how they're going to think about things as they go into the September meeting.
Bruce, just build on that. Vulnerable as an institution. What does that really mean?
Well, I think what it means is if you listen to Stephen Moran, if you listen to Bessent, there's talk about the Fed being reevaluated as an institution. This is not about who leads the Fed. This is not about firing members of the board. This is about, do we have a reevaluation of the Federal Reserve Act at some point here? Is the Fed as an institution going to be changed by this administration? They're certainly pointing in that direction. And I think the more the Fed falls behind the curve, the more the Fed puts itself in a position where it's not sensitive to growth risks that are realized, the more those risks increase. The Fed understands that. The Fed is a political institution. And I think it accommodates when it is under pressure. It's a marginal issue, I think. It won't make the Fed ease when there's not a good case for it. But when decisions are marginal, I think it leans in the dovish direction. And I think that's exactly where we're going to sit at the September meeting.
It's fantastic insight, Bruce. Appreciate your take. An original take there from Bruce Kasman of JP Morgan. Truly thoughtful on where he thinks the Fed is at right now. From a risk management perspective, from Bruce's perspective and Bruce's mind, it makes sense to cut interest rates soon. But the rate cutting cycle that this market has priced over the next year or so, different story.
I do think that's a really salient argument. I mean, Waller makes a lot of sense when he speaks. It's not like this is a far-out argument saying that they should be cutting. So the idea that they need to offer up some rate cuts because the other consequence of that, of not tackling growth, would be more changes to the institution is an interesting one. But yes, again, to your point, it still doesn't mean market pricing is right.
Chairman Powell, 1 hour, 18 minutes away. The coverage from Jackson Hole, Wyoming starts at 9 a.m. Eastern time with the team on the ground. Looking forward to it. Equity futures positive by 0.2% with an update on stories worldwide with your Bloomberg Brief. Here's Yahira Anand. Hey, Yahira.
Hi, John. FBI agents raided former Trump National Security Advisor John Bolton's Maryland home this morning. Sources telling us here at Bloomberg the raid involves classified documents. Bolton was previously alleged to have included classified information in a book he released several years ago. Bolton and the FBI have declined to comment. Meanwhile, Fed President Austin Goolsbee says one data point in the last inflation report was dangerous. In an interview with Bloomberg Television, he said he hopes the services inflation data, quote, shooting up was a blip. Goolsbee adding that the Fed's September policy gathering feels like a live meeting, no doubt. And ESPN and Major League Baseball are reportedly close to an agreement that would allow the network to carry MLB TV and the rights to all out-of-market baseball games. That's according to The Athletic. The deal would give ESPN the ability to offer MLB TV to fans as part of the network's newly launched direct-to-consumer streaming service. That's your Bloomberg Brief. John?
Yahara, thank you. Those of you who watch this program regularly might be familiar with this rant. My biggest frustration about sport is you don't know where to find it. And that's the problem I have with Premier League football. It disappears onto Peacock, then comes back onto normal TVs like USA or something like that, one of those channels. I can never find the games that I want to watch. I don't know where they are.
Okay, the worst, and I feel like this is really fitting right now because it's the US Open, is tennis. Tennis is so confusing. So many different channels. There's the tennis channel. I need to ask for a raise literally just to afford to watch all the tennis matches.
It's the same with the golf. Some of it's on ESPN, other bits of it are on the golf channel.
It's probably bad for business, right? They don't get as many eyeballs.
2 p.m. on the weekend, it switches to a different channel.
Oh, it's so sad to have to, you know,
like just sitting there trying to figure it
2
out.
2 p.m. on a weekend, just channel surf for golf.
Reduce the friction. That's all I ask for. Just reduce the friction. Let's set you up for the day ahead. That's coming up next. We'll catch up with Jean Barvan of BlackRock as we count you down to Chairman Powell's speech.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive. Getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
We want the Fed to react before we see a big problem. What they need to be right now is just incredibly data-driven, and that's going to mean looking at lots of sources of data. Remember, they have a dual mandate. They do want to keep employment at full employment, but they've also got to try to get that inflation back to their target of 2%.
That's the big objective for the Federal Reserve and Chairman Powell. We're counting you down to a big speech a little bit later on this morning. Equity futures on the S&P 500 positive by 0.2%. On the NASDAQ higher by 0.15%. That speech, 1 hour and 11 minutes away. Jean Bavin of BlackRock with this to say, we would still lean against the market pricing of multiple Fed rate cuts over the next year. John is with us in the studio. Morning, John.
Good morning.
Why would you push back?
Well, I think the situation is very murky, and it remains very much so. Yes, the payroll number that came out, the last one, was an important one, and we are paying close attention. I think it leans to even more of an easing bias, but the inflation story is far from clear. We have many more prints. I don't think it's even the next two. I mean, it's the next many before we get a real handle on that situation. And, you know, you get inflation and growth going in the opposite direction. How they're going to balance that is far from clear for me.
How do you put it in a speech in 1 hour's time?
I think you're careful to guide the market too much, especially since where the market is. I think you don't want to lug this in. I don't think so. I think there's a big story on inflation that needs to be spelled out. The labor market is a very, very unusual dynamic. I think it's very interesting that the topic of the conference is really about, you know, employment, labor market, demographics, which are big structural forces that are making the labor market very murky. And I think you emphasize that. And I think President Goolsbee is right that the service story on inflation is really puzzling. And I think, you know, it's important to remember that going into this year, if we hadn't had this kind of surprise weakness in service inflation, we would be more to like 3% inflation right now. So, and there's not a real explanation for this weakness in service inflation because it doesn't really line up with the labor market and wage dynamic that we're seeing. So, so I think the jury is very much out on inflation, and unless you get convinced that recession risk is really real, then it's going to be tough to deliver those cuts.
So is this then Powell that introduces two-way risk into this market in his speech today?
Yeah, I think this is very hard to do, but I think by emphasizing some of the inflation story that is not resolved, and recession, it's one data point on the payroll, right? I mean, we could get like a pretty strong one next one. We believe that 40 to 60,000 job is kind of what we need to keep inflation stable. So that's easy to achieve in the next payroll numbers, and that would not be screaming recession. So I don't know, making those kinds of points, I think, pushes a bit against 100% priced and cut. But.
And look, you're not the only one to say this. I think a lot of people have come around this table this week, have said that.
And before.
Right? Maybe for the past month, 2 months, we can go back further, saying that they're stuck between a hard place. It's not a market that's saying that, though, Jean. So how vulnerable are we at this moment to having a Fed that will push back and a Powell that will push back against current market pricing?
I think this is an environment that is as a result, very volatile. We keep telling clients and investors that this is an environment where we have more scenarios that are possible on the table than usual. You cannot bank on one being 100%. Things are not binary. And as a result, we think that creates a lot of alpha or investment opportunities. The fact that it's priced 100% and there might be room for some surprise will create some near-term opportunities, and I think that creates a pretty interesting trading environment for investors.
What do you like right now?
We like risk in general, because I mean, no matter what happens with the communication today, and even if there was like a surprise hawkishness coming out and the market were to react adversely, we think there's pretty strong underneath, support for risk assets. So we like equities. We like U.S. equities in particular. We would be, a bit more careful on the rate side of things and fixed income for like what we're just discussing here. In the context where the dollar has been, behaving the way it has this year, there are pockets of interest in emerging markets that continues to be there for us. And AI is certainly something that, despite the ongoing debate and so on, we think it's a pretty powerful force.
Let's just sit on that. You've talked about this as a team, the lack of macro anchors right now to focus on other things. Can you build out that just a little bit more?
Yeah, I think, there's this environment since 2020. It's ironic. They're going to be reviewing their framework now, 5 years. And that 5 years was exactly for us where we moved to a completely different regime. It used to be all about demand and risk of inflation undershooting in targets. Now we think it's all shaped by supply. It's a transformation. It's a real transformation. There's a lot of mega forces at play. AI is one in particular. And that means that, where we're going to be ending up in 2, 3, 5 years, I think is a lot more unclear than at any point in the 40 years prior to 2020. Are we going to get 3% growth? Are we going to get like on a sustained basis, which would be like a speed up? Or will we be in a 1% world? These are very different worlds. Very likely that we could be in both, but we just don't know. So we need to be ready for that. And then inflation, we are debating the near term, but we have big deficits. We have big debts. How this is going to play out, how these trade-offs will be navigated over the next 5 years is very unclear. And as a result, I think it's very difficult to build out a scenario 5 years out for strategic asset allocation and say this is like a reasonable basis where I can navigate around. Instead, I think you need to be a lot more tactical. And instead of looking at these macro anchor, I think we want to look to these mega force anchor. And AI, there are many macro scenarios, but we think AI will power through many of them. And as a result, is a better way to kind of shape portfolios.
Which is why I think so many of these names have been bid up so aggressively. Precisely for that reason, I think people feel more comfortable with that than they do with these other issues.
Because everything else is unknown. The politics of the moment, the deficit going down.
John, it's good to see you. It always is. Thank you, sir.
Thank you.
Jean Bavin of BlackRock there, breaking down these financial markets, both in equities and in rates, and the kind of anchors you need right now to get comfortable in financial markets worldwide. We're counting you down to the big one. That speech in Jackson Hole, Wyoming, 1 hour and 5 minutes away. The team on the ground in Jackson Hole, TK, Bramo, Mike McKee, bringing you special coverage in about 5 minutes' time. The speech itself at 10 a.m. Eastern time. Heading into it, equity futures positive by 0.2% on the S&P 500, following 5 days of losses on the benchmark stateside. In the bond market, the 2-year at 379, the 30-year at about 490. After all this is said and done, we'll catch up with you on Monday. We'll speak to Bob Elliott of Unlimited, Steve Rasciuto of Mizuho, Dan Skelly of Morgan Stanley, Liz Young-Thomas of SoFi. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, yeah, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
In case you missed it on the close.
Sweet Green, which has a kind of a similar business model to Kava, they're having some issues, and it's more about just the foot traffic. Maybe the price points are too high, or people have just moved on to other types of ways to feed themselves. What are you seeing?
We're not seeing anything underneath structurally in the business. If anything, we're seeing greater structural strength. In recent years, we've now underpriced CPI by 900 basis points. So again, our value scores continue to improve. We continue to make our food more accessible and really try and mitigate any of the impacts of, say, tariffs and not have to pass along to our guests.
There's been a lot of talk about how do you reimagine stores like this. What do you want your customer to do?
If you're in a hurry, we've got great digital channels. We've got 60 drive-through pickup windows. But if you want a great physical experience, you can have that walk-the-line experience, see the food, smell the food, interact with our team members. Our mission is to bring heart, health, and humanity to food. So we want to deliver that humanity in the four walls of our restaurants and have a great environment for you to enjoy your Mediterranean meal.
Don't miss the close, live every weekday.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
The toughest position the Fed has basically ever been in my lifetime.
The data is not there, and the uncertainty around trade and its impact on prices is still making its way through the system.
The Fed talks time and time again about wanting to be data dependent. Now, it always is, but it's more intensely data dependent now than normal.
I don't think there's a lot that can be said that's really going to impact the real issue, which is the longer end of the curve.
We still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
This is Bloomberg Surveillance, live from Jackson Hole, with Tom Keene and Lisa Abramowitz.
From Jackson Hole for our audience worldwide, this is Bloomberg Surveillance on television and radio. We're sitting in front of the beautiful Grand Tetons, as we typically do in late August for the Fed's annual gathering. But this year, under the glare of the global spotlight, it feels different. Good morning. I'm Lisa Abramowitz alongside Tom Keene, and you can just feel the different air this year.
Dramatically different. In 18 years here, it's one of like 07, 08. There's been a couple other years, but this is absolutely unique. And it's not that it's one thing unique. It's 4, 5, 6, 7 ideas that fold into the speech in 1 hour.
We have the idea of the political potential interference or discussion. On the flip side, the economics of the moment, quite distinct. We came into 2022, the pain speech, there will be pain. 2023, from Fed Chair Jay Powell, he talked about operating under a cloudy sky. And then last year, the beginning of accommodation. Where are we now with the dual mandate in question?
Well, the dual mandate is a question, and we don't know. We have James Bullard later, and he put the dot always at the bottom. Mike McKee's smarter about that than I am. But yes, it'll be about the framework. We're not going to get 50 beeps, 25 beeps raise. It may move the markets. That's true. But the mystery here forward with the politics is the independence of this central bank, not only for America, but for the international audience as well.
Which is the reason why a lot of people are looking at two particular securities. On one hand, 10-year Treasury yields, given the question of unmoored inflation or getting it under control. And then, of course, the the dollar and how much it has weakened or will weaken going forward. To me, since the last Fed meeting, 10-year Treasury yields up 50 basis points right now, hovering just around that 4.3%. The dollar down 2%, weaker just by 2% at a time where there's a real question, what is going to be the release valve?
I'm glad somebody did their homework here. I didn't do my homework. I'm going farther out the curve. Susan Collins, Jim Bullard, and others will say, don't do that. It doesn't matter. I'm sorry, the 10-year yield matters, but a 30-year bond through 5%, we're really not there yet. That will be important. And I look at the Japanese paper as an international litmus system with the own idiosyncratic Japanese story. I'm sorry, you have price down, yield up in too many places.
Yeah, well, let's get to an incredible lineup, and we will be talking about that as well. Coming up this hour, do not miss this. Boston Fed President Susan Collins, Adam Posen of the Peterson Institute for the International View, Bundesbank President Joachim Nagel, and former Philly Fed President Patrick Harker. In the next hour, also, the incredible reaction to the speech, former Fed Vice Chair Rich Clarida, former St. Louis Fed President Jim Bullard, and Citi Wealth CIO Kate Moore. But first, our ace economics correspondent, Michael McKee, is here alongside us. Mike, what are we expecting to hear in this particular speech?
Well, I think what you're going to get from Jay Powell is a bit of a pushback to market expectations that a rate cut is locked in, because you've got two things going on: a slowing labor market, which would call for rate cuts, but inflation starting to tick up because of tariffs, which would call for at least holding. So where does he come down? The markets at this point are pricing in a rate cut. Does he want to push back, get them a little more flexible as we get more data?
Yeah, and Mike, stand by, because we do have an incredible guest with us here on set. Joining us now, Boston Fed President Susan Collins, who has been in this meeting and coming here for what, 20 years, 20 some odd years?
Absolutely.
This one feels different, doesn't it?
Well, there's a lot going on with this meeting, I will say, and delighted to be here with you. The framework review, which we will hear more about, very complicated context, obviously, and love to tell you a little bit about how I'm seeing economic conditions in the outlook.
So let's get into that. There is this dual mandate that's in question, the idea of inflation versus labor. Where are you in the continuum of which you need to be most worried about?
Well, you need to be, this is a time when you need to be looking at the balance. You need to be looking at all of it. And, you know, growth has been slowing recently, but at the same time, overall economic fundamentals are relatively solid. And that's a context in which it's not surprising to see the indicators being mixed. Some are stronger and some are a bit weaker. So you got to look at the whole picture and not focus too much on any one or two specific indicators.
There's a lot of people who are concerned that you might be late getting to the economy if you wait for unemployment to rise significantly. On the other hand, you might see inflation rise fast. What about the compromise that's been floated by some people that you cut rate once and then you wait?
Well, so you do have to be thinking about all of it. We cannot wait until all of the uncertainty is behind us. You got to make decisions in real time. So I think that part is true. It is a complex context for monetary policy because I see upside risks to inflation related to tariffs. We're already starting to see some of that, and downside risks on the labor market side. And so it's about balancing those features. And I don't get ahead of a decision that we're going to make 4 weeks from now. We're going to see data in between now and then, but it's going to be about balancing those to really offset our risks and focus on both sides of that mandate.
Well, I know data is important, but it's also backward-looking. So what are companies in your district telling you about their plans for both employment and prices?
Yeah, absolutely, because I do think that complementing all of the statistical analysis that we are always, I'm a total data geek, right? You got to be in this role. With what we're hearing is really important. And what I'm hearing is pretty consistent with what I'm seeing in the data, actually. And so on the labor market side, while the job growth has certainly slowed, it's somewhat more concentrated. At the same time, a number of those indicators are quite healthy. And so on that side of it, there, I think that there are arguments for taking a bit more time. But I'm very focused on how those upside those downside risks are evolving. And then on the inflation side, what I'm hearing is that early days in terms of the impact of tariffs coming through into prices over time for a number of different reasons. So what I'm hearing from firms around my district, which is most of New England, and what we're seeing in the data as we do that analysis at the Boston Fed are pretty much telling a similar story from that context.
I was looking at where inflation was the last time that we were here and heard a Jackson Hole speech versus now, and it's crept higher. It's gone in the wrong direction when you look at CPI. It's basically ground around the same place in core PCE. Why did there seem to be confidence before that inflation was on a sustainable path down to 2%? Why is it no longer?
Well, you know, that underlying inflation, I was quite confident a year ago that that trajectory was back down to restoring price stability. And in terms of what I hear around the district, high price level and concern about inflation is one of the #1 things that I hear about, which is one of the reasons I'm so focused on the importance of that side of the mandate as well as maximum employment. But, you know, the tariff impacts are significant, and we have done analysis in the Boston Fed, understanding that it's not just direct imports, but the range of goods and services that rely on imported intermediate goods as well. A much broader range. It would surprise many people how many kinds of services actually use imported intermediates as part of what's happening there. And so we are anticipating that over the next couple of quarters, so the rest of this year into early next year, inflation is going to remain elevated. And then my baseline would be it would start to come back down, but I don't rule out a larger and more persistent impact.
But to Mike's earlier point, what is the harm in cutting by 25 basis points or even 50 basis points? Because would that really cause runaway inflation at a time when I know that the chair has talked about policy being relatively restrictive?
Well, it's about the balance, right? I mean, the inflation side, and again, that is what I hear about in every conversation I have across the first district, which is most of New England. And so it's about balancing that commitment to restoring price stability with an understanding that preserving healthy labor markets also really matters for the public. And so doing that balance, I would say it's not a done deal in terms of what we do at the next meeting, but a range of possibilities is on the table, and we're going to get more data between now and then.
Definitely, and everybody out there listening, that's good advice. Wait, don't bet yet. Is it more likely that we see a rapid rise in unemployment, because that tends to be what happens when it starts to go up, or a more long-term but steady rise in inflation that would lead to inflation expectations becoming unborn?
Well, so from my perspective, the risks on the two sides have come into rough balance. And so that's a really complex context for monetary policy when you could see the unemployment rate rising and you could see higher inflation. You know, my baseline is not one that is as concerned about inflation expectations rising at the moment. Earlier in the year, I had more concerns about that. I would say that at the moment, monetary policy is kind of modestly restrictive. That's actually appropriate for a period when inflation is elevated. We haven't brought back price stability, at which I'm totally committed to. But at the same time, there are those risks with the slower employment growth that could lead unemployment rates to rise, and balancing those risks. So I think at the moment where we are is appropriate, but if we start to see worsening labor market risks relative to inflation, then starting to dial back the restrictiveness would become appropriate.
Hey, Dr. Collins, I was going to ask you a bow tie question about the privilege of taking your PhD under Rudy Dornbush and what it means for the future of the dollar and that. Unfortunately, the economist Donald Trump is watching. Thank you, President Trump, for watching this morning. May I quote, "The United States is the, quote, hottest, unquote, country anywhere in the world. There is no other country that is even close. And just think 1 year ago, we were a, quote, all caps dead country with no hope of ever seeing all caps greatness again. But that all changed on Election Day, November 5th, 2024. Many, including Ken Rogoff of your Harvard, line up and say, markets all-time high, economy okay. inflation edging up, bond markets speaking. Is the Fed too ex post right now? Does the Fed just have to wait because so many things are firing on all cylinders, as the president just noted?
Well, you know, I am laser focused on the data and the range of data from what's happening in the relative short term to what the indicators are suggesting in terms of longer term trajectories. I think, as I said earlier, those underlying fundamentals are still quite healthy.
Have we broken the disinflation vector here? Or do we sit at this Jackson Hole where we got a service vector and a goods vector nudging upwards?
I think my baseline is, again, it's going to remain elevated for some time related to those tariffs, which are still unfolding. There's a lot of uncertainty with that. But it's possible that we'll see more persistence. There are a lot of unusual dimensions of behavior right now, which means that some of the history doesn't give us as much of an indicator of how things are going to unfold. We got to realize that. But again, we can't wait until all of that uncertainty is resolved before we make our decisions. Those fundamentals are still healthy, and keeping that balance in mind of the mandate that Congress gave us for price stability and maximum employment is where I will keep my focus.
We just have about 30 seconds. What's Fed Chair Powell going to say? No one's listening.
Well, I don't want to get ahead out of the chair. He's going to talk about, obviously, the framework. We have had a robust process there, which I'm, feel really good about, and about what he's seeing in conditions and the outlook.
That was really good. Really good massaging. Boston Fed President Susan Collins, thank you so much. That was great.
A word of that.
She's going to talk about, she said that she's going to talk about economics. Yeah, basically. Yeah, that was sort of the intent. I mean, look, this is a complicated moment. And as you said, I mean, you've got the president coming out and jawboning. At the same time, the economic story is really complicated here. That, to me, is what I keep saying.
There's an ambiguity to it.
Yeah, very much so.
I've seen that from a number of people. But Kit Jukes at SocGen was brilliant today on that. Yeah. It was just hugely ambiguous.
Which is a reason why I think all these different Fed officials have completely different views, as well as the economists and analysts coming up next. One of those views, Adam Posen of the Peterson Institute, will be joining us next. This is Bloomberg Surveillance on television and radio.
You missed it on Bloomberg Brief.
We do see that there are some real inflationary pressures. I mean, one thing is, of course, coming from the tariffs. We are seeing some push from various kind of climate situation, and so that is why we also think that there is a link between climate risk and financial risk. I do think there is for sure a danger that inflation could be quite persistent here.
Don't miss Bloomberg Brief, live every weekday.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Inflation report that came in where you saw services inflation, which is probably not driven by the tariffs, really start shooting up is a danger. That's a dangerous data point. I'm hoping that that's a bit of a blip. So I think we still have a fair bit of information that we're going to get before September or the whole fall to determine what path we're going to be on.
That was Chicago Fed President Austin Goolsbee. This is Bloomberg Surveillance on television and radio live from Jackson Hole, Wyoming, ahead of a very different Jackson Hole speech from Fed Chair Jay Powell. Tom, to me, I'm watching markets right now and wondering how much they are potentially hinged for a pretty big move right now. Can we break 5 straight days of losses on the S&P? And do we see that sustained yield drop on the long end ahead of what a lot of people expect could be a hawkish move from this Fed chair?
Well, we might have the speech, it may be a hawkish move, but the answer is we don't know, we don't know, we don't know, and we're going to go line by line in the speech. I am going to use the fixed income market as a litmus paper, not only the 2-year, but curve steepening. I'm going to go to 2s, 30s, not the vanilla 2s, 10s. Adam Posen taught me how to do that. And the answer is I'm watching the 30-year bond. It's different in Japan. It's different in the U.S. It's different in Italy, doing better than France right now in terms of yield. And the answer is it's going to be very nuanced internationally.
Yeah, which is a reason why a lot of people from the international community are here joining us now, who has been writing fire recently. Adam Posen of the Peterson Institute for International Economics, who has been pretty aggressively talking about some of the harmful ramifications from a new world order. But before we get to all of that, I want to get to how this is set up and how this feels very different than previous Jackson Hole meetings.
Thank you, Lisa, for having me back. It's good to be back with you and Tom, and you're right, it is different. It's different inherently because it will be Powell's last speech as chair, and he's had quite the tenure, and there's always the combination now, it so happens, of his potential legacy speech, talking about the framework review, and the fact that the economic situation is genuinely unclear. But then, of course, there's this whole overlay of the Trump administration's variegated attempts to put pressure on the Fed in an overt way, using personal attacks and using social media in a way that is unprecedented and harmful.
I know that human nature is such that if someone tells you what to do again and again and again, and you have somewhat of a rebellious spirit, you want to do the opposite. And I wonder how academics who get together and who want to do what they think is right are erring on the side of being overly hawkish in order to sort of thumb their nose at what they see as political interference and something that isn't their fault. Do you feel that in some capacity?
I feel they're thinking about it. I feel that they're trying to be very self-aware of that. And there is a history, Lisa, of central bank independence, and Tom and I are old enough to remember this, that when the Bundesbank was like the leading bank setting policy outside the U.S., whenever a left-wing finance minister, or for that matter, a conservative finance minister would say, you're too tight, the central bank would explicitly, Hans Tietmeyer would explicitly say, you yell at me, I'm not doing anything. So there is that element. But I think what Powell has said, what President Collins, who you just had, has said, is they are trying to make the right call in the economy. And in the end, I think, if anything, they're going to bend over backwards to not be hawkish today, because they want to show that no matter what the Trumpies do, they're going to make the call on the basis of the economy.
Adam Posen with us for the Peterson Institute. As we welcome all of you worldwide. Good morning on Bloomberg Radio and on Bloomberg Television as well. To cover this for you in the limited time that we have, Dr. Posen's essay in Foreign Affairs days ago sets the table for a post-American world. Dr. Posen, of course, channeling the economist Joni Mitchell from 1970. It was good of you to end the essay looking at a parking lot with the lights turned out. In the 70s, the inflation was 6.8%. We've been running 3-ish, 4-ish, depending how Jason Furman measures it for me. The answer is, do you fear an inflation back to the time of Big Yellow Taxi?
Yeah. Tom, thank you. I know you curate foreign affairs articles for your audience, and I'm grateful you've picked up on mine. And I think people have been missing the big picture. This is an economic regime change. It's not just the tariffs. It goes to the 30-year bonds and the international flows that you were talking about. And so is inflation going to get out of hand? No. Ultimately, no matter who succeeds Powell, who Trump appoints, they'll be forced to turn around if it gets big. But what you're going to get is the stuff we saw in the early 80s. You're going to get a steeper yield curve. You're going to get a higher yield curve. You're going to get risk premium. You're going to get more out of the dollar.
Right. Can we go all nerd now?
Please.
What
were we doing before?
They're awakening the tent, right?
Come on.
They're awakening
Carry
the tent.
on. All right.
Full nerd with Adam Posen. Buried in the middle of every textbook, chapter 20 or so, is in a chapter on insurance. Right. Your essay is that we've given up the ghost of us being the insurer for the world in the 70s, in the 60s, post-World War II. Can we recover after Trump back to an insured world where they trust America to be the insurer?
Just as some foreign policy types talked about after Vice President Vance at the Munich summit and all the stuff against NATO, you don't do it in a day. If the president realizes the mistake, if the Congress steps up, if there's an election and there changes, we can go back. But you have to think of it like Germany or Japan after the war. You have to rebuild trust. You have to invest. And the longer this goes on, the longer the U.S. ceases to provide the kinds of insurance that it did, other countries self-insure. And so they take money out of the dollar, they invest in different institutions, they make different trade deals, they try to build things up. So the longer it goes, the harder it's going to be to turn it back. And everybody's worse off, including the U.S., but they make the best of it they can.
That's the big picture as you see it. Some people would say that this was already fracturing in other ways heading into this, and we saw that in the post-pandemic reality. But shifting to the inflation side that Tom so rightly picked up on, if the Fed does cut by 25 or 50 basis points now, and you do see inflation pick up materially, what do you see as the risk that they have to hike materially next year? Something that Ken Rogoff has talked about.
Well, I mean, nothing against Ken, but you and I have been talking about this on your show for a year and a half.
All right, you were first. Carry on.
No, but anyway, but so I'm aligned with the brilliant Rogoff. I think they have a reversal built in at this point, because essentially they're gambling on the fact that the R-star hasn't risen. They're gambling on the fact that the recessionary effects of the tariffs and the anti-migration will more than offset the inflationary effects. They're gambling on the fact that long-term inflation expectations will remain fully anchored, which, amidst everything else, after the last few years and after the attacks on the Fed, seems like a bad gamble. And ultimately, they're gambling on the fact that the pass-through of these things is going to be very limited, which gets us back to Tom's 70s analogy.
At the same time, if you look at the unemployment rate of young adults, 16 to 24, it's 10%. It's the highest it's ever been outside of a recession. You see an increasing number of people remaining on jobless claims, receiving those roles because they cannot get a job. Doesn't the labor market worry you at this point?
It does, but that's different from what you and I were just talking about, Lisa. This is what happens when you run a terrible policy mix, when you get stagflation, is you have no good choice, and then you're stuck worrying about inflation despite the fact people are suffering. This is the problem. It's not because there aren't going to be problems and aren't already problems in the labor market. It's because the inflation threat is worse at this point. And if the Trump administration hadn't done all the things it had done, we wouldn't be facing this terrible trade-off.
I noticed last night, I looked at the Nielsen ratings, and there were 2 people listening in Wyoming as the Red Sox beat the Yankees. It was me and Adam. We were sitting in our little, he was in a pup tent, I'm in a little bigger tent, and we were listening to the Red Sox on our radio.
Oh yeah, this is your transistor radio that you have? I think everyone's buying that out here. They're sort of really good.
Do they have a chance?
Is that all you want to know today?
Of course they have a chance. Okay. They always have a chance.
Adam Posen of the Peterson Institute for International Economics, on policy, and on the Red Sox. Thank you so much for being with us.
Thank you, Lisa.
Tom, is that what you were doing last night? The whole night you were watching the Red Sox instead of...
No, you watch it on radio, and it's great. It's like they're playing in August. The games matter. We're not the Yankees.
Well, in seriousness, this is really the key debate. What is the potential risk-reward of cutting now? Not just because of any political pressure, but also because there is a sign of weakness in the labor market at the same time that those inflationary pressures
It doesn't make good news for radio and TV, but the framework is important. They did a framework a couple years ago. They're going to change it, and maybe they change it with a new humility.
Yeah, well, we'll be talking about the framework. We'll also be talking about the German Central Bank coming up with the Bundesbank President, Joachim Nagel. This is Bloomberg Surveillance.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, central bankers travel to Jackson, Wyoming, and we go with them to the richest county in the country. In Dallas, we take a look at its plans to challenge New York's position on top of the financial world.
Wall Street is great. The future is Dallas.
And we sit down with Chevron CEO Mike Wirth to hear what he's doing to restore some balance after all the ups and downs of fossil fuels. Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hordern in Anchorage, Alaska, and this is Bloomberg.
In case you missed it, on Bloomberg Tech Asia.
How does Samsung think about competition? Because you have also so many Chinese makers coming out with foldables, with good cameras.
You know, rather than focusing on competition, I think we have been focusing on our consumers. I think healthy competition with other companies, I think will bring more innovations and then bring more benefits to consumers.
Don't miss Bloomberg Tech Asia every month.
Can we break 5 straight days of losses in this August lull? Moments away from the start of trading, I hear
So
Tom saying that this is gloomy. Well, it's less gloomy when you take a look at S&P futures up about 0.3% as we have just seconds. Meanwhile, yields just slightly lower on the long end as people look to potentially a more hawkish message from the Federal Reserve. The NASDAQ trying to bounce back as well, and the Russell 2000 up some 0.6%. We do have an open market at this moment, and we are looking at yields that are lower on the day, at least in the long end. Front end is up just a touch. When you take a look at what's going on, expectations for a Fed rate cut next month have gone from 90% to 70%
come in a little bit
in the past
and
week.
they wait for the next tea leaf, right?
Yeah, well,
including a speech.
Well, I mean, we've gotten some data from it. It's not just tea leaves, but yes, we've got a speech coming
Can
up.
we go to WEI and get rid of the Bramall gloom here and mention that year to date we're in a raging bull market?
Okay,
and
I was
dollar
just giving a
adjusted,
sense of where
the
we were
DAX,
coming from.
The DAX in Germany is a Saturn V moonshot of superiority.
Well, we're going to be talking in just a minute with someone who has watched that all happen with the recovery. I will just say, I have been talking about how the S&P is up 13% since the last time we were here, and that the NASDAQ's up 18%, and this has been absolutely a really strong market pretty much across the board.
It's been a strong market, and of course, that's part of the issue of why are we cutting 20. The 50 beep rate cut, that all went away.
Yeah, like
Can we
that's
say that
absolutely not in the market at all.
But again, I would say all in all, it's looking at equities, bonds, currencies, commodities, and we are in an August doldrums, which is going to end at 10:01 Wall Street time.
Well, maybe.
This morning.
We'll see. I mean, we've seen some speeches that have left it in doldrums. I don't think this time around, though, and I think that's going to be important. One thing that's been interesting is the euro versus the dollar has strengthened about 4% since the last time we were here in Jackson Hole, and someone who's been watching that, but also watching their own central bank policy, as someone who has made the 11, 12, 13-hour trek. I'm guessing it's probably somewhat longer than that. Bundesbank President Joachim Nagel, who sits alongside us. Joachim, so great to have you here.
Good morning.
Thank you so much for being here. I want to start with a sort of overlay that makes this Jackson Hole different. It feels like there is the question of central bank independence that no one really wants to talk about, but is something that's very much at the forefront of your mind. How important was that question in your decision to make the trek out to Jackson Hole?
I think, as always, the Jackson Hole conference is a very important conference for central bankers, but maybe this year even more important. And when it comes to central bank independence, this is the DNA of good monetary policy. This is the conditio sine qua non to do what we have to do to fulfill our mandate to achieve price stability. And so central bank independence, we have to fight for it.
Do you have any fear that has already been compromised in some capacity in the Federal Reserve, which people used to call the central bank to the world?
Let me put it like this. I don't want to comment on U.S. politics. I hear one or the other comments I really do not like. But just to point out, to give you maybe a kind of a reminder when it comes to the history of my country, Germany, going back to 1948, and we are grateful to the United States that you gave us an independent central bank. This was the starting point for the famous German Wirtschaftswunder. So central bank independence is key to achieve price stability, to build the basis for economic growth. So we have to take this into account.
This is critically important, and to me, this Jackson Hole is far more international than any other Jackson Hole I've been at. Bill Rhodes' great phrase, central banker to the world. Jerome Powell has to speak today to the developed nation central banks and also fragile EM central banks as well. What's the message you need to hear from Chairman Powell that reaffirms independence at a central bank?
Jay Powell gave many important, relevant speeches here in Jackson Hole. And this year, I guess for him, it's a very important meeting. It's his last meeting in this role, giving such a speech. And what I expect from him, he is an outstanding, excellent central banker. And what I expect from him to deliver a clear message on price stability, the mandate of central banking, and this is price stability. And so he gives us this certainty we need in a very complicated world.
I want to ask this question. Bill called me up this morning and said, let's get Nagel in trouble. So here we go. I want you to talk about, I want you to talk not about American exceptionalism, but from where we sit, there's Leica exceptionalism, Mercedes exceptionalism, everything of Germany that we know. Tell us now about the future of German exceptionalism that you have to steer forward with monetary policy.
I think Germany, we are in a situation, this is definitely not an easy one. When you take the second quarter numbers for GDP, it was minus 0.3. So this year we expect maybe stagnation or a mild recession. But what I can tell you and what I can promise to you is that Germany has the capability to adapt to different situations. I think the world is changing. We are not happy with the current situation, so the trade conflict and everything is definitely not helpful. But at the end, we showed in the past our, let me say, strengths to come back and have a strong economy.
Post-Trump, can you and France and the other leaders of Europe reaffirm that growth, that spirit of growth that you had?
I guess we do something in the moment. We are going in the direction that you alluded to. We have structural reforms. We will do a lot of spending in new investments over the next year. So I think we do a lot of things in the moment, and I can guarantee you that there is a strong coalition on the European side. Germany, France, this axis is working again, and so I'm really confident that we can achieve a lot.
Given the fact that you could see some sort of mild recession in Germany, are you open to cutting interest rates further? After getting to 2%, which is sort of balanced, is it appropriate to become a little bit more accommodative?
Maybe a mild recession for this year, yes, this is true, but maybe we have also to think about that next year economic growth, there's a high probability that economic growth is coming back. When it comes to interest rate policy, I believe that we are in a kind of equilibrium. We have a 2%. We are on our target. This is good news. Interest rates are at 2%. So this is an equilibrium. So I do not see so many arguments that brings me to the point that we should do that we should do more here. So it's something. So I believe that inflation is not the point anymore.
Inflation is not the point anymore, that now it's potentially growth.
We are on our target.
But this is the issue. If inflation is not the issue, at what point do you see risk of disinflation, given the fact that the euro has been strengthening, right? That's importing disinflation. You have the potential for Chinese goods to be coming into the European region, cheap Chinese cars, that's sort of the cliche, that could lower prices. At what point are you going to be fighting disinflation again?
Well, it's definitely not time for complacency. So taking, for example, service inflation is still very high. It's above 3%. So we have to have this wait-and-see attitude. So this meeting-to-meeting approach is, I guess, the best way to do monetary policy in the euro system. When it comes to our September meeting, we will get new data, new projections, and then we will see. But at the moment, if I take all the numbers that I know, PMI numbers, I think not giving me enough arguments to change
change
the bars.
How high is the bar to cut
I think the bar is high. And so it needs a lot to convince me to change monetary policy.
The day after Russia invaded Ukraine, I had the honor of David Folkert's Landau on, and he was absolutely brilliant in predicting the fiscal expansion, the unleashing of a fiscal impulse across Europe. You're providing leadership on that. Is there a new nominal GDP to Germany which makes the business process that the Bundesbank looks over more, you're not going to like this phrase, but more Anglo-American, more modern, more new world? Is there a new nominal GDP permanence because of this fiscal impulse?
I think Volker's Landau made a great analysis in 2022. But let me take this opportunity first to say Russia has to stop this war. I think this unprovoked war of aggression against Ukraine did a lot of harm to us. I think, first of all, this war has to be stopped. And then I can give you maybe my interpretation of the current situation. Yes, you can say, well, this was an eye-opener for Germany, for the whole European Union. And we should take every step that is necessary to become more competitive.
This is so important, I have to interrupt. Do you see a new German political regime led by Mr. Merz, or there'll be a new impulse by Germany to say to Russia, stop?
I think Friedrich Merz, the new chancellor, he did it right over the past couple of months since he is in office. So he did a lot of reforms. I think he put the right things into the cupboard and say, well, we have to improve on all the structural issues. And I guess it was the right policy up till now. But now we have to implement all the things. Now this is what I can say from a central bank perspective. Now we have to come into action. We have to do it. The money is there. The funding is there. Now we have
the will.
I think there's a political will to do it, definitely.
We're about 20 minutes away from the Jackson Hole speech from Fed Chair Jay Powell at a time where all of these different international issues are very much at the forefront. A big question will be domestically how it sort of has ramifications on rates, and internationally the currency blowback as well. How independent are your policies from what the Fed does? In other words, how susceptible are you to either a more dovish or a more hawkish Federal Reserve?
I think central banking in a globalized world is like family business. So we are looking at each other for sure, but we are doing our own monetary policy. We are checking our data. Yes, we know that there are some spillovers from the US policy to the Euro system, but we are doing our independent own monetary policy.
One real ramification that people have looked at so far this year has been the dollar and how much it's weakened, particularly against the Europe. In the first 6 months, we've seen sort of a plateauing out recently, and I am wondering how much of a concern that is for you. I know that different people have talked about levels at which point it becomes a concern. Is there a point where you start to say, maybe this strength is something we don't really want?
So when it comes to exchange rates, I'm often, let me say, not too outspoken. What I can see when I'm checking the data, if you take the long-term mean of the exchange rate between the US dollar and the euro, so we are pretty much on this mean. So it's not something that is maybe producing too many concerns.
Jakob, I'm Mr. Outdoors, and so I have a question. Do the Tetons compare to the Ibsy Loop?
Oh yeah, you also have
Bavaria?
incredible language.
Is this like
aptitude.
even close to The Hills Are Alive with the Sound of Music?
I did a lot of hiking here. The Tetons are outstanding. It's so nice to be here. And now I have to go back to the conference. It is a little bit something you are to see the nice scenery, but listening to a great speech that I expect from Governor Powell. But you can be very proud to have this Teton Mountains here in the United States.
Commensurate diplomat to just avoid talking about the Alps and how gorgeous they are, but definitely
but
someone.
you have to come to Bavaria. It is so nice
We'd
there.
like to do a surveillance remote from there.
I would agree, actually, and we'll sing.
I hope you will. I hope you will invite me. I hope you will invite me.
Absolutely. Look out for that one. Bundesbank President Joachim
I'm thinking
Nagel.
October.
Thank you so much for being here. And we'll see
Thank you
you
so much.
in the Alps when we're singing The Hills Are Alive with the Sound of Music. Right now, we are just 18 minutes away from that key Fed speech. Coming up next, don't miss this. Patrick Harker, former Philadelphia Fed president, as we look at a market that's calm, up about 0.5% now on the S&P, and yields just slightly lower on the 10-year, 4.3% on the dot. This is Bloomberg Surveillance on television, on radio.
president says grocery prices are dropping. Is that what you're seeing?
If you go back to COVID and everything, they've obviously gone up since then. I think you see a pause in grocery prices right now because we don't know what to do as far as buying goes right now. The other big one that hit us today was this. India grows most of the shrimp in the world right now.
Wow.
And now this, what do we do now? This just got 50, is it 50% or 25%? I don't even know.
So how long do you think you can sustain margins here if these tariffs do not change? You mentioned the holidays. Is that when this starts to kick in?
Yeah, we're hanging by our fingernails right now. I mean, we can't do this forever. And I'm hoping all of Trump's tariff deals and everything will work themselves out.
Don't miss Balance of Power live every weekday.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, central bankers travel to Jackson, Wyoming, and we go with them to the richest county in the country. In Dallas, we take a look at its plans to challenge New York's position on top of the financial world.
Wall Street is great. The future is Dallas.
And we sit down with Chevron CEO Mike Wirth to hear what he's doing to restore some balance after all the ups and downs of fossil fuels. Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
There may be a change because I don't see any chance that there's a nod toward a September cut or any promise of a September cut. I think he's going to focus primarily on the decision framework and not give any indication of where he's leaning for September.
That was former Fed Governor Betsy Duke. As everybody waits for that key speech in about 14 minutes' time, we will hear from Fed Chair Jay Powell here in Wyoming. This is Bloomberg Surveillance on television and radio. As we count you down to that speech, we do see in markets a sense of calm after 5 straight days of losses, after a lot of gains, Tom. We've had a big market gain this year. We did see we saw a pause, an August pause, 5 days of losses, and now we're up about 0.5% on the S&P and seeing yields come in just slightly.
I take umbrage. We've forgotten what a correction is. We've forgotten what a bear market is, and we've forgotten what a 35% drawdown is.
We could still mention that markets were down for 5 straight days
because
in a
we're
row.
Abramowitz, and that's what we do. We got
even though you did see a 13% increase for the S&P 500. This is going to go in circles.
We're
going to be
flames is what we're doing.
right now. Let's have someone save us. Michael McKee is going to join us, and he's going to try to weigh in on this.
Am I going to save you?
You're going to save us. Absolutely.
I'm going to save you.
But also who's going to save us is a former Philadelphia Fed President Patrick Harker, who joins us here on set after a sojourn in Yellowstone. You wonder why everyone knows now. Everybody knows that you are hiking in Yellowstone. We've been talking about this with everyone, that it feels very different this time around. How much behind closed doors do all of the Fed members talk about the importance of central bank independence? Is that something very much at the forefront of their minds?
It's essential. It's absolutely essential. We know history, right? We know when that gets lost, what happens. We know that in this country, and we know it in countries around the world. So it is absolutely critical, the independence of the Fed. That does not mean the Fed is not held accountable. I think this is important. Independence doesn't mean you get to do whatever you want to do. There is still an accountability. There's an accountability to Congress, and there's an accountability to the markets, right? There's an accountability to the American people more generally. So I think you can't lose sight of that.
There is an argument that ultimately, if there is a policy on the Fed, whether it's response to political pressure or not, to ease now, and then inflation picks back up, the markets will be the ultimate arbiter, right? That ultimately, you will see some sort of market reaction that will be a natural check on whatever that is. Do you ascribe to that?
Yes, the bond markets. I mean, I look at the bond markets. Equities, they're choppy. They're always choppy. The fixed income folks, they're making longer term decisions. And so that's what I watch. And I think that's right. They will police the Fed in some ways. Because monetary policy flows through the markets. That's the implementer of monetary policy, not the Fed. The Fed moves one rate, the overnight rate. It's the markets that make monetary policy work.
So today, Jay Powell gets up with the markets anticipating a rate cut.
Yeah.
What does he say? Does he care what the markets are doing right now? Does he make the point that there's a lot of data? Does he open the door to a rate increase?
Yes.
Cut.
The answer is yes. All those things. I think Jay will be cautious. I think he will try to, my own sense, move things more to neutral. That is, there's a possibility of a September cut. I mean, if I think back these 7 weeks ago when I left the Fed, my last SEP, I had 2 rate cuts in for this year. I think that's still appropriate. There's one other tool, though, that he's not going to signal, which I think is important to put on the table, which is the balance sheet, right? We're talking about the rate cut, but the balance sheet runoff, my own view is I think the Fed should stop the runoff now, right? And that's a signal that we want to sit here and see how things play out, and then maybe in September a cut or later. But I think the balance sheet, we often forget about it. Again, it's small now because we slowed the rate, but it's still there. And I think it's an important signal that we want to sit and wait. We are entering a period I'm worried about. It's not the 70s, but it does feel like stagflation light, right? It doesn't feel great. When I talk to my contacts, there's something that just doesn't feel right.
Well, what's the balance of risks right now? Because we've heard a lot of your former colleagues say, we're worried about the labor market, but it still seems to be solid. We're worried about inflation, although it's only ticked up a little bit. We think it might in the future.
So I'm more worried about inflation in some ways because the labor market numbers are hard to discern right now. You think we're shrinking the labor force in some ways, right? And so we're keeping unemployment steady-ish. It's going to tick up, but steady-ish. So we're not going to see those big numbers of 100,000, 200,000 jobs. Part of it is because the labor market's shrinking.
We are mourning here at this Jackson Hole a wonderful guy, Charlie Plosser.
Yes, we are.
Just died. He was head of the Philadelphia Fed before you. I want you to recapitulate here right now, freshwater optimism about the American economic experiment that was with Finn Kinlan, Ned Prescott, and Charlie Plosser in Real Business Cycle Theory. Explain how that innovation isn't going to go away, even with the political intrusion of the moment.
No, I mean, Charlie was one of my mentors, and I just have tremendous respect for him. I was a director of the Fed when he was president, so I got to know him well. I knew him as a business school dean when I was a business school dean. He made tremendous contributions to education, to economics, and not just in macroeconomics, but economics more broadly. And so he's going to be really missed. And he was an incredibly strong and powerful voice for Fed independence.
Speak about centrist America, centrist Republicans, centrist Democrats that took, within the criticisms of RBC, said, you know what, this is about America and this is about our spirit. Is that at risk right now?
Yeah, so people would ask, what am I, a hawk or a dove? And I say I'm an eagle because I'm from Philadelphia. But now...
I don't get it.
Oh, God.
Ask people from Kansas City. They'll tell you all about it.
Ooh, sick bird.
But I consider myself right now a radical pragmatist, a radical centrist. We've got to get the center to rise up in the spirit of what Charlie and his colleagues did and reaffirm the centrality of markets, reaffirm the centrality of democracy. Those two go hand in hand. Human agency is what it's all about.
So we're about 7 minutes ahead of this speech, and one thing that you talked about a year ago when we were sitting here was something that stuck in my mind for the rest of the year, which is that at this point, you are looking at anecdotes with almost more importance than the hard data, that gave you a more real-time view of things. How much is that even more so now, given some of the questions around, forget the politics of the moment, just the collection of data, the surveys that people aren't responding to, things of that nature?
Oh, yeah, just look at employment, right? You have the establishment survey, the household survey. Those two aren't quite adding up. There's a lot of choppiness in that data right now. And so, yeah, you have to take that data seriously. And you have to be careful not to make anecdotes data, right? But you do need to listen to what people are saying. And people right now are sitting on their hands. What I'm hearing from lots of people is, I need to let some of this uncertainty. Now, the only exception to that are data centers, right? It's roaring ahead. The only problem is we don't have enough power to power these data centers. But there are areas of the economy that are growing, but a lot of people are just waiting.
Can I note here, Mike wants to get a question in. The temperature's dropped since we started live.
Oh, it feels warmer
It's gone
than usual.
43.
I'm not complaining.
Do we expect
You
snow
need to-
today?
Oh my gosh, it is actually warmer than usual.
Tom is
Mike.
now an outdoorsman.
Yeah.
42
You
degrees.
can see Pat sitting there just in a sport coat.
Yeah,
He's
understatement
fine.
of the
We're
year.
all
Carry
fine.
on.
I want to ask you about the framework review, which is something that Mr. Powell is likely to talk about today. What's the most important change that they are likely to make?
If you read the framework review, it was written in a period where we thought interest rates were going to be zero or low forever, right? And inflation was going to be under 2%. And so there was that color to the previous review. That's all going to be taken out, obviously. And I hope I haven't seen the final, right? But I hope that they then emphasize more a balanced approach and more principles as opposed to tactics. Right? We don't need to get into the details of the tactics. That's what the committee does. They need to reassert the principles of the dual mandate.
Well, going forward, under whatever new framework they have, do you think they can eliminate some of the risk that we saw coming into 2020 when Jay Powell here unveiled the last framework, which less than a year later was being junked because of COVID?
Yeah, you know, I get this question a lot. Like, before I went into every meeting, FOMC meeting, did I review the framework and that guided my decisions? The answer was no, right? You face the situation you have in front of you, and you deal with the cards you're dealt with. And so the framework provides a broad sense of where the committee needs to go, but day to day, meeting by meeting, it does not drive.
Wait, this is too important. This is breaking news. Do you read the Fed minutes?
Yeah.
Wow, redhead.
I was in there, yeah.
Exactly, of course. He actually listens, too. I am wondering, though, what the risk-reward here is, and just to sort of crystallize the moment, what the harm would be of cutting by 25 or 50 basis points. And you talked about how you penciled that in. It wouldn't be that big of a deal. Are we just making these big, grand pronouncements about the same thing, that essentially it might make sense to cut on the margins, but not necessarily go wholesale to 1%? I mean, is that essentially what everyone seems to be coalescing around?
I don't see how you would go 1%, right? I mean, that's just simply not in the cards. 25 basis points, what matters is not the number, but the signal it sends, right? Because what the Fed is, because is 25 basis points going to move the 10-year? No, not really. The market's going to move the 10-year. It's more the signal of where the Fed thinks the economy is, right, and where it's going. That's why I like the idea of pausing the balance sheet runoff as a signal. These are signals, not actual, they're not going to be reflected in people's mortgage rates or credit card rates.
Before we let you go, how much are people talking about who's going to come in to replace Fed Chair Jay Powell?
Well, all the time. You guys are talking about it all the time.
I mean, among the Fed members.
Yeah, that I don't know. I mean, I haven't really, part of my deal when you leave the Fed is you have to sort of stay on the sidelines for a while. I mean, obviously people are concerned about that. It's a very important position for this country. And so, yeah, I'm cheering for the team that's making this selection, that they make the right choice.
Patrick Harker, thank you so much for being here. Really appreciate it, and I guess go Eagles. Patrick Harker, former Philadelphia Fed president. We are awaiting that speech from Chair Powell, who is going to be speaking here in Jackson Hole in less than 3 minutes' time. Mike, we have been hearing from a number of people the fear of a 70s type of stagflation light. Not exactly 70s, but that seems to be the emphasis so far in the Fed speak we've heard so far.
Well, it's the data that we're seeing. We're seeing a slowdown in the labor market. We're seeing an increase in inflation, but I think the emphasis at this point would be on the light part of it, because it's nothing like what happened in the 1970s. And this is also very early in the process. We recognize what's going on because of what we went through the last time, so the Fed can react. And in the current framework, and I assume this will stay in the future framework, the Fed will do whatever it needs to do to keep price stability. That's going to be their main focus. And if that's the case, then hopefully they are ahead of any stagflation.
Totally unfair question to you, but I'm going to go with it. With a new framework, whatever it may be, does the Fed become ever more ex post after the fact waiting for data?
It's going to depend on how you define it, because what the Fed is going to do is take out the idea that we're going to make policy based on what we think is going to happen. And they're going to say, we're going to look at all the data that comes in. So it could be ex post, or it could be just consensus.
Do the dots stay?
Look, the dots it's all the communication tool, and how do you communicate? Maybe get on Twitter. I will say that we are waiting for Jerome Powell to come out and give his speech. We're less than a minute away. Unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer Grill.
You saw him?
I said good morning to the chairman this morning, and I did not see if it was, I didn't see if he went healthy or full English.
Oh, yeah. But, I can guarantee he didn't go full English ahead of this, but this is going to be a monumental moment for him. His last speech at Jackson Hole as Fed chair, with the whole world watching. Does he address independence? Does he deal with the inflation side of the mandate more than potentially the labor market side of things? And frankly, the international feel here, really notable, as you mentioned.
To me, that's a major theme for me, is the international community is screaming.
Yeah. Micah has some headlines.
The headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention, because it's opening the door to a rate cut. Here's the key sentence. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. The Fed is also announcing its new framework, which is pretty much as we were just talking about with Pat Harker, dropping the reference to the effective lower bound, eliminating the inflation makeup strategy, committing to contain inflation expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment. The Fed chairman says the inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising, the S&P 500 now up 1.3%, yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the make-up strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
That was Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson Hole speech that was. This is Bloomberg Surveillance on television and radio, live from Jackson Hole, Wyoming. What we heard there is they are prepared to move rates lower on the heels of their dual mandate being in conflict. We see a market reaction. We could see 10-year yields are lower by 10 basis points. 2-year yields are down by 10 basis points. So 10-year yields are down by 7 basis points. What you see is a weaker dollar, stronger euro by some 0.7%, which you can see the dollar just weakening across the board, and you can see that increase on the equity space. We have been getting some other news. President Trump has been tweeting saying that if Lisa Cook, Fed governor, doesn't resign, he will fire her. There also was some drama in the main hall of the Jackson Lake Lodge. Bloomberg's Michael McKee is with us. Mike, can you give us a picture of what's been going on as Jay Powell was speaking?
Well, it was, I guess, shortly before he spoke, Lisa Cook walked into the Jackson Lake Lodge. She was not here last night. I guess she's just arrived. And James Fishback, who runs Zora Capital, he sued the Fed in court trying to get the Fed to open its meetings to the public, and the court threw that out. But he was standing there and started shouting at her, "Why did you commit mortgage fraud?" He was apparently, according to the Bloomberg reporters who were there, escorted out by sheriff's deputies.
Yeah.
I think we have to be clear here that these are allegations at the
Absolutely.
best, that there are no charges, no process is in place at this time, right?
No process is in place at this time, and what we've seen from Bill Pulte from the Federal Housing Finance Administration and from the president are they're trying to say factually that she committed fraud, and there is no evidence of that yet.
We will discuss that at a later point. Right now, we're just still digesting the text of a 40 to 45-minute speech by Jerome Powell. It really compares to the 8-minute speech back in 2022. There will be pain. This is a complicated moment. The market sees it as maybe a little less complicated, and to really digest what we just heard, Citi Wealth Chief Investment Officer Kate Moore, who's on set with us in her beloved Jackson Hole, Wyoming. And Kate, what's your impression? I mean, how much did what we just hear from Fed Chair Jay Powell change your view of what their reaction function is going to be?
So it hasn't really changed my view. What I will say is in the last couple of weeks and talking to other people on the buy side and really getting a sense for investors, people were moving a little bit more towards the 50-50 in September, even if that's not what was getting priced into the market. There was the sense that this tension between the labor market and inflation was going to make the decision really difficult. And I think what we're hearing this morning is that, the Fed is on path to start easing rates again or proceed with the cycle. But I don't think that the rest of the meetings to the end of this year and through 2026 are done deals yet. So much is going to be data dependent. So I see the market price moves, and now with near certainty for September and on through the balance of the year. And I think we just have to watch the data.
Right. And watching the data in the Heritage of Citigroup economics is Willem Bouter, Catherine Mann out the Bank of England and all. There's a complete international and holistic view. Is this ginormous, that's a fancy word, CFA word, folks, this ginormous investment that we're seeing in AI, is the certitudes of this summer, are they at risk given the tumult?
Well, Tom, you point out something. The market's been really crowded. Most investor segments have been crowded around these secular themes. And for good reason, right? These companies are putting up great numbers. Every company across every industry is investing in AI and technology. So if you had uncertainty around policy or economic growth or geopolitical tensions or international relations or, fractures in the U.S. consumer, everyone was crowded in this space. That said, they're not crowded because these are companies with, they're crowded because these companies have great fundamentals and the path forward looks great. But what we'll have to see as we go into the back end of the year, if we get okay growth numbers, or if we get inflation that's a little bit too perky, if we get rotations in the market. I think some of the rotations in August into the small cap was unwarranted in my view.
So we are sitting here after digesting that speech, and I'm going to have to go read it about 3 more times to really internalize all of the complicated messages laid out by Jerome Powell in his last speech as Fed Chair. Mike, before we continue, Michael McKee here, our chief economics correspondent, can you just wrap through some of the key headlines once more so that we can really understand just how big of a policy shift in some ways this really was?
Well, it's a policy shift, but one that has been signaled for a little while, which is why the markets have been buying into it. But Powell basically accepted the market's argument that it looks like the labor market is weakening, and that is a threat to the overall economy. And inflation is rising, but it may not rise as quickly as the Fed had feared. And so, therefore, the door is open to a rate cut if we get supportive data from the CPI and the employment report that we get at the beginning of September. Now, the thing about what he said today that I think is important is once you open the door like that as Fed chair, it's almost impossible to close it. It would take a lot in these data points that are coming out to change that view. And the market's going to go overwhelmingly towards the idea of a rate cut. So he's pretty much baked it in at this point. So I think what then happens is it goes to Kate's point about where we go from there. The focus will be on the other two meetings this year and then what you do into 2026. And I think if you ask the chairman, he would say, we don't know yet. That's the data dependent part. But for right now, we're going to give you what you think you need.
And right now, what you are seeing is almost a certainty priced in for a rate cut next month. But Kate, one other thing you're seeing is weakness in the dollar on the heels of this.
Yeah.
Do you expect that to be very much an ongoing theme? And it just kind of edifies it, given that this is taking the more dovish approach.
Yeah, we had a pause in terms of the weakening of the dollar after a really vicious weakening in the first part of this year. And I've heard a lot of currency strategists say, we're going to tread water for a little bit. We've made a lot of the adjustment. But if the market really believes with high conviction that we're going to continue on a rate cutting cycle, I think it's fair to assume that the dollar would weaken a little bit. I think most people would say over the longer term, they agree that the dollar has been overvalued for a considerable period of time. And I expect that we'll see a little bit more of that adjustment. On balance, though, I think we're going to see appreciation in some U.S. assets, particularly the U.S. equity space, even as the dollar weakens a little bit. And I'm hedging some of the stuff and some of the concerns I have in the portfolio around uncertainty and perhaps pick up in volatility in September into the beginning of October with a little bit of gold.
Interesting. We'll catch up with Kate Moore. She's going to be sticking with us, Citi Wealth Chief Investment Officer, as we get through all the headlines and get some commentary. Joining us now is someone who is very familiar with these types of speeches, St. Louis Fed President James Bullard, who recently was in the media talking about his preference for 100 basis points of rate cuts this year heading into 2026. Also a potential contender, I should say, to be the next Fed chair. Jim, how much are you seeing what we heard from Fed Chair Jay Powell and seeing anything different that you would really say if you were at that podium?
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft. And so I think that's a done deal. He didn't say too much about beyond that, what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. So I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that they would have the framework discussion and that they would use the Jackson Hole speech to talk about changes to the framework. I thought those were thoughtful and they were well presented in this speech, and they're about what many have speculated on. So I think they did about as much as they can on the framework side.
Jim Bullard, Tom Keenan, good morning to you. I definitely consider this my conversation of the day. You served a lengthy term at the St. Louis Fed. You have lived the decline of a greater economy decades and decades ago in the effort to provide for a resurgent St. Louis. As the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to use a cliche, America flat on their back? How would a chairman execute those two Americas?
Just everything all the way around.
Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do. Providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics going forward.
Mike McKee's got a lot of smarter questions than me on the immediacy of this speech. I'm going to ask one more distant question, Jim Bullard. You're at Purdue executing online technology education every single day. How do you define the new technology productivity that America faces? Is it enough to save us? Is it enough to really add on to our present GDP?
Oh, yeah, I think that the AI boom is, it's a general purpose technology that will diffuse through the economy. I think the key question is how fast does that actually diffuse? And sometimes markets can get ahead of themselves and think it's going to happen sooner. Sometimes they're too late, and it happens faster than markets think. But nevertheless, any way you look at it, it's an important technology. It can drive productivity. And I think in higher education is one of the places where you can really have the biggest impact. We put a AI requirement in at the Daniels School here for every single student, and we're trying to expand that to all of Purdue. So I think that just shows you how important this technology is.
Jim, it's Mike McKee. I have a question about sort of the process involved in this speech. The chairman is giving his own speech, but basically when he says it's time to maybe adjust policy, he's speaking for the entire Open Market Committee. Going into a speech like this, would he have polled everybody? Does he think he has the votes for that? Because we've been speaking with Fed officials here in Jackson Hole, and there are still some who are saying, well, we're not sure that we need to do that yet.
Yeah, he's going to report on the center of gravity of the committee, even though there might be people that have misgivings. At the June meeting, the committee had a median dot plot of 2 rate reductions by the end of the year. And I think the minutes, suggested something that was more like 50-50, but then the labor market report came in. I think that tilted the balance. So he could have pushed back a little bit. I think financial markets were expecting him to be a little bit more hawkish here and try to set up a 50-50 meeting where you would wait and see for the rest of the data to come in. But I don't think that's where the center of gravity is on the committee. So he went ahead and leaned in. I thought there was quite a bit of talk about the labor market at the beginning. You could have been a little more, little more emphasis on the low unemployment rate, for instance. And, he did come out at the end of that discussion saying, well, it's in balance, but we're a little bit nervous. So I think, I think he's accurately describing where the bulk of the committee is.
Well, where would you be on this question? Because we've heard Fed officials for some time now saying, yes, we had poor job creation in recent months, but the unemployment rate, as you just mentioned, has been low. And they've described the labor market as solid. Now, this seems to be sort of a major shift in the way they view the outlook and the sort of balance between the two mandates.
Yeah, what he did at the end of that discussion, he said, well, it's in balance. But I think the committee's nervous. I think it has been slowing. And I think the policy rate is moderately restrictive. It's maybe, 125 basis points above the neutral rate. Is that really where you want to be in this circumstance? I think the answer is no. So you can come down some and still have moderately restrictive monetary policy that puts gentle downward pressure on inflation. And then the other thing I think has happened is that this argument from Chris Waller and others on the committee that you should look through the one-time increase in goods prices coming from tariffs. I think that's carrying the day. And, then he emphasized that inflation expectations remain anchored and so on. And so I think that sets up a modest move downward in September.
Jim, we've been talking with you for years, and you are very focused on the discipline of economics. Right now, I'm looking at the headlines that are crossing from the past hour. The top one, of course, is Jerome Powell, Fed chair, saying that shifting risks may warrant adjusting rates. The second one is that Trump says that he'll fire the Fed's Lisa's Cook if she doesn't resign. As someone who is thought to be a contender to become the next Fed chair, Jim, how much does it concern you that there's this increasing political noise around the seat and exactly what the path of policy forward looks like?
Yeah, I want to see due process around something like this. I want to see, you can make charges against anybody about anything, I guess, and the person can answer the charges and the DOJ can decide what they want to do and so on. So I think this has should have longer to play out before you took that step. Otherwise, it's just is kind of the Wild West, and she could get reinstated later, I guess, or something if there wasn't a conviction. So it seems messy to me. I think these kinds of charges are made from time to time against various officials around Washington, but I'd like to see due process there.
Jim, there's another question here, and aside from Governor Cook and what happens there, about how the perception of political interference handles the market reaction to Fed policy. There is this perception that could cause the dollar to weaken more because there is more of an emphasis on supporting growth and supporting the labor market than containing inflation. And some people are worried that if the Fed does cut by 50, 75, 100 basis points, as you were talking about this past week, that you could see a move up in long-end yields akin to what we saw last year. If you are on the Fed currently and you did see yields along the long end moving up in response to near-term Fed rate cuts, what would you do?
Well, that would definitely be a concern, and that's the tricky part of this business is that you think you're pursuing a dovish policy at the short end, but the long end goes up because inflation expectations start to rise. Markets start to lose confidence in the Fed and the credibility of the Fed, and that can go very, very badly and unfortunately fairly quickly. So I think you do have to be careful here. But I'm saying that I think the committee has room to maneuver if they proceed carefully over the remainder of 25 and the first half of 2026.
I don't want to get out front of the debate here or the moment, Jim Bullard, but what I would say to Chairman Bullard and Mike McKee, I got to turn to you. You and I used to sit and look at the dots and go, which one is Bullard? I mean, you and I have done
it's fairly easy after a while to figure out. I know Jim would probably agree with that.
Chairman Bullard, is your first act, if you take over the Fed, is your first act to get rid of the dots?
Yeah, I've threatened to, as president, I threatened to withdraw from the dot plot. I think this could be done better. This was discussed at the Framework Conference, and former Chair Bernanke gave a very nice presentation and talk about a quarterly monetary policy report, get more organized about it, put out a forecast. I think all of that could be done. I've advocated that for a long time, and so I think that would sort of clear up some of the misconceptions around the dot plot.
Okay, this is really, really important, folks. As Jim Bullard made economic history, I would say a decade ago, with a small, short paper, forceful on regime change. How do we get a new Fed away from the guessing and the certitude and the silly parlor game of it, Jim Bullard? With great respect, how do we get to that more disciplined study around the game of the Fed and regime change?
Yeah, I think regime switching is a great way to think about the global economy and the U.S. economy and how it operates. There are relatively long periods of time where you might have, let's say, slow growth and very low interest rates, and then you might switch to another time with faster growth and higher interest rates. I think understanding that and understanding how that affects policy choices is a great thing to study further and talk about further in the years ahead. So, I think it's very salient for what the committee does.
Jim Bullard, former Fed president of the St. Louis Bank, will be sticking with us right now in markets. You can see a cheering across Wall Street to the opening the door to a potential rate cut next month, and potentially more. You could see equities surging higher across the different indexes, led by some of the more interest rate sensitive sectors, the Russell 2000. You can see 10-year yields down now about 6 basis points, even more at the front end, down 10 basis points. As people look to the prospect of the Fed looking through some of the inflation from tariffs. You could see the dollar markedly weaker, 117 on the euro dollar cross, up 0.9% in terms of just the percentage rise, up about a basis point. And there's a real question here about what this means going forward. Citi Wealth Chief Investment Officer Kate Moore is still with us, freezing a little bit because it is a little bit chilly here, nippy in the morning. I am curious, though, about what you're hearing in terms of prospective Fed chairs and the politicization of the Federal Reserve. If this is a Fed willing to err on the dovish side, does that mean something that materially is higher with respect to returns and with respect to risk appetite?
Look, markets love certainty, and our investors love certainty, and we want a certainty in terms of the process around making monetary policy decisions. So I don't have any insight into who might be named next Fed chair, but what I will say is if there is a sense that the process is changing, I think that will lead to some pause and perhaps some volatility in the market. Our expectation is that regardless of who takes the next chair and what seats are filled, we'll have a continuation of the process of being data dependent, of being thoughtful, of having great debate and discussion amongst the Fed governors and their staff. But if that were to change, I think that would introduce volatility. I think the most important thing for us right now is to recognize that so much of the data is going to be mixed through the back half of the year, and that's going to have a huge impact, I think, in terms of investor sentiment, and I would suggest even more crowding in some of the favored trades.
We tend to get reactions like we're seeing in the market now on a day when news breaks, but I think we're probably going to see extended rally here because people are anticipating this rate cut. Does that worry you in terms of a bubble forming or some sort of excess spending that would push up inflation because of inflated asset prices?
Yeah, so I have been a little bit worried actually about positioning. I feel like I've been a little bit more cautious, frankly, than some of my peers on the street, and saying, people own the highest quality parts of the market. It's quite crowded. Some of the shorts, when we're looking at some of the fast money community, are very similar across the board. And we've seen people kind of shrug off concerns around economic growth or even the technological disruption across a lot of industries. We've seen significant improvements in terms of the earnings or vision ratios. Citi Economic Surprise Index has moved up. And all of this together, I think, sets us up for, a little bit of weakness if there was a bad data point or if there was a bit of a shock. There's a lot of consensus positioning.
Well, Jim Bullard, I'd love to bring you back in here. How much does that concern you, that sort of a bias to cut rates could cause asset price inflation to get ahead maybe of where the economy is?
Yeah, equities, except for just recently, equities have been doing very well as they've digested the new trade policy of the U.S. and how that's going to play out globally. You've got the AI boom going on, really a driver for the big tech companies, and I do get concerned that we get ahead of ourselves. Sure, it's a great technology and everything, but how fast is it really going to diffuse into actual productivity in the economy? But overall, I would say it's possible that we'll get higher productivity growth ahead and really a good outcome for the second half of the 2020s here, much as we had in the second half of the 1990s.
Right. Let me talk to the chief investment strategist, Purdue University, right now. I'm going to do a double-barrel question, first to Dr. Bullard and then to Dr. Moore. Jim Bullard, as simple as I can, all of my conversations, whether Joachim Nagel, Bundesbank, Kate Moore, Citigroup, and on, is about an elevated or persistent nominal GDP. Do you frame out that we're going to have an animal spirit in the country, whether it's better real growth, okay inflation, too much inflation, okay real growth, but what we're talking about forward is an elevated nominal GDP?
If you think real growth is going to be faster, then yes, nominal GDP growth would be faster, even if the Fed hits its 2% inflation target over that period. So, yeah, you would see higher, faster nominal GDP growth.
I mean, I look at this, Kate Moore, and it's a heart of the matter. I'm really surprised by your comments. I think they're extremely important here, back to U.S. quality, et cetera. But it sounds like Citigroup is modeling out through all the emotion, the fear, the turmoil, the political debate, as we just saw next to the 8-foot bear in the lobby. The answer here is you're modeling out that we'll be okay and there'll be a better nominal GDP. It leads into revenue, et cetera.
Look, I think we're going to have an okay growth environment, but one thing we keep on talking about is sort of the K-shape, right? There are the haves and have-nots across all the different industries, different consumer groups, and so I don't think that we want to assume that everyone is going to experience strong growth in the second half of the year. Yeah. And we're seeing this, of course, in the consumer companies. We're seeing this across, segments of different households. We're seeing this even in technology companies, those that have made the investments and are reaping dividends from it. So, yes, we may have these good headline numbers, but I think as investors, we have to really pay attention to what's going on beneath the surface. And I think there's an opportunity for differentiation over the next couple quarters.
We are looking at a market that is moving. We are looking at headlines that are coming. And I want to bring this to you, that Canada is planning to remove retaliatory tariffs on many U.S. products in an olive branch to President Trump. And there is this feeling that maybe some of the tariffs are fungible, that we are going to see some of them removed or used as a negotiating stick.
I strongly agree with what you're saying. This was sort of out there in the ether last night, but to see these headlines is another example we adjust.
Well, and that's one of the reasons why there has been a focus on the labor market. Fed Chair Jerome Powell speaking just moments ago, really focusing on the complications for the labor market.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
Some people might say that Fed Chair Jay Powell is coming around to the Chris Waller view of things, that there is this feeling of potentially the weakening in the labor market taking priority over inflation at a time where some of these tariffs are put on, taken off, and that's what we're seeing a little bit in terms of negotiation this morning.
Well, the give and the take, and it goes back to Kate Moore's optimism on investment in America, and you see it in dollar. Thank you, New York, for putting up that wonderful dollar loonie chart, and you see things adjust, and you wonder, okay, what do we do with China? What do we do with Mexico, with the produce debate, and pharmaceuticals with Europe? Guess what? There may be constructive surprises as the certitude of the tariff debate gives way. It makes it easier for the next chairman, and maybe I'll get out of triple leveraged all cash. It's 50-50.
Oh, now is the time to definitely do it. Yeah, for sure. Jim, before we let you get on with your day, I do want to finish there. That have we seen from tariffs that there is this fungibility there, that they get put on, they get taken off, and that right now the path of travel is lower from where we were maybe on April 2nd, not higher again. And so you can look through in another kind of way some of the inflationary impact.
Yeah, I mean, I think it was great to reach a preliminary deal with the EU. That's one of the bigger blocks in the world. China put on the back burner markets like that for now. And then you've got Canada and Mexico. Looks like we're headed toward renegotiation of the USMCA, which I think would be a fine thing to revisit. Was scheduled for 2026 anyway. So it's maybe a little bit more settled than it was earlier this year, and I think markets are liking that. That's making it easier to plan. So far so good on that.
Jim Bullard, former St. Louis Fed president, joining us. Thank you so much for being with us. Maybe future Fed chair, we shall see. The process is ongoing. And Citi Wealth Chief Investment Officer Kate Moore, before we let you go, I just would like your take on this, the idea that we are at a moment where suddenly people are looking through the inflationary ramifications of tariffs. Are you seeing the same kind of thing? And that's appropriate. That this isn't 1970s. This is a different shock that usually is a demand shock in the end.
Look, I will say people have been looking through the inflationary impact of tariffs for the entirety of the summer at this point. There's been an enormous roller coaster ride in terms of expectations for end tariffs. But what I will say is this, even if we're at a lower rate, I'm just going to say 15% effective tariffs relative to where expectations were in the beginning of April, I think we have to keep our eye on the sectoral tariffs. And this has potentially some of the biggest impact for overall earnings. And those are sticky, we know, and are likely to endure through multiple different administrations. So, this give and take between some of our trading partners around the reciprocal tariffs, we're watching that. It's very hard to trade around it. But I will say the sectoral tariffs are going to be very important for our outlook.
Kate Moore, you've been incredibly generous with your time. Thank you so much for being with us here. Yeah. We will see you in New York. Citi Wealth Chief Investment Officer Kate Moore. If you are just joining us, we did hear from Fed Chair Jay Powell. He said that this actually is a time where potentially they could start to look to the shifting policy dual mandate, and what could eventually come would be a rate cut in September. Mike, it seems like that's what the market is pricing in.
That's what the market's pricing in, and I'm fairly certain that's what Chair Powell is referring to. But because we're fair and balanced, I have to point out that Carl Weinberg has messaged from High Frequency Economics and said the chair didn't say cut, he said adjust, which means they could raise rates as well. Probably not in September, though.
Yeah, I don't know. I'm not thinking that that's actually at all what he meant. What do you think, Tom?
I think it'll be great to speak to the former vice chairman here as well. Within what we heard there from Jim Bullard and from Kate Moore, Mike McKee, to me, what is so interesting here is the outcome of the tariff debate. And the answer is we simply don't know. Today, it's Canada. Monday, it will be someone else.
Well, here's the thing. Tariffs are bringing in a lot of money right now. It's not that the other countries are paying it. We're all paying it because it's a tax on basically the consumer in the importing country. But what the administration seems to have done is made up for the deficit we're going to get from the big, beautiful bill by raising everyone's taxes and not telling them that their taxes are going up. So people are accepting it, which may mean, as Bloomberg Intelligence is putting out in a story today, that those don't go away, that we get used to this higher price level and get used to tariffs, and they stick around because they do add revenue. It's coming out of our pockets, but they do add revenue to the government. So what's the end game? If this is working and adding money to the Treasury's coffers, then this president could use them in many different ways, many different times to increase revenue. So I think that we're going to be living with this for a while, and the uncertainty it brings for a while.
Well, let's take a listen to what Fed Chair Jerome Powell had to say about tariffs and what the impact is on the economy. Take a listen.
The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem.
What you can see is the response is rip-roaring in markets, with equities surging, yields plunging on the front end, a yield curve steepening, and a dollar weaker. PIMCO Global Economic Advisor and former Fed Vice Chair Rich Clarida joining us now. And Rich, what's your take on what we just heard from Fed Chair Jay Powell?
Well, I think the chair certainly intended to open the door pretty wide to cutting in September. Importantly, Lisa, He spent a lot of time on balance of risk, which is what policymakers do, but at the two key junctures, he highlighted the balance of risk to the labor market is to a weaker labor market, and he basically indicated that the balance of risk to higher inflation doesn't appear to be a first-order concern in terms of persistent inflation. So I think the message was they think they're going to cut in September. We get some more data, and the markets have reacted to that.
How much do you think that this is partly to maintain the Fed's credibility, not necessarily with respect to the president, but that right now, if they get it wrong on the labor market front, that it is that much more pernicious based on some of the job owning by what we hear from the president?
Well, yeah. I mean, as the chair said in the remarks, it's a curious kind of balance in the labor market. The payroll employment growth has been very, very weak in the private sector, but the unemployment rate has not gone up. And so they are really focused on the balance of risk. Look, the Fed has a dual mandate. It's costly to let inflation move higher and stay there, but it's also costly to have a recession with a rise in the unemployment. And I think, Lisa, you're correct. They are tilting in that direction now.
It feels like a very different Jackson Hole, and this is something that we've been talking about with all of our guests today, Rich, that people have come on and said there is a different tone about central banking independence and a question of how to communicate at a time of such political interference. What's your sense of where that was in the speech that we just heard from Fed Chair Jay Powell?
I think the approach the chair took was to really focus front and center, Lisa, on the dual mandate. That's assigned by Congress, maximum employment and price stability. And the chair gave a very reasoned and thoughtful analysis and discussion of how they're balancing the dual mandate risks. And I think that's the Jay Powell message to the issue of Fed independence. We have an assignment from Congress, and this is what we're doing to achieve it.
At this point, we also are dealing with the headlines that are coming out about Fed Governor Lisa Cook, where at the same time that Jerome Powell was giving his speech, President Trump came out with this truth post saying that he will fire Lisa Cook if she doesn't resign. We did hear reports that in the Jackson Lake Lodge in the lobby, that James Fishback was screaming at Lisa Cook that why did she commit mortgage fraud? What's your take on what this does in terms of both the Fed composition, but also just the ability to be clear-minded about making Fed policy?
Well, obviously, understand, just looking at the headlines that you mentioned myself, and don't know the details or the facts in this particular situation. But clearly, we're in an environment where Fed independence is under scrutiny. And my conviction is that, notwithstanding all of the very relevant factors that you mentioned, that the Fed's is going to keep doing its job.
Richard Clarida, Tom Keene here. Thank you so much for joining us. Very valuable. I've got two tasks I want to take here that I think are important. You recently said that what matters is the institution, that this chairman and any future chairman has to protect the institution. What's the day one first mandate to protect the institution for the next chairman?
Well, I think first and foremost, it's to have in place a plan and communication that will deliver expectations of price stability. I think the chair was right today to emphasize that the Fed has to focus on getting price stability because that's going to deliver the ability to deliver maximum employment. Right. I've also written, Tom, that the Fed is sort of a complex and cumbersome institution with 19 folks around the table and the Reserve Bank presidents. But I do think that is a strength right now of the institution.
Right. Well, this is really important because it's as fractious as a meeting of the bond team at PIMCO. In the middle of the speech, Powell channeled a few years ago at PIMCO the new normal. For a moment, I thought Mohammed Hilarion had parachuted in to write the speech. What is your optimal new normal for the Fed, which Powell mentioned today? What's the best new normal for the next Fed?
Well, I think a new normal would be inflation moving down towards the 2% target, which would let the next Fed chair cut rates down towards a neutral level. You know, PIMCO in 2014, we rolled out the idea of a new neutral, and we've been operating in that new neutral world now for more than a decade. And so I think well-anchored inflation expectations, getting tariffs in the rear view mirror would allow the Fed to cut rates by probably 150 basis points from here and achieving that ultimate soft landing. So I think that would be a good new normal destination for the next Fed chair.
What risks are there to that, given what we're seeing with the dollar, given the fact that we really have a very high level of uncertainty around which tariffs are going to stick and how much is going to get passed along to consumers?
Sure, and I think the chair was right to point out that we are seeing evidence of tariffs showing up in the price indexes for imported goods, but that's been offset to some extent with a decline in services inflation. Again, I think where they are focused is to make sure that what is an inevitable increase in the price level from tariffs does not over time result in persistent inflation. And I think the speech today addressed their thinking right now, which is that their baseline is that that will not happen, which will give them the room possibly in September to cut rates.
Yeah, Lisa, I think it's important to mention within the market check that the market is putting on steam here an hour after the beginning of the speech, and Mike McKee's bombshell headlines, the Dow lifting up. I'm not told I can't leave Jackson Hole unless Dow goes up 1,000 points. Well, I'm getting pretty close to it.
It sounds like you're going to be hiking for maybe another 6 hours, and then all of a sudden not so much. Rich, I do want to know, though, about what this does in terms of the currency ramifications and where your preference lies in terms of the good investment backdrop, because what we heard from Fed Chair Jay Powell was so vastly different from what we heard from Joachim Nagel of the German central bank, where he said, we have to focus on inflation. And right now, that is more concerning to them than trying to support growth by cutting rates or being stimulative. The fact that that is the framework there, and it is such a different framework here, does that make you want to invest in Europe a little bit more?
Well, you know, I think one of our themes at PIMCO is that we're in a world where taking advantage of a global opportunity set makes sense. Also, we're in a world where it makes sense to focus on valuations. And without getting into particular markets or securities, there have been some pretty big divergences between valuation in the U.S. and Europe, especially in equity markets. Also, you know, the Europeans are much closer to their 2% target than is the Fed, because from the Europe point of view, the tariffs are really a disinflationary force. So we're at different points in the rate cycle, and that does open up some good opportunities.
Richard Clarida, you are definitive in the mathematics, the modern mathematics of our economics. Then, you know, we talk about a new framework, and it's a lot of jawboning about process. Maybe it's what are we going to do with the dots? What are we going to do with the mathematics of modern economics forward? Is it diminished after all this turmoil?
You know, Tom, you and I over the years, decades now, have talked about that a number of times, and my thinking continues to be the mathematics, the models, including my own, are tools. They're a starting point for analysis and discussion, but they're not handcuffs, nor are they the destination. And certainly, you know, the last 5 years have been unusual with a pandemic and all the rest. But I continue to believe that models and math are tools, not handcuffs.
My goal right now, Rich, is to get you on the short list is to be the next chairman. So let's talk tariffs here. What is the Clarida mathematics of Trump tariffs?
Well, as Mike McKee said, they are raising a heck of a lot of revenue, and I would agree with Mike.
There you go. There you go.
I think Washington may very quickly get hooked on the $200 or $300 billion a year in tariff revenue, especially if, you know, the initial cost of raising that revenue is in the rearview mirror, which I think I expect to be the case down the road. Look, we're in a different regime. You know, we talked at PIMCO in June about an era of fragmentation, and these trends have been accelerating, and the destination for the global trading system and global economy is going to be very different in 5 years than it was in the 30 years of globalization. So I think to be continued is the way I would answer your question.
He's running? Is that what you think?
I don't know if he's running. I know Bullitt's running.
Yeah.
I think by the time we get done on the show today, we're going to have Tracy Alloway running.
I think that maybe. We'll find out in just a hot second. But I am.
Yeah.
We will. She's sitting here with us. I'm sure she says hi back. Rich, I am curious, though, going forward, this idea of how inflationary tariffs could or couldn't be, given the fact that this is a new world order. And we were talking with Adam Posen of the Peterson Institute earlier, and he was talking about how he sees inflation as having nodes of the 1970s and potentially being really pernicious. Why do you not necessarily see that? Why are markets more sanguine on that risk?
Well, I think simply because the 1970s were a very serious experience for the current group of policymakers who lived through it. And I think there were some important lessons learned. And one lesson learned is high and persistent inflation is very costly to the economy. And I think politicians learned that as well. And so I think that central banks have earned a lot of credibility under Volcker, under Greenspan, under past Fed chairs in the U.S. and abroad. And I think that expectations of inflation, we're sort of in a world in which the bond markets at least think that over a 5-year period, the Fed is going to do whatever it takes to get inflation down, what I call 2 point something. And I think that's an important victory that central banks are still benefiting from. And I would expect that and certainly hope that will continue.
Richard Clarida with us. For all of you on radio and TV, we've extended this wonderful show with a huge market move we see today off of the Powell speech. I want to turn to Michael McKee because my head's spinning. I've got Chairman Bullard, Chairman Clarida, Chairman Alloway, and the rest. So when they're in the Oval Office and they're sitting on the couches, and President Trump is going to turn to the people he trusts here. Let's start with the Secretary of Treasury. What is Bessent going to say to him about the qualifications needed for a Trump chairman?
Well, probably from Scott Bessent, you would hear the importance of being able to relate on Wall Street. It was put once to me that the Treasury Secretary's job in terms of the markets is to be able to calm them down when something is going wrong. And so that would argue for a certain number of the candidates, maybe Ms. Alloway fits in that category, that have that gravitas to be able to do that. The idea that you want to cut rates is that's not really part of it, because you wouldn't be on the list if you didn't want to cut rates at this point. So it's going to be somebody who is the president will feel comfortable with. Maybe this move, if the Fed cuts rates, he's more comfortable with a wider group of people because he's started to get what he wants.
Add Joe Weisenthal?
We could add Joe Weisenthal because well, we don't know. If the president is a country music fan, we'd have to find that out first. But I think going forward, the one thing you could say maybe out of this speech is if in an ordinary administration, which wasn't going to be subject kind of the whims of the way Donald Trump does things, this would have really given a boost to Chris Waller. Because essentially what they're saying is Chris Waller was right that inflation, look through inflation from tariffs because it will be a one-time price boost.
Yeah, now the question's going to be, and ultimately, is this going to be a hawkish cut or a dovish cut in September? PIMCO's Rich Clarida, you've been incredibly generous with your time. Thank you so much for being with us as we dissect that speech. It was a lot longer than his prior speeches, and it was one that signaled the beginning of a new rate-cutting cycle. They have not cut rates since December in 2024. Just to give you a sense of what Jerome Powell had been talking about in that speech, he addressed a number of challenges facing the Fed and his forward projection on policy. Take a listen to what he had to say.
When I appeared at this podium 1 year ago, the economy was at an inflection point. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. There is significant uncertainty about where all of these policies will eventually settle. While the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with policy in restrictive territory. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
This has sent markets absolutely surging across the board in the equity space. Let's take a look. S&P up more than 1.5%, and as Tom was saying, as the session grows on, you see those gains just building. In the bond space, you can see two-year yields plunging by 10 basis points, 10-year yields down by 8 basis points. Again, gaining steam, almost a certainty that they are going to cut rates come next month. Then you have the dollar weakening dramatically. You see the euro now 117.28 as people look to the potential for an ongoing accommodation, even in the face of inflation that is still above that 2% target. This, to me, Tom, really does speak to the moment that we're in. People were expecting that maybe this was going to set the tone, and certainly right now in markets, it is.
Yeah, I have to wait to see what the action is, and the action this morning was to bring in a more accommodative regime. I'm sorry, we still have data coming up, and they may be sobered by the CPI data. I don't have a strong opinion on this, but I got to look at the data. I think I trust the data.
Well, we have two prospective Fed chairs here joining us now. Tracy Alloway and Joe Weisenthal. They also are the co-hosts of Bloomberg's Odd Lots podcast. And I believe you were actually sitting in the lobby, were you not?
Yes.
When we heard James Azora. So what actually happened? Yeah. Yeah, I mean, this is really a different kind of Jackson Hole that's fraught with that political question.
There's always someone who jumps into the lobby and says something,
Is that really?
This is the tone shift, though, because a year or two ago it was about climate change, and now it's about mortgage fraud.
Yes. No, there is. So now it's like a direct attack of this sort of attempt to maybe like change the composition of the governor. There's always someone who makes a scene, but this time obviously more directed at this impulse coming from the White House about changing the board.
There's also just more security around, which I'm sure you've noticed. Plus, there's more journalists around, which kind of indicates that the story has gotten even bigger.
Yeah, although Tracy, and this is something that I know that we've talked about before, this idea of the economic discussion being so interesting at this moment, whether it's immigration, whether it's what's going on with AI, whether it's youth unemployment. And based on what we heard from that speech, he really was trying to massage that and talk about his concern there.
Yeah, I know you guys were joking about me and Joe running for Fed chair. I'm just going to say right now, I don't want it. I don't want it. This is one of the most confusing moments in economic history that I can remember, because you could make a strong argument either way for staying the course on rates, for cutting rates, or for even hiking rates. We spoke to Kansas City Fed President Jeff Schmidt, and he was talking about how if you look at the Taylor rule right now, the Taylor rule actually suggests that maybe we should be thinking about a hike. I'm not saying you have to stick to the Taylor rule all the time, but it's something to think about.
Pro tip, if you want a good habit as you go into autumn here, listen to read Joe Weisenthal's newsletter. You had a newsletter within the last 48 hours. You're talking about a set of narratives forward. Which narrative today won within the Weisenthal newsletter?
Well, look, today is about the short-term cyclical, the short-term question of the cycle. And as Tracy pointed out, I think this is a very interesting moment precisely because there are many people, it's not necessarily saying like, oh, we need to hike right now, but they are saying like, look, there are conditions in which when you look at stocks, spreads, unemployment, and inflation, maybe many people, if this were severance, you're just waking up right now, you'd say, no, we need higher rates. And you didn't really hear that from
Is this a one-off cut that we're talking about, or do we still maintain a Greenspan-ian anchor where we're going to set up a trend here of rate cuts?
I think the only thing I can say, or that I would feel confident saying in response to this, look, the market does not see a deep cutting cycle, right? I defer to the wisdom of the markets, whether it's 1, 2, 3, whatever, like by and large, this is not a market that thinks there's a ton of room to cut.
Joe's still in efficient market hypothesis guy.
That's right.
Right now, I'm watching the crowds gather for the walk that we're expecting when Fed Chair Jay Powell comes out. And we are expecting him to be with some of the other international leaders. And we were talking about the international tone here at this particular Federal Reserve confab. How much does that really influence, do you think, the message that we're hearing from the U.S. Central Bank?
I mean, I think Powell has to walk a really fine line here where he's clearly paying attention to the U.S. domestic economy. That's the mandate, the dual mandate, right? But on the other hand, you do have other central bankers here. And as everyone knows, when the U.S. economy coughs, the rest of the world catches a cold and all of that. So it's a fine line. It's, a diplomatic exercise in many ways.
I also think, if there are questions about Fed central bank independence or central bank independence at the Fed, there's going to be questions everywhere, right? Like the U.S. is you would think sort of the gold standard globally for a good institutional arrangement and so forth, and aspired to by many places elsewhere. If this is an important debate here, it's going to be an important debate everywhere.
This actually was the reason why Joachim Nagel really got emotional actually talking about this, and really was focusing on how the United States allowed Germany to follow the mold of an independent central bank, which allowed it to emerge from World War II with a currency and with an economy. I mean, that to me is really this ultimate key question. How much does a loss of independence or even perceived loss of independence in the United States really trickle out into central banking policy around the world?
Well, I think the difficulty is no matter what they do now, there's an optics problem. Even if Powell really convincingly feels that he should be cutting rates, there are going to be some people who say, well, maybe he felt the pressure from Trump, and so he's sort of doing it because of that reason. Central bank credibility takes a long time to build up, and you could argue the Fed has been building it up basically since the 1980s now, since Volcker. It goes away really, really quickly.
It goes suddenly. Suddenly is the operative adverb. Now, you guys spent August in Alaska, and the rumor is you're heading for Japan. Is it September or October?
No,
we're going to get the walk.
We're making stuff up here.
And the guy with the biggest headache at the walk right now is Ueda of Japan, if he makes an appearance. I just looked at the Bloomberg, folks. The magic of the Bloomberg on your cell phone is when you need to look at the 20-year Japanese piece, you can look at it. Tracing, nobody's talking about this. Yields unraveling, price down, yields up in Japan. What does that signal to the international central bank community?
I mean, I'm still kind of surprised that Bessent was jawboning the BOJ recently. That to me is like a new angle in politics meets central bank policy. That's all I'm going to say.
I'll just say, look, you look at the last 5 years, there's a global factor to all of this. Inflation rose and fell everywhere, to varying degrees, et cetera, but almost every, especially developed market government, is essentially dealing with the same set of questions all in unison. There's slight changes at the margin. Inflation peaks a little lower here, a little lower there, but all of these stories are really global stories, the entire sort of developed world.
Can we talk about investment in America? Give me the wide shot right now, if you would. If anybody's still awake in the tent, give me a wide shot here. And the most important thing here at Jackson Hole this year, besides Chairman Alloway, is the split rail fence behind us, of which the leaders of central bank world are going to walk up to next. We have an investment in a brand new split rail fence at Jackson Hole. The last one was installed by Lewis and Clark a few years ago.
Thank you for this breaking news, Tom. This is really definitely the way to go.
But this, again, is the investment of America that you're going to see. We have a spanking new fence.
Yeah, and it's going to generate energy for all of the power centers that we have to try to generate II. That's what
I know this is kind of a joke, but I think this is an important point here, right? Because I was, one of the questions I've been asking, we've been asking lots of people, it's okay, 2025 versus 2019, why is that long-term rate higher? Why did market expect? There's just a lot of investment going on globally. Part of this reshoring, et cetera. And so I think, I think we should take the split seriously.
There's capacity issues as well, right? And the thing about this Jackson Hole is it resembles the 2021 Jackson Hole quite a bit. I think you were both there at the time. You remember the argument back then was, okay, pandemic supply chain issues were going to be transitory. We don't expect them to feed into services, inflation, just goods. You're hearing something very similar right now when it comes to tariffs, right? We think tariffs are going to be a one-time price level change, just isolated in goods, probably not seeping into services. I guess we'll see.
Well, to me, this is the key question. How much were people scarred by transitory?
Yeah.
And it seems like maybe not so much.
So inflation is all top of mind for all of us, right? Think back to 2020. We hadn't seen interest rates like much above zero for years and years and years. We all remember inflation now. I'm sure a bunch of companies remember the inflationary playbook now. So.
Indeed, which is the reason why potentially they could adjust and adapt and keep prices going higher. Tracy Alloway, Joe Weisenthal of Bloomberg's Odd Lots podcast. Thank you so much, both. And just for the record, Tracy is not in the running for a Fed chair. Well, she just said she doesn't want it. So there we go.
Just rejected
exactly.
it. You go for it,
there we go. So Joe is going to run himself. Right now, let's take a look at markets because it really has been a dramatic move. We have seen equities across the board shooting higher. The Russell 2000, let's just focus on that, up 3.9% as people look to the prospect of rate cuts. The S&P up 1.6%. The Y is in the next board, which is bonds. You could see yields plunging, particularly on the front end, with expectations of a Fed that is going to cut next month. What we are seeing is across the board, two-digit returns, 2-year yields, 5-year yields lower by 11 and 10 basis points apiece. 10-year yields are lower by 8 basis points. Even the 30-year are responding, but not that much. This is a yield curve steepening that is global, and I think that's interesting.
The 30-year would be a bigger move, and it's just not.
Well, you aren't necessarily seeing yields rise, which is a good thing, but you also aren't seeing them fall as much as people look to growth and potentially inflation. If you play this out in the currency space, it is the story you would expect. Dollar weakness in a significant way, down by 0.9% on the Bloomberg U.S. dollar spot, and we can see that across the different currency pairs with the euro, the yen, as well as the other majors. Right now, I'm really focused on the euro in particular, given the fact that we just talked to a member of the European Central Bank about why they will not cut and why they think they're in a good place at 2%, which I think is notable.
I agree. They're in a good place, but there's a wonderful debate about what's next for the ECB. It's off the U.S. radar, but again, I go back, folks, to animal spirit, to the nominal GDP. They just don't have the technology oomph that we have. So is there right now where it should be? No one, I don't think Christine Lagarde knows the answer to that.
Well, Christine Lagarde, I believe, is here. Also here is Michael McKee, a very similar person in ranking and stature for us here at Bloomberg. And what are we looking for? We are waiting for this walk with global central bank leaders at a time when potentially we could hear more about what this cut really looks like. Is it a hawkish or is it a dovish cut next month?
Well, I don't think they're going to say anything that we can hear. It's sort of set up that way. But one of the things that this may do is add some symbolic support for Jay Powell, because he's going to be walking with the three major central bankers in the world besides himself, who all agree that central bank independence is important. And at a time when Powell's under political pressure, it's a picture that's worth having for the Federal Reserve. They're going to do it a little bit differently this time, walk down a different ramp so we get a nice picture of them with the mountains in the background. But this has become a staple of Jackson Hole, and ordinarily it doesn't mean a whole lot other than it gives the TV networks a chance to have pictures of the Fed chairman here.
Right.
In this case, it may mean a little bit more.
It shows the marking of time. I have the clearest memory of 07 with Stan Fisher, the late Stan Fisher, I should say, on the phone, down the walkway here, on the phone for 3 hours as the world fell apart. How does the walk and how do these meetings, how are they different from 15 years ago?
Well, 15 years ago, television was barely getting started here. It wasn't such a big deal. And it has now put a focus on the chairman's speech that was never there before. This is an academic conference. Now that Chairman Powell is done, they're talking about academic papers, discussing them in a way that university professors do, about things that will happen years from now, or trends that are going to extrapolate out. The Fed chairman's speech has now become a focal point for Wall Street because there's not a lot of other news in August. And so that's the major change here, is that we're all here because of that.
And the other change with an aged Alan Greenspan is it used to be the chairman only spoke about monetary policy, never the fiscal space, never ever the dollar. Remember Phil Graham taking Greenspan's head off one day over that. Now everything's fair game, isn't it, for each and every central banker?
Well, you watch Jay Powell. He avoids, very strongly avoids anything that would represent a judgment on fiscal policy. The Fed doesn't have a choice. It has to accept the fact that there's going to be tariffs, and that's going to have an economic effect. So he talks about that. But he will never say whether tariffs are a good thing or a bad thing. He won't even say what I'm saying, whether the tariffs are a tax on you and me. When Alan Greenspan did that, which was basically when we were running a budget surplus and he endorsed a Republican tax cut, every other chairman felt like the Fed got its fingers burned there. And so they're not going near that stove. They want to stay away from fiscal policy. Now the question is, where does the Trump administration go? Because they have talked about being the fiscal side, the Treasury Secretary, the President, more control over monetary policy.
Right, Lisa, cut me off. We have to go to the walk. This is an important question for both of you. Are we beyond the pandemic at this Jackson Hole?
That's a great question.
I don't know if we are or not.
I guess my question back to you would be, what do you mean by that? The supply chain disruptions marked by the pandemic have continued, but maybe for different reasons, and the labor market has been transformed. And whether that's the pandemic that accelerated it or whether it's the post-pandemic economy, that I think is something that they're grappling with.
Do those academics in that lodge, do they believe we're beyond the pandemic?
I don't know if they believe we're beyond it, but yes, the pandemic, as Lisa said, has had a completely, has changed the economy completely for the future, because we've seen a move to work from home and work from wherever, work from Jackson, which Kate Moore is doing, that sort of thing. And it has had an effect on the economy overall. We've seen the baby boomers retire faster than they had been before, and that raises questions about what the size of the labor force is going to be. So it had profound effects on the overall economy that we're going to be dealing with for a long time.
There's something else that has changed materially since 20 years ago, 30 years ago, or even just 5 years ago, which is the type of communication that the Fed has to engage with has changed. And it has changed with some of the political pressure and some of the true social posts that are coming out in real time as Jerome Powell does speak. And it raises a question, how does this Fed message to the American people? We actually want to be true to our dual mandate, and we are not politically motivated in any way. And that was something that Patrick Harker mentioned, that maybe this would be dovish in spite of the political pressure to say, look, we're not going to cut off our nose to spite it too. We are going to stick to the economic data, and we want to prioritize some sort of soft landing above getting inflation very quickly down to 2%.
Well, just there, I mean, what you're saying encapsulates where we are, because the Fed would be reacting to the tariff effects on the economy no matter what. But now people are going to look at all of this through a partisan lens. It becomes a political thing. I was talking with Ben Bernanke last night here, and he was saying it's a good thing that social media wasn't around when we had the great financial crisis, because you can only imagine with the steps they had to take at the time, how so many people would have reacted.
Lisa, I'm looking down the alley where you and I played bocce one night drunk when we came out of the grill here. And the press down there, folks, you can't see this on camera right now or radio, but the press is triple what I've ever seen.
And that's the reason why security has also been triple or quadruple, as Tracy Alloway was talking about, because there is this renewed focus for the political reasons, let alone the framework review. I'm sure that all those journalists are very interested in the details of the framework review, but I have a feeling that that might have been another reason why they came here today.
I look at the moment we're in, and yes, we've got the market move. I haven't looked. I don't know where Dow futures are or that, but we're lifting, Mike, and it's sort of a all-clear feel into what you're expert at, which is that next inflation report, that next jobs day. Already, what's the gaming of those two reports?
Well, it's going to take a lot in there to change the Fed's path now, because I said earlier, once you open that door, it's very hard to close it. And the interesting thing is going to be that when we get that CPI report, we will be in the Fed blackout period. So whatever we get out of the jobs report will be what the market sets its expectations on until we get to CPI. The market may move a little bit, but the Fed's not going to have a chance to influence it after that. So we're looking at this rate cut, and then it becomes, and I guarantee you, Lisa and Tom, we're going to be talking on September 17th before the Fed meeting. We're going to be saying, well, so what is he going to say about the next meeting? Because then that's going to be the next question: is do we continue the string of rate cuts, or is this one and we wait for a while?
I mean, a little vignette here, folks. Yesterday, the papers come out. They won't let me see them. I'm a danger to society. McKee gets them all. And he prints them out and he reads them just like your freshman year in economics. Mike, within the grind that you do, where does this end up for the November meeting, the December meeting into next year? Or are people like you just completely focused on the 17th of September?
Right now, you have to focus on the 17th of September, but I say that economists are more focused on the 5th of September for the jobs report and the 11th of September for the CPI report, because those are going to inform us as to what the odds are that the Fed is going to do something or need to do something going forward into the rest of the year. If inflation rises faster than Chair Powell suggested today, then they might have to say we're going to pause for a while.
Lisa, is it rude to ask Mike if we can trust the numbers? The jobs report numbers?
No, I think that that's very much, you could speak it actually not even in a whisper.
Really?
Yeah.
Do you trust the numbers of the jobs report? I'm not kidding.
I trust the numbers of the jobs report as that they are as good as they can be under the circumstances. The people at the BLS are dedicated public servants who don't have a partisan bent to them. They are more interested in statistics than anything else. And yes, there are problems with the surveys, especially declining response rates, but that's not a political effort to manipulate the data. They're doing the best they can. And as we've always said about the Fed, they have to work with the numbers that they have. There will be revisions, but when they're making their decision, they work with the numbers that they have.
We are sitting here in front of the Grand Tetons waiting for the walk with Fed Chair Jay Powell and other luminaries. We understand Christine Lagarde among them as they walk out for a picture with the Grand Tetons as the backdrop, as is the tradition for Jackson Hole and the speech that we get at the symposium of the Fed. We have not necessarily heard that there is any kind of movement yet. We will bring that to you when we see it. What has been notable is that the speech took longer. There was a little bit of a delay with him getting to the speech, and it seems like maybe this has to do with security, maybe it has to do with the sort of import of the moment, but this has definitely been a different type.
I was not in the room, but I understand one of the reasons for the delay was that the audience gave him a standing ovation as he went up to the podium.
Very strong sense of trying to celebrate him in his last speech.
An audible here as we wait for the walk. We have a beautiful shot for Bloomberg Radio. It's of this magnificent international architecture of the Jackson Lake Lodge. Lisa, this was the architect who put the series together of the lodges, and we think of them like North by Northwest, Alfred Hitchcock, these gorgeous traditional Americana lodges. And then 60 years ago, OMG, they made a modern international lodge. This lodge, when it was built, caused an uproar in the West.
Yeah.
Absolute uproar.
Yeah, and Rockefeller, John Rockefeller, very much present here. You can see his name emblazoned on a rock that is up this trail here. I do want to bring you some headlines that we're hearing from other Fed members. Beth Hammack coming out and saying, I heard the chair is open-minded about September. My expectation is we will see inflation continue to rise. She has been out there talking about the importance of keeping focus on inflation. She said we may see unemployment continue to rise as well. We need to maintain modestly restrictive stance of policy. So not necessarily endorsing this wholesale dovish policy as the market seems to be taking and running with at a time when inflation has actually crept higher from the last time we were here. That said, a one-time price shock, as Jerome Powell described it, isn't something that should derail the labor market. And one thing that I thought was really interesting, Mike, in the speech that he gave was this idea that their dual mandate, when it comes into conflict, they need to weigh them equally. But it does seem like the labor market is taking a front and center focus at a time where inflation is still expected to creep higher over the long term.
The last framework set up what to do in case of tension between the mandates, and they kept this idea in the new framework. Is you look at both of those and you see which one is going to move the fastest in the wrong direction. And in this case, Powell was suggesting that unemployment, that the labor market could deteriorate faster than inflation rises because the tariffs take time to work their way into the economy. And so that's their concern. And that is why he is essentially signing on to the idea of a rate cut, because they want to make sure they get ahead of the labor market weakening. They have time to react to the inflation danger.
Marut, I asked you this before, but I think it's so important we've got to do it again. Do you assume this was stated as a one-off or maybe a two-off rate cut, or do they set a vector here of 3 or 4, whatever number of rate cuts?
Well, I think what it is set up for one rate cut, and he's not endorsing a continuing series of rate cuts.
Is that a radical change from previous?
Well, it's a radical change in the sense that the Fed was not committing to September. And now, while he didn't specifically say that we're going to cut, he essentially did that. The markets are going to take it that way. Where they go from there will depend on what happens with the data and the economy. And I would point out that September is a month where they will give us new economic projections and a new dot plot. So we will get an idea of where they think they're going to go from here and how much more they think they're going to have to do when we get to September 17th.
Yeah, we are sitting here as we talk about what potentially will come down the pike. 6 minutes late. This is unusual for Jerome Powell. He is very punctual usually. That's really interesting.
It's not up to him on the walk. What they are doing, as soon as he's done, they start the first session, the first paper. They discussed it, and then they have the discussion of the papers. And I'm told from our reporters inside the meeting, who are sitting in my chair, that the session has wrapped. So we could see this any moment now. They've got to get everybody together and walk out.
Very quickly here, what happens the rest of the day and into Saturday here? The press leaves, I leave, McKee stays. What happens?
Well, you leave, but we don't leave. The rest of the day, we have another paper and we have another discussion. Then there is a luncheon speech today. Ruth Porat from Alphabet is the luncheon speaker today.
Well, right now we do see Jerome Powell walking out with Christine Lagarde in tow. I believe Andrew Bailey also there. They are all walking and talking as they walk down the staircase. Mr. Ueda of Japan, a very long way to walk to fly from there as they approach the family photo this year in front of the Grand Tetons.
I can state in all the years I've been here, there's never been a photo like this. This is the absolute first, my comment on this, of the international audience standing up for the central banker of the world.
I think you can read some symbolism into it. I wouldn't read too much, but because they normally walk with a central banker from another country if they happen to be here. But the choice to have all three of them go out there at the same time is sort of an idea that we all support central bank independence. And we probably will hear that from them. Bailey, Ueda, and Christine Lagarde are speaking tomorrow on a panel together, and I think that will be, we've been told from the reporting from our Bloomberg News colleagues in Europe that that's going to be a message that they deliver. Not maybe mentioning Jay Powell by name, but mentioning the idea that central bank independence is very important.
Can we just sit on how historic this moment is? The last time that Jerome Powell will be giving this speech that he just gave at Jackson Hole at the symposium held by the Kansas City Fed in the Grand Tetons. You have the head of the European Central Bank, you have the head of the Bank of England, you have the head of the Bank of Japan standing alongside the head of the Federal Reserve looking out over the mountains at a time of highly complicated economic questions. And really, to me, goes to the question of how they deal with it going forward and how they fend off potential accusations and job ownings from administrations around the world.
In the single tightest, most intense 30 seconds of this show today, folks, from Jackson Hole, was a gentleman from Germany, Joachim Nagel, speaking, Russia must end the war. And for these central bankers, particularly Madame Lagarde, they're distracted, by that war.
Mike, can you give a sense of the international presence here this year versus prior years? There typically is an international presence, but does it feel different this time around?
There are more international central bankers here, and one thing that I found unusual on the guest list is there are central bankers who haven't been here before from the Middle East. So there's an expansion in the efforts by the Fed to bring people into this situation who are becoming more and more important. It's not just the big four central banks, but others who are going to play a role in the future. So they're integrating them into the discussions here because certainly from Africa and the Middle East, you're going to have much bigger economies going forward.
Mike McKee, Adam Posen with us earlier saying it is a post-American world. He talks about a new economic geography for the world. For these three central bankers, do they feel less support from the American Central Bank?
I don't think they feel any less support from the American Central Bank. They may worry that the central bank in the U.S. gets its powers crimped by the administration. One of the big innovations of the Bernanke years was the use of the swap lines. And if the swap lines were to go away, and the president has criticized those, then that would worry them because it's the way you can keep dollars flowing through the global economy at a time when dollars start to disappear. The Fed can send them overseas. And that's been a very important way of keeping the global system working at times. They used it certainly during COVID.
Am I right that this has been the longest perp walk we've ever had at Jackson Hole? They've restructured it this year. They look, I mean, Powell's cut and chiseled, but, you know, Governor Bailey, I think, looked a little peaked, as I say.
Well, we're up 6,000 feet above sea level here, which is a lot higher than London is. You know, it's interesting. We use the term perp walk. It's the old crime reporters term where the police department would march a suspect out so that the newspaper photographers could get a picture of them, and it's a kind of a shorthand. And the Fed fought us, the press, for years, saying it's not a perp walk. That's a terrible term to use, and now they use it too because it's just so convenient way to explain what we're doing.
Well,
here.
It definitely feels that way with all of the cameras flooding. Let's take a look at where markets are after the speech and as they digest some of the language. Yes, maybe Carl Weinberg talking about how an adjustment could mean a hike, but it doesn't seem like the market is taking it that way. What you could see in equities across the board surging higher. If you take a look at the Russell 2000, up almost 4%. The idea that rate cuts will help the smallest companies, the more leveraged companies, most of all. You could see yields plunging more at the front end than at the long end, down double digits, 10 basis points, 11 basis points on the 2 and the 5-year yields as people price in a Fed rate cut next month. And then maybe a sequence of them. And what I think is notable here, before we go to the currency space, Tom, is this idea we are seeing yields down at the long end. Yes, maybe not as much as at the front end, but this is bringing the whole curve lower. This isn't just an issue of front end going lower and then inflation picking up like what we saw necessarily, at least implied in markets last year when there were 100 basis points of rate cuts. I strongly agree to that.
We have the 10-year real yield come in, is still within range. Yes, it's a lower yield, but the drama there of yield curve dynamics really wasn't displayed this morning.
Which I think is really notable. You are, though, seeing the currency dynamics that so many people had been expecting to be in play. The dollar weaker, the euro stronger, the yen stronger. Across the board, strength in other currencies as people wonder if this is a real decision by the Central Bank of the United States to allow inflation to remain above 2% for that much longer in order to avoid disrupting any type of labor market strength that otherwise could gain some cloud. Mike, if this had been another type of Jackson Hole, we would have been talking about the immigration disruptions. We would have been talking about AI and what that means in terms of job losses or job gains and productivity. And I just wonder how they understand labor market data at a time of such dramatic transformation, not to mention the demographic shifts. We're all getting older. And who is going to really pay for this economy and the debt that's coming?
All our Social Security taxes are going to pay for Tom here. The academic papers that are being presented here are kind of on those issues.
Funny, huh?
I didn't laugh.
They're aimed at looking forward in the challenges that central banks will face with demographics and immigration, et cetera, right now. The problem for the Fed is they have to deal with the immediate, which is the economy and its reaction to the new fiscal policies that have come into place. And in the short run, what we're seeing is a labor market weakening, and the Fed uses that as a proxy, their best proxy for what's happening to the economy. Because if people lose their jobs, then they don't have money to spend, and companies pull back, and the economy starts to really slow down or actually contract. And so that's the marker they're looking at. And as you see, saw Jay Powell suggest today that is the bigger danger. The risks are pretty balanced, but if you had to pick one, it would be that the labor market weakens, and that weakens the whole economy.
Well, let's take a listen. Fed Chair Jerome Powell had just delivered his final speech in his position at Jackson Hole, and we had the perp walk, as you talked about it, with Andrew Bailey, Christine Lagarde, as well as the Bank of Japan's Ueda, as they support their colleague in his swan song at the Federal Reserve. Let's take a listen to some of the outclips from what he had to say.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored. We will not allow a one-time increase in the price level to become an ongoing inflation problem.
That speech has sent off an absolute eruption in markets. You could see stocks surging. You could see particularly the Russell 2000 gaining clout, and you could see yields plunging. We will continue to look at exactly what the significance of this coming up. This is Bloomberg Surveillance.
Sweet Green, which has a kind of a similar business model to Kava, they're having some issues, and it's more about just the foot traffic. Maybe the price points are too high, or people have just moved on to other types of ways to feed themselves. What are you seeing?
We're not seeing anything underneath structurally in the business. If anything, we're seeing greater structural strength. In recent years, we've now underpriced CPI by 900 basis points. So again, our value scores continue to improve. We continue to make our food more accessible and really try and mitigate any of the impacts of, say, tariffs and not have to pass along to our guests.
There's been a lot of talk about how do you reimagine stores like this. What do you want your customer to do?
If you're in a hurry, we've got great digital channels. We've got 60 drive-through pickup windows. But if you want a great physical experience, you can have that walk-the-line experience, see the food, smell the food, interact with our team members. Our mission is to bring heart, health, and humanity to food. So we want to deliver that humanity in the four walls of our restaurants and have a great environment for you to enjoy your Mediterranean meal.
Don't miss The Close, live every weekday.
In case you missed it on Bloomberg Tech Asia.
How does Samsung think about competition? Because you have also so many Chinese makers coming out with foldables, with good cameras.
You know, rather than focusing on competition, I think we have been focusing on our consumers. I think healthy competition with other companies, I think will bring more innovations and then bring more benefits to consumers.
Don't miss Bloomberg Tech Asia every month.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You said they ask interesting questions.
Bloomberg Television. Top experts, great questions.
With policy in restrictive territory, the baseline outlook, and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach.
That was Fed Chair Jerome Powell in his last speech as the head of the U.S. Central Bank, as he signaled that, yes, next month it would be live. They would be cutting rates. That was the implication, at least, picked up by the markets, and they ran with it. The Russell 2000, I keep focusing on that, up 3.9%. This absolute screaming endorsement of the idea of rate cuts as people really price in what's to come. And in the bond space, yields markedly lower at the front end, much more tempered move on the long end.
And again, it gets out to the performance of the American economy. I go back to nominal GDP, and you know what? We may get to September 30th, and I'm shocked. Earnings may be okay. The word that Chairman Powell would use is solid. We may get a better Mag 7. But I am going to back at this historic meeting, just as we were to break, waving to the former governor of the Bank of Israel, formerly with J.P. Morgan International, one of the giants of economics. Jacob Frenkel is here. And what Dr. Frenkel would say, with all of his history at the University of Chicago, it's a dynamic space and things adjust over time, and that's what Powell alluded to today.
And certainly a currency adjusting as well as you look at the dollar, markedly weaker, although back from some of the earlier weakness from the immediate knee-jerk reaction from the speech. Dollar spot index down about, just about 0.8%, but really the euro-dollar cross, the idea of 117 back again, 120 in sight as people look to a central bank in Europe that really is firm in that 2% level. Yes, they were ahead of the Federal Reserve when it came to their cutting cycle, but nonetheless saying even with concerns about weakness, we really don't want to see inflation picking up again.
It's still the litmus paper of the system, but on Monday, when I get back, you won't. But on Monday, when we get back, I'm sorry, fixed income is becoming the new foreign exchange when you correlate the dynamics between each country to country to country. Just as a complete aside here, to see Italy pricing their yields better than France, has that ever been in any realm of thinking I've ever had?
Yeah, well, this is the reason why, Michael McKee, there is such an international presence here as you chart toward a busy weekend for you, because you are not leaving. You will be here for all of those speeches. What are you focusing in on? What are we missing that we really ought to be picking up on at a time where some people, Carl Weinberg, saying maybe we're running too far with this idea of adjustment, meaning a rate cut?
Well, I'll go back to something Tim Geithner once said when he was Treasury Secretary. What keeps me up at night is what I don't know is keeping me up at night. You don't know what is going to happen going forward with inflation. That's going to be the biggest question. We can talk to companies and get a sense of what they're doing with their employees. The jobless claims numbers will give us an idea. But when the tariff payments hit those companies, what are they going to do? Are they going to absorb some of it, or are they going to pass it all along? And when we see the market reaction like we're seeing today, and you were talking about good earnings for this quarter, what's going through my head is, yes, but what are margins going to do? And what message will that send to investors? If margins start to get squeezed, then how do companies react? Then they start laying off people.
Do we know? Are there hints yet?
Well, you get different answers from different Fed people. When we talked to Austin Goolsbee, he said people are telling him that in the Chicago district, things are getting a little bit better. They're able to live with the prices that they're getting. And then when we talk to Susan Collins, she says it's much more difficult.
Well, this to me is actually something that's really important, which is the region by region and how different United States regions are. You hear some anecdotes from corporations that actually there is still quite a bit of strength in the labor market and confidence. You hear in others not so much, that actually they're worried about the prospects of the labor market going forward. How hard is it to aggregate all of this, the different regions of the United States, the different political persuasions and what that does with sentiment in different regions of the United States, and come up with some sort of cohesive policy at a time where there's a fracturing, even within the United States?
Well, it is difficult. At least we have 50 United States, whereas Christine Lagarde has to deal with 27 separate countries who all will have their own opinions. In this case, all of the people representing the regions of the United States are part of one organization. it was part of the great design of the Fed that you have input from all around the country, and it's not just decisions being made by the bankers in New York. But it is difficult because you do have different situations going on in different parts of the country. If you ask Mary Daly, she's got a tremendous a lot going on in California and that area with the AI growth and that sort of thing. And then you look at Texas. While the president wants to drill, baby, drill, drillers are stopping because oil prices have gone down, because demand has gone down. And so that's going to have a completely different impact in that region.
Right now we are sitting here. Just to wrap up what we have just heard, because to me this really has been a seminal moment for markets heading into the fall, but also for central banks around the world. This was the swan song for Fed Chair Jay Powell, his last big speech as the head of the biggest and most important central bank of the world, coming out and opening the door to potentially cutting rates as soon as next month, talking about some sort of adjustment that could come, which could be open to interpretation, and markets took that and they ran with that. And what markets are seeing right now is a Federal Reserve that will rather err on the side of inflation remaining higher for longer, even if they could protect the United States labor market.
Continue to watch how everyone reacts to President Trump. The fact is, he's the change agent of the moment, and to see what Canada did with tariffs today, there's going to be 10 more of those tweaks, announcements, adjustments, and as Kate Moore said, maybe that gets us to a better space.
But no tweet from Donald Trump yet on what Jay Powell has said, which surprised me.
Well, maybe that actually is a bonus, because if the less that there could be some interference, maybe the better for the members here. Thank you so much. That does it for us. This was Bloomberg Surveillance.
It's 5:56 on Wall Street. We do check markets all day long here at Bloomberg. A decisive move toward dovishness by Fed Chair Jay Powell, all but cementing bets on an imminent interest rate cut. That is driving stocks and bonds sharply higher at the end of a volatile week, right to the numbers, because they are big numbers to the upside. Here's where we stand. S&P right now up 99. That is a gain of 1.6%. We do have the Dow Jones Industrial Average up 924 now, up by 2.1%, while the NASDAQ Composite Index is up 386. For NASDAQ, that is a gain of 1.8%. The NASDAQ 100 Index up 1.6%. The Russell 2000 Index, by far the outperformer, surging 3.8%. The Bloomberg Mag 7 Index up 2.1%. Dow Transport's getting a lift up 3.3%, with a 10-year currently yielding 4.25%. The 2-year 3.68%. The 30-year 4.88%. Gold now up $31 the ounce, up by 1%. The precious metal at $33.71. West Texas Intermediate crude up 0.2%, $63.67 a barrel, and Bitcoin now up by 3.8% at $116,700. So bottom line here, Powell speaks, markets move higher. Reaction to his remarks from Kate Moore, Chief Investment Officer at Citi Wealth. She was interviewed right here on Bloomberg.
There was the sense that this tension between the labor market and inflation was going to make the decision really difficult. And I think what we're hearing this morning is that, the Fed is on path to start easing rates again or proceed with the cycle. But I don't think that the rest of the meetings to the end of this year and through 2026 are done deals yet. So much is going to be data dependent.
Kate Moore of Citi Wealth, interviewed during our special coverage, just wrapping up right here on Bloomberg Radio. So again, the Dow, the S&P, NASDAQ, they're all higher. S&P today up by 100 points. That is a gain of 1.6%. The Dow up 935, up now by 2.1%. NASDAQ Composite Index up 383 points, up by just about 1.8%. Again, Dow, S&P, NASDAQ all surging. Again, worth repeating on the Russell 2000 Index, up now by 3.8%. Our Fed coverage will continue on Balance of Power, and for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts, and Balance of Power kicks off right now. Back we go to Washington once again. Your hosts, Tyler Kendall and Michael Shepard.
All right, Charlie Pellet for us in World Headquarters. Hello to you and welcome to the Friday edition of the fastest show in politics. This is Balance Power. I'm Tyler Kendall here in Washington alongside Bloomberg's Michael Shepard. Joe Matthew is off, and all eyes today are on the Federal Reserve for multiple reasons. President Trump today threatening to fire a top official at the Fed, escalating what has been a pressure campaign against Fed Governor Lisa Cook over allegations of mortgage fraud. Cook says that she will not be bullied into stepping down, but we're going to follow all of the latest here with Bloomberg's Michael McKee, who will join us shortly from Jackson Hole, and that's where the Kansas City Fed is hosting its annual economic symposium, which is really the biggest reason why we are following this story today, because we heard the Fed chair, Michael Shepard, give these highly anticipated remarks that appear to be opening the door to a September rate cut.
Well, he sure answered the question about which direction he might be leaning, and that is in the concerns he expressed over the labor market and the downside risk potentially there. And of course, Wall Street and many out there on Main Street even are taking that as a signal that the Fed will go ahead and proceed with the rate cut that many have been anticipating, many traders certainly have been anticipating and hoping for September and even the months to come. So we're looking forward to talking to Mike about that. But also, Tyler, we have some other news today, and this is on the trade front. And we saw Canada are reporting today that Canadian officials are preparing to drop many of the retaliatory tariffs that they imposed on U.S. goods in response to some of the import levies that the U.S. had enacted against Canadian goods.
Exactly. A huge story here that we're going to be covering later this hour with Brian Platt out of our Ottawa Bureau. We've been covering this story for a long time because while many countries were able to perhaps secure a more favorable preferential tariff rate, Mike, Canada was not one of them.
Canada was not one of them, and they, in fact, took a very much elbows-up approach and had not really tried to embrace or curry favor with Trump in the way we had seen other leaders do, Tyler. So it will be interesting. In the next hour, we'll have President Donald Trump appearing at the White House, and he will very likely address this in remarks. He has an announcement on a still unspecified matter in the noon hour at the White House. So we'll be looking to hear what he has to say on that, on Lisa Cook, the economy, and more.
And more. And of course, we do want to get a check on how the markets are reacting to all of these stories. And we're going to bring in now Bloomberg News senior editor Eric Weiner. Eric, thanks for being here. It's good to see you. Can you just bring us the latest? Because it looks like traders are adding to their bets ahead of the next FOMC in September.
Yeah, they absolutely are. I mean, Powell delivered pretty much what the market wanted to hear. If you looked at the week's activity, there have been several down days, but they were pretty shallow turns. And what was going on was people peeling off of bets that they were going to cut rates at this next meeting. So you had this heavy expectation coming into the week that was going to be happening. And then suddenly it started looking like that wasn't the case. And Powell kind of confirmed for the market today that, yes, we are leaning toward a cut. He didn't say definitely it's coming, but if you look at the market pricing, that's where it's going. So everything is ripping higher. Stocks are ripping higher. Volatility is falling. Bond yields and the dollar are moving that way. So it's basically this broad sweep of the market moving up based on expectations.
Eric, how far are traders betting that the Fed will go, not only in September, but perhaps through the rest of the year? Are they now taking this as a cue from Jerome Powell that more cuts even may be in store?
I think that's the hope, but we're not exactly seeing that in the betting necessarily. If you listen to the comments that Powell made, he's very concerned about inflation. So the Fed has been very mindful of this. If you listen to some of the other Fed officials who have talked about it, there is this underlying concern that prices are going to come up. So what they're addressing right now is potential weakness in the employment outlook. And if you need companies to hire more workers, you need to cut rates. So it's that concern that is affecting them right now. The question then becomes where we go further down the road, because there are a couple more meetings, and that's a little bit more up in the air, and there's a lot of data coming. So we'll know a lot more in the next couple of weeks about where things stand.
Well, when it does come to next steps, can you just talk a little bit more on which data we should be watching? What are we anticipating? And that we should keep our eyes out that's going to inform this decision?
Well, you're going to have a couple of consumer price index reports. You're going to have, the Fed really relies on the personal consumption index. So those two things where you start seeing prices coming up, there was a lot of concern in some of the earnings from retailers saying that perhaps they're going to start having to pass along costs to consumers. That hasn't happened yet. So it was in Walmart's report. It's been in a couple of reports. So we haven't seen that kind of appreciation in inflation yet. And that's really what Powell was talking about, that the inflation rate is roughly around their target, and therefore you can cut if you need to stimulate the economy. The question then becomes what happens down the road if the consumer price index and PCE and these other measures of inflation start showing that yes, prices are going up as we head into Christmas, and then that you have to balance that with weakness in the job market.
All right, Eric Weiner, Bloomberg News senior editor. Eric, thank you so much for being here. We want to stick with this story as the Fed Chair Jerome Powell today gave his highly anticipated remarks at Jackson Hole. And Powell pointed to rising risks for the labor market even as worries over inflation remain.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
There was, of course, a lot hanging over these remarks, from the path, the monetary policy, and potential rate cuts to what is now the heightened tension between this White House and the central bank. And to dig into all of it, we are lucky to go now to the ground live in Jackson Hole, where we find, of course, our very own Michael McKee, Bloomberg Senior International Economics and Policy Correspondent. Mike, let's just start with Powell. And what did we learn when it comes to his view and the outlook of the economy?
Well, what we learned is that one economic data point could change the chairman's mind, and because he's speaking for the whole committee here, change most of the committee members' minds. It appears that the July employment report has really given the Fed a scare, and the Fed chairman is now suggesting that that's enough to start them on the path towards rate cuts. Because you remember July 30th in the news conference after they held rates steady, at that point the chairman said to reporters that the labor market, even though unemployment had ticked up a little bit, remained solid, and that it didn't look like interest rates were holding back the economy in any serious way. Now there seems to be concern that that could happen. And so the Fed is now on a course for rate cuts, because now that he's opened the door, it's going to be pretty hard to close that.
Yeah, Mike, you're right. It will be harder to close that. Wall Street is really seeming to take this as the cut is now baked into the cake. Did you read in his remarks any exit where if there is some other perhaps less favorable number, say in inflation or on the jobs, or maybe a stronger report on the jobs front, that might change the course and lead them to hold steady?
Well, he didn't put that into his speech. It would be assumed in a sense, but it's, as I said, hard to get out of once you've started down this road, because it does suggest that they feel the economy needs some additional stimulus. But you can also go back to the fact that he has said before, if it weren't for the president's fiscal policies, they would still be cutting, because they were trying to get back to normal before all of the tariff news hit the economy. So they could fall back on that. The interesting thing is going to be, we get the jobs report on September 5th, but September 11th is CPI, and that's going to be in the blackout period. So if we get an inflation report that's much higher that would cause the Fed to want to hold off, they won't be able to tell us they're going to do that unless they use the old tactic of leaking to a newspaper.
And Mike, to talk a little bit more about how the president's policies came into this conversation, two policies that we cover very closely here on Balanced Power, of course, have to do with tariffs and then also immigration policy. What struck you when it came to how the chair spoke about these issues this afternoon?
I don't think he broke any new ground on tariffs, but what he seemed to do was embrace Christopher Waller's view of the tariffs, that they're going to be more like a one-off rise in the price level, even if those one-offs are spread by sectors over time. And so inflation may go up, but it's not going to continue to rise over a long period of time. So the Fed isn't as worried, that is not to say they're not worried at all, but not as worried about inflation expectations becoming unmoored. And I think that's the message here that, as one person put it to me, the center of gravity at the Fed is now in the idea that the closer danger, the danger that something will happen in the labor market is more acute than the inflation danger at this point.
Mike, one thing that's been shadowing the Fed as this conference was about to come together, of course, has been the president's push for the ouster of Fed Governor Lisa Cook. In his remarks today, did Fed Chair Jerome Powell send any signal or message that you were able to divine about the central bank's independence that we should take away?
Nothing at all, which did surprise a number of observers. People I have talked to noted the fact that he didn't bring up Fed independence in his speech. Now, it may be that he's trying to keep that out of all the reporting about what they're doing here and what he's talking about, because it's just a distraction. But obviously, the Cook situation seems to have escalated again today. It's going to be a problem for the Fed. The president says he's going to fire her if she doesn't resign. And if he follows through on that, it sets up certainly a serious court case that the Fed is going to have to deal with. All of that moves from distraction perhaps to something of an impediment to the Fed doing its job. That's probably something that the chair didn't want to get into at this point.
Right. Well, Mike, can we drill down a little bit here when it does come to that legal authority? Because I think that is one of the big questions here in Washington, because it's my understanding there is a very high legal bar to remove an official, a Fed official. And didn't the Supreme Court reaffirm a carve-out for the Fed earlier this year? What sort of legal scrutiny would there be if the president were to make good on this threat, which we should say is over allegations at this point against Lisa Cook?
Yes, allegations, nothing's been proven, there are no charges, and as far as we know, they haven't even really started to investigate. But the Federal Reserve Act says that governors of the Federal Reserve Board shall serve 14-year terms unless otherwise removed for cause by the president. Now, the for cause clause is important here because it's generally thought of as malfeasance, dishonesty, or neglect of the job. So none of those at this point can be necessarily said of Jay Powell, which is where the Supreme Court carve-out comes in. They said the Supreme Court is set up differently than the other agencies where the president fired the heads because of the structure of the Fed. So unless you do have cause, it seems the Supreme Court is telling you you can't just fire people. Now the question is, was Lisa Cook's mortgage situation cause? The mortgages that she took out that Bill Pulte made public over the last couple of days were before she joined the Fed. Now Pulte is suggesting there's another one that she took out while she was on the Fed. Could that be cause? That's going to be the issue. If the Justice Department finds that's the case, that's going to be the issue that then gets fought out in court.
Mike, the end game for the president, of course, we have seen unfold this week is really to try to get the central bank to bend to his will when it comes to interest rate policy and getting the cuts that he desired. Does the signaling from Jerome Powell go at least part of the way toward meeting some of those concerns that the president and his advisors have articulated, or is this not going to be nearly enough for the White House?
Well, I'm kind of surprised that we haven't seen a Trump tweet on this yet, since it does go a bit of a way towards what the president wants. Now, remember, he's called for 200 or 300 basis points of cuts. He'd like a 1% Fed funds rate. That's not going to happen. I think what he'll hear from people like Scott Bessent is this is a start on the road that you want them to take, and back off. Let them do this because they're going in your direction. Now, the president may take this as, I told them to do this and they did it, so I'm going to keep the pressure on. It's really hard to know in this case how that's going to play out. I think we will see further cuts, but the timing of those cuts are going to be a question, and the magnitude of those cuts are going to be a question. I just don't think anybody here, unless the economy goes into recession, thinks the Fed will ever go back to 1%.
And Mike, when we are talking about next steps here, and we know that, as Michael Shepard was saying, a lot of this pressure originally started on the Fed chair himself, and there were questions about the future of Jerome Powell's tenure, and we know that the search for the next Fed chair has already begun, and some of those potential contenders are there where you are in Jackson Hole. Is there any update here when it comes to the White House's search for the next Fed chair?
Nothing from Jackson Hole. We heard from Scott Bessent yesterday that he's going to start the interviewing process around September 1st. We also know that the main contenders that have been talked about, including the Kevin Hassett and Kevin Warsh, have talked to the president on a regular basis. So Mr. Trump knows what he needs to know about those two. Chris Waller has talked to Scott Bessent, but only briefly, and others we don't know about at this point, other than some of them say they have been notified that they're on the list and will be contacted. But I think the only change that might come from Jackson Hole is that Powell today seemed to validate the theory that Chris Waller has been proposing, and that is that tariffs will be a one-off increase in the price level and not something that is going to cause the Fed to have to raise rates again. And if that's the case, maybe it gets explained to President Trump, and he likes Chris Waller a little more.
Mike, we wanted to get to a little bit of news that's been breaking even as the Jackson Hole conference is unfolding here in Washington and up north in Ottawa, and that is that Canada is planning to pull back on many of the retaliatory tariffs it imposed against U.S. goods in response to U.S. levies. How significant is this move, and how do we see this changing the state of pricing in cross-border traffic here?
Well, it is a significant move in that it suggests the Canadians have an idea that a deal could be reached. They wouldn't take off the tariffs if they didn't think they were within closing distance. And so it does appear that perhaps we get somewhere. The question is, what is the deal going to include? If it includes the kind of country tariffs that the president has put on everybody, yes, maybe Canada gets something like 10% that he put on Great Britain. But remember, most of what we buy from Canada is not tariffed anyway because it falls under the USMCA free trade agreement. The questions will really be on autos and steel and perhaps on energy, because those cross the border a lot from Canada and the United States, and they have been tariffed by the administration even before he put on the other tariffs. So we could see a deal that gets Canada maybe into the UK kind of position, but do they take off the other tariffs? We don't know.
All right, Bloomberg's Michael McKee for us out in Jackson Hole, Wyoming. We thank you as always. We're following this developing story. Canada's dropping many of its counter tariffs against the United States. We'll continue that conversation next. We're joined by Catherine Edwards. Stick with us. This is Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are surging, but we begin with a developing story as Canada says it will remove retaliatory tariffs on U.S. products that comply with the U.S.-Mexico-Canada agreement. The government will keep 25% import taxes on U.S. steel and aluminum products, as well as its tariffs on U.S. automobiles, despite the policy shift. The Dow, the S&P, NASDAQ are all surging. Wall Street, in fact, having its best day since April on signals from Fed Chair Jay Powell. The S&P right now up 96. That is a gain of 1.5%. We're holding close to session highs. The Dow up 937, up 2.1%, while the NASDAQ Composite Index up 360. That is a gain of 1.7%. The Bloomberg Mag 7 Index up 1.9%. The Russell 2000 Index of small cap shares up now by 3.8%. 10-year at 4.25%, with a 2-year 3.68%. Gold up 1%, 33.70 the ounce, and a retreat for crude. West Texas Intermediate crude down 0.1%, 63.46 a barrel. Bitcoin up 3.3% at 116,180. As we have been reporting, a topic we're exploring on balance of power, President Trump says he will fire Lisa Cook from the Federal Reserve Board of Governors if she does not resign her post over mortgage fraud accusations from a top ally. So again, U.S. stocks are advancing. We are keeping an eye on shares of trucking companies like J.B. Hunt and Saia after Secretary of State Marco Rubio said the U.S. will halt issuance of worker visas for commercial truck drivers. Shares of J.B. Hunt, they're up 5.6%. Saia Trucking up now by 9.1%. Recapping, stocks higher. S&P surge after Powell's remarks. S&P up by 1.5%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Tyler Kendall and Michael Shepard.
Charlie Pellet from World Headquarters for us in New York. Thanks so much. As Charlie mentioned, I'm Tyler Kendall here alongside Bloomberg's Michael Shepard in Washington. And we may be in Washington, but financial markets are definitely focused on what's happening out in Jackson Hole, Wyoming, as President Trump escalates a threat against Fed Governor Lisa Cook today. The White House has elevated allegations of mortgage fraud against Cook, with the president telling reporters earlier if Cook doesn't resign, he will fire her.
President Trump, you're going to fire Lisa Cook, the Fed governor, over her mortgage fraud?
I'll fire her if she doesn't resign, yeah. What she did was bad, so I'll fire her if she doesn't resign.
Now, no charges have been filed against Cook. These are just allegations, and we did get a statement from Cook the other day, earlier this week, where she said that she will not be bullied into stepping down, adding in part, quote, "I'm gathering the accurate information to answer any legitimate questions and provide the facts." Here to discuss is Catherine Edwards, economic policy consultant and Bloomberg opinion contributor. Catherine, thanks so much for being here. Can we just get your reaction to this developing story, this pressure campaign? And can you give us perhaps the economic angle here? What sort of economic risks, if at all, do you see as the White House sharpens its attacks?
Well, the economic risk is always, and the economic risk has not changed since he started attacking Chairman Powell. It's that the president is interfering in monetary policy because he doesn't agree with what they're saying, risking the independence of our central bank, which is paramount to our economic stability and our respect abroad. That is the risk here. This is just a new tactic of the same problem, which is attacking people who don't agree with him or do what he wants at an independent agency. The attack on Cook is pretty remarkable for a couple of reasons. One, everything she's accused of occurred before she became a board governor. So he's essentially saying that she should be fired for something she did before she started working for the Fed, which opens up a degree of precedence that anything you've ever done wrong before you become a Fed governor becomes grounds for firing. I don't think anyone would agree that that's necessarily a good policy. Second, to the extent that anything she's accused of is true, it's really common amongst elected officials that they mess up on their homestead deduction. In fact, the Attorney General of Texas is also currently accused of claiming the homestead deduction at 3 different properties. And when this happens, they pay the fine for whatever is remaining balance on their property taxes and go about their way, because it's rarely considered to be fraud. It's mostly considered to be an accident, and it hits people in political positions who have to be in D.C. and some other location all the time.
Catherine, the pressure by the president and other administrations on Fed Governor Lisa Cook has certainly overshadowed the proceedings in Jackson Hole, where today we just heard from Fed Chair Jerome Powell giving his take on the economy and what many see as his valedictory address at the annual gathering. Give us your theater review of his remarks, but more specifically on whatever he might have said or what signal he might have tried to send about Fed independence.
Well, I think it's helpful to remember that our president is many things, but he's also a reality TV star, and he understands how to manipulate the news very well. On the day that the chairman of the Federal Reserve, someone he can't fire but wants to, makes a speech about where our economy is, he draws attention to how he wants to fire the only black woman who has ever served on the board. I think this is really important because it helps to keep your eye on the ball. Powell's speech was very even but very clear. We can't change the long-term inflation target. We can't ignore the short-term inflation pressures, and we can't assume that whatever tariffs are going to do with inflation is over. The Fed has a dual mandate, and it has to put the needs of inflation equal with those of unemployment and the risk from inflation. At least my read of his speech was the risk for inflation is more pressing at the moment because prices are actively rising.
But I'm wondering what you think the White House's reaction would be to the Fed chair's comments today, and now we have traders betting on this September rate cut. Do you expect that the pressure on Cook could potentially alleviate if the White House felt it got a stronger signal from the central bank?
I can't pretend to understand how their communications department reacts to things like this or how the president does, simply because, you know, just the level and the degree to which he has attacked independent institutions, it makes it hard to understand how the economic data would be interpreted, you know, fairly. I mean, consider for a moment that Trump is his own worst enemy in this fight. The biggest motivation to lower interest rates right now would be that the economy is much more fragile than it appears, and in particular, the labor market, that the dual mandates to have stable employment and have our unemployment rate low is precarious. And if he wanted to have interest rates lowered, he should be making the case actively and loudly that the economy is not in good shape and we need interest rates to fall. But he doesn't do that. He fires people who tells them that the economy is actually doing poorly because he wants to maintain the case that the economy has never been stronger and interest rates should be lowered. So to put into a hypothetical, how do you think he would react to the news without Lisa Cook? I mean, he's not really making a case for himself that well regardless. So it's not, I don't know. I'm not saying that it was an unfair question. I'm just saying that he doesn't seem to be following what would be in his own best interest should he actually want interest rates to be lowered.
Catherine, let's turn to the question of inflation. And during his remarks, Jerome Powell talked about tariffs and how they would have a momentary or fleeting impact on prices rather than a persistent or lasting one. But he did not rule out the latter scenario entirely as a possibility. What is your take on the impact of tariffs over the long haul when it comes to prices and consumers' pocketbooks?
I'm with Powell on this one. We don't know what the effect will be. He laid out a pretty clear, set of scenarios of either it's a one-time increase or it's that's phased in quickly, a one-time increase that happens over a longer period of time, or a permanently upward inflationary pressure that comes from these tariffs. We've never had tariffs to this degree in our modern economy, so I think he's right in saying we don't know which way this inflationary impact will go, but he said, without maybe declaring as much, tariffs will absolutely increase prices in our economy. And that is the reality that we are living in. It is higher prices in the future because of presidential policy.
And of course, the other part of this is risks to the labor market. And we heard Fed Chair Jerome Powell cite tighter immigration policy from the administration, which he said has led to an abrupt slowdown in the labor force growth. We want to play you part of what he said and then get your reaction on the other side.
Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising.
Catherine, talk to us here about some of the tangible changes, tangible impacts that we've seen from the administration's immigration policy, which at the moment they've really been doubling down on when it comes to tighter immigration enforcement.
Yeah, it helps to understand the long history and context here. This century, the vast majority of growth of our working age population, in some years, all of the growth of our working age population has come from non-native workers. So if we were tomorrow cut off all entry into the United States for immigrants, our labor force would fall. It would start falling the next day. We are very much reliant on immigrants to keep the size of our labor force growing. So what I think Powell was trying to describe was just how difficult it is to understand what is going on in the labor market when this really key source for labor market growth is both being restricted by the current policy as well as pulling back on its own of people who are afraid to get picked up and deported. So I think what he was trying to clarify is just how unclear the labor market signals can become when you've added this element of reducing where growth has come from. So you can think about this in terms of the monthly jobs report. How many jobs does the U.S. need to add every month in order to be considered healthy? Now, for a long time, it was north of 100,000. But if immigration is going to slow and our population is no longer going to grow because we're cutting off the source of growth, do we need to add 150,000 jobs every month? Is 80 sufficient? Is the 35 we've seen over the past 3 months sufficient? These questions get a lot harder to answer when the key source of growth of the population is fluctuating so wildly.
Catherine, in the 30 seconds we have left, another reaction we have seen to Powell's comments, of course, has been on Wall Street, where traders are enjoying what for them is their best day since April. Are they perhaps a little over-enthusiastic, though, in their bets and expectations of what the Fed may do through the rest of the year?
It's hard to know what it is they're positively reacting to as well. Maybe they just liked knowing that the independent central bank said that they would stay independent and on task and on mission. If that's why they responded positively, I think that's good news. If there was some nugget that they latched onto, you know, the thing about the stock market is a lot of times those positive feelings are ephemeral and can go away. The substance of our economy has to be built on a strong independent central bank and sound fiscal policy.
All right. Catherine Edwards, economic policy consultant and a Bloomberg opinion contributor, we thank you so much for joining us here on Balance of Power. We do want to bring you some breaking news. Mark Carney, the Canadian Prime Minister, saying that he and President Trump see a chance to build on Canada-U.S. relations. Make sure to stick with us. We'll be talking a whole lot more here about tariffs, including another story when it comes to domestic policy. FBI agents searching the former home of National Security Advisor John Bolton. We'll have that story up next here on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all ripping higher. We are off session highs, but still very close with the S&P now up 94. Powell speaks. Market surge. S&P at 64.64, up 1.5%. Dow Industrials up 893 right now. That is a gain of just about 2%. The NASDAQ Composite Index up 359, up 1.7%. But perhaps the big market story, the surge in the Russell 2000 index up now by 3.7%. Our Bloomberg Mag 7 index is advancing by 2%. The 10-year, after Powell's remarks, 4.25%. The 2-year, 3.68%. Gold is up $33 the ounce, $33.71, up by 1%. West Texas Intermediate crude oil, little changed, up 0.2%, $63.65 a barrel. And Bitcoin cannot ignore the move there, up $4,100 a token, up 3.6%. Bitcoin at 116,530. You heard him live here on Bloomberg. Fed Chair Jay Powell saying the stability of the unemployment rate and other labor market measures allow the Fed to proceed carefully as they consider changes to their policy stance.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment.
Fed Chair Jay Powell remarks carried live from Jackson Hole here on Bloomberg Radio. Morgan Stanley sees a good chance of an OPEC oil supply cut in 2026. Oil majors higher. ExxonMobil, case in point, up 1.6%. ADRs of BP right now up 1.5%. Chevron up by 1.9%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Tyler Kendall and Michael Shepard.
Charlie Pellet in World Headquarters for us. Thanks so much. This is the Friday edition of the early edition of Balance of Power here on Bloomberg, and we're tracking a developing story here in Washington that FBI agents searched the home of former National Security Advisor John Bolton. A person familiar tells Bloomberg News it's over an investigation regarding classified documents. For all the questions that we have about this story and what's next, we're going to bring you now the reporter who broke the story for us here at Bloomberg, our very own Miles Miller, Bloomberg News senior reporter covering the FBI. Miles, it's good to see you and great reporting on this. What's the latest? What do we know about this search?
Yeah, the FBI is currently searching not only the home, but the office of John Bolton. And this all boils down to the book he wrote in 2020, The Room Where It Happened. And in order to even get this book out, he had to present it to the White House at the time to make sure that there was no classified information in it. And the investigation centers on whether or not there was, in fact, classified information. When this book came out, or before it came out, the Trump administration at the time had tried to block it. They went to court to block it. Trump accused Bolton of profiting from this classified information, and Bolton said he went through proper channels to get this done. It was taken to the DOJ at the time, and then the DOJ did not block the release of the book. The book came out, and he has been out of Trump's good graces since then. Just to give you a flavor of what Trump said back then, he said, washed-up creepster John Bolton is a lowlife who should be in jail, money seized for disseminating for-profit, highly classified information. Asked about it today, Trump said he didn't know anything about what happened, but he said he's not a fan of John Bolton.
Miles, we have to ask about the current context, though, and that is that John Bolton has been critical of the president's conduct when it comes to foreign policy recently with Russia's leader, Vladimir Putin. Is there any connection between that kind of criticism and this renewed inquiry into his former national security advisor?
Right. I mean, just as recently as Friday, John Bolton was on CNN for much of the night talking about that summit in Anchorage, Alaska. And, that sort of points to what some people say could be retaliation for that. But the FBI director, Kash Patel, as well as the Attorney General, Pam Bondi, they all were in unified message that no one is above the law and that this is all about really what they see as an issue of national security being leaked out. But beyond that, we have seen in the last few weeks and last few months of people who are related to any of these matters as related to the Trump classified documents cases involving the president himself and any other matters, January 6th, that people are being moved from government. They're being fired and all of that. And so, that is what points to these questions. Is this politically motivated, or is this really something that's just focused on a national security matter and these documents being out in the open and then in this book? It really is interesting. You saw at the beginning of this administration, President Trump pulling the Secret Service detail from John Bolton. If in my reporting today and looking at the landscape of where he was arrested, look at the landscape of where they searched the home this morning. There were, back in 2024, 4 Secret Service vehicles outside the house. And that's gone today because that Secret Service detail was taken from him. But he said he had credible threats from foreign adversaries who made threats on his life. So it's just interesting that the Trump administration comes in and immediately takes that away and then is now searching his home.
Miles, another major story that you have been covering, of course, has been the president's effort to take over law enforcement here in the nation's capital. How has that been playing out both for residents, the state of security here on the ground in the city, and how has it been in terms of the politics of it? We have seen J.D. Vance and the president himself last night visiting some of the National Guard troops who are taking part in this effort.
Yeah, so, new reporting today that National Guard troops in D.C., made up not just of folks from D.C., but from other, conservative-run states run by conservative governors who've lent, their National Guard's members to D.C. as part of this effort. So bolstering the initial 800 that were deployed will be carrying weapons at some point. Pete Hegseth, the defense secretary, making that determination today. We don't know exactly when that's going to happen, but on the ground, what we're seeing is that by and large, there are a number of arrests that happen overnight and large number of arrests. But when you compare that, we did a story earlier this week, when you compare that with the number of arrests made by Metropolitan Police Department during the same period, it's well under the amount of arrests that are already being made by officers. Now, we've been doing some exhaustive reporting, going through court dockets, and looking at really what were the top charges, the big things that people were charged with. In large part, they've only charged 12 people with any federal crimes, most of this winding up in Superior Court in Washington. And it's important to see where these cases go. Are they thrown out? What happens with them? Pam Bondi has said pretty critically that any of these judges that have leniency to any of the people who have attacked officers will be called out on social media, and they'll be going to do everything they can to fight back against that. But, you have a president who went out yesterday to really give a message to the folks who've been out there on the front lines to say, continue doing this effort, and it probably won't stop here in Washington.
Miles Miller, thank you so much for all your reporting. We're now going to take it to our signature political panel of Jeannie Sheehan Zaino, Democracy Visiting Fellow at Harvard Kennedy School's Ash Senator and Democratic strategist, and Ashley Davis, a partner at S3 Group and Republican strategist. Thank you both so much for joining us. Jeannie, I wanted to start with you. What are we seeing as this raid today unfolds at John Bolton's house? Are we seeing a widening campaign of retribution against national security officials who may have crossed Donald Trump in the past?
I think we have to be very careful. A judge had to sign off on the affidavit for the search warrant, which means that a judge found that there was reason to support the search warrant. And so I think until and unless we know what is found and what the scope of this is, we've heard it's all about, as you were just talking about, the information in this 2020 book, The Room Where It Happened, that Bolton wrote. but there could also be more. So I think we have to watch for that. But the second thing I would say, many people are talking about the timing of this. This is the same day that Congress is getting the Jeffrey Epstein files for the first time, and the DOJ, knowing that, decided to go in that day. So there's a couple of elements of this that I think we have to be careful about, but the timing here is very interesting.
Well, Ashley, let's get your take. Do you have those same concerns, or what are you making of this FBI search?
There's a couple things. First of all, Jeannie's exactly right. A judge did have to sign off on this. I think, and I would say the same thing about when the FBI went into Mar-a-Lago. I mean, this kind of going in for political reasons, we don't exactly know, but a judge did have to sign off on the affidavit. But I also think that it's not about the book, it's about the papers he used for the book. So even though, as Miles was saying earlier, that it was approved to be published from the Justice Department, that's one thing. But there's still documents, and remember he lost his security clearance in the beginning of this year. So if he has classified documents in his house that are not supported by a SCIF, which is a national security room that can hold national security documents, then that may be where there is concern. So I don't know that it really matters that the book was signed off on by the Justice Department. It's more the documents that supported the book, from what I've been told.
Jeannie, we wanted to turn also to other news of the day. Of course, we'd be remiss in not talking about the Fed and the economy. How do you see this unfolding politically for Republicans and for Democrats over the next month or so? This will be a critical time period with the Fed about to make a big decision here. What is your sense of where they go and how this will be played by both the White House and by Democrats?
Yeah, it was so fascinating to hear Jerome Powell's comments this morning. And it is striking that he has agreed with Chris Waller on the impact of these tariffs as sort of a one-off. I don't know if that indicates anything in terms of Waller's position as Donald Trump looks to replace Powell. But even putting that aside, I thought what was most striking is Jerome Powell said very little directly about Fed independence in the wake of the president's comments, and you and Tyler were just talking about them concerning Lisa Cook. And he did, though, say that they would always make these decisions regardless of pressure on the Fed based on the data. And so that would suggest that while he has walked down this path towards a September cut, that if additional data came, that he may be willing to change his mind. It's unknown. And the final thing I would say that's fascinating is it seems that Powell has made this switch based on the data that came on jobs. And yet Donald Trump should have then celebrated those data because they get him what he wants, which is potentially a rate cut. And yet what does he do? He fires the head of the BLS. So there you go, Mike. It's a fascinating turn of events.
Well, I mean, yeah, Ashley, let's hear what you think.
It always is. I do think, I mean, you guys better than anybody, that there probably was going to be a rate cut in September, the next meeting. But I also think that, and you read everything leading up to the speech today, that if he didn't say what he did in some version, the markets would have gone crazy, because I think they would have. And then obviously now with Cook, and that's a whole other issue that we can talk about. But the longer it goes into the fall, the less chance that he's ever going to get fired, because he's done. He's done beginning next year. So there's really no reason. And if Trump gets his rate cut in September, maybe they'll bury the hatchet.
But does this take the heat off the ball, Ashley, then for Lisa Cook, or is that a separate matter altogether?
Oh, I think that's a separate whole matter. And listen, I find this whole thing fascinating with Bill Pulte and the head of the Federal Housing Administration, and just some of the different information he's finding. Obviously, he has put the information to the Attorney General. They need to make a decision if she did, break the law, obviously, and if so, they will, I think then there's maybe a case for him to fire her, but that has to happen first. But right now it's playing out in the media.
All right, a great conversation today. And our political panelists sticking with us for hour 2 of Balance of Power. That was Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center and a Democratic strategist, alongside Ashley Davis, partner at S3 Group and Republican strategist. Of course, we are tracking all of these stories in our next hour of Balance of Power, from Fed Chair Jerome Powell now opening the door to a September cut. What we're learning about Canada tariffs. We want to keep it here in our next hour. We're going to be speaking with Bloomberg's Michael McKee. He's there again for all of the latest, as well as Lael Brainerd, the former NEC director under the Biden administration. This is Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump threatens to fire a top official at the Federal Reserve, escalating a pressure campaign. Welcome to the Friday edition of the fastest show in politics. This is Balance Power on Bloomberg Television and Radio. I'm Tyler Kendall here in Washington alongside Bloomberg's Michael Shepard. Joe Matthew is off, and all eyes are on the Federal Reserve today. The White House ramping up attacks against Fed Governor Lisa Cook over allegations of mortgage fraud. But our focus was already on the central bank today as Fed Chair Powell gave his highly anticipated remarks at the annual economic symposium out in Jackson Hole, Wyoming. We'll bring you a live report from there. Our very own Bloomberg's Michael McKee is on the ground, and we'll also have a conversation with Lael Brainerd, the former director of the National Economic Council. She joins us here in our studio in just moments as Michael Shepard, traders are really adding to their bets ahead of the next FOMC decision.
Well, they really are, and this has been one of the strongest days for markets in the past several months off of this news on the Fed. But there's other news that they've had to digest as well, Tyler. And we saw that Canada has decided to pull back on some of its retaliatory tariffs against the U.S. over some import levies that the governor there in Ottawa had found objectionable. Canada was one of the few countries that actually moved to retaliate against some of these Trump tariffs. And so we'll be looking to see more of the choreography between Prime Minister Mark Carney and, of course, President Donald Trump in coming days. And naturally, we're also going to want to get from Wall Street a sense of how they are digesting both the news from Canada and from Jackson Hole. We will go to Bloomberg's Charlie Pellet, the voice of Bloomberg Radio and the New York City subway for the numbers.
Hi, thank you very much, Michael Shepard. Here's what's going on. Stocks very close to session highs. All about Jackson Hole. We'll take you there live in just a moment with our Michael McKee. But the Dow, the S&P, NASDAQ, all advancing after Powell's remarks. You saw him on Bloomberg Television. You heard him on Bloomberg Radio. S&P right now up 93 at 64.64. That is a gain of 1.5%. Dow Industrials up 901. That's an advance of 2%. NASDAQ up 353, up 1.7%. Our Mag 7 index up 1.9%. Cannot ignore the Russell 2000 index. Big move there, up 3.8%. Dow Transport's taking part in the rally, surging 3.4%. Your 10-year at 4.25%, with the 2-year currently yielding 3.68%. Spot gold now up 1%, 33.72 the ounce. West Texas Intermediate crude a little changed, up 7 cents a barrel, 63.59. That's a gain of 0.1%. Bitcoin now surging by almost $4,000 a token, up 3.5%. Bitcoin at 116,398. As we have been reporting and as we continue to cover, President Trump says he will fire Lisa Cook from the Fed's Board of Governors if she does not resign her post over mortgage fraud accusations from a top ally. And NVIDIA has instructed component suppliers, including Samsung Electronics and Amkor Technology, to stop production relating to the H20 AI chip. This according to the information citing sources. NVIDIA shares today, they are advancing up by 1.3%. NVIDIA, very much a market focus next week when it reports earnings. Recapping stocks higher, S&P up 1.5%. Balance of power continues right now. Back we go to Washington. Once again, your hosts, Michael Shepard and Tyler Kendall.
All right, Charlie Pellet in World Headquarters for us in New York. Thanks so much. And today we're tracking our top story. Federal Reserve Chair Jerome Powell carefully opening the door to an interest rate cut come September. He gave what will be his last speech as chair to the Kansas City Fed's annual economic symposium earlier this morning out in Jackson Hole, Wyoming. And Powell pointed to rising risks for the labor market, even as concerns over inflation remain.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
There was a lot hanging over these remarks, from the path of rate cuts to heightened pressure on the central bank from the White House. And we want to get into all of it with our very own Bloomberg's Michael McKee. He's out there in Jackson Hole, has been covering this all week for us. He's our international economics and policy correspondent. Mike, let's just start with a recap from what we heard from the Fed chair. What sort of signals did we get out of him today?
Well, basically, by saying that the Fed it's okay to adjust policy, he told the markets that they are betting correctly. The Fed is on track to cut rates in September. That's a bit of a surprise. The feeling was he would keep his options more open, but for some reason, the Fed has decided that the threat of unemployment rising and people losing their jobs is greater than the threat of inflation for the time being. And so they are on a path to cut in September. They could change their mind, but right now, that's a pretty open suggestion that that's what they're going to do. It'd be pretty hard to walk that back. Their view is apparently that it is going to be a rough time for the labor market with hiring really slowing down, but tariff inflation only slowly going into the economy.
Mike, we've had a lot overshadowing the Fed as we headed into the Jackson Hole Symposium, and that, of course, has been the saga of Lisa Cook and the pressure from the president himself on her to resign. And today he escalated that by threatening to fire her if she didn't leave voluntarily. Have we heard from her today or from the Fed on this? And let me also ask Mike, what sort of signal did Jerome Powell send about Fed independence during his remarks?
Well, I can tell you Lisa Cook is here. She arrived this morning and she attended the first opening session. She got a round of applause when she walked in. Then the question becomes, what happens next in her case? That has been a distraction for the Fed, but it now could rise above that and become more of a problem if indeed the president does follow through with his threat to try to fire her, because that would trigger a legal battle between the Fed and the administration. And we're not sure how all that would play out, and we're not sure how the Fed would react. I know that Donald Trump is about ready to have reporters into the Oval Office, and he always makes remarks, so I'm sure he'll be asked about that, and we may get some more guidance on what he's thinking. The Fed is not talking about it. They, as I said, consider this a distraction, and they said they don't want to get into a tit-for-tat back and forth. But at this point, we're just waiting to see what happens with that. Powell didn't send a major signal today because he didn't talk about Fed independence, also a bit of a surprise. But the other issue is what is the Fed's future? What is Jay Powell's future? So far, no word from the president.
And Mike, as you are talking, reporters have been let in at the White House. Nothing yet here when it comes to the Fed, but we can't break at least one headline. President Trump saying that the World Cup draw will be at the Kennedy Center on December 5th. There, you see him there if you're joining us on Bloomberg TV, talking inside the Oval Office. Mike, just one more question for you to put a finer point on this conversation when it comes to the future of Fed independence. And I know we talk about this a lot, but it's because it's a big focus here in Washington, and that is those legal questions around whether or not the president could remove a Fed official. What do we know about what my understanding is a very high legal bar if there were to be a removal? And of course, these allegations against Lisa Cook at this point are just that, they are allegations. Looks like we might have lost Michael McKee there, but of course we thank him as always for joining and for his coverage. But to continue this conversation, and perhaps we will pick up right there, we are lucky to be joined now by Lael Brainerd, the former director of the National Economic Council under the Biden administration, also former vice chair of the Federal Reserve. She's a distinguished fellow at the Georgetown Center for Financial Markets and Policies. Lael, thank you so much for being there. Can we just pick up this conversation at this point when it does come to Fed independence, and what risks you see as we watch this pressure campaign from the White House ramp up?
Absolutely. Well, I think that first, what Jay Powell said today should have been music to the president's ears. He essentially, that was a very dovish set of remarks, where he essentially said that he also viewed the risks to the labor market as the greater set of risks, saw inflation rising perhaps more slowly over time, and opened the door, I think, very clearly for a cut in December, which is exactly what the president has been pushing so hard for. So it was a dovish set of remarks, and it really went quite far in the direction of confirming there would be a cut in September. Of course, we have two more important pieces of data that couldn't go in the other direction, but he did not qualify his remarks very much. So I think the question that you're raising about the Fed's independence is very important. The president looks to be getting what he wants in terms of the path of rate cuts coming down over time, reflecting what's going on in the economy. And it's counterproductive, I think, to suggest that this should be done due to political pressure as opposed to simply following the statutory mandate of the Federal Reserve.
Director Brainerd, you have also sat in that room as a member of the Federal Open Market Committee as Fed Vice Chair. Previously, describe the challenge in balancing that dual mandate, especially at a moment like this when the economy is facing some strains that it really hasn't faced in more than a century, really. And we're talking about tariffs and how those are affecting the whole outlook on inflation. We heard the Fed chair talk about how the impact of those tariffs on prices might be momentary, but he did hold out the possibility that they might be more lasting. What is your view on the impact of prices, and how is the central bank balancing all that as it also looks at the labor market?
Well, I think this is a very tricky juncture for the Federal Reserve because it is responsible for keeping inflation low and keeping the economy at maximum employment. And when you see the large increases in tariffs going from 2% to 17% on average in a short period of time, that puts upward pressure on prices and downward pressure on hiring and the labor market. That's a stagflationary shock, which is the most difficult kind of shock for the Federal Reserve to handle. And they're trying to tell the public, the markets, exactly how they're weighing those risks. Up until now, we've heard a lot more about risks to inflation. Today, what we heard at Jackson Hole was the chair articulating how important it was to get out ahead of the potential recessionary risk from a weakening labor market.
We also heard Jerome Powell really highlight this idea of tighter immigration policy and how that is impacting the labor market. And I'm curious to dovetail this with the conversation we're having about tariffs. As these companies are trying to absorb perhaps the higher costs, are they also going to have to face higher labor costs?
Well, you're exactly right that not only have the tariffs created that kind of stagflationary shock, but into that mix is a much smaller inflow into the labor supply. And so it's very hard for the Federal Reserve to read the labor market right now. Unemployment hasn't budged, it hasn't gone up, but the rate of job creation has come down dramatically. And so they are trying to gauge, is that because we have so many fewer people coming into the labor market because immigration has essentially stopped, or is the labor market weakening, which will, of course, lead to an increase in the unemployment rate. And unemployment tends to rise very quickly when it does start rising, which is what the chair said in his speech today, which is why I think they are quite cautious about what's going on in the labor market.
Director Brainerd, we also wanted to ask you about economic policy more broadly. And do you see an end game in the tariffs that the president has been unrolling? And what is the lasting impact in terms of U.S. global economic relations with trading partners and allies and adversaries alike?
So I think this question about, is this the end game, is so important for businesses who are making these hiring decisions, they're making sourcing decisions, they are making pricing decisions, and what they want more than anything, which I think we all hear, is certainty. They want to know that the tariff structure is going to essentially be completed at some point. And that will allow them to basically change their supply chains and their hiring. And hopefully, you won't see an ongoing increase in inflation. But if tariffs keep changing, keep ratcheting up, that will both make employers more cautious about hiring, and it could feed into inflation for longer. And of course, with respect to the international environment, I think trade partners are asking, to what extent can I really count on the U.S. to be a reliable international partner if the U.S. keeps changing tariff rates unilaterally based not only on trade considerations, but in some countries' cases, non-economic reasons.
To follow on that, what is the impact on the role of the dollar as the world's reserve currency? Do we see that at risk at all from this approach that the president is taking with trade and other areas?
Well, it's kind of a very important point. One of the great privileges of having the dollar be dominant is that it costs the U.S. government a lot less to borrow to service its debt than it would if we didn't have that dollar privilege. And so at a time when the national debt is projected to go up $3 to $4 trillion, the fact that we are playing fast and loose with the dollar, I think, does raise some questions about whether we might lose that advantage in terms of our borrowing costs. And that hasn't happened yet. The dollar has weakened a great deal, but when you see attacks on the independence of the Federal Reserve, it really does raise some questions about whether investors are going to want to continue to be as disproportionately invested in dollar assets, Treasury securities, as they have historically.
In the final minutes that we have with you, I wanted to pull on some of your expertise from working in the Biden White House, and I wanted to ask you about the more hands-on industrial policy that we've seen from this White House when it comes to a potential government equity stake in Intel, the so-called golden share in the Nippon Steel deal. How are you viewing what seems to be a shift in the public-private partnership? And a lot of this is because the administration is trying to bolster that domestic manufacturing. That's one of those reasons underpinning their tariff plans. How do you view this strategy by them that they're saying needs to happen in order to reach these goals that they've set out?
Well, let me just say I do think that in order to compete with China, which engages in a lot of industrial policy, that it has been important for the United States, for instance, to provide investment incentives for advanced manufacturing of chips here in America. It's great that we now have TSMC manufacturing the most advanced chips because of the CHIPS and Science Act. But we should compete with China based on our dynamic private sector. We should not be emulating China's state capitalism. And when I hear about these moves to take ownership stakes in some of America's most important and dynamic businesses, it really troubles me that we would be upsetting that balance. It's one thing to support the private sector. It's another thing to be moving into a kind of state capitalist model, which I do not support.
Well, in the 30 seconds we have left, let's drill down into that. Is this a proper use of CHIPS Act money then to do what the president is deliberating on doing, that is to take the Intel stake?
Yeah, so I think I don't know exactly the legalities of the stakes, but I just think it's bad policy. I don't think the U.S. government should be a shareholder in these companies. I think we should support private sector investment, support Intel and TSMC's and others' ability to compete with China so we can have the most advanced semiconductors here in the U.S. But moving to state capitalism is something that really troubles me.
All right, Lael Brainerd, we were lucky to have you here on this important Fed Day, former director of the National Economic Council under the Biden administration, former vice chair of the Federal Reserve, and distinguished fellow at the Georgetown Center for Financial Markets and Policy. Thank you for being here. We'll continue this conversation on Balanced Power Plus, the latest on tariffs with Canada. Stick with us. This is Bloomberg.
1:21 on Wall Street. We do check markets all day long here at Bloomberg. Developing story on Apple, on reporting from our Mark Gurman. Apple in early discussions about using Google Gemini to power a revamped version of the Siri voice assistant, marking a key potential step toward outsourcing more of its AI technology. Apple shares part of a broader tech rally today. Apple up now by 1.6%. Google parent Alphabet up now by 3.3%. It is an up day for the Dow, the S&P, and NASDAQ after Jay Powell's remarks carried live on Bloomberg. S&P right now up 102. That is a gain of 1.6%. Dow Industrials up 902, up by 2%. NASDAQ up by 408 for the NASDAQ Composite Index, a gain of 1.9%. Our Mag 7 index surging 2.4%, while the Russell 2000 index of small cap shares up by 3.9%. The 10-year, 4.25%, with the 2-year, 3.68%. Gold up 1%, 33.72 the ounce, and West Texas Intermediate crude little changed, up just about 0.1% right now, 63.57 a barrel. Bitcoin, meanwhile, up 3.9% at 116,777 on a Bitcoin. As we have been reporting, Canada will remove retaliatory tariffs on U.S. products that comply with the U.S.-Mexico-Canada agreement. We got a whole lot more on that topic for you coming up in just a moment, right here on Balance of Power. Again, recapping here, Powell speaks, market surge, S&P up 102 now, up by 1.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. Back we go to Washington. Balance of Power continues. Once again, your hosts, Michael Shepard and Tyler Kendall.
Charlie, thank you so much for the rundown there. We do have some more news coming in from the White House. We had heard the president earlier say that the World Cup draw would be held at the Kennedy Center, but now we are hearing him talk about perhaps expanding his efforts to toughen policing by sending federal assistance, including perhaps troops, to other cities. And those include the Democratic bastions of New York and Chicago that could be coming next. And of course, we don't have very many details beyond that, but we are looking to see what else the president may have in store for us, Tyler.
Right, exactly. We'll continue to monitor this. And if you're joining us on Bloomberg Television, you would have just seen there President Trump in the Oval Office addressing reporters. We'll bring you headlines as they come in. And another headline that we did get today here has to do with tariffs, a big story that we track all the time at Bloomberg, including this one that has to do with one of our largest trading partners, and that is Canada. Canada will remove its retaliatory tariffs on a long list of U.S. products that comply with the existing North American trade deal that's in place, seeking to lower tensions with the White House. Now, this was first reported by Bloomberg News, and we're lucky to have that reporter on the byline of that story with us now. That's Brian Platt. He's a Bloomberg Canada government reporter. He joins us now from Ottawa. Brian, it's good to see you, and thanks for being here. Can you just give us some context here? Was this move expected, and which goods does it apply to?
So, yeah, to give a very brief history of this, this is a big climb down for Canada. When Donald Trump's second term started, Justin Trudeau was still Canadian Prime Minister, and Trudeau believed in retaliation. And so to go dollar for dollar retaliation. And so when Trump first imposed the fentanyl-related tariffs on Canada, Trudeau hit back with a big list of tariffs on American goods. So that was things like Florida orange juice and Harley-Davidson motorcycles and Kentucky bourbon. Canada was really the only country in the world that hit back as hard as Trump hit Canada or hit the country when it comes to tariffs. And Carney took over as prime minister in April, but those tariffs have remained ever since. And what our sourcing tells us is that White House officials have made it clear to Mark Carney's government that if they wanted to get to any kind of trade talks on steel and autos and some of these sectoral tariffs, that initial list of tariffs that Trudeau brought in needed to go away. And so that's what Carney announced today. He said they're dropping all of those counter tariffs if the goods comply with the USMCA. And the idea here is that that's going to pave the way for Canada and the U.S. to start talking about steel and autos.
Brian, before we get back into Canada and U.S. trade relations, we do want to break in with a little bit of news A scoop coming in now that the Trump administration and Intel Corp are poised to announce details later today of an agreement that will give the U.S. government an equity stake in the iconic American chip maker. The exact details and timing of this announcement today, of course, are unclear, but Bloomberg has previously reported that a stake of up to 10% had been considered, and that, of course, would make the U.S. government the largest shareholder in Intel. Something we'll be watching through the rest of the program. But, Brian, we want to bring it back to the whole question of Canada and its relationship with the U.S. when it comes to trade. How significant a breakthrough is this, and what does it set up as a next step in terms of discussions with the U.S. on trade? And this includes the USMCA.
Yeah, I mean, that's like the big next step here is the USMCA talks, which there's a joint review that's due to be completed by next summer, and we'll get in. That process will start pretty soon. So that's reviewing the entire free trade deal between Canada and the U.S. and Mexico. In terms of how big of a breakthrough is this, that's the biggest question right now, because the U.S. did not give up anything here. Canada gave up its counter tariffs. The U.S. did not give anything. The idea is that this was kind of an olive branch to restart trade talks in full. Carney is going to be under a lot of pressure now to get to some kind of deal with Trump. Otherwise, Canada just keeps giving things up. I mean, this is not the first time Carney has sort of given up some concessions to Trump. Carney's going to be under a lot of domestic political pressure now to show some results in exchange for this, so we'll see where those talks go.
And Brian, can you also just give us a little bit more details here when it comes to those sector-specific tariffs and why these have perhaps, when it comes to steel, aluminum, autos, why there have been perhaps more sticking points with these negotiations compared to the tariffs that we saw implemented much earlier this year around the fentanyl and the border concerns when it comes to Canada?
Yeah, the thing to understand about this existing situation is that a lot of the trade between Canada and the U.S. right now is tariff-free because Trump has given an exemption if it's covered under the USMCA. Steel and aluminum in particular are two really big exceptions. Canada exports a ton of steel and aluminum to the U.S. They're the biggest supplier of both. Aluminum in particular, I mean, there's no other country that comes close to the amount that Canada exports to the U.S. Trump's 50% tariff is hammering the Canadian industries. Like, there's steel mills that are built all along the southern border of Canada with the U.S. who export a ton of their production normally to the U.S., and those exports are basically halted right now because of the 50% tariff that Trump has in place. So Canada's under Mark Carney's under a lot of pressure to try to get some deal done on steel and aluminum in particular. And so I think that's the biggest thing that Carney hopes to get to out of the announcement today is to somehow get some kind of deal done with Trump on steel and aluminum and get those metals shipping over the border again.
All right, Brian Platt, Bloomberg Canada government reporter, we thank you so much for all of your reporting. And to extend the conversation, we're going to bring in our signature political panel. We're joined again for Hour 2 of Balance of Power by Jeannie Shanzano, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center and Democratic strategist, alongside Ashley Davis, partner at S3 Group and Republican strategist. Ashley, let me start with you, and let's pick up on tariffs, because we've gotten quite a few headlines when it comes to tariffs this week, including the U.S. and the European Union putting pen to paper, starting to get a little bit more details when it comes to these trade deals. But at this point, a lot of them are frameworks. How are you viewing the White House's strategy so far when it does come to tariffs and they really dominate the headlines?
Absolutely, and obviously it dominates some of the market conversations as well. But I think that, especially with Canada, this has been something that there's been no movement and a lot of rhetoric. And I think the fact of what Carney did, obviously there was a really, really bad relationship between Trudeau and Trump. So when Carney won, and since he's come in, there has been an effort to kind of stop the rhetoric between the two leaders. But Canada taking away these secondary tariffs, so to speak, or I think that it is something that will really help the overall negotiations. Exactly as Brian said, there was no movement. Obviously, there were bigger deals with the EU, China. We still haven't figured out India. But I think the more that these frameworks are at least discussed, it takes the pressure out of the balloon, so to speak. But the frameworks are really going to what's matter at the end of the day.
All right, well, we're going to have to pause this conversation because we do want to bring our viewers and listeners some breaking news. President Trump is taking questions in the Oval Office from reporters. Let's listen in.
A lot of our business over the years, over 25, 30 years, especially during the Biden years. They took a lot of our business, and it's basically all coming back into the United States now. Well, hot as a pistol, and it's coming back in. Because of tariffs and the incentives we give, it's coming back. And it's impossible, I think, for another country to stop it. And we are working on something. We want to be very good to Canada. I like Carney a lot. I think he's a good person. And we had a very good talk yesterday. So I think it'll be good.
Mr. President, I have a question about the search of Ambassador Bolton's home. The Vice President recently just did an interview saying that it's about classified documents, but that there's also broad concern about him. What are the concerns?
Well, I haven't spoken to Pam in the group yet, but I will be. I saw that just like everybody else. I try and stay out of that stuff. I'm allowed to be, and I'm chief law enforcement officer, believe it or not. You know, I don't like to go around saying that, but I am. That's the position. But I purposely don't want to really get involved in it. I'm not a fan of John Bolton. I thought he was a sleazebag, actually. And he suffers major Trump derangement syndrome, but so do a lot of people, and they're not being affected by anything we do. I don't know anything about it. I just saw that. I'll find out about it. But if you believe the news, which I do, I guess his house was raided today. But my house was raided also, called Mar-a-Lago. They went through everything they could, including my young son's room and my wife's area. They went through her drawers, as the expression goes. They went through everything you can imagine. And when she came back, she said, she's very neat, you know, she's meticulous. And she looked and she said, whoa, this wasn't the way that she had it. So, you know, so I know the feeling. It's not a good feeling. Thank you.
Mr. President, how long will you give Putin?
A couple of weeks. We're going to figure it out. We'll find it.
Do you think you'll have to intervene at some point?
Look, it takes two to tango. You understand that. I wanted to have a meeting with those two. I could have been at the meeting, but a lot of people think that nothing's going to come out of that meeting. You have to be there. Maybe that's true. Maybe it's not. But we're going to see. In the meantime, people continue to die. But I've solved 7 of them where they were in wars for 31, 35, and 37 years. We had 3 of them that were for more than 30 years, Johnny, and I got them solved. And we solved one that could have been a nuclear war with India and Pakistan. That was getting ready to be a nuclear war. I solved them all. And this one, I thought we would have had it done by now, but it's more difficult. There's a lot of anger, a lot of hatred. There's a tremendous amount of hatred there. So, but we'll see what happens. I think in 2 weeks we'll know which way I'm going. Because I'm going to go one way or the other. And they'll learn which way I'm going.
Mr. President.
If I got 2 questions for you, one on FIFA, the other one on DC. Can you talk about the economic impact that FIFA will have in these cities, and what's your message to the mayors to get their cities prepared, not only the beautification process, but also the safety aspect?
Well, Los Angeles is an example. You know, it's poorly run. We have a mayor there that can't even get permits to the people that lost their houses. Lee Zeldin got every permit. The hardest permit is the federal permit. Within 20 days, every single permit was there for the people to build their houses. But people are writing us and they're saying they won't give us. The mayor is incompetent. The governor's incompetent. You know, Gavin. I know Gavin very well. He's an incompetent guy with a good line of bullshit, and he doesn't get the job done. And frankly, those people want to build their houses. It's terrible. They could have been built. Some of them could have been built already. But think of it, the federal government that has the most complex part, it's the most complex environmental thing to do. We got it, everybody had it within 30 days. And they're not even close to getting their permits. And now they're talking about taking some of those sites and building low-income housing on them. These are high-end neighborhoods. And I'm all for low-income housing. I built a lot of low-income housing. I know all about 236. I know every program that there is in the government. I used every one of them. I know more about low-income housing than probably almost anybody. And it's great. It's fine. It's wonderful. But you don't build it in Pacific Palisades. You don't build it there, and you don't build it in the other areas that burned down. So they're talking about putting up low-income housing. And you talk about riots. They're going to have riots if that happens because you're taking the people's property away. They want to build their houses, and they're unable to get permits from the mayor and from the governor. And that's a terrible thing. But, and let me tell you, if I didn't send in the troops in Los Angeles, Johnny wouldn't be in Los Angeles. You wouldn't be having your World Cup there. I sent in the troops, and we kept it. And even the police commissioner, the sheriff and the police commissioner, they all said the same thing. They said, we could have never handled what was happening. You saw that, you were there. He said, we could have never handled what was happening. And then you hear Gavin Newsom, after it's all quelled, you hear Newsom get up and say, we could have done this for ourselves. No, they couldn't have. And if they could have, I wouldn't have taken the chance either.
Okay, my second question is on crime prevention. Would you be open to expanding the national concealed carry to apply to D.C. like it does in other states like Texas?
Yeah. Well, they have it in some states, and they feel strongly about it. As you know, I'm in favor of it. People have to protect themselves. I'm a Second Amendment person, very simply. People have to be able to protect themselves. Especially like in Washington, you walk down the street, a guy comes up and slugs you. He's got a pistol in his hand. You can be tough. You can be in great shape. You can be a powerful person. Or you can be a guy that weighs 100 pounds with a gun in your hand. And I'll bet on the guy with a gun 100% of the time, right? And so you need protection. So I'm a Second Amendment person all the way. Yeah, please.
President Trump, you said this morning that you're working with Congress to get $2 billion to help clean up D.C. Have you had any conversations with Mike Johnson and John Thune about where they're going to get that money from?
Which money?
You said this morning that you're going to get $2 billion from Congress to help clean up
D.C.
Yeah,
I've spoken to Mike Johnson. I've spoken to John Thune, the Senate, the House. And I think it's going to be very easy to get. It's going to be not a lot of money. I wouldn't even know where to spend the number that you mentioned, but it's going to be money to beautify the city. Yeah, they're ready. Everybody wants to save D.C. In one way, it's the easiest. The violence was more than any other city in the country, actually, by far. It may have been more than any other city in the world, if you could think. We looked at some of the worst cities in the world. It was worse, and that's why it angers me to see the mayor saying about how they have it on the slide. Not on the slide. It was worse than ever. Yeah, we have no problem getting that money. That money will come out of Congress. I think it'll be even bipartisan.
And is the plan
I mean, I would imagine Democrats would vote for that one.
Is the plan to get it before the September 30 spending deadline on the Hill?
Well, I don't know if there is a deadline, because if I declare a national emergency, which this was, that ends the deadline. So, I mean, I keep seeing about a 30-day deadline, of which we have 22 days left or something. But if I think we're in great shape here, that's one thing. But if I don't, I'm going to just say it's a national emergency. And if I have a national emergency, I can keep the troops there as long as I want. If people are not going to want to have the troops in 30 days, it's one thing to get them out. It's another thing to keep them out for a long period of time. You've got to train people. You can't do this. You can't bop people over the head. And a lot of those people are in courts right now, going to court. They're going to go to jail for a long time. So that's going to take more than 30 days. But if I have to, I'll declare a national emergency, which I don't think I'll have to do. Yeah.
Mr. President, can I ask you about Russia? You said in 2 weeks you'll know whether you go.
Yeah, I think I'll know. I think I'll know the attitude of Russia and, frankly, of Ukraine. It takes two.
What are the 2 ways you can go at the end of 2 weeks then?
Well, then I'm going to make a decision as to what we do. And it's going to be a very important decision. And that's whether or not it's massive sanctions or massive tariffs or both. Or do we do nothing and say it's your fight? Look, I would have never been in this war if I were president. You wouldn't have had this war. It was never going to happen. This was caused by stupid people that fought. And people say, well, how do we know? Because for 4 years, it was never even a subject. And Vladimir knew, and you see his picture right here. It was nice that he sent, but Vladimir knew very strongly we wouldn't have stood for it. It wouldn't have happened. 100% wouldn't have happened, but it did happen. And now they're losing from 5 to 7 young kids. Think of it, you're a parent and your son is leaving. He's Russian or he's Ukrainian. and he's leaving, and they're waving goodbye. Nice, beautiful kid, nice crew cut, all set. He wants to be a soldier, and he goes there. First week, he has his head blown off, and he's no different than you people, me. And it doesn't matter where. I mean, I solved a problem in the Congo that was vicious. Rwanda and the Congo, the Republic of the Congo, and they were fighting for 31 years, and it was machetes. People were getting their heads chopped off. That was going on for 31 years. I got it solved. You saw it. They came to the White House and we signed an agreement. It was amazing. People can't believe we got it done. I love to stop killing. I really do. People thought it would be just the opposite. Hillary Clinton said, "Oh, he'll get us into a war." No, I'm getting everybody else out of wars.
Are you saying there's a real possibility then that you do nothing if Putin doesn't come to the table for a ceasefire?
I'll see whose fault it is. If there are reasons why, I'll understand that. I know exactly what I'm doing. We're going to see whether or not they have a meeting. That'll be interesting to see. And if they don't, why didn't they have a meeting? Because I told them to have a meeting. But I'll know in 2 weeks what I'm going to do. I have pretty good ideas.
Your Justice Department is also sending some of the Epstein files over to the House Oversight Committee today. Are you in support of them releasing all of them?
I'm in support of keeping it open.
If they wanted to release,
people shouldn't be hurt, but I'm in support of keeping it totally open. I couldn't care less. You got a lot of people that it could be mentioned in those files that don't deserve to be. People, because he knew everybody in Palm Beach. I don't know anything about that, but I have said to Pam and everybody else, give them everything you can give them, because it's a Democrat hoax. It's just a hoax. The whole Epstein thing is a Democrat hoax. So we had the greatest 6 months, 7 months in the history of the presidency, and the Democrats don't know what to do, so they keep bringing up that stuff. But it affected them. Bill Clinton was on his plane and went to the island supposedly 28 times. I don't want to bring that up, frankly. You have Larry, whatever his name is, Summers, the head of Harvard, who was Jeffrey Epstein's best friend. Nobody ever talks about that. I mean, but I don't want to hurt Larry Summers, but he was best friends with Jeffrey Epstein. No, this is a Democratic hoax to try and get the significance of what we've done over the past 7 months. Nobody's ever seen anything like it. They say it's #1 in history. What we've done, including stopping 7 wars. I mean, just include that. And now you look at the stock market today. It's way up to start off with from where I took it. And this market was going to crash. If Joe Biden or Kamala were president, this market we would have had a crash like in 1929. You're not going to have that. It's only a question of how high is it going to go. You know, I had the strongest economy in the history of our country. And despite COVID, we had the strongest economy in the history of our country. And we're going to blow it away this time. I was always good at making a lot of money. And whether it was for myself or whether it was, I like doing it this way better. I mean, I like making it for the country. Our country's been ripped off by friend and foe, nations all over the world ripped off. And the friends have been much worse than the foes for the most part. And they're not ripping us off. We just signed a deal with the European Union. They're paying us essentially $950 billion, like a signing fee. They're going to buy $750 billion worth of energy. They weren't buying much of our energy there. And they're very smart in doing it. And as you know, Ursula was here a couple of days ago having to do with the people, the leaders that we had a great, people said they've never seen anything like it. Well, we had the leaders of Europe right here in the Oval Office. And she's so happy that she has an agreement. But people aren't ripping us anymore. We're run by, this country is run by smart people now.
Mr. President, in Israel... Two questions. One is about Intel. There have been reports that you're considering taking a stake in Intel. Can you tell us
About the 10%?
About the 10%.
Yeah, I met a man. He was a very nice man, and I called for his removal because I saw something by a man named Tom Cotton, a senator from Arkansas. He's a great guy, friend of mine, supporter of mine, big supporter. I'm a supporter of his too. And he wrote a pretty nasty story about the head of Intel. And I said, well, if that's right, he should resign. And he came in, he saw me, we talked for a while. I liked him a lot. I thought he was very good. I thought he was somewhat a victim, but, you know, nobody's a total victim, I guess. And I said, you know what? I think the United States should be given 10% of Intel. And he said, I would consider that. I said, well, I'd like you to do that because Intel has been left behind, as you know, compared to Jensen and some of our friends, NVIDIA, some of the people, and the people because Intel should have never been. Intel was the biggest, most powerful chip company in the world. And then they started leaving. And they started going to foreign countries, in particular Taiwan. And if we had a president that would have said, okay, you can go to Taiwan, but we're going to put a 100% tariff or 200 or 300 or 500% tariff, anybody that sells into the United States has to pay. They wouldn't have left. They would have never left, and we wouldn't have. So in the meantime, we had people that were, in some cases, good politicians that weren't good on trade. I loved that man, but he was not good on trade. I totally disagreed. He allowed the car industry to be taken out of this country. We lost 50% of our car industry. But that's all coming back. It's all coming back. But if somebody would have said that with Intel, would be a giant right now. Now, with that, they've had some bad management over the years, and they got lost. And I said, I think you should pay us 10% of your company. And they said, yes. That's about $10 billion. I don't get it. This comes to the United States of America. And I said, I think it would be good having the United States as your partner. He agreed. And they've agreed to do it. And I think it's a great deal for them. And I think it's a great deal. He walked in wanting to keep his job, and he ended up giving us $10 billion for the United States. So we picked up $10 billion. And we do a lot of deals like that. I'll do more of them. If somebody has, like we have restrictive covenants with Jensen. We have, it's NVIDIA. And to unrestrict the covenant, nothing to do with losing our powers or military or anything, because that I wouldn't do. But there are things you can do that don't affect us, that actually help us. And if we're going to give somebody a restricted covenant, we have a strong restrictive covenant on certain industries. And I will absolutely give somebody a opening on a to do a lot of business, which is good for us, as long as it doesn't hurt us in a security or military way. And if I do that, I think the country should be paid, because anybody else, I have it in real estate where I'll have a deal with somebody and I'll have them restrictive covenant. Then they'll come back and they'll say, I'd love to be able to build over here, but I'm not allowed to because you have me covered, you have me restricted. I say, I'll let you build over there, but pay me a lot of money. No different. But the country never did it because the country was run by foolish people.
You said Chicago might be next. Are you making, have there been concrete steps that the administration is taking to do that? Or what are other cities as well?
I haven't spoken to the mayor. He's grossly incompetent. I haven't spoken to the mayor. No. When we're ready, we'll go in and we'll straighten out Chicago, just like we did D.C. Chicago is very dangerous. Great place. I built great stuff there. I have the most beautiful building in Chicago, I think. But I hate to see what's happened to Chicago. Chicago was our greatest city, actually. Bob Tisch, a great friend of mine, passed away. He used to own the Giants and very successful Lowe's. He said Chicago, I think they had their main office in Chicago. He said Chicago and San Francisco are the two greatest cities in the world. Now you look at what the Democrats have done to San Francisco. They've destroyed it. I own a big chunk of the Bank of America building in San Francisco. And, you know, it's just different. We can clean that up too. We'll clean that one up too. Now, if everything works out, and we've already had calls from other cities, quiet calls from Democrats. We'd love you to come here, because they've lost control of their cities. I'm not going to say, because I don't want them to lose their elections. But we've had calls from Democrats and calls from people generally. We'd love you to come here, because we'll straighten out the problem.
In Israel, the families of hostages are opposed to the reoccupying of Gaza. Why is the U.S. still?
Well, not all of them. And you have to understand, I'm the one that got all of the hostages out. You got a lot of people out. If it wasn't for me, they wouldn't be out. I worked with Bibi and I worked with Steve Witkoff. But if it wasn't for me, you would have all these hostages would most likely be dead right now, every one of them. So they all come up here. They come in groups of 10, 12, 13, and many of them. And I've gotten to know a lot of them. They're great people. What they had to go through is incredible. But so now they have 20, but the 20 is actually probably not 20 because a couple maybe aren't around any longer. It's a terrible thing. No, I don't like anymore. I said, you know, when you get down to 20, they're not going to make deals anymore. And they didn't. And then I put out a statement, as you know, that was a tough statement. Go in and get them. And they said, we'll give you 10, we'll give you 10. I don't know what Israel's doing, but they were willing now immediately to give us another 10. The situation has to end. It's extortion and it has to end. And we'll see what happens. I actually think they're safer in many ways if you went in and you really went in fast and you did it. And people can't forget October 7th, remember that. I'm friendly with all groups. I won the Arab vote in Michigan. I did so great with the Arab vote, remember? I started off at 0, I ended up winning. I wouldn't say the candidate was the greatest, but I would have won against anybody. They're great people. But we have to do things properly. And, you know, I'm very proud to say I got the hostages out. You have hundreds of people that are living now because of me. And now we have that final little group of people. And Hamas knows that if they give them, that's probably the end of their lives. So it's not easy to get. And I know if you're a parent, you just don't care. You want, I want my baby back. They want their babies back. They want their kids back. And I understand it. But I got them out and did a good job. And we're doing everything we can to get the hostages out. Thank you all very much. Yes?
So Jackson Hole, Jay Powell today said, he suggested that they might cut interest rates, but they haven't proceeded.
Well, we call him too late for a reason. He should have cut him a year ago. He's too late. You know, we have a stock market that's up 1,000 points today. I better be careful because I go out there and I'll see it's down 1,000, right? But it's up 1,000 points when I came in here. We have a country that the market's the hottest it's ever been. The country's better than it's ever been. We have a military that I rebuilt largely in my first term. We had a great, successful first term, but this is going to be even better. But we rebuilt it. We gave a lot of it away to Afghanistan, but relatively small compared to the overall. But I think it was the most embarrassing day and period in the history of our country that they allowed those 13 wonderful people, but it's really hundreds of people were killed. And they don't talk about the 48 that was so severely wounded with no legs, no arms, nobody ever mentions them except me. But that was the worst day, the most, it just showed how incompetent. Frankly, if that didn't happen, I really believe that you might not have had the problem with Russia. I think Putin was sitting there watching these stupid people running our country and said, this is a time to invade. It's, you know, this is a time. And then Biden made the statement, well, he can do a small incursion. When he said that, it was off to the races, right? When he said he can do a small incursion, remember that? I was surprised he knew the word incursion. I didn't think he had that good of a vocabulary. I want to thank everybody. It's very important to me and to everybody up here, the World Cup. And Johnny has been so incredible. I mean, he's really a great leader. I mean, to think, I said, Johnny, do it by phone. You don't have to come. No, he said, I'll come. And he flew all night long to be here and listen to this about how great we're doing in D.C. But he's a fantastic leader, and this will be your most successful World Cup ever. Thank you, Jim.
Thank you so much. America. Yeah, can we win it, Mr. President?
I don't know. I watch some of those teams go around. They go down that field. I don't know. But let me ask you, what chance does America have of winning?
Well, the home team always has a good chance to win. It depends how it starts. No, but it has some good players. Yeah, of course. You have a chance.
Will Bear be going to the games, Mr. President?
I'd love to have him. He'd love to. He's very tall. Maybe we can make him a goalie. The goalies are very tall now, right?
Yeah, goalies are very tall.
The goalies, well, he'd be a perfect goalie.
100%.
At his height, he'll be a great goalie.
Exactly.
So we'll put him on the American team.
Yeah.
No, but do the Americans have a chance of, like, getting into the quarterfinals?
Yes, definitely. No, the quarterfinal, definitely. But then, you know, as the tournament goes on with the public 250 years of the United States, let's don't forget.
All right, that's been President Trump speaking in the Oval Office, taking questions from reporters on a range of topics, including one redhead that hit the Bloomberg terminal. President Trump saying that Intel has agreed to give the U.S. a 10% equity stake, appearing to confirm a Bloomberg News scoop on this story. We are waiting for additional details. We will bring you a couple other headlines that came out from the president, notably when it comes to the war in Ukraine. President Trump reiterated that he's going to give Vladimir Putin a couple of weeks to come to the negotiating table, and then we'll make a decision on what to do. He outlined that could look like a few different things. He threatened sanctions as well as additional tariffs, but then floated that maybe the U.S. would do nothing, saying that he will say, quote, "It's your fight," We also heard him touch on another story we're following today when it comes to tariffs, saying that he will have another call with the Canadian Prime Minister Mark Carney after Canada moved today to drop retaliatory tariffs against the U.S. in what was widely seen as a peace offering, perhaps, to the White House as they try to negotiate down their tariff levies. But Michael Shepard, really the big news here on Intel, giving us some insight into his thinking here when it comes to the U.S. potentially taking this equity stake.
And Tyler, he was moving very clearly to take credit for this idea of an equity stake. And he, when asked by reporters about the discussions with Intel, described his meeting with the CEO, Lip-Bu Tan, whose name he did not utter, but he did talk at length about how the two men had met, how he had gone into the meeting even with some suspicion of the CEO based on some earlier reporting that had emerged from Senate Intelligence Committee Chair Tom Cotton, but somehow the Intel chief had won him over, and that the idea for a U.S. stake of up to 10% in the company had originated with Trump.
Because this was a pretty big reversal in just the matter of days, right? We had heard from President Trump posting on Truth Social, potentially calling for his ouster, and now we have this deal emerging. What do we know about the timeline here and when we could actually get some firmer details about what we're about to see?
Well, we're waiting to see what exactly will unfold next, and that is the nitty-gritty and the details and what will appear in the paperwork, where the deal is actually described. And the president is describing what he calls these restrictive covenants, and he is trying to make sure that not only the arrangement with Intel, but the one he has also set up with NVIDIA, where the company will give the U.S. government a 15% cut of any sales of AI chips to China. These are the kinds of chips that the administration had initially tried to forbid from being sold in China back in April, but reversed course under pressure from another big-name tech CEO, and that, of course, is Jensen Huang, who Trump also name-dropped during his appearance here. And overall, this is just an example, Tyler, of the kind of hands-on corporate and industrial policy that we're seeing. And it's one we heard his former vice president in a conversation with us yesterday, Mike Pence, express some objections to. He thinks that it's not a good idea for the U.S. to be taking these stakes and being so interventionist in corporate affairs. And we just heard former National Economic Council director under President Joe Biden, Lael Brainerd, express those same reservations.
Right, exactly. And you could catch that conversation on the Bloomberg terminal or on Bloomberg.com. We'll continue covering all of these stories here on Bloomberg. And as we say goodbye to this edition of Balance of Power, we do want to say a very special hello to a very lucky baby out there. Our very own Kaylee Lines, welcome to healthy and beautiful baby boy. Earlier this year, as we end the program, we want to send a big congratulations from our Bloomberg family to Kaylee, who we miss but are so excited for as she starts this new chapter. Bloomberg Business Week Daily is up next. I'm Tyler Kendall alongside Bloomberg's Michael Shepard here in Washington. Stick with us. This is Bloomberg.
Hey, Tyler, Mike, thank you so much. It is Bloomberg Business Week Daily on this Federal Reserve Friday. I think it's fair to say. I'm Tim Stenivek, along with Nora Melinda from the Bloomberg News Equities team. It is Friday, August 22nd, 2025, and our focus squarely on not just the equity market, but certainly on what we heard from Fed Chair Jay Powell a little earlier today, because Wall Street getting the rally signal they were hoping for from the chair of the Federal Reserve. Taking a look at markets right now, and we're going to have more from Charlie Pellet in just a second. The S&P 500 up 1.6%, the NASDAQ Composite up 2%, the Dow up 2%, but type in RTY on the Bloomberg terminal. That's the Russell 2000, and that is surging. Earlier in the session is up as much as 4%, really hovering at around 3.9% to the upside since we heard from Fed Chair Jay Powell. Nora Melinda, we're going to have Molly Smith join us in just a second. She's Bloomberg News economics editor. Give us a breakdown of everything we heard in that speech, because it wasn't just the equity market and traders being happy about the idea of a potential September rate cut. They covered a lot of ground.
Absolutely. There was so much ground that was covered. I mean, we saw a lot of activity also in the bond market. That's something, of course, to note. But I think people are really just waiting to hear from Jerome Powell. There's a lot to focus on, especially as we look ahead to next month. But later on, super interesting, we're going to be hearing from CFO of Webtoon. It surged more than 80% after it announced a deal with Disney. They'll be joining us later.
Also, the CFO of Axiom Space is back with us just ahead of an orbital data center launch. Yeah, We're talking about data centers and space now, guys. You got to stay tuned for that one. All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, a check of the day's trade and top business stories. Here he is, Charlie Pell.
Hi, thank you very much. And right now we do have stocks rocketing higher with the Dow, the S&P, NASDAQ solidly in the green. But a couple of developing stories. You heard it live on Bloomberg. President Trump says Intel has agreed to give the U.S. government a 10% equity stake in the company. Trump cast the agreement as one that would revitalize Intel, saying the company has been, quote, left behind compared to competitors in the chip-making industry. Intel shares right now, they're up by 5%. The Dow, the S&P, NASDAQ, they're all advancing. Jay Powell spoke. Markets moved higher. S&P up 103 right now at 64.73. That is a gain of 1.6%. We've got the Dow up 892, a higher by 2%, and NASDAQ up 427, up by 2%. Stocks surging on rate cut expectations in September. We'll have more throughout the day right here on Bloomberg. Our Mag 7 index up 2.6%. Tim mentioned the Russell 2000 index of small cap shares. That is surging now by 3.8%. Dow Transport's taking part in the rally big time, up 3.2%. The 10-year yield 4.25%. The 2-year 3.68%. Spot gold up $36 the ounce, up 1.1%, 33.74. West Texas Intermediate crude up 0.2%, 63.74 a barrel. And Bitcoin is surging 4.2% right now at 117,095. Bitcoin, again, up by 4.2%. Briefly, Apple in early discussions about using Google Gemini to power a revamped version of the Siri voice assistant. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Covering a lot of ground there. Shares of Apple, as Charlie mentioned, up 1.5%. Worth repeating the redhead that crossed the Bloomberg terminal, and exclusive by Bloomberg's Mark Gurman. Apple's exploring using Google's Gemini AI to power a revamped Siri. We're going to have more on that a little later in the program. I'm also watching what's going on with Intel right now, up close to 5% as we speak. We just heard the president saying that Intel has agreed to giving the U.S. a 10% stake. As soon as he said that, we saw shares shoot higher. The president saying that Intel has agreed to give the U.S. government a 10% equity stake in the chip maker. A formal announcement is expected on Friday. That's according to people familiar with the matter. Here's what the president said. They've agreed to do it, and I think it's a great deal for them. The president telling reporters this just moments ago at the White House. We're going to have more on this story a little later in the program as well. We are also squarely focused on everything happening in the equity trade and in the bond market today, because traders got the green light. Stocks surging after Jay Powell today struck a more dovish tone than many expected during his highly anticipated final speech at Jackson Hole. The Fed chair covered a lot, during which treasuries rallied and the dollar tumbled. He addressed the dual mandate, the effects of tariffs, and emphasized the committee's data-driven approach.
While the labor market appears to be in balance, it is a curious kind of balance. This unusual situation suggests that downside risks to employment are rising. At the same time, GDP growth has slowed notably. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months. With high uncertainty, a reasonable base case is that the effects will be relatively short-lived. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic. The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach.
That was Fed Chair Jay Powell live from Jackson Hole earlier today for his last speech there. We've got Molly Smith with us right now. She's Bloomberg News economics editor. She joins us here in the Bloomberg Business Week studio. Wow, a lot happened, including him coming out a little late, which is very unusual for Jay Powell. This guy's like always on time, so I was surprised to, still be listening at like 10:04.
He's always ready to go.
And he hasn't started.
Yeah, but I mean, as Trump would say, he's too late.
He's
always too late.
Okay, there it is.
And actually, Trump did come in today also just to say that it was too late for Powell to signal a September cut. So, very on brand.
Okay. Everything is on brand. He covered a lot of ground, and we got some of the highlights, the tidbits there. And it was also a very, I think, as Mike McKee talked about earlier, one of the reasons, according to reporters who were in the room, about why he was late is because he got a standing ovation. When he came in, according to Mike's reporting.
Oh, because we probably won't be seeing much of him anymore.
Well,
at this event.
At this event.
Yes.
And he kind of alluded to that. He said, apart from a couple of years during COVID when I did this virtually, and he talked, he thanked the Kansas City Fed chief for everything they've done. And what was your biggest takeaway? We saw what the market's excited about, but what were your big takeaways?
I mean, I think it's just amazing when you look at this amazing market rally that we've had in response, that it really is just because of these 4 words, adjusting our policy stance. Or really the couple before it, may warrant adjusting our policy stance.
And everybody says that policy stance is looser monetary policy?
Well, that it's going to be then that rates will be cut then because that will be the signal effectively. So those, what is that? 1, 2, 3, 4, 5, 6 words there. That is why your 401ks are doing really well today. That is basically the essence of the speech.
Well, we're definitely seeing a really strong showing here in the equity markets. We're looking at the Dow Jones Industrial Average up almost 2%. We're just seeing green all across the screen today. But I mean, of course, what has really been overcast during this time period is all the spotlight that's been here on Lisa Cook. And that's something that we've all really been focused on here. But I'm curious, what is the importance here of the Fed's independence?
Yeah, I mean, that's obviously something that central bankers at the Fed at this conference, as well as from all around the world who are also at this conference, are very much in support of. And that was a huge part of, coming into Jackson Hole. It was probably going to be a big theme of this, and that this is a concept that's really meant to be respected globally, and that central bankers take this really core to their mission of being able to operate free from the governments where they live. So this is yeah, I mean, it's something that Powell has made very clear in all of his speeches, and I'm pretty, again, on brand for him to stick with that today.
We heard from the Fed chair at the July policy meeting, and then we got the minutes earlier this week. And a few days after the meeting, we got the payrolls report for the month of July. And that kind of changed the narrative around the dual mandate, the maximum employment part of the dual mandate versus the stable prices part of the dual mandate. Did we get any insight from the chair as to how the Fed is thinking about the balance of that dual mandate right now and how that may have shifted since the latest employment report?
Yeah, this is what everyone was waiting to see, because a lot of people at the time had speculated that if Powell and the rest of the Fed had seen that July employment report before that FOMC meeting, which was 2 days before the report dropped, maybe it would have been different, the outcome of that meeting, and maybe they would have cut rates, or if not cut rates of that meeting, maybe would have at least signaled it more strongly at that point. But they didn't know that at the time. This came out 48 hours later, and certainly, as you said, Tim, like, our whole understanding of the labor market really changed that day. So Powell did allude to that, and that there are certainly risks to the unemployment side of the mandate, and that's really where the opening the door to the September cut comes in, because at the same time, he's still saying that we have to be wary of inflation risks and that they're tilted to the upside, and being mindful of tariffs, even if he thinks that those effects are ultimately going to be short-lived.
And one thing that Powell really tries to do, he tries to avoid anything that would represent him weighing on, fiscal policy as opposed to monetary policy. We know that he really is squarely focused on monetary policy here. But we can't leave out the fact that tariffs remain a clear concern here for the economy more broadly. What are your sources telling you about how the Fed is really factoring in the effects of tariffs as we look ahead?
I mean, Powell's made it seem pretty clear that his base case is for tariffs to be a short-lived inflationary effect, which is interesting, I think, because, there was a time where I think he was maybe viewing it a little bit more balanced, or perhaps even more wary of it being of a more persistent impact, and which has then been interesting then if you are in the camp that you think that this is going to be a one-time hit to inflation, why you wouldn't be more open to lowering rates sooner. That if you are in the persistent camp, that would certainly lend credence a lot more to the holding rates elevated side of the argument. So they're all definitely mindful of this. There are definitely some Fed policymakers who are more mindful of it than others. We had Beth Hammack of the Cleveland Fed come on CNBC after Powell spoke, and she had a very different tone to when she was talking, and she said that she is squarely focused on inflation right now. And remember, she had just said yesterday or the day before that if the meeting was tomorrow, she's not going to cut.
I want to sit tight, Molly Smith. I want to bring in Eric Weiner. He's Senior Editor, Equities Americas for Bloomberg News. And also just take a quick look at the equity in the bond markets. The S&P 500 up 1.6%, the NASDAQ composite up 2%. The small caps, those interest rate sensitive, smaller market cap companies, up 3.8% as we speak. It's essentially the best cross-asset rally that we've seen, Eric. On the yield curve, we're seeing yields lower by about 11 basis points on the front end of the 2-year, and the 5-year down 10 basis points. And we're also seeing the 30-year yields lower by 3.6 basis points right now. 4.88 on yield on the 30-year. The 10-year yield is 4.25 right now, kind of moving around a little bit. What was your big takeaway? Obviously, the market reaction is huge, but you're kind of smiling a little bit right now.
Well, like to Molly's point.
You a little skeptical?
Well, I think that he said that they are going to cut rates, and it's not for a good reason. They're going to cut rates because the inflation is not showing up yet. And their real concern right now is growth and the labor market. And if you listen to what he said about rates, yes, he talked about it being temporary, but he also talked about how they haven't really shown up yet. So when you're talking about inflation, I'm sorry, so if inflation is temporary, but if you think that the effect of tariffs is going to be usually a year to 18 months after they're implemented, we haven't seen what they're going to do. And in fact, if you think about it, most likely it will be the next.
Just because it's uncharted territory.
Right, it's new. The new Fed chairman, he probably, Powell himself, probably will not be the one who handles this. That by next May, we will probably be seeing a bunch of this, but at that point, he'll be out.
And maybe a Kevin will be there.
Right. So we don't know. But it's not necessarily his problem. However, what the market is doing is taking back 5 days of peeling off of interest rate bets. So you had 5 down days in the S&P 500, fairly shallow days, but still 5 down days.
We're basically down 1.8% off all-time highs.
So we reversed that. 25 basis points is cooked back in for coming up this next meeting. But from there, we'll see, because I don't necessarily know what the inflation reports are going to show, but a lot of company earnings were talking about seeing inflation in their results.
But they're eating it right now, Molly, and we're seeing that in the producer price index data.
Yeah.
And we're hearing that from companies too.
Right, yeah. I mean, Walmart said as much on their earnings the other day. Target, very similar messaging. And of course, you would expect that from retailers who cater to that kind of audience. But you guys were just saying a minute ago, I wanted to come back to this, of maybe the next Fed chair, maybe a Kevin. We heard from Jim Bullard. He's also in the mix. He was on Bloomberg TV after Powell spoke, and he's out here saying, who knows, maybe we'll see 100 basis points of cuts going into next year. So that, just to map that out, if we've got 3 meetings between now and the end of the year, would be September, November, December. So one of those then would have to be 50 basis points, and the other would be 225s, presumably, which, if you remember, was exactly the pattern a year ago. And this is so funny because Trump, in his remarks in the Oval Office just a few minutes ago, in saying that Powell was too late to signal this September cut, also said Powell should have cut rates a year ago. And he did.
He did.
He did cut rates by 100 basis points a year ago.
Exactly. The last time he cut rates was December of 2024.
That's correct.
Or not him.
The board. Yes, that's correct.
Not him.
Not Powell. Right.
Yeah.
It's a collaborative process. But yes, the Fed did cut rates by a full percentage point coming into this year.
So one thing I've really been watching throughout this entire session has been volatility in the market, right? If you look back at the VIX index back in April, when we were talking all about tariffs and everything, you're seeing it's spiking up to what? 52, the 52 handle. But if you look at today's trading session, right, we were sitting around maybe 16, but then as soon as Powell starts speaking, it just plummets and drops. We're now hanging around 13. Eric, how are you really analyzing this? What are you thinking when you really address the volatility here in the market for traders?
Oh, we saw it. I mean, we saw the chart. It's like a needle down. That's again the interest rate cuts. So if people were concerned about what the Fed was seeing, now you kind of know what they're seeing. You know that they're going to take out 25 basis points. They're going to take things down. What you don't know is where things go from here. And that's why, like, the next few reports, whether it's Consumer Price Index, PCE, they are really key because that will determine whether what Bullard was talking about will actually be feasible. If unemployment continues to be a problem, but prices start really rising and showing up that way, the Fed's kind of caught. And it's hard for anybody to justify taking like 100 basis points out of the Fed funds rate when inflation is up. So we're right now in this limbo of not knowing, and that's what we're going to be waiting on, is what the data show.
Hey, we only have about a minute left. Molly, Nora said we're going to talk about the attacks on Fed Governor Lisa Cook, who did end up going to Jackson Hole. We have reporting on that from earlier this morning, Mike McKee as well. The president, basically at the same time that we were hearing from Fed Chair Powell, said that he would fire Lisa Cook if she does not resign. Can he do that? And what has been the response thus far?
Trying to remind myself on all of where the Fed governor's heading. I think this is one on the for cause.
Exactly.
Yeah. So yes, this does. I think that right. Thank you. Sorry, spaced out a second. From what I've heard from people, this does seem like it would be for cause. That if these allegations turn out to be true, that if this is really a case of mortgage fraud, then that would be a legitimate reason.
But I think you have a good caveat in there, which is if these allegations turn out to be true, because as of now they are only allegations.
Right, and like obviously Lisa Cook is defending herself endlessly, that she has said that she will not be bullied into stepping down. She's looking into it. I'm sure Fed is. I'm sure she has a legal team that's doing so as well. So we'll see how this all shakes out.
All right. Molly Smith, economics editor for Bloomberg News. Also Eric Weiner, senior editor for Equities Americas for Bloomberg News, both here in the Bloomberg Business Week studio. Coming up next on Bloomberg Business Week Daily, the CFO of Webtoon joins us. That's next on Business Week.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. President Trump says Intel has agreed to give the U.S. government a 10% equity stake in the company. We've got Intel shares rallying on that news. Intel up by just about 5%. We have got the Dow, the S&P, and NASDAQ all advancing today. After remarks from Fed Chair Jay Powell, you heard them live on Bloomberg. Wall Street got the rally signals from Powell it was hoping for. Powell opening the door to an interest rate cut, citing labor market. So here's where we stand. S&P off session highs, up 98, now it's 64.68. That is a gain of 1.5%. Dow Industrials up 849 now, also off session highs, up by 1.9%. The NASDAQ Composite Index up 2%. The Russell 2000 Index of small cap shares is surging 3.8%. Our Mag 7 Index up 2.5%. Dow Transport's up by 3.2%. The 10-year 4.25%, with the 2-year 3.68%. Gold up $32 the ounce, up by 1%. West Texas Intermediate crude oil up 0.4%, 63.76 a barrel. And Bitcoin now up by 4.1%, just above $117,000. We're keeping an eye on trucking stocks like J.B. Hunt and Saia after Secretary of State Marco Rubio said the U.S. will halt issuance of worker visas for commercial truck drivers. Shares of J.B. Hunt, they're up by 4.9%. Saia up by 9.1%. Again, recapping a Powell rally on this Friday. S&P 500 index up now by about 98 points, a gain of 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Appreciate it. Shares of Webtoon Entertainment. You remember this? We talked about this on the close just last week. Surged 81% last Wednesday. It was its best day since going public last year. You remember this? They announced a partnership with Walt Disney. It's going to bring characters such as Marvel's Spider-Man and Luke Skywalker of Star Wars to its platform. The announcement also came as Webtoon reported quarterly results that beat analyst expectations. That helped fuel the rally last week as well. We've got with us David Lee. He's CFO and COO of the $1.9 billion market cap company. It calls itself a, quote, global storytelling platform that enables creators and users to discover, create, and share stories. David joins us from our Los Angeles bureau. Also with us is Nina Trentman. She's Bloomberg News senior editor. She writes the Bloomberg CFO Briefing newsletter. She joins us here in the studio. Check out her newsletter at bloomberg.com/CFO Briefing. David will be featured in an upcoming edition of that. David, welcome. Good to talk to you again. I think last time we spoke, you were CFO and COO at Impossible Foods. It was a previous lifetime. You're at Webtoon now. I think, though, at Webtoon, a lot of people who don't have kids of a certain age, maybe they're too young, maybe they're too old, might not be familiar with the platform. What is it?
So Webtoon is, as you say, it's a global storytelling platform. And while many of us may not have heard it ourselves, I bet our Gen Z kids and friends have. In fact, the majority of our 150+ million monthly active users are exactly in that demographic. They spend 30 minutes a day plus enjoying news stories from this network of 24 million creators globally that get to write great webcomic and web novel stories on our platform. I bet you've seen a movie or two, though, that you didn't realize started as a Webtoon.
David, thanks for joining us. Just wondering, actually, in terms of the spending on the platform, one of the things that we've been wondering about at CFO Briefing recently is this: what is the consumer doing and how are consumers responding to all the different news that we're hearing on tariffs, on what's going on in DC? I'm wondering, are you seeing any changes in terms of spending amongst your consumers?
Well, Webtoon's very fortunate. You know, our consumers love a good story. They love a good story in good times and bad times. And increasingly, they love a good story independent of the language or the country that the story came out of. We have examples of 900 adaptations, 100 rich film, movie, and TV series that came from all over the world, because in good times and bad, people want to tuck into a story from an unexpected source. And our privilege is to allow these 24 million creators, by the way, most of them who have full-time jobs. They're kindergarten teachers, they're They're plumbers. They're people who are hard at work, who get a chance to break through and maybe even have a great movie like we saw with Sidelined, The Quarterback and Me on Tubi. So far, we've been immune from some of the news that you carry every day because our product is great storytelling and consumers seem to still love it.
That is good to hear. I'm just wondering, Tim just mentioned the Disney partnership. I'm curious, for you as a CFO, how does it change the financial trajectory of the company?
Well, the Disney collaboration, I think, is pivotal. What it indicates to me is that we are not niche. We are mainstream for our Gen Z consumers today here in the U.S., the largest market that we see ahead of us. It also means that a wonderful company is comfortable allowing us to take their iconic stories. You know, The Amazing Spider-Man's coming out soon, and it's coming out as a webcomic in our platform. Disney recently said in an article, they said, you know, we looked at a lot and they're the leader, and we feel grateful to be able to bring their stories to life. And frankly, we're gonna bring alternative endings, background characters to the forefront. We're gonna write original stories with Disney because our powerhouse of creators can allow a story that may have been written years ago to be really fresh for the Gen Z consumers on our platform.
How important is it to really be working with such an established company like Walt Disney and just getting that visibility through this partnership?
I think it's critical because, frankly, the biggest challenge we have is that while our Gen Z consumers here in the U.S. know us, love us, and spend 30 to 60 minutes every day on us, a lot of investors, a lot of corporations, a lot of your audience has never heard of Webtoon, even though we went public a little over a year ago. I think part of the movement that you may have seen in the company's stock is simply awareness that Disney is recognizing that Webtoon is going mainstream here in the U.S., that we're a great source of fresh content, but we're the powerful leader of the category where we just released short-form video on Monday of this week. You know, these short 5-minute videos crafted out of proven stories on our platform is exactly what Gen Z wants. And so for us, it's really important to bring awareness to investors and companies about what Gen Z consumers here already know, which is that we're a great source of storytelling.
Should investors expect more partnerships similar to the one that was announced last week with Disney?
Well, I think if you look at what we've talked about in the last couple of quarters, I mean, just the quarter release prior, we talked about our partnership with IDW. We talked about bringing Sonic the Hedgehog and Godzilla and other great platforms to our content and our storytelling. We also are constantly seeing things hit the main screens. You know, just last week, we saw a major movie release called My Daughter is a Zombie. It just got released in the last couple of weeks here in the US, but it's one of the #1 best-selling releases in Korea already. That came from us. So increasingly, you're gonna see us partner, but also create original content on our platform and on screens coming to you, whether it's Amazon, Tubi, Netflix, or even a movie theater more and more.
David, I'm wondering how you're thinking about profitability on the back of the partnership with Disney. We talked about this before. I'm wondering, does that change how you're thinking about that?
Well, one of the great things about our collaboration with Disney is it's notable what I did not release. I did not release onerous upfront financial terms. I didn't even talk about it as being different than the great way in which we partner with franchises previously. And we posted in the quarter a positive 9.7 million adjusted EBITDA, which I think it shows that our cash balance that was given to us from the IPO on NASDAQ a little over a year ago is growing. So even as we grow our webcomic app MAU here in the US and in English-speaking locales 19% year on year for the last 2 quarters, we're still building cash. That doesn't mean we hoard it. You know, we love the ability to create shareholder value, but we're very careful to return shareholder value very prudently. We believe in self-reliance. That's why we went public. And right now, there is no need for me to disclose any different set of financial conditions other than excitement strategically for the Disney collaboration.
We're speaking with David Lee, CFO and COO of the $1.9 billion market cap Webtoon. Also with us is Nina Tretman, Bloomberg News senior editor. She writes the Bloomberg CFO Briefing newsletter.
Yeah, we're unfortunately running out of time, David, but maybe one question in terms of the customer group that you mostly tracked at Webtoon. You mentioned Gen Zs to us. I'm wondering, how do you keep track of that specific customer group?
Well, it's funny. This generation of consumers, the younger generation, Gen Z and Gen Alpha, they want to discover on their own content. So we're very data rich, and we want to make sure we have the best source of stories. And we have 120,000 stories that arrive every single day to our platform. But because we're so data driven, we can tell, we call her Maddie, our target consumer. We know what Maddie is reading 30 minutes every day. We know what chapter of what story she's reading. And so it's easier for us to use our technology to ensure she finds her next story, which is part of the reason why we've revamped our product here in the US. Importantly, as Maddie grows older, we know from a longer experience elsewhere that she'll like different genres. And the great thing about Webtoon is we can offer every genre because it comes from 24 million creators that we've cultivated over the last over 10 years. So she, Maddie, will grow old with us, even as she changes her tastes. We love her to finish and complete stories because we have so many more coming as an evergreen platform every day.
And she's not a zombie. I just want to make sure.
I would never characterize Maddie as a zombie.
Okay, you just said my daughter's a zombie. Talk about Maddie. I just want to make sure we're...
Yeah, no.
Okay.
No zombie there. Okay.
Cool. All right. Sorry, go ahead, Nora.
Well, David, I did want to ask you about how you all are thinking about AI. Of course, we know this has been a really big topic this year as people think about how we're using AI spend for some of these large companies. So how are you all integrating AI into your platform?
You know, it's interesting. Webtoon started from a parent called Naver, which is a tech powerhouse. And we use our technology, including our AI, which we have a lot of, actually, to protect the human creator. We protect them by fighting piracy, arguably better than a lot of other bigger consumer tech platforms I know. We allow consumers to find these 120,000 stories I mentioned that come every day. We help them find the stories they want using AI and technology. We may be the best untold story about AI promoting human creativity, generating returns for our human creators, protecting them in a way that I don't think is oftentimes on your network or in the press. And we're really excited to have a business model. You know, we've shared $2.8 billion with our creators from 2017 to 2023, because from the very beginning, our founder said, we will build a global network of people who can fair share in the success neither of us know how big is yet. And that allows an amateur creator somewhere in the world with the dream of being a storyteller to change their lives and contribute to the platform that we've built. So I feel really good about our use of AI. I'm held accountable by my teenage daughters, who are also consumers. And this is one case where I think tech is at work for human good.
David, good to see you. Thanks for joining us on Bloomberg Business Week Daily for the CFO Brief. And that's David Lee, CFO and COO of Webtoon. Also, a big thank you to Nina Tretman. She's Bloomberg News Senior Editor. She writes the Bloomberg CFO Briefing newsletter. You can sign up for it at bloomberg.com/CFO-briefing. Let's take a look at markets as they continue to surge. Equity markets higher. S&P 500 up 1.6%. The NASDAQ Composite up 2%. The Dow up 1.9%. But it's the Russell 2000, those interest rate sensitive small caps, that are the standouts of the day. 3.8% to the upside, where they've been pretty much all day since just after 11 o'clock when we heard from Fed Chair Jay Powell at Jackson Hole. We're going to have much more on that in just a few minutes. In the meantime, I want to pivot back to technology a little bit and legislation, regulation, because U.S. tech companies are under pressure from foreign governments to censor speech. This is according to the Federal Trade Commission Chairman, Andrew Ferguson. In a letter to firms including Meta, Amazon, and X, he urged companies to safeguard U.S. consumers. Chair Ferguson spoke with Bloomberg Technology's Caroline Hyde.
In the United Kingdom and Europe and elsewhere, American tech companies that do business, in the United States and elsewhere are coming under pressure, sometimes through direct legislation, to potentially censor speech in Europe, maybe even in the United States. Of course, the Brazilian Supreme Court Justice is of the view that American tech companies need to censor speech everywhere because it's the nature of the internet. And it was really important to me as an American law enforcer to make it clear to American companies, you don't get to take a free shot at American consumers just because of something that governments in other parts of the world are asking you to do. We've got laws here in the United States that, protect the relationship between American consumers and American tech firms. And so no one should think that you just sort of get to do to Americans whatever you want in order to comply with the demands of foreign governments. and that American laws, particularly the Federal Trade Commission Act that I enforce, don't allow American tech companies to hurt American consumers just because a foreign government is demanding it. And I just wanted to make sure that everyone, consumers and the tech firms, understood this is how I see the law. And I want you to come to explain to me how you are planning to protect American consumers, notwithstanding the demands of these foreign governments. And if they aren't, then I'm going to enforce the law against them.
Thus far, we have seen action taken, in particular by Apple, pushing back at requirements by the United Kingdom for a so-called backdoor into data that they hold, encrypted data. I'm interested as to how you felt that unfolded in the UK and whether Apple played by the playbook you wanted to see.
Yeah, I mean, look, and I think a lot of credit here needs to go to the vice president who, sort of personally managed trying to protect Americans from these demands of a foreign government. But yeah, I mean, look, I want American tech firms to understand you have legal obligations in your home country, in the country that made it possible for you to become what you have become, to protect American consumers and not basically to give Americans the short shrift because it would be easier to comply with the demands of a foreign government. And so I'm glad that because of pressure from the United States and particularly from the vice president, that we were able to achieve this outcome and protect consumers from Apple. But this isn't going away. Europe has passed these laws that promote censorship. Britain has these laws. We're seeing this sort of thing happening in Brazil. And it's very important that American tech companies understand you cannot just sort of take it out on Americans in order to comply with these other foreign governments. You have to protect Americans first.
That was FTC Chairman Andrew Ferguson speaking just earlier today to Bloomberg Technologies' Caroline Hyde. For more, check out The Terminal, and we'll play more from that a little later on Bloomberg Television. In the meantime, stocks still in the green. The bond market, too, rallying with yields giving off a little bit, especially at the front end of the curve. For an update on everything on today's trade, let's head on over to Charlie Pallett.
Thank you very much indeed. Lots going on today. You keep it locked into Bloomberg for the very latest. Let's begin with that 2-year, 3.68%. 10-year right now, 4.25%. Powell speaks, equity markets surge. Right now we're off session highs, but we got the S&P up 100 right now, 64.70 where we stand. That is a gain of 1.6%. Dow Industrials up 843, up 1.9%. NASDAQ up 422. That is a gain of 2% on the NASDAQ Composite Index. The NASDAQ 100 Index up 1.7%. Russell 2000 Index of small cap shares up 3.7%. And our Mag 7 Index surging by 2.6%. Again, the 10-year 4.25%. The 2-year 3.68%. Gold up $34 the ounce for the precious metal, a gain now of 1%. Gold at $33.73. West Texas Intermediate crude up 0.4%, 63.78 a barrel, and Bitcoin rallying 4% at 116,887. Briefly, President Trump says Intel has agreed to give the U.S. government a 10% equity stake in the company. Intel shares up by more than 5%. And Apple in early discussions about using Google Gemini to power a revamped version of the Siri voice assistant, based on reporting by our Mark Gurman, marking a key potential step toward outsourcing more of its AI technology. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pallett, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. If you type in Top Go on the Bloomberg Terminal, you get the top news. And the top of Top Go on the Bloomberg Terminal is a story right now by none other than Denitsa Sakova, along with some other folks on the Bloomberg News cross-asset team. Denitsa Sakova is Bloomberg News cross-asset reporter. She joins us here in the Bloomberg Business Week studio. The headline, Wall Street gets the rally signals from Powell that it was hoping for. Talk about a sigh of relief, or maybe a little bit even of exuberance, but quite a different tone in today's trade because, well, traders liked what they heard.
Yeah, just 1 year after the memorable Jackson Hole, when we saw the signal of rates going down, here we are again. And what we're seeing is some of the frothiest parts of the markets are leading the rally. We've always talked about a lot about the Russell 2000 leading the gains, but a lot of the meme stocks, a lot of the laggards of this year are seeing a very strong rally today. So obviously that's hinting to some exuberance. Of course, this is a big cross-asset rally. We're seeing stocks, we're seeing Treasuries all jump in unison. We haven't seen such a daily move since April. Of course, that's coming after a short sell-off we saw in the S&P 500. Everyone was expecting a very different Jackson Hole. No one was preparing for a clear opening of the door to a rate cut in September. Of course, now the questions remain of what is going to happen going forward. It seems like for September's traders pretty much priced in 100% rates cut. But what happens after that is where the questions began. We saw a lot of other pockets of the market rallying, like emerging markets. We saw all the economically sensitive shares on a tear, regional banks. So, of course, it makes sense. All of those are rate-sensitive sectors, and we're seeing them react as they should to a potential of rate cuts. So we're here to watch what happens next.
So you mentioned the short sell-off that we saw earlier this week. We were in the red a little bit, but of course we're talking about a pretty strong year where we've been notching so many all-time highs. But I mean, this is coming off of 2 years previously where we saw gains of more than 20%. But of course we're seeing this relief rally today, pretty strong showing here. What are your sources telling you about what performance could look like moving forward through the end of the year if this rate cut were to come?
For sure. There are a lot of technical forces in the market that were supporting it through the last few months, that some of them are a little bit exhausted. Of course, we have volatility targeting funds, we have CTAs. We've been looking at all those numbers, and they've been buyers for some time, and they have been supporting the market upwards. Some of them is obviously exhausted. But that said, we had a very strong earnings seasons, and we've seen that gap open between fundamental traders and systematic traders. And fundamental traders are actually that have more scope to increase allocation. So potentially what happens here is that the macro and of course the micro is more important, and we can see those fundamental traders potentially increase allocation even as forces like CTAs, like volatility targeted funds have maybe exhausted some of their cash power.
The highly anticipated, the closely watched, the Fed chair speech that has already happened is not something we're looking forward to anymore because it's happened. Next, is it NVIDIA earnings Wednesday after the bell? Is that the next catalyst for this market?
I think so. I think the moment we got the statements, we got so many people saying just like, okay, we're done with that. We move to the next one. And I think that's clearly NVIDIA. Obviously, it's been a very strong earnings season. That has supported the rally. This is a rally that's built on a strong fundamentals and sentiment. And you can imagine the same way as the bar was really high for beats versus misses, everyone will be super sensitive to what we see from NVIDIA, and that's clearly the next big event.
Denitsa Sikova from the Bloomberg News Cross Asset team. Check out her story along with her colleagues. It's among the most read story on the Bloomberg terminal. Also, just type in Top Go to find it right at the top there. I want to go to space now because there's some news this week in the world of space. Boeing's X-37 spaceplane, which the company describes as a, quote, orbital test vehicle, last night blasted off on a SpaceX Falcon 9 from Kennedy Space Center in Florida. It's the 8th mission for the reusable spacecraft. Tejpal Bhatia is back with us. He watches all of those launches closely. He's CEO over at Axiom Space. It provides mission services, and it's also working to build the next space station. Tejpal, welcome back. I want to start with the upcoming orbital data center launch. This is something, do we know when that, do we have a date for that yet?
Yeah, well, first, thank you for having me back. And second, I like that you said you want to go to space.
Oh,
you started to say, I was like, I'll go with you in a second if you want. I know a guy who sends people up. Yeah, I would go in a heartbeat.
Why haven't you been?
You know, for the last 4 years at Axiom, the last 4 months as CEO, you know, it's been my dream since I was like 3 years old. When I say dream, it's all I've been thinking about. And as we as a company have now sent multiple countries, multiple missions, 16 astronauts to the ISS, and I figured out how to go, I realized that my purpose is much more about getting as many people up as we possibly can, because I am certain that we will have many opportunities to go.
So do you think you will in your lifetime?
Yeah, for sure.
And how many years?
Sure. You know, possibly this decade, definitely next decade.
Okay.
Yeah.
Okay, before that though, the orbital data center.
Yes.
Can you explain what exactly this is? Because we talk a lot about data centers here, but we never talk about them in the orbital context.
Yes.
Yeah, why do we need them? Yeah.
Yes, exactly. So it's interesting. Like I'm smiling now because I'm just thinking about going to space. You know, while my first passion has always been space, actually the one thing I'm probably another expert on in the world is cloud. Before getting into space, I had my own startups. I worked at ESPN in the early days of HD streaming, and I was at Google on the startup side while we were ramping up Google Cloud. And as we know on the terrestrial side, cloud is a phenomenal business, right? It's a phenomenal business model. The market's growing faster than the largest cloud providers combined. We believe space is going to be exactly the same thing from a business model standpoint. But then the question is, why send a data center up there when we have so many down here? And the first thing I would say is, think of it this way. When we're talking about orbital data centers, and we've been running cloud computing on the International Space Station, Axiom Space, along with Amazon, since our AX-1
the snow cone edge computer.
Exactly.
Yeah.
And on every single mission, we've done significant compute on it, and between missions, we've done workloads from the ground. On the AX-4 mission, we sent up an Aura ring that was checking the biometrics of the astronauts. I'm going to go, you give me the finger?
No, I'm wearing one right now.
Yeah, I love it. I'm obsessed.
You are
looking at the ring.
Yeah, I got it the first day I took the CEO role, and I got it to track my stress.
So it was like bestowed upon you.
Sort of.
Okay.
I think the metric that I care the most about is sleep. That's the one I track in terms of my performance. But we were measuring all these things on the AX-4 mission and feeding it to the snow cone on ISS. So actually using edge compute, cloud compute in space versus on the ground. But the point here is, when you think about orbital data centers in the ISS, don't think of them as so far away. It's literally 250 miles away.
So how much power does it take?
A lot. A lot. So
Okay,
it's the
what's a
same.
lot?
It's the same problem that we're going to have here on Earth, which is also interesting to me now with AI, that the limiting factor is power. And you're seeing this growth for nuclear startups, and you're seeing this growth for AI data centers needing nuclear power. When we're talking about space, that's going to be the limiting factor.
So is that the answer? Nuclear, small modular reactors? How do you power
I would think
these
so.
things?
It's a little.
Is there any other way to do it? Could you do it with solar?
You could, but at some point, those are going to get so big to give the power we need. And a lot of people will say, and I'm not speaking as a scientist here, because I said the wrong thing first also, which is, well, you don't have to worry about cooling there. You do. You have to, convection is something that is, you have to, for all the power you create, you have to dissipate it as well. So that just surface area is going to get so large. So I think ultimately that will be the same solution. But the point about the orbital data centers is, for many people on the Earth, not like us here in New York or in Virginia or DC or other cities, that will be the closest data center to someone at any given time.
Wow.
So how concentrated is this space? How many players are here alongside you all?
So we, as Axiom, we're building the replacement to the International Space Station, and our modules that will connect to the ISS due to our exclusive contract to connect the commercial module, those are cloud first. To keep human life going, you need cloud computing services. Now, we could fractionalize those and offer those to other companies. We're actually sending up separate infrastructure later this year. You had asked when? Q4.
Okay.
In the next couple of months. But the point of this network, ours we call a heterogeneous network. A module could be a data center, a satellite could be a data center. But when you look at other constellations, those are homogeneous networks, all the same, but the point is they're connected by data. Some are all one network, some are federated, but this is where we're going. In terms of where the space is, I think people are finally starting to wake up. Just even the fact that you're talking about orbital data center, ODCs, as we call them, just 6 months ago, people wouldn't know what you were talking about. The words are very obvious, a data center that's orbiting the Earth, but still it's just kind of like, why? But I think we've gone well past that, and now it's how and when.
You said that the potential use case here is that some people who live around the world, this might be the closest data center to them at any given moment, one that does orbit. But there are latency issues with that and speed of connectivity issues that I would imagine are better handled on the ground by wireline connections.
So I love that question. I would have had the same thing. When my team came to me, and they gave me all the reasons why we should do this. And again, I'm a cloud nut and a space nut. I was looking for solutions for that.
Like, this is the literal cloud.
Yeah, literal. This is literally literal cloud above the clouds, right? Like not data centers around here. One of the most powerful use cases of orbital data centers is low latency AI. So it actually solves the latency problem for many distance issues like cars driving around in remote areas, navigation for maritime needs. Now, there's many cases of that for Earth, but now when you just go a little bit above the atmosphere and look at space, edge computing on labs in space, edge computing for other satellites. Where it gets really crazy and awesome for me is what happens when latency actually becomes a problem because of distance. So we have laser and optical communication. I'm not worried about speed and bandwidth. I am worried about power. But what happens when your distance is so long that actually synchronizing the internet is a problem? Or when two planets are on opposite sides of the sun? You don't even have line of sight. How are we going to synchronize Twitter? How are we going to synchronize YouTube? How are we going to FaceTime? I think those are just such cool problems for students around the world to solve.
So super quickly, the ISS is set to retire by the end of 2030. How confident are you in that timeline? And what risks does Axiom face if NASA extends its life longer than expected?
Yeah, I'm pretty confident it will come down. It's already been extended, right? Originally, I think the expiration date was 2024, and Congress has stretched it out. It's a piece of equipment, right? It was designed with a certain lifespan. Some parts are newer than others, but the whole thing was designed to come down as one. So I think it's a given. It will come down. Like when, we'll see, but I think by 2030. I feel very confident about it. I don't think there's any risk if the government extends it. I think it's great if they extend it. But independent of that, if there isn't a commercial solution, if Axiom Space is not up and running by the time it comes down, the only other space station in operation is a Chinese station, right? So that is a very real, I'll say competitive threat, strategic competitive threat. And from a diplomatic standpoint, the leadership that the US has provided, and now the leadership that companies like Axiom Space, the diplomatic interest we can push for the US around the world with all the different countries, we'll basically just be ceding that to the Chinese. And I don't think that's what we want.
Taj Bhatia, good to see you. Thanks for stopping by.
Me back. Yeah.
100 days as CEO of Axiom Space. I want to take a look at markets right now because we're still seeing equity markets surge and bond yields lower. The Dow up more than 1.9%, the S&P 500 up 1.6%, the NASDAQ composite up a cool 2% right now. The Russell 2000 RTY on the Bloomberg terminal, those more interest rate sensitive small caps up 3.8%, been hovering there much of the day. In terms of bond yields, we're seeing yields fall across the curve, the front end more so, with the yields on the 2-year down more than 10 basis points. The yield on the 10-year down, go ahead and call that 7 basis points to 4.26%. I'm Tim Stenivek along with Nora Melinda. Let's take a look at some stocks on the move today. We're joined by Bloomberg News cross-asset reporter Denitsa Sakova. Denitsa, you have a lot to choose from. Did you even find any that are moving lower?
It was very hard to find moving lower, so let's start with those moving higher. It's Intel. It's been the big news of the day, apart from obviously everything Fed. President Trump said that